Nasdaq and S&P 500 closed at record highs as investors cheered lower than expected inflation data with hopes of a rate cut in coming policies. Dollar eases while treasury yields climb. Asia Pacific markets opened higher, tracking gains on Wall Street, with Nikkei surging another 1% after a record high made on Tuesday. GIFT Nifty too indicates a higher start for the Indian markets. Oil prices dip overnight as traders awaited inventory report from the U.S. Energy Information Administration, while gold prices surged near the $3,350 mark following the U.S. CPI data. India's retail inflation in July eased to 1.55%, the lowest reading in 8 years, but this was slightly above the CNBC-TV18 poll, which predicted a reading of 1.3%. Oil major ONGC posted a mixed set of earnings, with profit rising 18% YOY to above rupees 11,500 crores, while revenue fell nearly 3%. Apollo Hospitals, on the other hand, posted a strong set of numbers, beating the street estimates. The company's net profit surged over 40% in the quarter. Hello, good morning. You've tuned into CNBC TV18 and you're watching Power Breakfast with me, Vinny Motiwala. And subdued day is what we saw coming in yesterday for the Indian markets. But today, what we're seeing for the Asian markets in terms of an opening, a good opening that's come in there. Look at Taiwan index up 0.8%, Hang Seng 0.9% of gain. And other than that, whether you're looking at the Japanese index, record high levels again coming in for that. For Nikkei, we're talking about that one. We're seeing Topics also managing to hold on to gains of around 0.8 to 0.9% as of now. ASX 200, that's an Australian index, also opened up with very good and strong gains. So that is something we'll watch out for. After opening up in the gains, we're seeing ASX 200 has actually seen a bit of a correction as of now. So it's down 0.6%. But other than that, all the indices are managing to hold on to gains. Even the Korean index is managing to hold on to gains. What is Indian market looking like in terms of an opening that we should be expecting? 61-point uptick is what the Nifty implied open is indicating as of now for the Indian markets. Obviously, do not forget we had our inflation and CPI data that came in as well. So that was also a good data point that came in. Though, like I was saying before in the headlines as well, it's slightly above the inflation data point, is slightly above what the CNBC TV18 poll was expecting, but nonetheless a good data point over there for the Indian markets as well. But that was the Asian market outlook that we have for you all this morning. Now, how is all this going to be impacting our Indian markets? We have a team of research joining in with us to set you up for trade, tell you which are the important stocks to watch out for in today's trading session as well. First up, we have Vamakshi, as always, to tell us what are the important cues to watch out for in today's trading session. Good morning, Vamakshi.
Good morning, Vinny. Yesterday, of course, was a wobbly day for our own Indian markets. The Nifty slipped over 200 points. Excuse me, from the day's high and closed below the 100 DMA. Indian markets actually underperformed some of its Asian peers yesterday. Of course, you mentioned Japanese Nikkei. The ASX 200 also hit a record high yesterday. The broader markets, though, they slightly performed better as compared to the benchmark indices, with the mid-cap index declining by only 0.3% and the small-cap index, in fact, ending in the green, although barely in the green. Now, when we look at the US markets, though, they had a very strong run yesterday. The US CPI rose at 2.7%. This is slightly lower than the 2.8% rise that was largely estimated. And with that, the S&P 500 as well as the Nasdaq advanced to record highs yesterday. Now, today, in terms of cues, we'll be watching out for a lot of earnings reaction. Remember, we're at the fag end of the earnings season. Keep your eye out on JSPL, Apollo Hospitals, Oil India, some new age companies like Honasa, Nykaa, NSDL, which just listed recently, Cochin Shipyard, PI Industries, as well as Nazara Tech. These are some of the counters that will react to their numbers. As far as earnings today are concerned, we'll be keeping an eye out on Jubilant FoodWorks, IRCTC, BPCL, Hindustan Copper, Muthoot Finance, as well as United Spirits. These are just some of the counters that will be reporting numbers. Of course, there's a whole list out there. Dredging Corp and MIRC Electronics will also be in focus because the board will be considering fundraising plans. Lastly, keep an eye out on the primary market. Bluestone's IPO closes for subscription today. So far, it has been subscribed approximately 0.7 times, and today is the third and final day. The GIFT Nifty, as you were indicating, Minnie, looks like we're off to a great start.
Thank you so much for that, Mamakshi. An interesting setup coming in for our trade in today's market. But what are the important stocks that you should be keeping on your radar? We have Gaurav joining in with us for that. Good morning, Gaurav.
Well, yes, first let's talk about ONGC. A good set of numbers is what we saw here. Although revenue has declined almost by 9% on a sequential basis, profit increased almost by 24%. JSPL also came up with good set of numbers in terms of EBITDA per ton, because India's EBITDA per ton has improved. Specifically, when we talk about profit, that has also increased almost by 12% on a year-on-year basis. Apollo Hospital, here also we saw good set of numbers. Revenue increased by 15%, while profit increased almost by 39% on a year-on-year basis. Now it stands at around 441 crores. Nykaa also reported good set of numbers, because when we look at net profit, that increased almost by 80% on a year-on-year basis. Let's move on to NHPC. When it comes to revenue, that increased almost by 19%, while profit increased just by 4% on a year-on-year basis. So a muted side is what we can say in terms of net profit. But on the other hand, let's also talk about NSDL. Here also we saw mixed set of numbers. Revenue declined almost by 14%, while net profit actually increased almost by 8% on a sequential basis, and this was because of 15% jump in the other income segment. Suzlon came up with a little bit of good set of numbers, because net profit there increased almost by 7% on a year-on-year basis. While let's also talk about Cochin Shipyard. Here also we saw some kind of good set of numbers, because net profit increased by 8%, and this was actually also higher than the street's expectation. Let's also watch out for Nazara Tech. Now, two news flows here. First is that when it comes to profit, it has almost doubled. Now it stands at around 51 crores versus what it was at 23 crores just a year ago. And at the same time, board has now approved stock split in the ratio of 1:2, and they have also approved bonus issue in the ratio of 1:1. So definitely a stock to track today. And let's also talk about Paytm. Now big news is coming up here. Now RBI has given in principle authorization to operate as an online payment aggregator to Paytm payment. Now let's not forget that this was banned in November 2022. So after 3 years, this relief is coming, and that is the reason sentimentally positive news for Paytm. And lastly, let's also focus on Translate Lighting, because company has now secured a fresh order worth 700 crores. So definitely all these stocks are going to be on our radar today.
Okay, thank you so much for that, Gaurav. And in terms of the final update that we have in Power Prep today, we have Mangalam joining with us to tell us which are the important cues that we should be keeping an eye out on in the world of FNO. Good morning, Mangalam.
Good morning. So if you look at the way the Nifty moved on Monday and the first half of yesterday, it told you that yes, the market does have a floor, but the second half of yesterday told you that the market has a ceiling as well. So we have Nifty, the Nifty Bank and the Midcap Index, all of them selling off sharply in the second half of trade in what was a volatile session where, dips were bought, but as vociferously, all the up moves were sold as well. Yesterday's range tells you a near-term range that the street would be working with for the market. 24,703, the Nifty's high, is extremely crucial to cross for the bulls to have hope of another up move. And at the lower level was 24,465. The Nifty closed around those levels itself. And the GIFT Nifty comes up for you. That's indicating a start which is 61 points in the green. So immediately yesterday's high comes into picture. The FIS sold about 3,400 crores in the cash market. DIS bought about 3,500 crores. No change in the trend out there. But the FIIs, they continue to sell in index futures. In fact, it was on Monday where they, unwound some short positions, added some long positions. But yesterday they unwound all of that as well, added 4,800 short contracts. So if you look at the net contracts of, the FIIs, on August 8, it was minus 1.83. Then because of the up move that we saw on Monday, they unwound some of those shorts. It became minus 1.79. But now back to where it was, square one, 1.85 lakh net short contracts is what FIIs are in index futures, with just 8% long exposure, which is the lowest that we've seen in a very long time. And yesterday, the FIIs also sold index calls and unwound short index puts, telling you that they were fearing that there could be, some further downside on the market and upsides may be faced with some ceiling. Remember, the put call ratio, which bounced from 0.6 all the way up to 1.03, is now back to 0.8. And we saw call writers active at 24,700 and 24,500. Put writers who wrote options at 24,400 and 24,500 had to unwind their positions as the market fell in the second half. The 100 EMA of the Nifty, 24,530, is extremely crucial. So that's something we'll watch out for on the way up. And finally, a couple of stocks. Alchem saw some long positions being added. Astral saw some short positions being added post numbers decline. And Titagar, that stock saw a lot of open interest activity, entered FNO band today.
Okay, Mangalam, thank you so much for that. But on that note, we're going to slip into a very short break. Up next, global market action on the other side. Stay tuned in. Welcome back to Power Breakfast on CNBC-TV18. Now, in the US market, what happened overnight was that Wall Street ended at fresh record highs after a tamer than expected inflation report raised the possibility that the Fed could cut interest rates next month. The S&P 500 rose 1.1% to hit an all-time high for S&P 500. Nasdaq Composite also notched another record peak with 1.4% jump. The Dow Jones Industrial Average climbed almost 500 points. We have CNBC's Rick Santelli with the highlights of the US CPI data and obviously the positive impact that came in there.
Headline number, as expected, up 0.2 exactly. Strip out food and energy, up 0.3 exactly as expected. Year-over-year numbers, 2.7, that's the headline. That's 1/10 cooler than we were expecting, but it equals the rear view mirror. 2.7, well, how does it compare? 2.8 was February, 3% was January. So we have been sliding. The low for the year in this metric, 2.3, that was in April. And here's what I was looking at, 3.1% on the year-over-year core. Definitely hotter than expected. It's hotter than the rearview mirror at 2.9. 3.1 would equal February. The high reading of the year was 3.3 in January, and that was the highest since May of last year. So if I look at the data on the month-over-month basis, exactly as expected. If I look at the year-over-year, obviously we got a little bit warm on the core. Now, we look at it sequentially. The headline number is 1/10 hotter than the 3/10s, and the 3/10s core is 1/10 hotter than last month, 2/10s. The only one that isn't hotter is the year-over-year, 2.7 equaling last month. But we do see that expectations were for a much warmer number.
Now, the former St. Louis Fed President James Bullard is on the list of the potential Fed chair picks, and he believes that tariffs don't cause inflation and expects the Fed could cut 100 basis points in the next year.
I don't really think tariffs cause inflation. Taxes don't cause inflation. And so what you're seeing in the data is very muted effects that are one-time increases in the price level. And so you're not really seeing anything. And the committee's coming around to the view, I think, that this is probably a one-time increase in the price level and is not interrupting the longer-term trend toward 2% inflation. So they're ready to come down. I think they'll cut here in September, probably again later in the year. And as I said last time, I think you could continue that into next year. So you'd probably get 100 basis points by this time next year, and then you'd be close to the neutral policy rate.
So that's all the update that we have coming in from the US market. So on that note, we're going to slip into a very short break. Up next, we'll get to the latest on India's July CPI data. Stay tuned in. Welcome back and thanks for staying tuned into Power Breakfast on CNBC TV18. Now let's talk about India's CPI inflation data that came in yesterday. For July, it came in at a 98-month low of 1.55%. Yet it was a tad bit higher than the CNBC TV18 poll, which we estimated the CPI data to come in at 1.3%. Now July CPI was expectedly dragged down by the food index. Lata is joining in with us now to give us more details on this front. Good morning, Lata.
Well, quite a bit of records, actually. As you pointed out, it is a 98-month low or something like an 8-year low for inflation at 1.5%, still lower than the still higher than the 1.3%, which our poll had thrown up just to set the record. It is 1.55 in July versus 2.1% in June, and year ago was 3.6. So, 3.6 itself is not a very high base, but you're getting just a 1.5% inflation. The food index is very important. The inflation has been pulled down largely because cereals and pulses, the weightiest elements, are falling even month on month, right up to July. Normally in monsoon months, they start rising because of traffic dislocation, but this time it's been falling because sentiment is so good with the good monsoons. Other things like meat, egg and milk have also been falling. In fact, food is also a record. It's a 78-month low, the food CPI. It's a deflation. It's minus 2%. It's minus 1.75%. The poll had expected minus 2%. The vegetable inflation year on year is lower, much lower, double-digit lower, but month on month it has gone up, and that's why you still see tomatoes at 100 rupees or even 80 rupees, even though the vegetable or the overall food inflation is lower. Core CPI is important to note, it is lower. It's 4% compared to 4.4% in June. And that means, the Asian disinflation is helping, base effect is helping. More importantly, if you exclude gold, then the core inflation falls to 3%. So all round, the numbers are positive, but the market won't react. It will react more to the US CPI number, which has come in lower than expected. For July, it's come in at 2.7 against expectations or 2.8. So we may see a minor fall in yields in the Indian market, but no. The Indian bond markets are sulking for other reasons because there are going to be no more rate cuts. Don't expect this to have an impact.
Okay, Lata, thank you so much for that. Important updates that are coming in India's inflation data point as well as the US point as well. So keep an eye out on the yields as well. Now, on that note, Manisha Gupta is also joining in with us to give us the update that we have in terms for the commodities. What are we watching out for in terms of important cues that came in overnight? Good morning, Manisha.
Morning, Vinny, and thank you for that. I'll start with the crude oil prices, where we are trading at a 2-month lows right now. Well, the U.S. crude inventories have shown an increase. The OPEC says that the demand for 2025 is going to be unchanged, and the U.S. Department of Energy also is looking at a global surplus in this year. That is keeping the prices in check. And in any case, by the time it's the fourth quarter in this year, most of the banks and brokerages believe that you could be looking at much lower crude oil prices. I want to put in a quick word for the metals as well, where gold is holding strong. The U.S. inflation reinforcing expectations of a Fed rate cut in the month of September with nearly 93% of a probability. That's exactly what the markets are working with. We also have seen some gains come in for silver, copper, many of these metals trading in the positive right now.
Okay, metals are trading on the positive side, but crude, that is the one which is trading at a 2-month low as of now. Thank you so much for that update coming in there, Manisha. But with that, we're absolutely out of time on this edition of Power Breakfast on CNBC TV18. Thank you so much for tuning in. Up next, a Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Reema. Guys, hi. Good morning.
Hi, good morning. Looks like today will be a little better day. Record highs for S&P, a soft comment.
But you, the green, Reema, I mean, I think it's
a vibrant.
Market's going to take a cue.
Yeah. Vibrant colors this morning.
Well, indeed. And yesterday we were glaring at red. And I think today should actually be a better day. We can't really run away because we don't know what Trump's going to do next. But I think today we should be a little bit more optimistic about the day. And then just tomorrow and then the long weekend.
The eyes are gleaming. And
end of earnings as well, guys.
Absolutely. Well, I think the start is also good in terms of inflation numbers, right? And I think that's essentially what I want to start with before we go any further. And this is not, by the way, inflation just in the US. Yesterday evening, we had India inflation numbers as well, which is not a big surprise or anything. I mean, actually, it's in line with what markets were expecting. The numbers should come up on your screen. India, 1.6% growth. US inflation, 2.7%. So those are the figures up on your screen. I mean, I think you can add... maybe if you wanted to comment, India inflation 1.6%, comfortable, not a problem. US 2.7% has not risen yet. I mean, the expectation is that eventually US inflation, because of tariffs, etc., maybe a month, 2 months down the line, is going to rise. But for now, I mean, this is a good-looking screen. So US equities on the back of the number in the US, it reached all-time high. The changes on your screen, the S&P, the NASDAQ, but it was actually the small cap space which really rallied hard, 3% or so in the green. So the CPI number out of the US was taken as a sort of a clearing event for a 25 basis point cut in the month of September. Actually, your Treasury Secretary Scott Bessent, who went on to Fox, the news network, and said, the Fed ought to be open to a 50 basis point cut in September. So, of course, I mean, this is just, coming in from the Trump administration in terms of a push. But 25 is something that the markets now are comfortable pricing in because of the inflation number. Dollar fell sharply, and we're about 0.5% lower to 98. Of course, it was to do with the cooling off inflation. Actually, the no rise in inflation, I should put it that way. But there was also one more factor. And that factor, of course, was the new Bureau of Labor Statistics chief. Remember, Trump asked the previous BLS chief to leave. He basically fired him, and his new pick has essentially apparently said that he wants to suspend the monthly NFP report, the non-farm payrolls report. He says there are too many problems in it. What we'll do is we'll sort of look at this. We'll release this data on a quarterly basis till we fix the monthly report. I mean, is it actually going to happen? But at least this is what reports are suggesting. This is another headwind as far as the dollar is concerned. And it was, I think, a mix of both that you saw a pretty large, pretty steep fall as far as the broader dollar is concerned, which is the dollar index. Oil prices, $66 a barrel, not very much. To talk about, a few specific news items. Intel was up 6%. 3 days in a row it's been gaining. Remember, there's another situation where President Trump publicly asked the Intel CEO to leave. Of course, I mean, the CEO went and met President Trump in the White House. Stock's done well since. In terms of just talking about chip-related news flow, China is urging NVIDIA, the Chinese firms from not using NVIDIA H20 chips. The background, of course, is President Trump saying that NVIDIA and AMD, etc., are going to, pay U.S. government 15% of what they make in China to the U.S. government to be able to sell to China. This is essentially what is coming in from China. And of course, the point with regards to China has been that they think that there are perhaps some backdoor to these chips where US, etc., can access data in China. So, I mean, that continues. With regards to China, some bit of positive news flow yesterday. China and India are set to resume direct flights to each other after a gap of almost 5 years or so. And apparently this is going to happen in the next 1 month. A fair bit of easing, remember. We've seen between attempts at normalization. Press note 3, for example, is something which is being diluted, which is being walked back, etc., etc. So we'll see perhaps more, but this is, of course, a big step. I mean, so far, flyers were going through Singapore, Hong Kong, etc. Now you got, after 5 years, direct flights, perhaps, which once again will start. Another bit of news flow, a cargo of Indian diesel refined products is heading to China again, the first since 2021. So a lot of change which seems to be afoot with regards to India and China. And of course, in the backdrop, of course, is the worsening of relations between India and the US. Just to tie in the markets and what they perhaps will do today, yesterday was disappointing. Monday was a big, decent day. Yesterday, the market gave up about 50% of the gains. And the question really is, if both the Nifty and the Nifty Bank break the recent lows, are we going to sort of slide without a bounce? I mean, I thought there perhaps is a pullback which is due, and it looked like Monday gave us that indication that pullback is coming. But yesterday the market sold off. This morning, I think the start, of course, is set to be higher. We'll have to pick up indices from there. Just the levels, the Nifty near-term levels. Of course, we broke the previous levels of 24,634 on the upside, but could not sustain above it. The high which the market made was 24,702, and that remains the first level which the market needs to take out. The low of 24,337 is the number on the downside. For the Nifty Bank, it also gave up most of its gains. It's back to the prior lows of 54,905, and here 55,582 and 55,652 are the upper end, the resistance level, the resistance zone really. And on the way down, if the recent low of 54,905 goes, then you're looking at about 55,440 to 54,054. So these are two levels. We're already at the first support level. We just need to see if that breaks. If it breaks, then the second support level comes into view. But I think the GIFT Nifty is indicating a higher start. Hopefully, we kind of build on that 70-point up move that the GIFT Nifty is implying. Rima.
Indeed, a softer CPI inflation print back home and record highs on Wall Street. Both these two factors helping the GIFT Nifty up by about 75 to 80 points. But as Prashant said, there are lots of big global stories to take note of. Investors doubling down on a September Fed rate cut. BSE batting for a 50 basis points rate cut. And then there is this battle for AI supremacy. Perplexity AI has made an unsolicited $34.5 billion bid for Google's Chrome browser. This was confirmed by CNBC. And what's absolutely stunning is the valuation, because in July, a month back, Perplexity AI's own valuation was $18 billion. And now they're making a bid for Chrome at double that. And yet they say investors seem to be backing this deal. So it's all happening in the world of AI, and that's the other one we need to track. Let's just take a quick note on what's happening in Asia. As we pointed out, GIFT Nifty is higher. Japan is soaring. That's up another 1.5%. It's a fresh high, and it's crossed that 43,000 mark for the first time ever. We also got the quarterly or the latest Tankan survey, which shows that manufacturers in Japan are turning more optimistic after Japan struck that deal with Washington. Also, with respect to China, U.S. Treasury Secretary Bessent has signaled that he might meet his Chinese counterparts within the next 2 to 3 months. Back home, just some more numbers on that inflation print. 1.55% for the India CPI inflation print. It's cooled down in the month of July. This is the 9th straight month of moderation and the lowest since July of 2017. So it's beaten consensus. In terms of flows, the DIIs were net buyers to the tune of 3,500 crore rupees, while the FIs sold a similar amount, 3,400 crores sold in the cash market. Earnings season remains in focus. Today, Nykaa, Honasa, both of them have delivered good set of numbers. And we will track numbers from Jubilant Foodworks, IRCTC, BPCL, United Spirits, amongst some of the others. Nigel?
Well, today, by the end of the day, if we don't end with some good gains, I think I'll be a little bit disappointed, because just looking at the screen, looking at the global cues, some optimism that maybe, in fact, the peak Trump tariffs have played out. And also, if you look at yesterday's trading session, well, we ended at the day's low. So by the end of today, you'll be optimistic that maybe, in fact, you go home with some gains. And just take a look at that. Yesterday, you had the Sensex that ended at the low point of the day. It's a Tuesday. You have weekly expiry that played out there. So that could be one factor at play. But otherwise, the problem pocket for the market has been the Nifty Bank, because the shots are getting added out there. And in yesterday's trade, though the Nifty ended down with a cut-off closure around 100 points, the India VIX remains at very, very subdued levels. So the India VIX at least is not indicating that we're going to pull back big time from here. Though the Nifty was down close to 100 points. But as I mentioned, the shots are getting added onto the Nifty Bank. The open risk moved up yesterday. That one, in fact, lost its way in trade. And the FIs, they have been adding shots, and yesterday was no different. They added close to 5,000 contracts, short positioning at around 92%. Yes, those are at extreme levels that we're seeing, but the clients, they continue to remain net long in terms of their positioning. On the option side as well, yesterday the FIs, they in fact wrote calls while they unwound some puts as well, in terms of the options data. And if you tie that in with the options data for the market on the whole, well, it perfectly ties in, because yesterday the call writers, they felt that they're back in the game. And that's what called the PCR to come down from around 1 to around 0.78 or thereabouts. And at around 0.65 to 0.7, that's when you see a bit of a bounce. So we're moving gradually towards that zone. I'll keep an eye out on that zone, 0.65 to around 0.7, because the call writing was extremely aggressive. Remember, these options expire tomorrow. That's a 24,700 call, 60 lakh shares getting added there. 24,500 call as well was very, very aggressively written in trade yesterday. And the premium had come down from around 120 rupees or thereabouts. So let's bring the levels up for you on the screen. The Nifty, well, yesterday's high, which was at around this 24,700 odd, that's the resistance zone that we're looking at. Once you get past this, then you look at higher levels like the 20-day MA. But for the time being, this appears to be a very stiff resistance, because in the first hour of trade, we already went to that mark. The reference point on the downside, though, is 24,350. That's the recent low that were made in that vicinity itself. But one positive yesterday was at least the Nifty made a higher high. After many, many days of making, lower highs, we broke that trend, and now, in fact, yesterday as well. So today, this is the mark that you're looking at in case the Nifty can get up and going. Crucial resistance mark. The Nifty Bank, that's lost its form totally. It needs to find its footing. Otherwise, the Nifty will be in trouble. And yesterday, in fact, it ended at around that 100 DMA. So you'll want it to protect it today on a closing basis. So I'll keep an eye out on that one. But as I said earlier, today you should be a little bit more optimistic. And by the end of the day, hopefully we go home with some gains. If you're looking at the stocks, Titagar Rail, yesterday I had mentioned numerous times during the course of the day, that could probably get into the FNO ban. That's precisely what's happened. So that's a stock you should keep on your radar.
Thank you very much for that. Let's get to the equity calls then. It's Mahesh Nandarkar of Jefferies who believes the Indian market is poised for a short-term bounce. This is after a sharp underperformance to the MSCI emerging markets over the last 12 months. What will drive it? Relative valuations getting back to average, domestic flows jumping considerably, and a stronger year-on-year number in the September quarter earnings fine print on account of the low base. And then there is the potential trade dispute resolution with the US, which could act as a trigger. The bounce he adds may not sustain for a long time. It could be short-lived due to the weak value versus growth equation and equity supply concerns. He says the laggards in the last 3 months that they like are Lodha, Cholamandalam, Adani Energy, Shriram Finance, Jubilant Food, Mankind, NTPC and Crompton to play the near-term bounce and beyond. And they also like cement, given the pricing-led recovery, and it remains their high-conviction idea.
Okay, well, views coming in. Let's get one more. Prashant Parola is Portfolio Manager, Emerging Markets at Allspring Global Investments. Prashant, good morning. Great to have you with us here. Actually, late evening to you, right? Prashant, quick word on the sentiment here in India. I don't know if you have a firm view on whether the 50% tariff, the 25%, which takes it to 50, gets resolved in this 20-day period. Do you believe it'll happen? Some see hardening of positions, others see, well, eventually it'll get done. When I say eventually, in this 20-day period. And of course, sentiment during the course till it happens remains weak. How are you looking at things, Prashant?
Yeah, I think the Indian market's been weak, especially because of the 50% tariff number. That seems a little too high given where all the other countries are placed today. I think if you look forward, we have President Trump meeting President Putin on August 15th. And we still have some time before this 20-day period kind of comes in. So I remain optimistic that something will move. It might actually happen on August 15th during Russia and US negotiations. But it seems like a pretty high price to pay today.
Prashant, what about the US markets? Do you think a 50 basis points rate cut is coming in September?
Yes, I think some rate cut is definitely come into the picture, especially after today's announcement of the CPI numbers. They were not as high as expected. So if we look forward, the Fed has a dual mandate on employment and inflation. And if inflation kind of continues to hover around these numbers that it is today, and employment numbers, you were talking about the revision that happened was pretty bad in the last revision cycle. So I think the Fed will wait towards employment, and we would expect either a 25 or a 50 basis points rate cut.
Hi, Prashant. Good to see you, Vin. What about the Indian markets, though? You know, such a stark underperformance. Do you think we have good reason to believe that maybe, in fact, we're closer to the lower end of the range? At one point of time, we were leading the way. We've entirely given up that underperformance. Do you think it's time for us to catch up a little bit, going by the global market buoyancy?
Yes, I think definitely there's room for Indian market to move up. People will eagerly await what happens over the next few days with Russia, Ukraine, and also I think there's still time for the Indian government to talk to US and figure out a deal from the secondary tariff picture. So if we move back from 50% to 25, which was the base case there, that will give some sort of relief rally to a lot of these names.
You know, another factor, Prashant, that I know you look at some of this stuff closely, I put this out yesterday, just something to think about, right? Which is the lack of AI plays in India, and especially at a time like this, because you know, market goes through fads and fancies, and the number one fad and fancy, which it has been for the last 6 months, AI, and you don't have very many core AI plays here. Is that a bit of a factor? Does that come up in conversations at all?
Yes, India is kind of missing out on the AI factor, especially, and I know Perplexity did a deal with Bharti to get their Chrome kind of competitor on Bharti network. So maybe with time, there'll be some sort of plays emerging. But today, when you look at the AI landscape, it's basically the US markets and a little bit of Taiwan and Korea that people can play with. So it's limited choices today with regards to AI in India, which, I mean, if AI factor is going to peak out, might even help the Indian markets on that side. But today, I think India is definitely missing on the AI picture.
Prashant, we'll leave it there. Good speaking with you as always. Thank you very much for joining us here on CNBC-TV18. Appreciate it. Well, I think what we're going to do is look at the big number, right, which is the macro number. We talked about the number in the US. Let's talk about the number in India. Retail inflation in July eased to 1.55%, the lowest reading in 8 years. But this was slightly above the CNBC-TV18 poll, which predicted a reading of 1.3%. Lata is here with more on the fine print. Lata.
Yes, it was records galore actually on the downside. You could also put the 8-year low as a 98-month low. 1.55 compared to 2.1 in the previous month, and year ago 3.6. All really very meek numbers, very low numbers. And if you looked at the key actor, it is food, and food CPI has come in at a 78-month low. In fact, the two weighty items, cereals and pulses, they're falling even month on month. A little unusual because by July, traffic dislocation normally pushes up prices. But now, because the monsoon is early and bountiful, the trader sentiment is a little bearish on these items. Even others like milk, meat and eggs are all falling year-on-year terms. We also see vegetables falling year-on-year terms, but month-on-month vegetable is still expensive. That's just by way of detail. The core inflation number also has come in lower. That's very big because that was the one that was at 4.4 in June, which means above the mandatory level. But now that's fallen to 4.1. By some calculations, it's even fallen to 4. People interpret this number differently. But it's all ends up lower. If you took away gold from core, then it falls to actually 3%. So a very, very benign inflation number. What happened to bond yields? They didn't do anything. They actually went up. We are still sitting at 6.47 on the 10-year, which is a good 30 basis above what it was in May after all those rate cuts, giant rate cuts that the Reserve Bank has given. Clearly because the market is looking ahead. Even if you looked at the very benign US inflation numbers, 2.7 instead of expectations of 2.8, the bond market is not reacting much for other reasons. One, it doesn't see too much of rate cuts ahead. One more, usually the bond markets don't react when you're at the end of the rate cutting cycle. But more importantly, now there is a fiscal worry. The worry is that if tax revenues are going to fall, if nominal inflation, nominal GDP itself is going to be very low because of 1% or negative WPI, wholesale price index, then fiscal deficit as a percentage of nominal GDP starts to look higher. Also, tax revenues may surprise us. There may be a surprise package for exporters who are struggling. All that is making the bond market very bearish. Will they have to look for more supplies of bonds from the market? Very little appetite. FPIs are selling bonds. So for all the good news in inflation, don't expect good news in the bond market.
Thank you very much for that. Moving on then, let's also tell our viewers what we've lined up on the show today. So first up, coming up at 8:35, the management of Balrampur Chini Mills will be joining in to discuss their Q1 earnings. 9 a.m., the management of Suzlon Group. As their CFO, Himanshu Modi steps down. We will also talk about their Q1 earnings. 9:20, Manish Gunwani of Bandhan AMC will be a market master of the day. 9:30, the management of BEML will join in to talk about their Q1 earnings. Following that, Sunita Reddy of Apollo Hospitals will be chatting with us at 9:40. A little later, 9:50, the management of Granules India will talk about the Q1 performance. And towards the end of the show, in our special segment, it's the economy. Lata will be in conversation with Ashish Gupta of Axis AMC on stocks, banks and bonds.
Well, time to slip into a short break. Got a lot of stock-specific action to track for you. We get to that in just a bit in our special top 10 segment, but we're looking at Apollo Hospitals, ONGC, JSPL, Suzlon, NHPC. You have Nykaa as well as Kochi Shipyard and Paytm. So 8 stocks will be reacting to positive news flow. But PI Industries, those numbers look weak, and NSDL will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Invest.
Welcome back. Indian markets are likely to open with a positive bias, mirroring the positive sentiment on Wall Street, and Asia too is tracking higher. But let's talk about stocks. Our research team is standing by. This is CNBC TV18's list of top stocks for the day. First up, Apollo Hospitals. Vinny joins in to tell us how the numbers looked.
Hi, good morning. So Apollo Hospitals, a good set of numbers that's coming from the company. Revenue, 15% growth there. EBITDA is up around 26%. Profits up almost 40%. Improvement in terms of EBITDA margins by around 130 basis points on a year-on-year basis. So strong performance, mainly led by good growth that the company saw across all the three segments. Better than estimates, better than CNBC TV18 poll, as well as better than what the street was anticipating as well. Now, talking about the healthcare service part of the business, that's the hospital business of the company. That saw a good growth of 11.2%. The IP volumes over there were up by 4% year-on-year basis. Margins, that saw a bit of a expansion that came in, and this is, do not forget, despite the Bangladesh patients not being there, which is impacted, during this quarter. Despite that not being there, they've witnessed an expansion in terms of margins. Occupancy is a bit lower than what we saw last year. 65% is what the hospital occupancy came in at. Healthcare business revenues grew by 19%, so strong growth there. They turned PAT positive this time. 57 crores was the PAT versus a loss last year of 12.9 crores. And Apollo 24/7, the GMV, that was also up by 23%. Lastly, we had AHLL that was also seeing a good growth this time. That was up by around 19% and expansion in terms of margins. So good growth, strong growth across its segments, and that is why we're expecting green on the screen for the stock.
Green on the screen, Vinny says, for Apollo Health and Hospitals. We'll keep an eye out on that one. In fact, we'll be joined by the management at around 9:40 a.m. Ms. Reddy will be joining to detail the past quarter's numbers and the way ahead. Let's hop across to Sonal, though. She's here to tell us about ONGC, and I think she's got some good news for us as well. Sonal.
Good morning, Nigel. Yes, expecting green for ONGC as well this time around. The numbers, though lower on a quarter-on-quarter basis, they were much better than what the street was working with. Revenue is down 9%, but better than estimates. EBITDA was down 2% to come in at 18,657 crore rupees, which compares with a poll of 17,000 crore rupees. Profits also higher at 8,024 crore rupees. It's an increase on a quarter-on-quarter basis as well. Crude production was in line with expectations, flat on a quarter-on-quarter and on a YOY basis. Average daily production, however, declined 1% on a sequential basis. This is a decline that we are seeing after a rise for the last 2 quarters. Gross crude realizations at $66 per barrel were largely in line with estimates. So expecting a green tick on the stock. Management commentary is something we'll get at 3:30 p.m. on the conference call today.
Okay, all right. Thanks a lot for that, Sonal. Well, I'm going with green on JSPL as well, and those numbers actually look better than estimates. Look at it on the top line, well, that was more or less in line, but the EBITDA performance, that was heartening at around 3,000 crores approximately, which led margins to come in at around 24%, and net profit number as well, that did come in better because of lower finance cost. What played out? Remember, for the past quarter, you had destocking that took place, in fact, and that's why, because of, in quarter 4, there was a lot of inventory that was pushed out. That's why quarter 1, you had volume degrowth. But in spite of having volume degrowth, still these numbers look very, very good. And the India EBITDA per ton scaled to around, scale big time to around 15,000 rupees, which is a sharp improvement. Most of that came in because realizations did improve by close to around 6 to around 7%. Besides realizations improving, well, their sales mix as well looked quite good. So the value-added sales, the exports proportion as well did improve both on a year-on-year as well as on a sequential basis. And the net debt, yes, it moved up, but that's because of nearly around 2,200 crores of capex. So these numbers on the whole look good. Higher realizations, no benefit of operating leverage, but a better product mix and lower than expected cost played out in that favor. The stock, though, yesterday saw a big delivery-based buying, expected to open up in the green. Vivek joins us, though, to tell us about Suzlon as well as NHPC. Morning, Vivek.
Well, good morning. Two results to track quite closely. First one, Suzlon, remember this particular quarter, at the end of Q4, in fact, the company had said that across all parameters that they would grow 60%. So largely in line with that, especially when you're looking at the financial parameters, most of the growth is in line. PAT was impacted by one-off. Key things to watch out for, especially for Suzlon, given the fact that there has been a significant resignation as far as the CFO Himanshu Modi is concerned. And along with that, remember, the company also had a large block deal where promoter offloaded shares, something that we will get more clarity on. Now, talking about the numbers, Revenues higher by 55%, EBITDA higher by over 62%, margins quite strong at 19.1 versus 18.2%, profitability higher by 7.3%, but there was a one-off tax expense this time of close to 135 crore that impacted the bottom line. Order book quite strong at 5.7 gigawatt, and Q1 deliveries too was quite steady at 444 megawatt. Trajectory as far as deliveries is concerned is another key monitorable. Now coming to NHPC, again a steady quarter from the company this time around. Key commissioning of the Parbati 2 was something that aided the performance. So revenues higher by 19%, EBITDA higher by 12%, margins quite steady at 56.1%, and profitability higher by 4.2%. In terms of the conference call, the company said that the generation was up almost 11.3% this time around. Plant availability factor too was quite high at 83.7%. Parbati 2, 800 megawatts, was commissioned in the quarter gone by. They expect further commissioning by Q1 FY27, and along with that, some important guidance in terms of Subansiri. They have said that they target the full commissioning of Subansiri by FY27, with all 3 units to come online in FY26, going with a green on both of these names.
All right. Vivek, thank you very much for that. Suzlon management joins us, Mr. Chalsani, at 9 o'clock to talk about, of course, the numbers, the outlook, etc. as well. PI Industries is the next one we want to focus on. Ria's got details here. Ria, good morning.
Good morning. A weak quarter for PI Industries this time around, well below the estimates that we were working with. Revenue has declined by around 8% versus estimates of 8% growth for quarter one. EBITDA and net profit have declined by 11% each versus estimates of 5% and 1% growth respectively. Margins although have been largely in line with estimates at around 27%. In terms of the agrichem exports, those have seen a 14% decline in revenues as well as a 9% decline in volumes. The domestic revenue though grew by around 6% with a volume growth of 7% for the domestic business. The biologicals product business though, the revenue declined by around 38% on a year-on-year basis, and this was largely due to the abrupt regulatory suspension of sales for biologicals in June for the entire industry. Pharma revenues were up around 186% on a year-on-year basis of a very low base, but remember this is still below the estimates of over 200% growth that the street was working with. Now going forward, the company has said that destocking of inventories is expected to be normalized by the second half of 2025, and in terms of the CSM exports, they have a cautiously optimistic stance despite destocking of inventory amid the uncertain US tariff regime.
Thank you very much for that. Let's now go across to Mangalam to tell us how Nykaa performed in Q1. Look good?
Well, Nykaa did look good. You know, the street had already the Nykaa's first quarter update, and after that, we were expecting some margin improvement, and that's exactly what has happened. Not to the extent that the street would have liked, but, you know, given the sort of expansion that we've seen in the beauty business and the contained losses in the fashion business, the street may go with a positive move on Nykaa. 23% revenue growth, the reported EBITDA grew 46%, and the net profit grew 79%. Beauty business, there was a revenue growth of 24% and an EBIT margin expansion of nearly 30 basis points. In the fashion business, while there was a revenue growth of 15%, it was lower than expected. The EBITDA margins actually, or the losses got contained. From 30 crore loss, it came down to 27 crore. Remember, in its annual investor day, the company is targeting this business to break even by the end of this year itself. The gross merchandise value for the company grew at 26%, and more importantly, their own brands, which are high gross margins, House of Nykaa, there the GMV grew at 70%, much above the company's own sustainable growth target of 30%.
All right, Mangalam, thanks a lot for that, and good to see you back to better fitness today. Well, let's hop across to Ria. She's here to tell us about Kochi Shipyard. Ria?
Well, yes, very good set coming in for Cochin Shipyard this time around, well above brokerage estimates. The revenue growth this time around was around 38% versus estimates of 14%, and this was likely driven by the execution of the ASW Corvette and the NGMV projects and the higher contribution from the ship repair segment. EBITDA up around 28% versus estimates of a 17% decline, so very good growth on this front as well. Margins also at 23.9%, well above the estimates that we were working with. Net profit has improved by 4% on a year-on-year basis versus the estimates of a 26% decline. This time around, the profitability improvement that we've seen has been led by the higher contribution of the ship repair business, which is the high margin segment for the company. This time around, it has contributed around 64% to the revenue versus about 34% in Q1 of last year. So the revenue mix has actually flipped completely for the company, and this has also led to a margin improvement of around 100 basis points for the ship repair segment. Material cost to sales this time around has also come down to 29% versus 39% earlier earlier. So that has also aided profitability for the company. For the shipbuilding segment, margins have dropped to around 5% versus about 21% last year. So good numbers this time around for Cochin Shipyard, despite the sharp increases that we've seen in the subcontracting expenses as well as provisions on a year-on-year basis. But remember, on both of these metrics, they have actually fallen sharply on a sequential basis.
All right, Ria, thank you very much for that. NSDL, the stock has been jumping and galloping since listing. Came to the market, 850 handle or so, and this, of course, moved up very, very sharply from there. Vamakshi is here with details. Vamakshi, morning.
Well, good morning, Prashant. NSDL has reported a mixed set of numbers this time around. The revenues declined by almost 14% on a quarter-on-quarter basis. The fall in the operating expenses was much higher at almost 20.5%, which is why the EBITDA margins have contracted by around 550 basis points to, rather the EBITDA margins have expanded to by 543 basis points to 30.5%. The EBITDA is up almost 4.4% sequentially, and the net profit is seeing a jump of almost 8% quarter-on-quarter, and there is some support coming in from other income as well, which saw an uptick of almost 15% sequentially. Now, largely, let's also look at how the different segments for the company performed. The depository business, which is the core business of the company, actually saw a degrowth of almost 3.4%. The larger hit came in on the banking, which is the NSDL Payments Bank, which saw a downtick of almost 26% quarter-on-quarter. Database management too did not do too well. As far as EBIT margins are concerned, margins expanded across the board, mostly for database management, which expanded by 450 odd points. Depository also saw an expansion of around 300 basis points. But when we look at the valuation for NSDL, PE ratio is currently at 72 times, which is much higher as compared to CDSL's 53 times. So therefore, given the high valuations, mixed set of numbers, going with the red for this counter.
Thank you very much for that. Moving on to Paytm. Some relief coming in for Paytm on the regulatory front, Ritu?
That's right, Rima, because RBI has granted them an in-principle authorization to their 100% owned subsidiary, Paytm Payment Services Limited, which is PPSL, to operate as an online payment aggregator. And it has also lifted the ban on new merchant onboarding, which had been in place since November of 2022. So this ends, nearly a 3-year wait for Paytm's license, and of course removes a key overhang on the payment gateway business. Now remember, Paytm had reapplied for this license in September last year after the initial application was returned in 2022. Now keep in mind, this payment segment is quite crowded. There's more than 50 licensed players, but Paytm has the leverage and it can scale that 1.3 crore merchant base it already has to be more competitive in the market. The approval also comes just days after Paytm's Chinese investor Antfin completely exited the company, selling the remaining 5.8% stake. But keep in mind, this nod is not unconditional. PPSL will have to complete a system and cybersecurity audit within 6 months or risk losing the license. That said, an important development for Paytm and definitely sentimentally positive.
Can we see more relaxations coming through, right, on the regulatory front? And that's a conversation we'll have with Ritu as we go on. But this is definitely good news for Paytm. Ritu, thanks very much for that. Manisha is now joining in with a roundup of all the action from the commodity space. Manisha, good morning.
Morning, and thank you for that, Prashant. I'll start with the crude oil prices because we are looking at a 2-month lows onto this one. Well, the U.S. crude inventories have risen. EIA says that the U.S. crude oil output will peak at a record 3.4 million barrels per day in this year itself. Also, OPEC has not changed demand for 2025, and the U.S. Department of Energy is talking about a global surplus estimated at 1.7 million barrels per day in this year itself. So everywhere that you look, there's no reason for the crude oil prices to go higher, is the reason you've seen constant declines onto this one. What is doing well, though, has been the metal prices. Gold is supportive with the markets working with a probability of around 93% for a U.S. Fed rate cut in the month of September. We've seen silver prices gain some support as well. Copper, after that crash that we saw in the previous week, is now trading at a 1-week highs. Aluminum and zinc as well trading 0.5 to 1% on the higher side. So metals, precious and industrial all doing quite well right now.
Thank you very much for that. Let's get into a short break. On the other side, let's invite the management of Balrampur Chinis to talk about the Q1 earnings.
Welcome back. You're tuned into Bazaar Morning Call. Well, let's focus on Balrampur Chini Mills. That's the company on our radar. The Q1 sugar volumes increased while realizations also improved, but crushing declined. Let's discuss the past quarter with Mr. Pramod Patwari, the CFO of the company. Hi, sir. Good morning. Always a pleasure to have you on the show. Good to speak to you after a while. Well, the first quarter, crushing has been lower. It's typically off-season, so that's on expected lines. But what's the outlook for cane crushing, if you could help us out? What kind of recovery? And also realizations, the last time around, you said at around 41 rupees per kg. You don't think it's really sustainable. So where is that number headed?
Good morning. Yeah, as far as the upcoming sugar season is concerned, we are witnessing lower acreage in UP. So for a UP basis, the overall cane availability should be at par with last year as per the initial estimates. However, at a country level, the production from Maharashtra and Karnataka is very high. So we are looking at a gross sugar production of around 35 million ton, which was around 29.5 million ton last year. So there is a strong case for very high diversion of sugar into ethanol, which could be in the region of around 4.5 million ton. This will further leave a room for exports. So the policy on export front will be extremely crucial as well as the timing. As far as Balrampur Chini is concerned, our cane area is slightly lower than last year, but on the basis of the current monsoon conditions, we are hopeful that yield should be better this time. And if this kind of weather continues for another 2 to 3 months, then we will get a better visibility with respect to recovery. It is too early to predict any number as far as the recoveries are concerned. On the realizations front, as I said, realizations will be a function of sugar availability to the country. At a country level, the production or the availability is very high. So going forward, the realizations will depend upon the government policy as well as the timing. What kind of ethanol price increase the government gives, as well as the timing of the exports.
Sir, do you export to the US markets?
No, we don't export to the US.
Okay. So no impact then on account of the Trump tariffs, right?
Right.
Got that. Could you give us an indication, some numbers in terms of what you might do in terms of sugar sales volumes for the full year, and even a number on realization? I know Nigel was trying to get to that, but is there some number we could work with?
It will be difficult to give any number because we are dependent upon the government policy. The country level domestic consumption in the sugar season 24-25 is expected to be around 28 million ton. And next year it can be around 28.5 million ton. So our quota for domestic release will be a function or in proportion to that only. This year, Diwali is early, so maybe the crushing will start 2 to 3 weeks early. Government will have a better visibility as far as the availability of sugar in the country is concerned. So if the decision on the export is taken at an appropriate time, then the revenue from the exports may also kick in the last quarter of this financial year. So that is very important. Currently, we are selling sugar at around 40.5 rupees per kg. And we are expecting that end inventory of sugar at the country on 30th September will be around 5.2 million ton. So going by this number, for the period up to September, October, availability of sugar is there. So we are not seeing any run up in the prices, but this prices should sustain by that till that time.
Mr. Patwari, hi, good morning. Good morning. Ethanol, sir, could you give us a sense on volumes? For ethanol, Mr. Patwari, could you give us a sense on volumes?
Yeah, if we are expecting around 4 to 5% increase in cane availability for our company, so going by that number, we are expecting that for the next ethanol year, which will start from November and end on October, maybe around 27 to 28 crores liter of ethanol is a possibility for us. But obviously that will also depend upon the pricing of the ethanol.
Right. There has been some chatter with 20% blending, which has already been achieved. That number perhaps needs to go up, Mr. Patwari. Anything you've heard with regards to that?
So the current blending the government has achieved 5 years in advance. This is all in accordance with the BIS standards. So currently the government is looking or working with the formation or the fixation of the BIS standards for E20, E25, E27 or E30, which will take some time, maybe another 5-6 months. Till November 2026, I think we would continue to be in the region of around 20% ethanol blending.
Okay, November 2026, and after that, we may see. Could you give us an update on the the PLA manufacturing venture as well? I think give us a status update.
Yeah, the physical progress of the project underway is as per schedule as of now. We have already spent around 925 crores out of the project cost of 2850 crores. Financial tie-up has been done. Most of the orders for the large lead items have already been placed. We are in the process of developing the market now. So we have started seeding the market by importing the PLA and selling. So project is as per schedule as of now.
And it kicks off, according to your earlier guidance, when, sir?
In the last quarter of FY27.
Okay,
maybe October 26 or November 26.
October 26 or November?
26.
Okay, October, 2026 basically.
Absolutely.
All right, so third quarter of 27 basically is what you're looking at. Fair enough. We'll leave it there, sir. Thank you very much for joining us. Good speaking with you, and a quick snapshot view across the business verticals at Balrampur Chini. Thank you indeed. It's 560, 561 on Balrampur. We'll take a quick commercial break here. We're going to come back. We'll connect with Devin Choksi on the other side. Stay tuned. Welcome back. Devin Chokshi is with us. Devin, thanks for waiting. Appreciate your time here as always. Just wanted a quick word, Devin, to kick off the conversation on Paytm. The aggregator license is in. They can onboard new merchants. Is it in the price? Stock's done very well. Or do you think we should expect more regulatory easing? I mean, there is a broader, larger context to this as well. It's not just about Paytm. It is about, the ANFIN getting out. Perhaps there is the US angle as well, right? With regards to, maybe the government takes a view that we don't want, American firms to have a very large share of the payment market. We want homegrown businesses as well. So the Paytm fits right in. What are your thoughts, Devin?
Yeah, Prashant, good morning. Well, I think from a technology perspective, yes, I think the company is well settled. I think as far as the payment solutions are concerned on different aspects. Not completely sure as to, I think this is going to be a game changer for the company as a whole. In my viewpoint, I think if one has to look at this entire business and whatever we understood from it, I find that I think the higher amount of game changer possibilities could be when India starts providing, I think, the solutions on the payment side to other parts of the world. I think some of the countries, particularly, looking forward to this kind of a solution. And that's where I think your market can probably expand. At this point of time, we do not have any view whether Paytm is going to move into that territory. But certainly, I think the opportunity-wise, I think the things could possibly move in a positive direction. That's what we believe. As far as I think the outlook on the price concerned, I think at this point of time, based on the current fundamentals and the revenue generation that company has done along with profits, I feel everything is priced in. Maybe I think one will have to wait and see how the revenue side increases and so along with the profit.
Devin, what about NSDL? Fantastic run-up post-listing. We got the Q1 numbers, and even in the core depository business, we've seen a drop in the company's revenues, 3.5% decline quarter-on-quarter. It's been losing market share to CDSL, and plus in the current quarter, their banking business was a bit of a drag. Considering that the valuations now are quite expensive, more than 70 times forward multiple, what would the advice be on NSDL?
Yeah, so I think both CDSL and NSDL, both of them are very strong market intermediaries, and both of them will have, I think, a large part of the role to play. NSDL has recently crossed 4 crore accounts. CDSL is, I think, 16 crore, so 20 crore accounts in depository already in the country as we see today. And the volume-wise, the account number-wise, I think CDSL definitely remains the leader here. But the size of assets which are under depository, I think where the NSDL has a large market share in this particular category. So I think some part of the business definitely, I think, looks attractive for sure. In my viewpoint, a couple of things in this result. A, the cost structure has come under control, and that has resulted into better profitability. Should the volume start picking up in the market overall, then in my viewpoint, I think the business could possibly give better than expected numbers as far as I think the revenue with profit is concerned. Yes, currently I agree that 75 times on paid basis, the price earning ratio is definitely expensive. And for it to make more sense, I think somewhere in the vicinity of around 45 to 50 times price earning ratio, this could become an attractive proposition from the investment perspective.
Got that. Any thoughts, Devin, on Astral, which sold off very sharply yesterday?
Well, again, I think the cyclical factor which affected I think, many of the plastic processors, which is a PVC price. And certainly, I think sudden drop in the PVC price led to inventory-led loss also in the books of the companies. It could be, in my viewpoint, I think it was probably one of the factor in the I think in the quarterly results. I believe that given the strong demand that we have for the pipes, in particular, and leadership the Astral is enjoying today, I believe that I think subsequent quarters should be relatively, I think, much stronger quarters, particularly with the festive season setting in now in the second quarter of the financial year. I believe that I think in the second half of the financial year, we should be seeing significantly large turnaround for the business as we are seeing. Maybe the volatility in the PVC prices has taken a toll in the first quarter, which may not be the case I think, in subsequent quarters. So on dips and correct corrections, I think the stock should become an attractive buy proposition.
All right. A couple of other questions, Devin, but we'll chat again. Thanks very much for joining us for now. Appreciate you sort of taking out the time and being here on CNBC TV18. We'll take a quick commercial break here. Some technical trades and focus with Mitesh and Sudarshan. Stay with us. Okay, welcome back. Let's welcome in Sudarshan and Mitesh, who are with us with what they'd want you to do with regards to specific trades today. There's news at the bottom of the screen. Anthony Waste has won 2 contracts worth 1,600 crores. That's a large order. So that's Anthony Waste for your stocks, of course, underperformed quite a bit. Gentlemen, good morning. Great to have both of you here, Sudarshan and Mitesh. Sudarshan, how would you approach things? I mean, Monday, 200 points. Yesterday was minus 100. Today, implied open is plus 100. What's the trade? Indices first.
Well, for today, the trade is to look for a minor dip and go long. The chances are that the rally we see today could extend all the way till tomorrow afternoon when positions should be closed. So for the very short-term trader, for the intraday trader, for the swing trader looking for a 2-day trade, identify a small dip, not large, or a trading range in the day, early in the day, and go long. Keep a 100-point stop loss. Next week would be different, but that's something we can discuss tomorrow.
Yeah. Mitesh, what about you? Indices first?
So on the index, I think, there's some process of consolidation which has begun. See, we've been declining and, I've advocated having some good spreads. But anything close to this 24, 400, 350 zone, there's a big and huge gap, which the Nifty left when it was going on the upside on the 12th of May. Now, around that gap, strong support will come in. There's also retracement area and a couple of weekly averages. So I think we might see some base building around this 24,350 mark, give and take 50 points. But there is no strength or sign of a reversal, which means that on the upside, close to about 24,750, and yesterday we got a high of 24,703. Around those levels, you will see supply emerge. So I think we are settling in for a range kind of a trade for the next few days. Only if we see some kind of a reversal sign, then I'll assume that a possibility of an upward breakout happens. But till then, try to buy near the lower end of the range with a 50-70 point stop and try to take profits as you get closer to about 24,700, 750 levels.
Okay, got that. Sudarshan, what are your trades?
Well, it's an all buy list. NHPC is a buy with a stop under 82. Indian hotels, in fact, the entire hotel group, that hospitality sector itself is a buy. So Indian hotels is a buy with a stop under 733. Tata Powers now emerges out of a consolidation. Consider buying, stop under 376. And finally, M&M Finance. M&M Finance is a buy under 242 with a stop at 252. And you could also consider M&M Finance as a positional trade.
Okay. M&M Finance is a positional trade as well. Mitesh, what about you?
I also have buying calls today. A buy on BHEL. Again, the stock is at a gap support area, so could bounce back. Buy here with the stop below 218.5. Look for 230 kind of a target. Coal India is a buy with a stop at 382 for a target of 395. A buy on NQPC with a stop at 337. Look for a small target of 348, 350 on the upside. And DMart or Revenue Supermarts is the final buy call. Keep a stop below 4,200. Look for targets of 4,350.
Okay, all right, Mitesh and Sudarshan, thank you very much, both of you, for joining us. Good speaking with you with those trades. We'll talk again in about 10 minutes or so. The pre-open is kicked off, 21 points on the Nifty. The Sensex is up about 110 points or so. Suzlon reported numbers, and we have the management with us to take us through the earnings. JP Chalsani is Chief Executive Officer at the Suzlon Group. Mr. Chalsani, good to have you with us here. Not in our studios like the last time, but we'll get to the numbers and the outlook, etc. in a bit. But there's another news item which I should start with, which is, of course, your CFO putting in his papers. He's someone who joined you in 2021 and has been, with you as you sort of engineered this turnaround at Suzlon, massive turnaround at Suzlon. Could you give us a sense of what happened? Why is Mr. Modi leaving?
I thought it's a bold news. You people broke it almost 24 hours back. Anyway, having said that, Himanshu had been a great colleague, and then he was integral part of our growth story, as you said, for the last 4 years. We now reached a stage where we are on the right momentum. If you look at it, we become debt free. We got 600 crores cash, 7,000 crores of working capital, and the credit rating has been consistently moving up with the latest of A+. Obviously, at this stage, for him, having done so much, the question is the next growth opportunities. He had an options to move the business in Suzlon or move out into financial sector. So after careful consideration, this is what is decided. He, as he said in his resignation, is always available to us, and we continue to tap him. But as far as the company is concerned, because as I said that we're on the right track, right momentum, I don't see any sort of an impact. And the next person who has to come in as a successor to Group CFO is also in the advanced stage of appointment. Yes, we will miss him definitely, but then the company would move on the growth momentum what we're setting.
Was there obviously, natural to assume that you'd aspire to, CFO, you'd aspire for a CEO level position, right? Was that one of the factors?
See, it is individual decisions. Obviously, you need to talk to Himanshu why he took this decision, but he had the opportunities to grow in the business in Switzerland as well. Okay. So therefore, the question is that whether you want to move on the business or you want to stay in the financial services and grow. Careful consideration after a couple of months, he decided to grow in the financial sector.
And the new CEO.
And then you need to check with him beyond that, obviously. But as I said, that one is he has been a great colleague for me.
Sure, absolutely, Mr. Chalsani, new CFO in how much time?
It's an advance. By when? Actually, Prashant, we started the search quite some time back because there is nothing beyond CFO for him, so we wanted to move into the business. So it's an advanced stage. You will hear from us the appointment. So,
Okay. From the family or an outsider, professional?
it's a professional. We always had a
Professional. Okay.
I don't think company ever had a family CFO till now.
Okay, got that. Sir, in just post your Q4 numbers, in the early part of June, there was this large promoter block which took place. And I think it was about, the promoter stake came down from 13.2 to 11.8%. I mean, the street was surprised because your Q4 was good. You gave a strong guidance for FY26, 60% growth across all key parameters. What prompted that? And is the promoter looking to sell more stake?
Rima, one thing let me confirm as a group CEO, their commitment is there, was there, and will continue to be there. They are deeply involved in the business. It is their BV, so therefore there is no issue with respect to that. As far as the block sale is concerned, obviously, they have been in the company for so long. They never had the decent dividends. I think there's no other options. So therefore, it's more for cash generation at one time, but otherwise there's absolutely no the thing like to forward sale or anything else. I can reconfirm again with all my seriousness that there's no impact on the long-term commitment. Both the brothers are they extremely hands-on the business as well as on the policy level, and they would continue to be so.
Okay. Just some more business questions. Does the 60% growth target continue for FY26, something you shared last time? And what will you end FY26 in terms of an order book? And what kind of visibility does it give you?
Yeah, the first question is that 60% is what we gave guidance end of last quarter, and we stand by that. The 60% on an annual basis on all key parameters, we would stand by that guidance. As far as the order book is concerned, right now we're at 5.7 closing order book. Okay, it's an extremely strong order book. There are a number of the proposals being under discussion. I don't want to put a number to where we will end the year end, but one thing I want to say is in the last 10 consecutive quarters, our closing order book has been higher than the opening order book quarter-wise, in spite of the fact that our supplies have increasing from quarter to quarter. Even after supplying it, our closing order book has been higher. So therefore, it clearly shows that we are in sustainable growth, and order book is not really a concern at this stage. We will end up with a very strong order book.
Can you give us a number, sir, by end of 26?
No, we're at 5.7, Prashant. I can definitely tell you that it will be more than that.
Okay, it'll be higher than what you as you have over the last couple of years. These amended ALMM norms, you're the sole integrated domestic player in many categories. How much of an opportunity is this?
See, there are three aspects. First of all, that we completely comply with the regulations that came in. Okay, whether it's in terms of sourcing or in terms of R&D or in terms of operation maintenance, data control, and everything. And as far as the sourcing is concerned, what it does, Prashant, is that we were at a little bit of disadvantageous position compared earlier because there were cheaper imports happening in the country. Whereas we looked at domestic plus also more importantly looked at the quality because we offer 25-year service. We got to be sure that our equipment operates for 25 years. In the service period, we actually replace parts if they fail. This, what it does is that it provides a level playing field for everybody. I know I'm saying this as an Indian company in India that we got a level playing field now. Everybody has to pick from the listed wind turbine component sources only. And that listing, as they said, that would be very strict in terms of inspection, quality and everything. So it's good for the sector, good for us definitely.
Thank you, Mr. Chalthani, for joining in. Short conversation, but we're just heading into the pre-opening right now. Thank you for joining in. That's the word coming in from Suzlon. Let's go across to Sudarshan now for his 9:10 call.
Well, buy Indian Hotel with a stop under 733.
Indian Hotel buy. Mitesh, yours?
I'll go with the buy on Coal India for targets of 395.
Okay, all right. Thanks a lot for that, Mitesh. Well, let's get to a couple of stocks and sectors that will be in focus. Solar manufacturers, they're going to be in focus today. Vivek joins us to tell us exactly why. Vivek?
Well, that's right. A development to take note of. Number one, it's actually a consortium of US solar manufacturing companies, cells, modules, panels that earlier had petitioned for both an anti-dumping duty as well as a countervailing duty to be imposed on Indian exports along with 2 other countries. So now the US Department of Commerce has initiated this particular probe into both solar cells, modules as well as panels. So there are 3 countries that are part of this particular probe: India, Indonesia as well as Laos. Now what is the claim? The claim is that these companies from these countries actually benefit from unfair government subsidies, and the sale price at which they sell in the US market is lower than the fair market prices which the US companies produce and sell at. So now when you're looking at the impact, currently the impact will be determined by the final outcome of this particular probe, but any adverse ruling may lead to one-time large penalties that these companies will have to face. So which are the companies that will remain in focus? Well, the company that will be impacted the most is Waaree. Over 40% of the order book is from exports, mainly into the US markets. Two other companies do export, very minimal, Premier Energies have continuously told us that the order book mainly is in the domestic market, and also Adani Energy does go ahead and export, Adani Enterprises, does export some solar products into the US market. So these companies will be impacted. When it comes to Waaree, remember the company will also face the double whammy of the 50% tariff that the USA has imposed on India. That could be offset by a 1.6 gigawatt facility that the company is planning to set up in the US market. Overall, a slightly negative development, but key details are still awaited.
All right. Vivek, thanks very much for that. Flattish kind of start as far as Waaree and Premier, etc. go. Suzlon is coming up at the bottom of the screen. Landmark Cars is a big one, right? 6.5% higher on Landmark Cars in the pre-open session. A very strong EBITDA. Look at Shakti Pumps. I mean, I think the high was about $1,100, fell to about $750 or so. So it's coming back up after that. This new order which has come through. Senco is another one. I mean, very strong numbers from Senco. 70% growth in EBITDA. And we'll have the management coming on later. So lots of movers, individual stock-specific movers coming through. One more, Honasa is something you should pay attention to. Mangalam is here with reasons. Mangalam.
Well, there are a couple of quarters that was weak for Honasa, and that led to the big decline that we saw in the company's stock price. But it seems like these numbers tell you that maybe the company is turning around a corner. Why do I say that? Because the reported revenues grew 7.5%. The EBITDA declined by 1%. Brokerages were expecting a much bigger decline to the tune of almost 15 to 20% in the company's EBITDA, and the margins came in at 7.7% versus 8.3%. Net profit saw a marginal growth year on year, but that's better than a big gash that the street was expecting. What's good is that the revenues grew 7.5% despite a near 200 basis point impact on sunscreen due to unseasonal rains, and the underlying volume growth has been 10.5%, which is much higher than all the others in the industry. And there has been a 264 basis points improvement in EBITDA margins quarter on quarter, and their focus categories, which is about 80% of their sales, grew in double digits as well. So all these factors working well for Honasa. The question is, has the company turned the quarter? We have brokerages which are positive on the stock, but Jefferies puts it best. They say it's a high-risk, high-reward story right now.
And CLSA today has upgraded Honasa to an outperform and raised the target price to 333. 5% up on Honasa in pre-open. And you also have Nykaa giving it company, again, a 5% up move. So some of these companies higher.
Just one more stock, NMDC Steel. From the time it's listed, that's from the time it got demerged from NMDC, it's been delivering losses. First quarter, it's seen revenue ramp up that will be supported partly by pricing. Also, I think utilization levels could have improved. So because of that, the stock that had gone all the way to around 70 rupees, it's come back down to around 35. But this morning, opening well in the green because they have turned profitable. Interesting to see whether they can sustain this and what the government decides to do with this asset, because in the past they've spoken about divesting it.
All right. Well, 0.4%. Look at the start. I mean. 24,487, 0.4 lower.
We'll get those. Yeah, that's the number.
It's about a third of a percent higher. Those are the rates, the first rates which are coming through. 89 points. The Nifty Bank is down about, is up about 0.4%, 55,267. The mid-cap index is up 0.5. The small-cap index is coming up with a higher rate as well. So this is a decent start, almost at 24,600 at this point in time. Market breadth on the Nifty 50 pack heat map perhaps gives you a sense of where we are starting before we dive straight into individual names. Almost 100-point pop and 300-point pop on Nifty Sensex respectively. It's all in the green, except three names which are starting lower. Apollo, Hindalco, Power Grid are some of the large cap names. And there are three, Tech Mahindra, Axis and Titan, which are in the red. Prima.
By the way, before we get to the large cap action, three mid caps. One is Yatra, another 5% up move on Yatra Online. This week, the stock is up 50%. So continues to raise post its numbers. Honasa and Nykaa, the two stocks. Honasa now up 10%, Nykaa up nearly 5%. Getting to the large cap action, well, it's earnings reactions playing out. Apollo Hospitals is your top gainer, so that's up nearly 4.5%. ONGC has a positive tick to begin trade with. And we should get Hidalgo. Came out with numbers towards the close of markets yesterday, and that too has started off trade on a positive note. Power Grid, BEL, Tata Motors, Adani Enterprises, these are some of the gainers in today's trade. On the way down, not too many. You've got a Tech Mahindra, but that was a star yesterday, up 2%, so retreating a bit. Axis Bank, Wipro on the flatter side. All in all, it's 100 points up now on the Nifty. Nifty once again trying to get towards that 24,600 mark. Sensex is open with a gain of about 300 points. Midcaps are outperforming.
Well, that's right, but plenty of stocks actually doing well. Honasa, as you pointed out, Nykaa is flying away. Senco as well is up closer on 4 to around 10%. All these stocks doing very, very well. Paytm, that's up 3.5%. You know, that's sentiment positive that's coming from them. JM Financial, yesterday intraday the stocks did see some profit taking, but that's done well yet again. So big up move is what we're seeing on that particular name. On the flip side, you have Jupiter Wagons, that's under some pressure. That's down closer on 3.5% or thereabouts. We'll be joined by the management shortly, to detail those numbers. Anthony Waste Handling, that's another stock that's popped up in trade. It's up closer on 7.5%. So massive move is what we're seeing out there. Big move on decent volumes as well. And, I think Dream Folks, that one has been, locked in upper circuit for the last few trading sessions. So that's doing quite well. What's not doing too well, I think one stock that I'm looking at is Aarti Pharma. That one is down closer on 9%. So slam dunk on that one. Rupa as well is down decent volumes, 1.5 lakh shares already traded. That's down closer on 8%. Both those two have come in for some profit taking. So keep an eye out on those names as well. But it's a good start to trade, guys. Sustaining this opening gap up is going to be very, very important from the bulls' perspective.
Okay, all right. Let's just look at the first rates, which are sort of settling down. It's a triple-digit gain, 24,590 on the index. And you've got the mid-cap index and the small-cap indices, etc., which are going to come up on your screens as well. What do we have, apart from what we've kind of mentioned? I think Alchem is recovering a little bit. Alchem was a big casual, I think it was about 6% yesterday, Alchem. So from a close of about 4,800, it left yesterday at 5,150, and it's at about 53. The high today, by the way, has been about almost 5,400. So it's following through. Transrail is up about 3%, and it's got large size volumes at this point in time. I mentioned Shakti Pumps back at almost 900 rupees. I think the high was 899 today. It's cooled off a little bit, but still 4% on it. Premier Explosives, I don't know if you mentioned it, 11%, 12% on Premier Explosives. Very large sized volumes at this point. So 476 on Premier Explosives. Look at, there you go. And 30,000 shares as well. Look at Techno Electric. 8% move on Techno Electric, 1,410. Stocks at about 1,473. So it's a pretty large size move coming through there. And you could look at a few other names, but volumes start to thin out. This is pretty much the biggest volume-led pack out there. Suzlon is down 3%, and we just had the management with us. Suzlon is the number one volume-led loser coming through on the NSE. 21 million shares, 22 million shares from on Suzlon at this stage. Sonata Software was a huge volume-led gainer yesterday by close. It's seeing some profit booking. There was no news really on the in terms of what led to the big move, but it's down 2% as we start this particular session. All right, let's welcome in Manish Gunwani, who's with us. He's a market master of the day, head of equity at Bandhan Asset Management Company. Manish, good morning. Great to have you with us here. Thank you for joining us. One viewpoint is that since late October last year, the market here, you look at MSCI India, for example, it's underperformed MSCI World by about 20% dollar terms. So one view is that, you're going to come to a point where some of this underperformance is going to give us a bit of a fillip, a bit of a spring when market starts to move higher. But you need some triggers, right, for that to happen. What are those going to be, according to you, Manish, as you look ahead?
So if I think about globally, I guess the biggest trigger can, of course, be a renewed weakness in dollar. The dollar's been consolidating post the 10% fall we saw over the last 4-5 months. And I guess part of the reasons emerging markets are doing well is the dollar looks weak, while it's not fallen recently, but it does seem to have its challenges fundamentally. On the domestic side, I think last 12 months have seen a slowdown in the economy versus expectations. And I think what can probably turn this around, hopefully, is falling interest rates, tax cuts playing through, maybe pay commission in a few quarters. So we're quite hopeful that the slowdown that we've seen over the last 12 months will get reversed in a sense over the next 2-3 quarters. So I think once you start seeing some traction in nominal GDP, I think India has seen a fairly decent fall in nominal GDP coming down to single digits. I think it's important to get it back to
Oopsie.
Oops.
I think we lost the line there.
monetary side, we've seen similar, right? So on the monetary side, we've seen significant stimulus. So we are hopeful that once we see the nominal GDP come back, the outlook on earnings will improve, and we should then see the market resume its uptrend.
India has greatly underperformed the MSCI emerging markets, right, in the last 1 year. Now you're saying that things will improve from here on. What would you bet on? What would be the extent of the improvement? You know, for instance, we were just, reading out a call from Mahesh Nandurkar from Jefferies, and he believes that we will see a bounce, again, for the same reasons that you articulated, but the bounce may not sustain for long due to weak value versus growth equation and equity supply concerns. Now, in the last 1 year, Manish, we've already seen no return for the Indian equity markets.
So I think we should not be focused just on last 2-3 quarters. If you see on a 3-5 year basis, Indian markets have healthily outperformed emerging markets. And once that extent of outperformance happens, there'll be phases where mean reversion happens. So today, obviously, China, Korea, Taiwan, they probably got very cheap at the end of last calendar year. And this year, they will outperform, I guess, just by mean reversion. I think India remains a bit of an insulated story in the sense that, look, foreign investors don't play India to play US consumer or something like that, right? Or US tech, for example. We are a steadily growing, primarily domestic economy. To be fair, we have, as I said, undershot our expected growth over the last 12 to 15 months. I do hope that given the monetary stimulus, and I would think that even fiscal stimulus should start picking up. I think the kind of CPI number we saw yesterday, for example, just shows how much space we have in terms of the macro stability has gone to an extent where I think it's given you a lot of space to stimulate the economy. And I hope we see some strong policy action as a mix of fiscal and monetary, because we definitely, I think, should be, as a country, aiming for double-digit nominal GDP growth. And given that our current account is in a brilliant shape, inflation is in brilliant shape, there's not excess leverage in banking or household sector, I think there is a lot of space to stimulate this economy and get growth back.
Hi, Manish. Good to see you. Where do you generate alpha, though, in this sort of market? In the past, you've spoken about a couple of sectors. I recall towards the end of last calendar year, you were talking about metals, oil and gas as well. Those could be themes that actually you could make better returns. Do you stick to that, or do you think that things have changed? In the metal space itself, if China is going to recover, since there are regulators that are peppering the economy, maybe it could be better times. What's your gut on it?
Yeah, I think metals worth a risk-reward rate. See, metals is not a buy-and-hold sector, but given the expectation we have, at least, of medium-term dollar being weak and China probably bottoming out. And the fact that it just bottom up when you see the cost of extracting and producing these metals versus the current market price. A lot of these industrial metals are definitely cheap. So I think metals is a good risk reward sector. I think consumption at the mass level, um, while it may not be a very structural buy and hold story, but uh, given this phase of last 3-4 years where a lot of consumption stocks have been flattish, I think, as I mentioned last time, there are a lot of brand companies which are available at 1 to 3 time kind of sales. Typically in India, those are very good entry points for consumption stories. And while when you play a cycle, nothing is clear when it will play out. So you can't be 100% sure of a strong consumption cycle coming through. But I think the risk reward is good. I think as I said, the valuations are cheap, expectations are low. So I think with a view of 12 to 18 months, because pay commission may come by that time, I think these consumption stocks which are cheap, I think that is a good theme. Structurally, I think the theme remains technology, the internet platforms. Those I think are good buy and hold stories, or any company which can produce medium to high end products and services and export to the world, because there is a shortage of trained manpower globally. So whether it's engineering, pharma, if you can find a company which has got good R&D, has products with moat, and which can go global with those products and services, I think that those are two structural themes, I think, which we continue to believe in.
What about cement, Manish? In Q1, we saw good improvement in the realization across in the industry. Do you see competition being rational, and from here on, the EBITDA per ton improving or sustaining? And how is cement looking for you? Looking to you?
Personally, I'm not very hot on cement. I see cement as a trading sector because the penetration in India is very high. While it is consolidating a bit, it is not a sector with very secular pricing power to my mind. So you have to buy when things are down and you sell when things are good. Today, I think a lot of market participants are very bullish on cement. Valuations are high. Stocks have done well. So not a sector I would be very hot on at this point of time.
Okay, all right, Manish, very quickly, what about defense? It's got a longer runway and there's going to be plenty of focus both in India and globally, but valuations became too expensive. Some of them have corrected. What's your view?
Yeah, to be honest, we've not played this theme very aggressively. The macro has been always attractive in the sense that not only in India, but globally also, particularly in Europe, you're seeing defense budgets shoot up. If you see defense stocks globally have done well. But the point, what concerns us is just it's a one client sector. And the kind of margins we are seeing defense companies make, they are a bit surprising because they've gone up a lot. And of course, the P multiples, even on those higher margins, are very high. So it's not a sector I would be massively bullish on, to be honest.
Look at Aarti Pharma. I don't know if you've highlighted this, right? It's a large cut, 8.5% cut. So just pull the stock up, 784 on very large volumes, by the way, coming through. Coromandel is another one which is around about 4% or so. So that's a large cut, 4% loss there. And by the way, these are all within the top 5 volume-led losers list. Vari started slow. It started actually almost flat, but Vari is now number 2 volume-led gainer, 3% lower on Vari. And of course, we highlighted Suzlon, which is down almost 4.5% at this stage. So stuff is moving on both sides. Although with about 15 minutes of trade behind us, it's clearly advantage. Gainers over decline. 70 points on the Nifty is what you have. Manish, thank you very much for joining us. Great speaking with you here on CNBC-TV18. Really appreciate it. as always. Nigel, but I think we have the management of BEML with us.
Well, that's right. Let's focus on BEML. The start to the year was actually muted, but what's the way ahead? We're joined by Mr. Shantanu Roy, the chairman and managing director of BEML. Hi, Mr. Roy. Good morning. Good to see you. And as always, well, the start to the year has been a little bit muted. So I wanted to ask you whether you want to revise any of the big three numbers you gave us last time around. You were talking about revenue growth of around 20%. For the start, it's been flattish. You were talking about margins improving by around 100-150 basis points. And the order book ending at around 22,000 crores for the year. All these three numbers do hold out?
Hi, Nigel. Good morning. Thank you for having me here. All the three numbers, it should remain the same. The 20% growth, the margins, as well as the order book. The order book has done pretty well. In the current financial year, we have already received orders of more than 2,900 crores, out of which 60% has come from rail, metro, 20% each from mining and defense. We are at an all-time high as far as order book is concerned, 16,673 crores of orders, out of which rail, metro makes up 65% of the order book, 26% is defense, and 9% is mining. So we have held on to the numbers in the first quarter. There have been some pluses, some gains, especially in terms of the margins getting better. Number two is the cost going down. We have held on to our employee remuneration. We have held on. We have reduced the inventory. This year, our major focus is on reducing the working capital, and for that, reduction in inventory, reduction in the debtors. To our
Mr. Roy, just to comment out there, actually the start to the year has been very, very feeble. There's not been any growth. But just to reiterate, you're saying that the remaining quarters onwards will be good, such that you achieve a 20% growth, right?
Yeah.
And because of the cost focus measures as well as operating leverage that will play out, margins this year will improve by around 150 basis points in comparison to last.
Yeah.
And order book goes to around 22,000 crores. That's right? Any particular reason why the last quarter then was flattish? Are you having some supply issues? Is there, any kind of difficulty you all experienced in the first quarter that it was so soft?
You see, there are four critical pillars for any organization to perform. First is the design, second is the supply chain, third is the capacity or capability in terms of human resource, and the plant and machinery. So here the material, that is the supply chain, has been of major concern to us. The supply chain is taking more time to stabilize than what we expected, especially for rail and metro, especially for the defense. And more so because we are indigenizing, and in the process, in our journey of indigenization, the supply chain has to not only be able to give the numbers, but also they are to come up and give the quality that is desired. So these two areas, the supply chain partners, the industry partners, have to ramp up. And that is where it is taking some more time to stabilize. In spite of that, it's a commendable effort, I should say, that we have held on to the numbers. But the second quarter onwards, and more so from the third quarter, when we expect the supply chain to further stabilize, and with more options coming our way, especially in the rail and metro, especially in the defense, in terms of the industry partners, the number of industry partners who will be onboarded by that time and who will be developed by that time. So things should go well. So this year, majorly, it is an execution challenge.
Okay, so that explains the
Orders will come, but execution is the main challenge.
Okay, and is that what explains even the Q1 softness, the execution?
Absolutely.
Got that. I think last time you spoke about one large Mumbai tender, which you were hoping to close about 30,000 crore. Is that correct? Which you were hopeful will close soon.
The tender.
It was a Mumbai MRVC train contract, about estimated, I think, 30,000 crore. You said expected to be floated soon, but likely execution will start only next year. Has that closed? What's happened on that front?
The MRVC tender is yet to be announced and yet to be floated. And once it is floated, it will take at least 6 to 8 months for the conclusion to be reached. And the execution will start 2 years, at least 2 years. It's a huge number. It's 2,856 cars to be precise. And it will be executed over at least 5 years. And the execution will start only after 2 years. But in our estimates, we have not considered the MRVC for the current year.
Okay. And exports, what was the contribution, Mr. Roy, of exports in the current quarter, and how will it trend going ahead in FY26?
Current quarter exports has not been very good, but in the second quarter, the exports contribution is going to go up to at least 3 to 4%. We are in the process of executing one big order from the CIS region. We expect some more orders. I'm talking about the mining and construction vertical. We expect some more orders which we'll be executing in the current financial year. We expect some orders for the rolling stock in exports for the first time. The order that we have recently received is only for the retrofitment and upgradation. But the new rolling stock order, we should expect some rolling stock orders in the export market in the current financial year, which will then go for execution in the next financial year.
Okay. What about the Vande Bharat order, sir?
Vande Bharat, already the order is there. We are in the process of executing. Okay. And very shortly, the second, third, fourth rakes will come out. And the balance 6 rakes also in the coming 4 to 5 months, we will be completing that order.
So what is the contribution to the revenue, sir, in this year? Please go ahead.
The contribution of Vande Bharat to the revenue this year should be around 10%. Into 10%.
Got it. All right. So just want to clear out 2 numbers. One is on exports as a percentage of your mix in this 20% growth, that you're talking about. How much will exports stabilize at for the fiscal? And defense as well, you were guiding that, it will contribute more in this year. Yes. So as a percentage of the mix, what will it be?
You see, last year, defense contributed around 27%. This year, we are expecting defense to grow by at least 70 to 80%. That is what we are looking at, and we have the orders also. So contribution of defense should cross 30% this year. That is number one. As far as exports is concerned, the overall export, the physical export that we expect this year to the top line should be around 3 to 4%.
Okay. All right. Well, it's always a pleasure having you on the show, Mr. Roy. We're going to hold you to these numbers, but you're saying there were some supply issues in the first quarter. You're optimistic things recover from here on, and the 3 big numbers you're giving us, 20% growth, 150 basis points improvement in margins, and order book to around 22,000 crores. Thanks a lot for joining in here on CNBC TV18. The stock as well is perking up a little bit post that positive commentary.
Okay, by the way, for the markets, it's holding on to gains about 0.25% higher on the Nifty, not 100 points up now, but about 80 points up. It's 24,568. Some of the gainers include NMDC Steel, Honasa now 12.5% higher. Apollo Hospitals, 6% surge seen in Apollo Hospitals post the numbers. Paytm is moving up smartly, 5%. Shakti Pumps also higher. In fact, let's talk about Apollo Hospitals. Reacting to a strong set of Q1 numbers, healthy revenue growth, margin expansion. Sunita Reddy, Managing Director at Apollo Hospitals, is now with us on the show. Thank you very much, ma'am, for joining in. Strong performance in Q1, 15% revenue growth, EBITDA margins 14.6. Give us an overview what led to the growth in the current quarter and what would the guidance be for FY26? I think you're targeting a double-digit revenue growth. What will drive that?
So we grew 15% consolidated revenue. Numbers came in at 5,842 crores. But more importantly, EBITDA grew to 845 crores. So there's a significant improvement of 26%. And PAT at 433 crores, improvement of 42%. So headline numbers look good. More importantly, I think, the revenue has translated into profitability, into EBITDA. In the healthcare services business, there was 11% growth with 2,935 crores of revenue, representing 11% growth. EBITDA grew by 17% to 718 crores, and profits came in at 384 crores, representing an 18% growth in profits. So more importantly, healthcare margins were strong at 24.3%, representing an 83 basis points improvement over last year. Apollo Health and Diagnostics showed a healthy growth of 19% with the revenue of 430 crores, EBITDA at 40 crores, and a slightly negative PAT of 8 crores. But moving forward, I think, Apollo has established a primary care platform, a secondary, tertiary, as well as a great funnel for patients, an ecosystem for patients to move through the system using digital, which is our 24/7 app.
Ma'am, good morning. Prashant here. Strong numbers, and I think the market is responding to that. Was you said healthcare services revenue, that's hospital revenue, went up 11%, right?
Yes, yes.
Whereas the AHLL and the Healthco are the ones which really led growth, 19-20% growth there. Was the hospital revenue growth at 11% a little softer than what you expected? And what can we expect here?
Yes, I think definitely it was a little bit softer than we expected. In terms of, moving forward, I expected to get back to 68%, 70%. And with that, the 14% improvement in revenue over the rest of the year. With this, we did have an impact of Bangladesh, where that impact is being mitigated in the second quarter. We found more patients, international patients, entering the system through the offices we've opened internationally. So, however, our payer mix continues to be strong, which is why our EBITDA is at 24.3%, and I think that is a very important factor. Insurance, private insurance, go ahead.
Yeah. You're saying international patients will pick up substantially.
Yes.
What is that as a share now, ma'am?
Currently, it's about 5% of revenue. It was 7% of revenue, but in the North Indian destinations, it is picking up. In our hospitals in the north, in Karnataka and Hyderabad, we're seeing a significant uplift. Chennai is starting to see patients, international patients once again.
So you'd go back to 7% as a share?
Yes, we should.
By when, ma'am?
By the end of this year, we should be able to achieve 7%, moving towards 10% next year.
Right. So again, just to focus on the hospital business, inpatient and outpatient volumes are also maybe a little softer than what you thought, right? 3% and 9% respectively.
Yes, I think, you're right. The focus this year was on improving case mix, which is revenue from cardiology, oncology, orthopedics, gastroenterology, and this played out very well. We had an 8% increase in high-end tertiary care, which resulted in a 9% improvement in ARPP, which came in at 1,72,000 rupees.
Right. Got that. Could you give us a sense on the bed addition plans for the full year, ma'am? Where do we stand?
Yes. Currently, we're opening Pune with 250 beds by the third quarter. We're opening Defence Colony this quarter with 87 beds. Defence Colony is a fully focused women's healthcare, including onco unit. We have Sonapur in Calcutta with 250 beds, as well as Belapur. So Belapur is an acquisition, Belenis Hospital, which is an acquisition in Bangalore with 150 beds. So these are the 4 hospitals that we will be opening in the third and fourth quarter of the year.
So in total, what are we looking at in terms of addition?
In terms of addition, we're looking at 500 beds added this year.
Okay.
Okay. Ma'am, you also announced the demerger of the omni-channel pharmacy Digital Health 24/7 into the new entity Apollo Health Tech. It's a move to unlock value for your shareholders. What's the status of the demerger right now?
It's been approved by the board. I think we've made the application to CCI and NCLT. This should take about 18 months. In about 18 months, we should be ready to announce, and following that AGM approval, we should be able to list.
Got that. But 18 months from here on, in terms of a timeline for listing.
Yes.
Okay. I know we've asked you this when, the plan was formulated about the Apollo Health Tech guidance, 25,000 crore of a top line, 7% margins by FY27. Now, I mean, even since then, the street is still a bit circumspect on how you're going to get to these numbers. I mean, can you tell us how it's changed? What's changed in the last 3 months that makes you even more confident or equally confident?
No, I'm very confident because even if you look at the numbers, there was 2,747 crores of revenue from both online and offline. And in this, the most important 19% growth. EBITDA, however, grew more strongly at 25%. And this came in at 97 crores. Profits grew to 57 crores. So as I guide for the future, I think the change that's going to happen is with the integration of KeyMed, the back-end pharmacy. So you're already looking at a huge potential for almost doubling growth. And over a 3-year period with the integration, they should reach revenues of 25,000 crores. And currently, the offline margins are at 7.7%. Holistic margins for online and offline are at 3.8%. So they're also showing a margin improvement. If you look at the different lines of business, 4 lines of business, unit economics are good. All of them are profitable. So if you add to this the addition of the back end, I think, it is not only a growth at scale, but it's profitable growth.
We're also seeing competition rev up in the entire sector. Manipal acquired Sayadri Hotels for about 6,000 crores. They're adding 11 hospitals. I mean, give us the competitive landscape right now from organized players. There is PE backing large hospitals and large chains. Your own thoughts and what are you planning? Are you looking at any acquisitions?
We continue to look at acquisitions. Let me just put this one figure before you. Of the 16 lakh beds in the private sector, 1 lakh are totally private, held by trusts, etc. They are only less than 50,000 corporate beds. So there is a huge structural demand-supply gap. And I think that corporate has done very well in lifting clinical quality. More importantly, if you look at our average revenue per patient, which is 1.72, it's 1.72 lakhs. It's now, we're accessible to insurance. So insurance has grown by 30%. Corporate hospitals, patients can access corporate hospitals. So therefore, we believe that the demand is strong. Patients have access to private health insurance, and this it will continue to grow. So consolidation is one way of growth. In Apollo, we believe both in acquisitions, brownfield growth as well as green.
All right, we'll leave it there, ma'am. Thank you very much for joining us. Good speaking with you, and I really appreciate your time here. Stock surging 6% the last I checked, and these are on the back of a very strong EBITDA beat which has come through. 7,700. The share of international patients is going to rise. It's at about 5% now. It used to be 7%. They're hopeful it'll go back to 7% by the end of this year. That's the guidance coming in from Apollo. We'll take a break. We are back. We stick with broadly the pharma healthcare space. Granules India will be with us to talk about their first quarter performance. Stay tuned.
Welcome back. Let's talk about Granules India. Subdued quarterly performance. Top line growth only at 2.6%. Profits are down 16%. We have with us Krishna Prasad, Chairman and Managing Director at Granules India. Thank you very much for joining in. Can you tell us the 2 to 3 reasons for the weakness in Q1? It's just a modest 2.5% revenue growth. I mean, what were the pressure points in the current quarter? And 2, are you seeing a recovery Q2, Q3, looking ahead? And can you maintain margins at 20% plus?
Yeah, good morning. The main reasons for subdued performance or flattish performance for Q1 was, compared to Q4, was a capacity constraint. We are having a remediation going on in our Gagillapur facility. And actually, the production has come down by 10 to 15%. And the main problem is only supply. We have now our GLS plant, a new plant with 10 billion dosage capacity, inspected by the FDA, and we expect approval in a month or 2. And once we get that, we expect that we will be overcoming the supply issues. And also, Gagillapur facility, which is under remediation, we are planning to go back to the FDA shortly, and then we expect that that also should be cleared by December, Q3. And Q4 onwards, we are very confident we'll see an increased performance.
Okay. So at least half of Q2 is going to be impacted by capacity constraints because Gagillapur still stays as is with production down 10%. And even the new facility you said comes up only in the second half of Q2. And can it ramp up immediately? How much of the shortfall in capacity can it make up?
We do have a good order book position, and I think we can definitely do good with another 20%, 25% capacity. We should be able to easily sell. And all that is holding us back on the new facility is the FDA approval. We have filed, they did a pre-approval inspection, and we're just waiting to hear from them. There's no issue. The inspection went very well.
Okay, so as soon as you hear from them, I mean, it comes back up and the supply problems go away. That's the hope. Okay, now margins at 20% have been maintained despite these remediation costs, integration of Sen chemicals. Can you guide us on margins as well? Where do they head from here?
Margins will definitely, you see our gross margin, it's been actually increasing, and only the increase in revenue is going to contribute to a very healthy margin. I cannot tell you numbers, but definitely there'll be a very good uptick in margins once the revenue increases.
Okay, all right. Hi, sir. Good morning. Good to see you, Ben. What can you guide us, though, in terms of a revenue growth for the year? The start has been in low single digits. What should we work with?
I think quarter on quarter we'll definitely see an improvement. And the whole year, I'm sure that we will see at least 15% improvement over the last year.
13% improvement. Got it. Yeah, what about, what is it?
13 to 15% for this year.
Okay.
And
all
next year, when with full capacity, I think we will see a very good takeoff.
So 13 to 15% this year, and next year, given that you'll have full capacity on stream and available, what should we work with? What is the aspiration?
Let's get to that. Definitely the aspiration is high. And
yeah,
yes, maybe we can talk about it in the last quarter of this year.
You led me to it, so I thought maybe you want to give me a number. But that said, you are facing some headwinds in the paracetamol API segment. Have things normalized over there? Demand is okay. Are you seeing an uptick now?
The demand has improved a little bit. There's a small uptick, but definitely not to the old levels. I think it's not going to greatly improve. There's a lot of capacity in the world today. People have increased capacities in India and China. And we actually have concentrated on more of PFIs and finished dosages of paracetamol. That's what keeps us going. But otherwise, APIs are not in great shape.
What is the revenue contribution purely of paracetamol API?
Oh, that'll hardly be about 10%. It's more from PFIs and FDs.
Got that. But this 10% is headwinded on account of excess capacity in the world. US was up about 7%, and that, I believe, is the company's largest market?
That's right.
Okay. So, I mean, what are you projecting from in terms of growth or numbers from the US? And considering this, you know, the expectation on tariffs on pharma under the Trump administration, your own view?
It's going to be, I mean, US, we do expect a good growth, but the tariff situation is a little unpredictable as of today. We don't know what's going to happen. However, the confidence we have is we are in generic market. The margins are at the lowest, and the competition, it's a level playing field for all companies. If today, if we have a market share, good market share, with the extra duty, which is equal for everybody, we don't see a dip in the market share. And also the customers have been very understanding, and definitely we are having talks with them, and we definitely are sure that we should be able to pass on the increases to the customers.
You know, this is not so much a question with regards to granules, but if there are, you know, farmers right now exempt, but there are these investigations under Section 232, which apparently are going on. At some point, we'll hear. What is the, you know, is it, what's the increase in cost that you will have to take? And, you know, even with those increase in costs, I mean, what are the difference? I mean, is it a factor of 10 as compared to what you make when you make in the US as compared to what you make from here and then export out? Could you give us a sense?
But if you make in the US, it's not a factor of 10%. I would say.
Not 10%. I mean, a factor of 10. I mean, you know, not 10%. So is it, I mean, would a 10-15% kind of tariff derail, you know, businesses like you who sell into the US at all? Or no, it'll be a minor speed bump?
For normal generic products, even at 25% rate of duty will not justify manufacturing in the US as of now. But for certain type of products, we have a manufacturing plant there. About 20% of our revenue comes from US manufactured products. And there we have a healthy margin because the type of products are different. It's mostly in the CNS and ADHD space. But normal generics still doesn't make sense to produce in the US.
And that's unlikely that is the attempt as well, right? Because, I mean, generally the conversation there has been to lower cost of drugs for Americans. So would you imagine that that's something which comes under, were they trying to do something there on generics?
Whatever the attempt is or whatever comes out, duties are only going to impact the American public, and the cost of healthcare in the US is going to go up.
Yeah, eventually the consumer is to pay. Thank you very much for joining us. Good speaking with you. Good luck with the business as you look ahead. So that is the overall picture as far as granules is concerned. A bit about the overall environment as well. Mitesh is back with us with what she'd want you to do in terms of specific trades. We're up 114%, 24,600 holding. Mitesh, what would one do?
As of now, today looks like a day on the positive side. On the index, as I said, I think we might head towards 24,750. Right now, I have one buy and one sell recommendation. On the selling side is Oil India with a stop at about 420. Look for targets of roughly around 400 on the downside over here. And metals are doing very well. So I have JSL as a buy call. Keep a stop at 712. Look for targets of 760.
Okay, all right. Thanks a lot for that, Mitesh. Well, in fact, yesterday we had mentioned as well in our morning chat that metals could be the space to look out for because there's some recovery in China, as well as we're seeing some weakness on the dollar index. And now the street is waiting by for some rate cuts as well. But talking about metals, we'll slip into a short break. Manisha is waiting for us on the other side. She'll tell us what's going on in the commodity space.
Okay, welcome back. 100 points on the Nifty, 24,600 still holding. Let's focus on some stocks which are moving. Honasa is up 10% in trade. Mangalam is here to revisit. He told you about the name right before we open, sticking on to gains. Mangalam.
It is sticking on to gains, and the street expects it to continue to stick on to gains because, despite, there being a weakness in terms of their summer portfolio, the revenues of the company grew 7.5%, which is higher than the industry on a low base, obviously. The EBITDA did not decline as much as the street was fearing. Brokerages were expecting around a 20-25% decline in the overall EBITDA, but here the EBITDA decline was contained to just about a 1% mark. Ad spends as a percentage of sales continued to hold that 34 to 35% sort of mark, and we had a net profit which saw a marginal growth year on year. What's good is that the underlying volume growth has come in at 10.5%. There has been a 200 basis points impact on sunscreen due to unseasonal rain. So if you add that back, the revenue growth would also be near double digits. The margins, while declined year on year, there has been a sequential improvement telling you that that trend may continue as well. There's a near 264 basis points improvement quarter on quarter. And focus categories, there are 7 categories in which the company is focusing on, which accounts for 80% of their sales. They've shown a double-digit growth already. And in the conference call, the management said that they aspire high teens growth in focus categories. And for FY26, they will expect margins, at 7% with 100 to 150 basis points improvement every year thereafter. Brokerages, they're positive as well. CLSA has written, on the stock, they've upgraded the stock to outperform a target price of 333. Jefferies too has upped their EBITDA estimates basis this beat by about 3 to 11%, and they have a target of 400. They say it's a high risk, high reward play, and currently it's high reward.
Thank you very much for that. The other big mover is Premier Explosive, exploding in trade, 14% up. Ria joins in.
Well, yes, Premier Explosives has been trading higher in today's session after reporting a very strong set of numbers in quarter one of FY26. Revenue up nearly 72% compared to the previous year. EBITDA has also gained around 35%, but remember the margins have contracted by around 400 basis points in this quarter. Net profit has more than doubled to rupees 15 crores this time around. The material cost to sales has also jumped significantly to about 66% versus about 41%. However, other expenses have dropped to around 9 crores versus about 18 crores in Q1 of FY25. Coming to the order book performance has also been very strong, up over 32% compared to rupees 750 crores at the end of FY25. Right now it's at about rupees 988 odd crores, with defense contributing the most to the order book at around 87% of contribution. And apart from this, the company has also approved a fundraise of rupees 300 crores. So all of these factors are leading to the gain in today's stock of over 14%.
Okay, that's a big move, right? Ria, thank you very much for that. I just want to quickly make a mention of Shakti Pumps. I mean, it was a big start. The high today was about 899. It's cooled off. I mean, just 3% left now. 862 or so after the big gap up that we had in that one. Commodities in focus now. Manisha is here with what's top of mind for her. Manisha, good morning.
Morning, and thank you for that, Prashant. I'm looking at the crude oil prices because we've seen constant declines into this one. Previous week was 4.5% of a decline, and we are trading in the negative in the Asian markets right now as well. So with that, it's trading at a 2-month lows. Various factors really which are weighing onto the markets. To begin with, it is about the US crude inventories, which have risen by 1.52 million barrels. This is as per the API data, which is weighing onto the markets. The second point really is the EIA numbers, which say that the US crude oil output will peak at record 13.4 million barrels per day in 2025, and 2026 the output is going to be lower than these numbers. The other point is from the OPEC report, which says that they are leaving the demand unchanged, but 2026 they expect the demand to gain up anywhere between 1 to 1.4 million barrels per day. The markets also are looking at the US Department of Energy, which also says that in 2025 the global surplus is estimated at around 1.7 million barrels per day. So clearly we are looking at higher production, higher inventories and a surplus as well. And then you also have optimism around the US and Russia meeting, which is on 15th of August. In the meanwhile, while there are not going to be any sanctions on Russia, we already have seen US imposing higher tariffs on buyers of Russian oil. That is something that the markets hopes will perhaps be corrected going forward. But quickly, I also want to share the outlook for crude oil prices now for the rest of 2025. A lot of reiteration and some revisions as well have happened here. UBS talks about 62. Remember, we're trading at around $66 to $67 a barrel right now. Not too many banks and brokerages believe that the crude oil prices will gain on from here on. Most of them expect this year to end on a lower note. So $62 a barrel coming in from UBS. Goldman Sachs has talked about 66 on an average. JP Morgan talks about 60 by the time it's ending this year. Morgan Stanley is talking about 62.5. ETO market says that 55 to 75, a $20 of a range, is something that's becoming a norm now in sense of crude oil prices in a matter of 6 months. And you could be looking at prices moving within that range.
All right, Manisha, thank you very much for that. Commodities in focus there. We're going to take a quick commercial break here. On the other side, our special segment, Market Masters. Latha in conversation with Ashish Gupta of Axis AMC on stocks, banks, bonds, and more. Stay tuned.
Welcome back. This is Market Masters, actually not so much economy, because the earnings season is drawing to a close and the Nifty is staring at barely a 5% growth in first quarter EPS. Year on year, it's flat. Just 2% year on year rise in the Nifty index itself. With tariff headwinds still very strong, how is the earnings picture going to look for the rest of the year? And of course, the market picture. Bond markets have actually done worse. Despite massive rate cuts, and the 10-year yield is actually 0.25% higher than it was in early June. So therefore, what are the prospects for both fixed income and for equity markets? We have with us Ashish Gupta, Chief Investment Officer at Axis AMC. Ashish, good morning and thank you very much for joining us. Ashish is also a master of the F&O market. He's also a very keen observer of the banking system. So time permitting, all those questions. But Ashish, first up, the earnings season is almost ending. Maybe one or two results to come. What's the sense? How has the season itself been? And what are the next 3 quarters looking like?
Oh, I think the earnings season has kind of somehow reiterated the trends we saw last couple of quarters. I think earnings have not disappointed too much, but the overall growth continues to be lackluster. It continues to be in the single digit. And actually, more than the earnings per se, I am actually also tracking what is happening on the top line. And actually, if you see the top line growth that we continue to deliver is only around 6-7% for the broader market. Of course, in some sectors, in some mid cap and small cap cohorts, you are getting still between 10 to 12% top line growth. But for the larger cohorts, you are actually continuing to see top line growth continue to stay at about 6-7%. I think this is reflective of what's happening in the economy as well. And I think one thing we underappreciate is that we actually live in the world of nominal GDP rather than real GDP, right? And while we focus on the real GDP numbers, actually now consistently for the last 4 years, we have been seeing a drop in nominal GDP, and that's kind of weighing on corporate earnings as well. And I think this is what's reflective. The slowdown in nominal GDP is reflected in your GST collections. They are, as you know, also down to about 6-7% growth. And I think the trend is quite clear. Right? So post-pandemic, I think FY22, we had almost a 20% nominal GDP. Right? Of course, we were coming from a low. And since then, we have consistently seen a drop in nominal GDP. Right, so from 20% growth in FY22, I think next year was about 15%.
Yes.
The following year was around 12%. Then last year we were sub 10%, and I think this year, or at least currently, we are probably around 8% or so. And I think that is something that is going to weigh on corporate earnings.
Okay. Well, just for those who don't like this kind of jargon, nominal GDP and real GDP. Real GDP is the actual amount of goods and services that the country produces more than last year. But then you have to add a price rise, then you get nominal GDP. The point is the price rise has not been much. Actually, wholesale price index has been negative year on year. That's why Ashish is complaining that nominal GDP has been bad. Actually, the number that will come out on August 31st for the first quarter, we may see a huge convergence of nominal and real GDP. Okay, I take your point on that, Ashish, but the useful point in the result season has been the performance of the mid-cap segment. We've seen some standout performance. I'll just read out from a report I have, and I'm reading EPS, earnings, not top line, as you say. See, cement is up 35%, obviously because of base reasons as well. EMS, up about 46%, logistics 20%, healthcare about 11%, real estate again 40%. So do you think that we are looking at the wrong place? We are all used to looking at the Nifty and the big stocks. Will midcap deliver as good and better for FY26?
So I think there's no doubt that there are certain pockets, and actually it's some of those pockets are reflected even in the large cap, maybe not in the Nifty, but if in the Nifty next 50, where instead of single-digit top-line growth, you are getting double-digit top-line growth. So if you see that cohort, you are getting instead of 6-7% top-line growth, about 11-12% top-line growth. And in some of the sectors, like you mentioned, cement, real estate, hospitality, you are actually continuing to see a 20% plus kind of earnings growth. What we also have to keep in mind is that expectations are also similarly high for those sets of companies and those industries, right? And if you look at the average multiples that these companies are trading at, that's literally at a 60-70% premium to what the Nifty is trading at. So I think, yes, some of these have delivered. And actually, the good news is that we have not seen an increase in the misses in earnings. So what first quarter delivered both for the Nifty companies as well as the broader set of companies was largely in line with expectations. But the fact is that for the broader market, we have seen only a single-digit earnings growth.
Okay. So therefore, if you can give us some forecast for the year, we have the tariff headwinds. Now, the best case scenario has become if we are back to 25%. You know, that 50% is such a complete embargo, as the Gokuldas exports gentleman pointed out. It's a no trade zone. So what is a working number? I know it's a difficult question because it's such a mercurial position we are dealing with. But what kind of earnings growth can we look at in the Nifty next, as you call it?
So I think we should not, at least for the earnings growth perspective and short-term earnings growth perspective, really focus too much on tariffs, right? So fortunately or unfortunately, we don't export much to the US, right? So our merchandise exports are only 2% of GDP. There is some carve-outs as well out of that. And on top of that, if you take out the piece of value add, so the impact on GDP will not be material. Of course, there will be some sectors and companies like textiles, as you mentioned, that may see a larger impact. But for larger corporate India, it will not be material. I think of course, it's a challenge for us because we were actually hoping that there will be a huge opportunity for us as a country to develop as an alternate manufacturing base, and some of those plans may come under cloud. But for earnings per se, I think what is more important is what's happening on the domestic economy. Given all the liquidity infusions that we have had and drop in interest rates, do we see a revival in domestic growth? Yes, and consumption has been weak. We have seen, fortunately now for 3 quarters,
Ashish, you know, I'm sorry, I'm going to interrupt because I'm going to pack in so many questions. So just tell me, what sectors will Axis AMC bet on in this mid-cap space where we have seen growth?
Sure. So we do like real estate. We are actually seeing on the real estate side, the commercial cycle actually continuing to strengthen. We like still capital goods space, and if you see earnings delivery among companies such as power equipment manufacturers continues to be very good. We like healthcare and hospitality, travel sector. So there are the whole host of sectors which continue to do well, and the growth rates here are significantly better. Similarly, on the consumption side, while aggregate consumption trends have not picked up still, but you actually still see market share gains for retailing companies. You see for quick commerce companies, consumer tech companies.
Yeah, take your point. All those, we were just discussing Nykaa numbers looking very good. So quick commerce, consumption, all doing well. Let me cut to a topic which I used to interview you frequently in your previous avatar. ICICI having this higher minimum balance. How do you look at it? You know, do you think that there is going to be an elite versus mass, classes versus masses kind of division in the banking sector itself?
I think the fact is that banks also have this challenge of providing high quality service, right? And I think both because of the customer's expectations, as well as the fact that the regulatory burden on the quality of service being provided is increasing. In fact, if you look at banks in India, the kind of services they provide for the fee, including real-time transfer, I think that is unparalleled anywhere. So I think in some senses, it is fair for banks to kind of look at cohort of customers where they can meet the customer's expectations and
Okay, I take your point on that, but I think I'll have to invite you for 3 separate discussions because I have 3 separate areas to ask you. Finally, leave us with what we should expect in the F&O space. There is some speculation that weekly will give way to fortnightly. Is that a solution to the somewhat recklessness that we saw in the weekly expiries?
So I think what SEBI has done is really act on 2 fronts, right? So one is on the regulatory side, and then it found some potential mispractices in the industry. So it has come out and used its supervisory powers to clamp down on some of the practices. I think there have been multiple regulatory actions taken between October and March, and some of them will continue to get implemented over the coming months. The good news is that we are seeing some tempering down in the volumes and activity in the F&O market. So my sense is SEBI will probably wait to see what is the impact of these measures. And if these measures don't prove effective, then it will come out with the next set of measures, right? But as of now, the first 2 sets of measures are still being implemented, and at least directionally, it is showing an impact on the market.
Okay. Thank you very much, Ashish. That's some kind of hope for, the market intermediaries more than anyone else. BSE will be happy if it continues with that expiries. It's a money spinner for them. We have to wrap up on Bazaar, not because we're run out of questions, we're run out of time. Thank you very much for joining us. The market's actually surprisingly positive today. And let's hope it continues like that when Chartbusters comes up after the break.
Apollo Hospitals is the top Nifty gainer, up 7% after strong first quarter numbers beat expectations. The management also tells CNBC-TV18 that they are also on track to add 500 beds in 4 new hospitals by the end of FY26.
And Hindalco surges in trade on the back of a good showing in the first quarter, where copper as well as aluminium business beat estimates. The managing director Satish Pai will join in shortly to discuss the first quarter's numbers.
Paytm rallies as the RBI withdraws merchant onboarding restrictions which were in place since November 2022. Brokerages Citi and Bernstein also issue bullish calls on the stock.
Wellness and beauty brands Nykaa and Honasa Consumer surge on strong showing in the first quarter. Both companies register strong volume growth. Honasa's margin also improves, while Nykaa's beauty business registers strong growth.
Landmark Cars too delivers strong revenue growth in the first quarter, driven by new fast-growing brands. The stock higher by 6%.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangala, and the markets have made a good start. We're up 100 points in the first hour of trade itself, but yesterday around this time is when the markets lost its way. One notable underperformer is the Nifty Bank. It's been underperforming for the last few trading sessions, and it continues to do that as of now. So the markets need to scale higher. The Nifty Bank needs to find its form. Hey, Mangala.
Take that point on the frontline index, Nigel. You know, yesterday's high would be an extremely crucial mark to watch out for on the way up. But the good part about today's trading session as against yesterday is the advance decline is far more in favor of advances than decliners in yesterday's trading session. Towards the end, we saw both the red and green lines come very close to each other. Today, they've maintained that distance. It looks like it is a railway track with the green one being much above. So parallel, almost 1,700 stocks in the green for about 900 stocks which are in the red. Indian Hotels, a notable gainer over the last few minutes, currently at the high point of trade. And we are seeing some traction in names like Aarti Industries, Strides Pharma and Uno Minda as well, which has just spiked in the last 10 minutes or so. So Uno Minda also comes up for you on the screen. The first conversation on the show today we have lined up for you is with All Cargo Logistics. The company witnessed a weak operational performance in its June quarter. Profitability was impacted by forex loss and overall revenues were fairly subdued as well. Not unperturbed out here by this because the street was already prepared for that. The stock is down 5%, but remember Ravi Jakhar, who's the Director, Strategy and Group CFO, had told us earlier that the next couple of quarters would be subdued given the sort of problems that we are seeing internationally. Ravi, thank you so much for joining in. Now that the next couple of quarters have been subdued as you had promised a couple of quarters ago, do you see signs of improvement? If yes, then what's the kind of volume growth you are likely to see in both your domestic and international business? And if you could break that up into less than container load and full container load volumes for this year?
Yeah, thanks. It's always a pleasure to be on your show. And, talking about the business performance, we have two parts to it, the domestic side and the international side. On the domestic side, there are no problems on the macroeconomic front. The country has been doing well. The trade has been going up. And as an outcome of that, if you look at our numbers closely, we have reported a 50% increase in revenue year on year for our contract logistics business, and which is also translated into almost 30% increase year on year in the EBITDA. For the contract logistics business. Express business has also seen about 18% increase in EBITDA over the last quarter. So on the domestic side, businesses have a good momentum. And particularly on the express logistics, I would say we are seeing that the business is picking up traction now. We had kind of changed the management team about a quarter or maybe about 4 months ago. And we are seeing a good outcome of that. In the months to follow, you would see that positive momentum reflect in the revenue growth as well, which has been kind of muted if you see the last 2-3 quarters. So contract logistics business has been doing fantastic throughout last few years and remains on the same trend. Express logistics also picking steam. On the international business side, while the company-specific initiatives have all been good, the macroeconomic environment, as I indicated, has been quite challenging. Now, if you look at the coming quarter, this is a quarter which leads to festive demand. People are shopping for Christmas, and before they start shopping, inventories are stocked up. So as an outcome of that, you would see a stronger quarter, July to September. But I would say that, even a stronger performance in July to September does not necessarily warrant a continued momentum. For the continued momentum, we need the geopolitical instability, the entire tariff conversations to stabilize And that's something which we would know in the coming 2-3 months. We have these 90-day and 60-day deadlines with various countries. So I would say, in short, the next quarter is going to be good for the international supply chain, primarily driven by the festive demand. You could see up to 8 to 10% higher volumes quarter on quarter, which would significantly impact the profits as well. But for that momentum to sustain and profits to really grow, we would need to see more certainty on the global geopolitical environment and the whole tariff discussions.
Yes, this entire tariff tantrum has put the entire globe into a bit of a tizzy, so it becomes a little bit difficult. But you mentioned that number 8 to 10%. That's the volume growth you're likely to see in both LCL as well as FCL. Is that the number you've given us?
Yes, that's the broad number for this quarter. On the back of
that's quarter on quarter for the second quarter, right?
Yeah, that's right. Yeah,
and
quarter over June quarter.
For the year, what should it look like then?
Like I said, in the current environment, we have seen weekly changes. There was a week in which, for 2 consecutive weeks, the China-US trade dropped by 80%. And the next week, which was up 3 times, right? We have seen in the recent times our Brazil to US trade had, significant downtrend. So, the patterns are so volatile, it is difficult to predict beyond weeks. But as of now, as we look into, July and August and a bit into September demand as well, these 3 months looks good. And therefore, like I said, we should see an 8 to 10% momentum on the volume uptick on the back of the festive demand.
Right. You have near-term views, but nothing to do with the long-term because uncertainty is still underway right now. What about margins? EBITDA ex Forex in your international supply chain division was down from 2.5% to 1.6%. It's a business where you anyway have wafer-thin margins. And on top of that, there is, the Forex element, there is this international geopolitical uncertainty, etc. What is a sustainable margin run rate that we can expect in a business like this?
Yeah, so as far as the Forex part is concerned, that is notional. Let me explain to you very quickly. What happens is that, we have our main global holding company in Belgium, which reports in euro, and it gives intercompany loans in US dollars. And they need to be valued, quarter on quarter because of the accounting standards. Now, if you see the long term, over the last 5 years, euro to USD has only changed by 1.8 or 2%. But this was an extreme quarter where it changed by almost 9%. At the same time, we're also reviewing if we can change some of the accounting policies to eliminate these notional gains or losses because, they create unnecessary fluctuations in the reported earnings. So we're also evaluating that. Having said that, from a business standpoint, you may recall that our gross profits are largely dependent on the volumes. And if you see the recent trends are actually gross profits have gone up. Margins may not be the real indicator because revenue may go up or down based on the freight rates. But if you look at even this quarter, the margins have actually gone up. The gross profit has actually gone up. And that is not driven necessarily by the business performance. A part of that is also because our local charges that we earn in European countries have also gone up as the euro became stronger. But corresponding to that, the staff costs and the administrative costs in Europe also went up. So you see slightly higher gross profit than what should have been normally reported. You see slightly higher SG&A costs, and therefore the impact on the EBITDA from the euro perspective is neutral. There have been some, variable annual pay outs, etc. But from a long-term perspective, I believe that we can, look at 6 to 8% growth in volumes, which should compound into an equal growth in gross profit. That's what our estimation is based on assuming some settlement on the whole tariff debate and the trade normalizing a bit. And with that, translating into GP, SG&A remaining flat, we believe that could have a significant operating leverage on the profits. And that's what is the broad strategy we are working on, trying to retain the costs at the current levels. There could be some one-off movements here or there on account of annual payouts, but largely, I would say we're not focused on quarter to quarter at this point in time. It could still be a couple of quarters of reorganizing, outsourcing, trying to see how we can rebalance our cost structures. But in the long term, if I look at the full year 2026, and we operate January to December on the international business, I would say we're reasonably confident that we are in control on the cost side, and some momentum on the macroeconomic environment should put us in the right spot. And on the domestic side, like I said, the business is already performing well.
All right, take that point, Ravi. Thank you so much for joining in. Wish you good luck. Hope to speak to you once things are better. But for now, the near-term visibility that you have is 8 to 10% volume growth in the second quarter. Take a short break. On the other side, we get chatting management of Hindalco post their first quarter earnings. The stock zooming in trade.
Welcome back. Well, a few stocks actually are moving quite well in today's trading session. Just pull up JM Financial. The stock is now locked. It's up closer on 10%. So big move is what we're seeing on that particular name, and volumes as well, very, very large. I think we should get the intraday chart on that name up for you on the screen. Another one that's moving well is Eternal. That's spiked up to the high point of the day. So good move is what we're seeing on that name. The one that's struggling actually today is Jupiter Wagons. Just take a look at that stock. It's moving lower, and from the word go itself, it's seeing some kind of selling. And the other big listing that we saw was Lotus. On the day of listing itself, it moved, I think the IPO price was 150 rupees. It went all the way to around 180 on day of listing, and in the consecutive days, it went all the way to around 220 rupees. But from there, actually, it's seen some kind of profit taking. We're talking about Lotus Developers, the real estate company that has presence here in Mumbai. I think the intraday chart should come up for you. Someone has, suddenly pressed the exit button on that particular name. Lotus Developers should come up for you. And Jain Irrigation is another stock that's spiking up as well. At some point of time, some of these stocks should come up for you on the screen. Well, the other one that's doing well actually today is Hindalco. As we told you yesterday, the numbers were quite good, though the problem is with regard to the Novelis business. Novelis business has been under some pressure. In fact, I spoke to the managing director, Mr. Satish Pai, and started off by asking him about the tariff impact in the second quarter on their Novelis business and how is demand shaping up. Let's listen in to what he had to say.
The point was about Novelis's quarter. So when I look at the Novelis business, a couple of things have started to be tailwinds. First, the scrap spreads in the US especially have started to improve, which will be in the second quarter and the second half of this year, a positive tailwind. Other steps that we are taking to reduce the cost, our structural cost adjustment program is actually going well ahead of its time. So I think the other part, as you also rightfully mentioned, the end markets are very strong. The can market actually grew by more than 10% year on year. So a combination of strong market demand, scrap spreads improving, as well as structural cost reductions that we have put in place, give us the confidence that Q2 will be more or less equal to Q1. And then in the second half of the year, the steps that we have taken to bring back more production capacity to the US will help us deal with the tariff issue as well.
All right, Mr. Pai, but if tariffs stay at current levels, should we rule out you going to around $500 per ton in this fiscal year, or do you think there's still a possibility?
No, as I said, the remaining tariff issue for us really is the volume that comes from Canada. In the second half of the year, we will move that capacity through various measures we are taking into the US. So even if the tariffs stay in place, we believe that the second half of this year, we would have mitigated the tariff impact.
So $500 per ton is a possibility still, is what you believe. That's an aspiration.
We will be certainly moving towards that target.
All right, got that. So that's about the Novelis piece then. Let's come back to India. The aluminium business continues to stride ahead, and you're doing closer on $1,450 to around $1,500 per ton in the aluminium business. You have some quantity that's also hedged, but do you think that you can continue to hold on to these levels either in the absolute term of 4,300 crores or in a per ton basis? Is it sustainable, the India aluminium business?
I think that the fundamentals of our business in India are very strong. We run a very sound operation with good control on our cost. Operating efficiencies are running very well. So if the LME stays north of 2,500, which it is today, and the coal costs do not escalate, the Q2 will be slightly higher than Q1 because it's the monsoon season. But overall, I think that the current levels of profitability are sustainable. The big caveat I'm giving again is that LME should be north of 2,500.
All right. And what kind of LME prices you're working with? Since you have a lot of uncertainty with regard to Trump's tariffs, but the hope is that China as well will pepper their economy, which in turn could help metals on the whole. So what is the range we should work with?
So look, the very clear thing that is coming out is both aluminium and copper, the two metals that we are dealing with. Supply and demand is very tight, and the end market demand for aluminium and copper is also extremely strong. So if you can see now, both the metals, the prices are holding firm. So for LME, we are working, as I said, with a range of around $2,400 to $2,600 per ton.
Got it. Copper, in the past, you've said that we should be working at around 600 crores per quarter. But this quarter as well, you went ahead and surprised the street at around 670 crores. What's it? Would you like to up that guidance from 600 crores per quarter?
See, the copper business is a very varied value chain. So there are many moving parts that go up and down. So I think the 600 guidance was given so that there is a base to what you can expect since TCRCs are dropped. But it will be 600 to 600 plus is our feeling.
Okay. Despite undertaking a big capex at Novelis, your absolute debt number actually has cooled off. That was a pleasant surprise. Where is that number headed from here?
Yeah, see, the Novelis debt numbers and the Novelis net debt to EBITDA, we have always guided in the next year or so as the Bay Minette project goes through its completion. The net debt to EBITDA will go up to about 3.5 and then start to come down. I think when you look at the consolidated balance sheet, the net debt to EBITDA is at 1 because in India, we are sitting on a net cash of around 11,000 crores. And the India business is generating a lot of cash. So hence, the consolidated balance sheet will remain very strong. And I think this year, our net debt to EBITDAs will be around 1.
Okay. All right. And what is the capex plan, sir, just to revise that you have laid out for this year and break it up between India as well as Novelis?
So in Novelis, it will be around 2 billion with the Bay Minette project that is ongoing. And in India, we are saying about 7,500 to 8,000 crores, so about $1 billion.
Okay, all right. Well, that's Mr. Pai sounding extremely optimistic on prospects of Hindalco from here on. For the India business, the aluminium EBITDA can hold around current levels provided aluminium holds above $2,500 per ton and coal prices are subdued. For copper, the EBITDA number should hover around $600 on a per quarter basis, while Novelis, he's calling out that the past quarter, there's a basing out process in terms of EBITDA, and things will improve, particularly in the second half of the year because of the cost focus that they are doing. And in fact, he believes that gradually that EBITDA per ton number for Novelis will start moving towards $500 per ton. So explains why the stock is doing quite well. It's a tailwind as well with regard to the Fed probably cutting rates in the month of September itself. Slip into a break, come back, continue our focus on markets. Don't go anywhere.
The last few minutes belong to the pharmaceutical space. Just look at Cipla. That's moved higher to the high point of trade. Giving it company at the higher end is Devis Labs. And alongside that, we have Dr. Reddy's, which has moved higher as well. Sun Pharma too, over the last few minutes, has moved higher. So the entire pharmaceutical pack has seen a bit of a spike. This weekend, there is that big meeting between Donald Trump and Putin. Let's see whether that yields any sort of improvement or certainty on the tariff side as well. Be that as it may, there are always ideas for profit. And this one comes in from our colleague at Money Control Pro. Sachin Pal joins in with the stock. Sachin.
Crompton with Consumer Electricals delivered a muted financial performance in the first quarter of FY26 with a revenue decline of almost 7% on year-on-year. This was primarily attributed to the early arrival of the monsoon seasons, which really impacted the sales of its summer products in the quarter gone by. In the ECD segment, which contributes almost 75 to 80% of its revenues, the company witnessed a revenue decline of almost 8% year, primarily due to weak sales in fans and other summer-focused products. On the other hand, the solar pumps as well as the small domestic appliances continued strong momentum and witnessed a robust growth on a year-on-year basis. The other two business verticals, which is lighting vertical as well as the Butterfly Ganimati, which is the kitchen appliances vertical of the company, witnessed a stagnant growth in terms of top line year-on-year. The margins in both these verticals were stronger on a year-on-year basis, which really had a positive impact in terms of overall profitability of the company in the quarter gone by. In terms of the balance sheet, the company has achieved a net debt-free status and is currently running a cash positive account, which really paves well for further expansions as well as market share gains. The company remains well positioned, and the quarter gone by has been primarily attributed to the weather disruptions, which is expected to normalize in the next 2 to 3 quarters. The company remains well positioned in terms of the growth revival, and the stock has also taken a beating, which factoring most of the negatives associated with the business at this point of time. It is currently trading at almost 33 times 1 year forward earnings, which we believe is very reasonable for accumulation from a long-term standpoint.
Sachin, thanks a lot for that. With that, we'll wrap up on this edition of Chartbusters with an all-green screen at the top of our heads. The Nifty Bank, mild underperformer, but still in green. Take it to the team of Trading Hour to hold the markets higher.
Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Hormis Patakia and Reema Tendulkar. A green-looking screen after markets ending at the day's low yesterday. It's a 100-point uptick on the Nifty currently, and it's led by metal index, auto consumption. Actually, you name it, most of the indices are in the green today, but metals definitely supporting what we are seeing on the index level as well. Nifty, FMCG and IT, they are in the red currently, but the kind of gains that we are seeing across the board, be the mid-caps, which is up 0.6%, be it the Bank Nifty, which is up 0.1%. It's an overall uptick that we are seeing across the board. Above 24,500 mark, actually very close to 24,600. We'll have to see whether things remain this way or we will see some changes when it comes to overall market moves towards especially the last hour of trade.
Indeed. And what also helps is the good earnings reaction, right? Like in Apollo Hospitals, Hindalco yesterday, but you can see the stock reaction today. Honasa, Nykaa, Premier Explosives, so many. But we've got an action-packed 1 hour coming up for you. So let's tell you. First up, we get chatting with the management of Senco Gold on the Q1 earnings. In our special segment, Crypto Corner, Manisha today puts the spotlight on real-world asset tokenization on blockchain. And the big story of the day, we'll put the spotlight on Nykaa, Honasa, both the big movers of the day. We'll decode the rationale behind the move, the key triggers, the valuation picture, a complete deep dive into the business models and the financials of these companies. A little later, 11:30, the management of Jupiter Wagons. And finally, on the show, we'll also be joined by the management of SmartWorks co-working space. So it's a power-packed trading hour. And straight away, let's go across to Hormis first to begin the show with the top buzzers.
Since you mentioned earnings reactions, those are the ones that are hogging the limelight today. First up being NMDC Steel. Of course, it was the first ever profit that the company has delivered, the demerged entity of NMDC. This is the biggest single day gain on record that the stock has seen, now 19% higher on the stock. We have had almost 4.5 crore shares traded compared to a 20-day average of just 5.5 lakh shares. The Archean Chemicals is the other one. That's not an earnings reaction, but it's the third straight day of gains. This is the biggest single day gain that the stock has seen since January of this year. Is now up 7%, was at one point up around 10.5, but we have already had 17 lakh shares traded compared to a 20-day average of 50,000 shares. Its unit has received the cabinet approval to set up a semiconductor facility in Bhubaneswar. Windlass Biotech is the other positive earnings reaction. This is the biggest single day gain for the stock since February of this year, 13.5% higher on that stock. And take a look at the volumes here as well. 3.5 lakh shares already traded compared to a 20-day average of just 30,000 shares. And from the stock listed at a discount, it made a low, and from those lows of June 2022, the stock is up 5x, and from its IPO price of 460, the stock is already up 2.5x. But to round it off, balancing it out, Aarti Pharma Labs on the downside today. This is the biggest single day drop since April of this year. It snapped a 3-day gaining streak yesterday, and the stock fall also comes on the back of strong volumes here. 6 lakh shares already traded compared to a 20-day average of around 75,000 shares. Back to you guys.
Thank you very much for that. Let's straight away go across to Senco Gold. Stock is surging on the back of a strong set of Q1 numbers. Top line growth at 30%. EBITDA margins have come in at 10%. We have with us Suvankar Sen, MD and CEO. Mr. Sen, morning. This is Reema here. You had guided for about an 18-19% revenue growth for this year. Now, Q1 has been strong, 30% revenue growth, and Q2 is the festive season, Q2 onwards. Can you up your guidance for the full year? What is FY26 going to look like? And what led to the margin expansion to 10%? And can you hold on to it?
So, thank you very much, Reema. The whole objective is that, we have the whole year ahead of us. And in terms of the guidance, we will continue to guide everyone with around 18 to 20%. But now that the Q1 has performed so well with above 30% of growth, I think that achieving 20% should not be an issue. We also need to look at how, we are looking at the numbers as Q2 is in progress and the festive season, in effect, has already started. Dhanteras, Diwali, these are all coming in October, which will be in the beginning of Q3. So I think that, Q2 will have a mixed kind of a reaction with the Shraddh period in the middle. But then the pickup will happen again back to Q3. So I think a 20% is a reasonable target and a reasonable expectation for every one of us. As we cross Q2 and move closer to Q3 end, I think we will be in a better position to guide everyone if there is any kind of an increase. And the reason for the profitability that has gone up, there are basically 2 to 3 reasons. Majorly, what we have seen is that our diamond jewelry sales, that has increased largely. Our charge ratio, which was about 9.9 in the last year, 9.9%, has moved up to close to 11% back again. At the onset of this high gold price, people are moving on to buying more of diamond jewelry, and we've seen a 54% growth in terms of sales of diamond jewelry compared to the previous year's quarter. So that is how we are looking at the consumers. They are saying that now gold prices have moved up so much. Let us look at 14 karat, 18 karat jewelry or diamonds studded with those 14 karat and 18 karat jewelry.
So
And now
that
we
was
have also
exactly.
seen.
Yes, that's exactly was going to be my next point, because gold prices are at a record high yet again, Mr. Sen. Is this something which is keeping you a little conservative on the revenue growth side? 18 to 19%, you're saying you'll do 20% when you've already done 30% in Q1. And what does it do with diamond sales growth? 30% already in Q1. Will you be able to do better than 20 to 25% growth that you had guided for earlier? Ultimately, what does it mean for your margins?
So see, with the higher increase of diamond jewelry sale, obviously the way it has impacted in Q1, the margins will be on an upper side and it will improve. But then, what we saw in the previous financial year was that the mood of the consumer toward diamonds were a little lesser, but the mood is changing. We saw it in Q4 of the last financial year. We are seeing it back again in Q1 and Q2 also. The mood of the consumer towards diamond continues to remain robust. Now 9 karat has also become a part of the hallmarking scheme. So that will only allow the jewelers to provide more lightweight jewelry, which will be affordable, studded with diamonds. And I think that, yes, the festive season is there. But on top of that, what we are more positive about is the wedding season. So in the summer months, we this time never had that many weddings. But post Diwali, Dhanteras, November, December, January, we will have the number of weddings increasing. So I'm sure that, the consumers are just waiting for the right price. Once they realize that, yes, this is the price and the prices will move up further, or there is any kind of small correction, I think consumers will come back to the stores in big numbers and start buying again. Bit mood and the respect towards the commodity is very much there from the consumer side.
Multiple positive triggers that you are highlighting, Mr. Sen, but does that be a fair assumption that 6.8 to 7.2% EBITDA margins for this year is an achievable task? Or maybe considering the optimism that you are highlighting, maybe you would want to go to 7.5?
See, I'd rather say 6.8 to 7.2. And I don't want to, make everyone very euphoric. But let's be positive. And I think 7% plus is always a good number, which looks achievable with the current situation that is going right now. And one more thing, I would like to add on to this particular thing is that the monsoons have been good. We are already seeing that the rural market demand is picking up. And I think that, volumes is the only thing that one needs to look at. Volumes have taken a hit. The ability to buy that much quantity of gold for an individual consumer has come down. So we saw in Q1 the volumes of gold getting hit by 2.5–3%. If you look at the YTD numbers, it's down by about 10–12%. So yes, we have to make lighter weight jewelry, make it affordable for the consumer. And I'm sure that they will come back and keep buying gold and silver and diamonds.
So this 10% EBITDA margin, I understand you're holding on to your margin guidance, but this 10% in Q1, other than a higher contribution of diamond sales, studded jewelry, is there any other reason what led to that?
If you remember in the last, interview that I gave on CNBC, our hedge ratio usually stays at about 75 to 80%. But we kept the hedge ratio lower at about 55 to 60% for this particular quarter. I think that lowering of hedge ratio has allowed us to take a little bit of a benefit of the increase in gold price, and that has led to a little bit of marginal impact and positive impact on the overall EBITDA numbers for the Q1 as well.
All right, Mr. Sen, thank you so much for joining in and telling us what we're expecting from FY26. So the start of festive season, that could aid earnings, where there could be Shraddh at the start of Q3. The management is holding on to their revenue growth and margin guidance. Let's slip into a short break. When we come back, we'll put focus on the crypto market with Manisha Gupta on the other side.
protection. CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back on Crypto Corner. Today we are going to discuss about the real world asset tokenization. Well, it's an interesting market. It has been going quite strongly as well. So when you look at the overall market, it is 25 billion worth of market at this point in time. It has been growing quite strongly. If you look at the last 3 years numbers, it has grown up by 380%. Well, what is tokenization? I'll start with that first of all. It is the process of creating a digital representation of a real-world asset on a blockchain network, and it has been going on for the last many years now. It's just that in the last 3 or 4 years, it really has taken quite a strong lead. Now, what it does, it allows people to own smaller, more affordable portions of high-value assets. I mean, this could be large properties, it could be commodities, piece of art, etc. It does allow fractionalization or tokenization. Now, the distributed ledger technology enables assets to be easily broken down in smaller pieces is what it does. What we can do is, as I said, it can lead to larger things that can be held in sense of buying, selling, holding and trading asset classes. And the blockchain records this process completely. It does ensure that there is credibility to this and it is easily available as well in sense of records. Now, this can be done in sense of real estate, art, commodities, paintings, bigger assets, collectibles, company shares, mutual funds, you name it, and the real-world asset tokenization is being done quite strongly by various companies and countries as well. Just to name a few, Dubai clearly seems to be taking lead in this, and then you have BlackRock and Libre leading into this trend at this point in time. Interestingly, when you look at on where this market can really go, there is a forecast from McKinsey suggesting that it could be a 2 trillion of a market by 2030. BCG talks about 16 trillion by 2030, and StanChart in a report says that this could be a 30 trillion market by the time it's 2034. Now, let me break it down in sense of an example to you. Imagine that there's a property worth 50 lakh rupees. The owner aims to raise 5 lakh rupees. The owner does not want to sell it, does not want to put it out as a collateral as well. So what the owner can now do is, under RWA, he can tokenize this and convert it into ownership of a property into 50 lakh tokens. Now, what this does is it allows the owner to raise money by giving a tokenization or a fractionalization of its property as low as 0.0002% perhaps of its property ownership to another person. And many people can basically come in for this. Just to give you an example in sense of the Indian markets as well, imagine there's a student in Ahmedabad who can invest in a tokenized portion of a tech startup in Bangalore, which he wants to be part of. And then it also could be a fish business in Kerala who wants to own a portion of a cold storage business in Maharashtra. It could be you or me who wants to own a small portion of a yacht or a plane. That can be done by the way of tokenization in the markets. Okay. Well, with that, let's go for a short break, but more news and updates follow on the other side.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. Still 100 points higher on the index and 100 points away from yesterday's high of 24,700. Mitesh Thakkar joins in for a quick chart check. Mitesh, you still have the legs to go and retest yesterday's high. What's your call on the index now and your stock recommendations for the morning?
Good morning. So on the index, there's a good chance that we might actually get back to the upper end range, which is just above yesterday's high. 24,750 is what I've advocated as the level to watch. I think we are still in the process of making a choppy consolidation at a bottom around 24,400, 350 zones. And around 24,750, you might see some supply. We might consolidate for a few days in this range, but eventually then, there's a stronger chance of a reversal happening. So in that sense, I think I'm positive. On the stock side, I have a buy on Jindal Steel. In fact, metal as a pack is doing extremely well. Jindal Steel is a buy at the stop at about 1,002 for targets of 1,050 to begin with. Eventually, we may look at higher levels over here. And the other stock which is covered by that is Hindustan Zinc. Buy at the stop below 424.5. Look for targets of 442.
Thank you very much for that. Now let's get a handle on the latest trends from the futures and options space. Manglam joins in.
Well, it's been a good day so far for the frontline index. If you look at the Nifty as well as the mid-cap index, both of them trading higher levels. The Nifty Bank is actually a bit of an underperformer in the sense that it's not gaining as much as the other indices are. But then there's no problem for the Nifty there because we have the metals index, the autos, as well as the pharmaceutical index, all these sectoral indices leading the Nifty higher, though there is absence from the Nifty Bank as well as the Nifty IT index. So two heavyweight indices are actually not performing in today's rally. The broader markets would have your portfolios feel a lot better today than yesterday. The same time yesterday, the Nifty was close to 24,700 mark. We still had more stocks there was an even keel of advanced decline. Right now, if you look at it, there has been almost 1,800 stocks which are in the green for about 1,000 stocks which are in the red. Those lines are fairly, distant through the course of today's trading session so far. Where do we go from here? That's the big question, right? On the one hand, there is support at the 100-day moving average of the Nifty, which is 24,531. We're slightly above that. But for us to see further short covering, the Nifty has to cross yesterday's high of 24,703 as well. And there are a lot of shorts in the systems. The FIIs actually are just 8% long and 92% short. So if we do cross past yesterday's high, we will perhaps see some short covering ahead of weekly options expiry tomorrow. And then we have the Nifty Bank, which is the 100-day moving average around that 55,000 mark, which is seeing a lot of support. For the Nifty is the 24,600 put, which is extremely active in today's trading session. Put writers believe that around 24,550 thereabouts, there could be some support coming in. The 24,600 call writers haven't given up hope either. They're saying that yesterday's high could act as a bit of a resistance. So 24,670, 24,700, as we move towards that area, we could see some supply. So 24,550 to 24,670 is the broad range that the street is working with ahead of expiry. A couple of stocks on our radar. Alchem seeing a lot of long positions being added for second day running. And we have fresh shorts added on Suzlon. The company reported their numbers. There's been a big 27-28% jump in open interest on the short side here.
Okay, all right. Take that point. Thank you so much, Manglam, for joining us with what's happening in the F&O space. Let's take a short break. Up next, we'll be joined by the management of Jupiter Wagons to discuss their Q1 earnings. Welcome back. You're still tuned into Trading Hour, and this is our special segment, The Big Story, where we highlight key stocks with themes and deep dive into their financial and historical performances. Today, we have Mangalam joining us. Mangalam, tell us first up, what worked for Honasa and Nykaa this quarter? Look at the moves on those stocks.
Yep, incredible moves that have come in on both Nykaa as well as Honasa, both new age beauty companies, beauty wellness, some beauty and personal care sort of companies coming in. Let's start with Honasa. You know, the revenue growth picked up post the last 2 quarters, which were a disappointment as the company was, rationalizing their offline dealer inventory. The overall revenues, they grew 7.5% despite a 200 basis points impact on their sunscreen category. Remember, this time there was a short summer on account of the unseasonal rains that happened, and that impacted their overall revenue by about 200 basis points. Add that back and there'll be a near double-digit growth. And we've also seen the margins improve. Yes, year on year there was some drop in margins, but that was a lot less than what the street was working with. And quarter on quarter, there was a near 300 basis points improvement in the margin. So after 2 quarters of weakness, there are signs of recovery in Honasa, and that's what the street is betting on. On Nykaa, 2 things stand out in particular. One, beauty, which is the mainstay of the company, continues to do well. 24% revenue growth, 32% EBITDA growth. So out there, the margins have also expanded in the mainstay of the company. The second part, which is the fashion business, which wasn't growing as well, has now started to show some signs of growth. And there as well, the EBIT loss has declined. In fact, the EBITDA margin loss has declined by about 300 basis points. And their own brands, which have the highest margins in the overall business, House of Nykaa, their gross merchandise value has actually grown by 70%, which is a lot more than the company's own guided range of 30% CAGR over the next few years. So all these factors working for both Nykaa as well as Honasa.
So, Mangalam, this is one of the reasons, the fundamentals, right? In the case of Honasa, 2 subdued quarters, and now this quarter they've shown a strong performance. But, we're seeing a big move, 10% on Honasa. Nykaa right now is up 4-5%. How do the valuations stack up? How has the historical share price performance been?
So, historically, Nykaa, had been a bit of an underperformer post-IPO. Thereafter, we saw big surge, big drop. They've been fairly volatile. Now, there is some element of predictability coming in on Nykaa, and which is what the street likes, and which is why they're betting on it. The last 3 or 4 quarters that I remember on Nykaa, they've actually outpaced the industry growth. Before that, the underperformance came in on worries of competition, etc. For Honasa, it was a high flyer post-IPO. Thereafter, the last couple of quarters, there was that weakness. And that weakness led to a big drop of nearly halving of the stock price from the highs. The highs, I remember, were close to around 531 thereabouts. And which was, a big gash that we saw from the top. And even after this 10% up move that we're seeing, the stock is still 45% away from its 52-week high. In the last 12 months, it's down 35%. And the issue price, the IPO price is 324. Even after this 10% up move that we're seeing, the stock is still below the IPO price. So in case of Honasa, they've turned the corner. Are the results incredible? No. But the stock price has fallen so much that any turn in corner has led to an up move. And for Nykaa, after the volatility, there's some amount of predictability which is setting in, which has taken the stock higher today.
Now that the results have played out and is showing up in the numbers as well, the very common question, what next for both Nykaa and for Honasa?
What next is, the answer that anyone seeks to, not just for these stocks, but in life in general. But let's talk about Honasa. The management has aspired focus categories. They're growing, which is 80% of their sales. They have grown in double digits this time around. And they believe that this category can continue to sustain high teens growth. So things are good.
What comes in their focus categories?
Focus categories would be, the Dermaco. You would have Dr. Sheth's. You would have a lot of these active ingredient-based businesses. You would have a lot of, the Mamaearth's own core brand itself. So all those factors doing extremely well for them. They believe this can grow in mid-teens. And the margins, yes, 7% margins this year, possible with the remainder of the year that is there, with 100 to 150 basis points improvement each year going forward. Now, here the thing is that they spend about 35% of their sales on advertising. They believe that for their mature categories, this can actually go down to about 27 to 28%. So this is about 600 basis points in terms of a delta that comes in out here. So that means that, over the next 4 years, 100, 150 basis points each year, that gives you that 600 basis points delta out there. For Nykaa, the biggest thing, everyone was wondering, okay, in a world of quick commerce, 15 minutes, 20 minutes deliveries, how will 2-day, 3-day delivery for Nykaa beauty products work? Well, they've launched Nykaa now in the metro. 7 cities they've launched where, products are delivered between 30 minutes to 3 hours. And that is something which the street believes that will lead growth going forward for the beauty business. Fashion business, it's severely under-indexed when it comes to the men's category. It's about 16% of their GMV, and that's growing at 74%. So there is headroom for that as well. And even as the losses narrowed in the fashion business, they believe that, it will break even in the end of this year with about mid-teen sort of, with about 10% sustainable margins coming post FY28. So all these are good. And this is just the first quarter that we're talking about. Second, third quarter, we have the festive season playing out. So big launches expected out there. And House of Nykaa, which is their own brands, Dot & Key, etc., that is likely to grow 30% CAGR over the next few years. So the way ahead looks good for them. That's also what the street is betting on.
Okay, and when you talk about street, what are the brokerages making of this?
On Hunasa, CLSA has gone ahead and upgraded the stock from outperform to hold. They have a target price, from hold to outperform rather. They have a target price of 333 rupees. Jeffries, because of the EBITDA beat, have upped their EBITDA estimates by 3 to 11%. They have a target price of 400 rupees. I think they sum it up best for Hunasa. They say it's a high risk, high reward play, and today is the reward which is coming in after a few quarters of high risk. And on Nykaa, ICICI Securities says that fashion business, which has grown 25%, has been led by 74% growth in the men's category, which is under indexed. So obviously, this will sustain from here on. Nykaa Now, which is the quick commerce foray, can actually be 10 to 15% of the beauty GMV over the next couple of quarters. So that's something we'll have to watch out for. And they have a target price of 230. They have an ad rating on Nykaa too.
Thank you. Very well explained, very comprehensive. We will be chatting with the management of Nykaa today at 12 p.m. on the Q1 earnings. So don't forget to tune in. But moving on, Jupiter Wagons is under pressure on the back of a weak Q1. Very weak set of numbers. I think the revenues are down 50%, profits are down 66%. Vivek Lohia, MD of the company, is now joining in. Vivek, you've already articulated that the reason for the performance, the weak performance, is shortage of wheel sets supplied by the Railway Wheel Factory of Indian Railways. Is this problem going to sustain in Q2? When do you see this problem recovering? And what happens to your guidance? I think you had hoped for a 5,000 crore revenue in FY26.
Yeah. So good morning, Rima. So we expect the guidance. I'm pretty positive on that. From July onwards, we have seen that the railway supply of wheels has stabilized considerably, and we expect things to improve in the coming months. So we don't, whatever discussions which we had with the railways, we don't expect any challenges going forward. Our wheel production itself is picking up this year. Our wheel plant, Jupiter Tatra Wagonka, we will be doubling our production capacity. In the last quarter itself, also, the supply positions were much worse than what you see from the railways. We pushed in about 4,000 wheel sets from our own supplies to take care of the shortfall. But if the wheel situation improves, and which we expect it to happen, we expect the whatever guidance which we have given, that will make it up in the coming quarters. On the private side, you see our performance is steady. We are building on the order books. And if you see the margins, per wagon margins, that has improved. And now with the, in the next quarters, once the revenues improve, you will see the EBITDA as well as the profit margins to improve.
Okay, Vivek, when you're talking about you maintaining your guidance that you have for FY25, what happens with CapEx? You had a 2,500 crore expansion plan. When will you start seeing the synergies from this CapEx that came by? And what about the capacity addition that you'll see because of that?
That the capex which we are talking about is completely on track. The Orissa wheel project which we are talking about, it's already the construction has started. We are very, very bullish on that project. We expect that from end of next year, I think the revenues from that project will start kicking in. It's got a big element of exports to the European Union also built into that project. So that is something which, and independent of that, our wheel business in Aurangabad is growing. As I've told you, this year we expect the revenues to be close to about 600 crores from that facility itself, which will go up to 1,000 crores in the next financial year. So on the wheel side, the capex, we are very confident that's on track. On the EV business, again, that business is now, we have launched our first vehicle. We are going to be launching 2 other vehicles by end of this year. We are expanding our dealership network. In the next 2 months, we expect about 8 to 10 dealerships to open across India. Again, on the battery side itself, we are seeing the battery business growing by about 200% month on month. And we have this month we'll be launching our first BESS system, a 10 feet as well as a 20 feet BESS system. So that market is again, the demand in that market is very strong. And so we expect that business also to pick up.
Right. Two quick questions, Vivek. You mentioned your revenue guidance stands. Does your margin guidance stand as well between 14 to 15%? And two, what's the order pipeline looking like for you, especially because for a network as big as the railways, as much as the upgrades that you have seen in terms of coaches, the L2 from Utkrishт to the LHB, are you seeing more orders towards that coming forward as well? What's the order pipeline looking like?
So in terms of the margin guidelines, again, as I've told that our per wagon margins have improved. So we expect the margin guidelines, we don't expect any kind of challenges on the margin guidelines. The order books, definitely before end of the year, we expect railways to come out with substantial orders. As you're aware that, under Honorable PM's Gati Shakti scheme, railway is expanding its network considerably, and there's a huge push to bring in traffic to the railways. So we do see that the order pipeline should improve. On the private side, again, we are seeing a huge traction. And if you see our private order book numbers, they continue to remain strong, and our deliveries also there is consistent. So in terms of order book, definitely before end of the year, we expect things to improve.
All right. Thank you so much for joining in today and telling us what the plans are for the company going forward. Q1 was weak, but they maintained their revenue growth and EBITDA guidance. That's the word coming in from Jupiter Wagons. Time for a short break. Management of SmartWorks co-working spaces will join in next to discuss their Q1 numbers. Welcome back. You're still tuned into Trading Hour. SmartWorks co-working spaces reported good Q1 numbers. Revenue surged 21%. Their P&L EBITDA expanded 55%. Their losses have also narrowed. Nitish Sarda, who is the managing director at SmartWorks co-working spaces, is joining in now to take a few questions. Nitish, thank you so much for joining in. Well, losses have narrowed for you this quarter. So could FY26 be the year where you will see profits on the bottom line? Also asking this because majority of your revenues are coming in from the IT space. We saw those layoffs coming in by TCS. Do you think that is something which could impact demand? What is the tenure of agreements with bigger clients of yours?
Absolutely. First of all, Sonal, thank you so much for having us on your show. SmartWorks has shown tremendous growth over the last year. We are well on track to become not just India's, but one of the largest flexible workspace in Asia with our presence in Singapore now. We are already India's largest with a total of footprint of over 12 million square foot and have consistently performed on improving all our financial metrics, whether it's our revenue, which has grown to 379 crores, which is a 21% jump year on year and almost a 6% sequential growth from the last quarter. Our cash EBIT or our normalized EBITDA, which is our NDS EBITDA minus all the lease liabilities that we pay, has significantly grown to almost 61 crores, which is a 100% jump from the same quarter last year. So SmartWorks is moving towards increasing all its financial metrics on a non-GAAP basis, which is removing the NDS adjustments that we have. We have shown a profit of over 16 crores in this quarter because of the accounting provisions that we have to create because in the high growth stage that we are in. There is a loss, but if you look at that loss, that has also meaningfully come down from 23 crores. We stand at 4 crores in this quarter. Last year, that number stood at 60 crores. In the first quarter of this year, it's only at 4 crores. So our metrics are increasing with the significant increase in scale. So it's a very good situation that we are in. To answer the second part of your question on the growth of the industry and the demand for our product, while obviously IT/ITES is a significant portion of India's commercial RE, for SmartWorks, that number is only 42%, which is lower than what the industry standard is. Commercial real estate, IT/ITES contribute to about 60%. So we have also onboarded a lot of manufacturing, BFSI, logistic companies into our platform who are expanding with SmartWorks across the country. And with our strategy of focusing on mid to large enterprise clients, the tenures that we are able to get with them are much longer in nature. On an average, we get a tenure of over 49 months with these large enterprises, and our occupancies are very, very steady. In fact, our committed occupancies today stand as high as 89%. So you'll see these numbers continuously go up.
Got that. Nitish, hi, Rima here. Adjusted EBITDA came in at 16%. In FY25, I think the number was 12.5%.
Yes.
So what led to the margin expansion on an adjusted basis? And can you hold on to 16%? And plus, you will repay the debt, right, that you raised right now from the IPO proceeds. So will that not overall help in you turning profitable even with NDS accounting?
Absolutely. Thank you for that question, Rima. I think for us, if you look at our total numbers, it is driven significantly by the increase in our occupancy and the new centers which are driving towards the profitability. Despite that high growth, we've been able to demonstrate an increase in EBITDA margins from 12.5%, as you mentioned, to almost 16% this quarter. It is driven basically because of 2 or 3 things. Our SG&A cost, which is our corporate cost, keeps going down with the larger scale that corporate cost gets distributed over a larger base. And I think with our frugality, our operational cost and other costs are also going down with the increase in occupancy. So all of this is contributing towards the EBITDA growth margin. If you look at our last quarter from the year, we had already grown. So 12.5% was the entire year. Quarter on quarter, that number is continuously increasing. And you'll see that trend from 9.5% in the first quarter last year. We ended the year at 12.5% on average, and we've started this year at 16%. So you'll see these numbers go up. From the use of funds, from the IPO money that we've raised, we've repaid 114 crores of high-cost debt. That will help us reduce our finance costs significantly. The NDS profitability that you were talking about is also subjective to the new centers that we add. So if we end up adding a significant amount of centers in this year, the accounting provisions that you need to create is on the year that you add those centers. So it is very difficult to predict that. But on a non-GAAP basis, which is normalized for any NDS adjustments, you will definitely see a continuous growth. From a negative 3% last year, in the same quarter, it has grown to 168 million, which is 16.8 crores this quarter, which is a 4.4% PBT.
All right, Nitish, running out of time. I had more questions, but thank you for sparing time and joining us today. Wish you good luck for the rest of the year as well. SmartWorks co-working spaces there on the show. Take a short break. More on the markets on the other side. Stay tuned. Welcome back. Parikshit is now joining in. He's picking up some details with regards to Prime Minister Narendra Modi's likely visit to China amidst the US tariff war. Parikshit, tell us more.
Well, this will be a meeting of huge geopolitical significance. India and Chinese ties had broken down after the border clashes in Galwan in June 2020. But there is an expectation that from September this year, there will be some stability and predictability in ties. Prime Minister Narendra Modi is set to visit China for the SCO summit in Tianjin from the 31st of August to the 1st of September. This will be his first visit in 7 years. Sources say India's objective would be to instill positivity in the relationship. We've also been told by sources that the India-China relationship and the upcoming meeting between Modi and Xi should not be seen through the prism of an India-US relationship. While India and US relations have taken a rough turn recently, India and China have been working on improving ties for the past few years, and more so after October 2024, when Prime Minister Modi met President Xi Jinping on the sidelines of the BRICS summit in Kazan, Russia. Both leaders have agreed to work together for a peaceful and stable India-China relationship, and they had also decided not to allow differences on the boundary issue to disturb peace and tranquility at the LAC. Since then, there have been multiple meetings at the level of foreign secretaries, NSAs, defense ministers, external affairs ministers. Sources say the consensus reached between Modi and Xi is now being given shape to ahead of the SCO summit in Tianjin. There are signs of a thaw as well. India has restarted issuing tourist visas for Chinese nationals after 5 years. Final timelines for resumption of direct air flights between India and China is expected soon. India and China had earlier agreed in principle to resume direct flights. Reports say China has eased curbs on urea shipments to India, and the Indian industry hopes China will ease the supply of specialty fertilizers as well. China's restrictions on rare earth magnets have created a crisis for the Indian industry, and the automotive industry is very hopeful that a positive meeting between Modi and Xi will help ease high rare earth magnet exports to India. India has also been clearing Chinese JVs with Indian companies wherever a technology partner is needed for Indian manufacturing. Also in a first since 2001, an Indian vessel with 496,000 barrels of ultra-low sulfur diesel has been shipped to China. PM Modi is expected to have a one-on-one meeting on the sidelines of the SCO summit with Xi Jinping, and the meeting will definitely set a roadmap for ties for the next few years.
Okay, all right. Pariksha, thank you so much for joining us with those important details. This is an important story to track. We'll keep coming back to you for more. With that, it's a wrap on this edition of Trading Hour. Stay tuned. Halftime Report is up next.
Stocks notch small gains even as geopolitical and trade uncertainties persist. Metals and healthcare gains even as FMCG and IT drag.
Apollo Hospital turns in a strong show with all three verticals growing in double digits. The addition of 500 beds in second half of the year is expected to further push growth in FY26. The healthcare major is also keenly scouting for acquisitions.
Hindalco MD Satish Pai holds out a firm forecast for aluminum and copper demand that should help it sustain profitability through FY26. He also expects cost savings to boost Novelis performance in the second half. The stock perks up.
RBI grants Paytm Payment Services the nod to operate as an online payment aggregator, pulling back on merchant onboarding restrictions imposed in November 2022. The easing opens up the channel for growth, sparking a rally in the stock.
Nykaa owner FSN e-commerce turns in a good show with strong growth accompanied by margin expansion, though fashion sales remain a drag. Honasa Consumer too beats expectations with healthy growth in volumes despite early monsoon hurting the sunscreen sales.
Good afternoon. You're watching us here on Halftime Report. I'm Bangla Malu. With me, Ekta Batra and Vinny Motiwala. We come to you live from the CNBC-TV18 Motilal Oswal studio. It's looking better for the markets than it was yesterday. Yes, we moved to higher levels yesterday, but there was a lot of volatility through the course of yesterday's trading session as well. Today, we're not as high as we were yesterday at close to around 24,700, which was yesterday's high on the Nifty. We're holding with gains, but it's the Nifty Bank, which is, slight underperformer. We're managing to hold on with the advanced decline as well, doing better than what it was yesterday. So all said and done, we're better than what it was yesterday. Just mild green is what we're seeing.
Hi guys, yes, absolutely. It's consolidation, you'd have to say, and that seems to be the big theme that is playing out for our markets in the past couple of weeks. We're just about treading water, considering that we have a lot of uncertainties to deal with. What will be the eventual tariff that India will have to reckon with? And not to mention that in the more near term, we do have the US-Russia meeting, which is taking place on the 15th of August. So, and that I think would be very important as a trigger to watch out for. But in the near term, at least, it is the inflation data from the US as well as India, which has boded well in terms of sentiment for the markets. For the India CPI, that has come in at an 8-year low. So definitely possibly opening the room in the future for possible rate cuts. But nonetheless, for the Nifty, just about consolidating with a gain of around 0.3%.
Absolutely. Hi guys, good afternoon. So in terms of individual sectors, let's look at that. We have Nifty Metal that's managing to hold on to some bit of a gain today, 1% gain coming in there. Pharma, again, some of the names over there are doing well. So Apollo Hospital numbers that came in. Alchem, also good numbers that we're seeing in terms of a good traction for the stock as well in today's trading session. So Pharma today is buzzing in trade. Other than that, a lot of names on the back of their earnings. Whether you look at Nykaa, that's FSN e-commerce, Honasa Consumers, among some of the names that are buzzing in trade. But like we're talking about Nykaa, good strong show that came in from the company. Margin expansion is also what we saw in Q1 FY26. Now, Mangalam caught up with Adwaita Nair, the co-founder at Nykaa, and executive director and CEO at Nykaa Fashions and head of owned brands, to discuss the quarter gone by, and began by asking about the growth in the beauty and fashion segment and what's the outlook going forward there. Listen into that conversation.
We're feeling really good about this quarter for two big reasons. One is the fashion growth is back. After about 5-6 quarters of, sort of a challenging environment for fashion. And I think fashion generally remains quite competitive and challenging in the market. But Nykaa Fashion has emerged really well. In Q1, the fashion business has delivered 25% growth, which is a significant improvement from the last couple of quarters, and also significantly higher than what the market is seeing. And also a very significant loss reduction, with EBITDA loss coming down by 300 bips. So I think that's one big theme that we're excited about, that fashion is on track. And we're really confident that that thesis will play out. And the second is that this house of brands business that you sort of alluded to, which is where we're building our own brands, has also had a very, very strong quarter with over 70% growth. And now that one business where we make our own brands is tracking towards a 2,700 crore top line. And again, very profitable, compared to the rest of the business as well. So it's a great shift that the business is undertaking from retailer to also being a house of brands.
All right, the first quarter was good. You think that the next couple of quarters are likely to be fairly strong as well, continue the momentum. If you could give us a sense on, what kind of GMV growth can we expect in both the beauty and the fashion business over the next couple of quarters? The second half typically better for the fashion business as we move towards festive season.
Yeah, I think, beauty has been very consistent at this sort of mid-20s for the last, 6 quarters or so, and we'll hope to kind of stay steady with that. We're slightly outpacing the market growth there, and, every quarter sort of chipping away at a little bit more market share. I think fashion is where we should see an acceleration. We are feeling really confident with where the business stands today. I think Q1 at about 25% is sort of the start. I'm hoping, and we're sort of looking forward to collectively for a higher growth rate going into Q2, Q3. That is season for us. And we also have some really strong launches and partnerships that should come through to drive much of that.
Would that mean, better EBITDA margins as well? Because in your investor day, you had guided for break-even on the fashion business, at least by the end of this year. You're on track for that?
As of now, if the growth momentum continues the way it is and the way we're seeing it, even going into the next couple of quarters, there is definite intent to get to that EBITDA break-even number. If you just look at the track record, year-on-year, fashion has improved the EBITDA margin from a -9% to a -6%. And even if you just look from last quarter to this quarter, there's again 100 bips improvement. So I think the fashion team does have a track record of continuously improving the cost profile. So I think as long as both these trends sort of continue, it should be on track.
Give me a sense on Nykaa now, because you guys had plans for that. I mean, what have the initial, numbers on Nykaa now been? What's the investment been like? How much incremental growth have you seen in areas where there is Nykaa now?
So we launched our Nykaa Now, which is our quick commerce proposition a couple of quarters ago, and we've been slowly kind of steadily building on it. It's now available in 7 cities with 50 dark stores. We've serviced about 1.3 million orders till date. I think what was really important to us as a team was not just rushing into quick commerce in that form, but more finding a value proposition and a customer proposition that made sense. So when people opened up the Nykaa Now section of the app, what really was the proposition? And for us, we honed in on the widest delivery of beauty products in that, that need quick commerce in the shortest amount of time. So we've spent a lot of time figuring out what the merchandising strategy should be there. And therefore, I think we're really hoping that the merchandising strategy creates a lot of product market fit, and then we scale further from there.
So what's the expected scale-up of Nykaa Now from here on? And could you give us a sense on the investments that it'll entail? And could there be an eat into the beauty business margin because of this?
So right now we see sort of a measured kind of foray into further expanding. We feel that this is a top city strategy, and we're going to focus on attacking the top 10 cities. We are not trying to go after the 15-minute delivery. We do state strongly to our customers that this is a 30-minute to a 3-hour delivery time frame. And we think that the customer is totally fine with that. So it is going to be more of a measured play for us.
What kind of margin guidance can you give us for the beauty business for this year, even as GMVs grow at mid-20s?
I think, it's a story of different parts. So you've got the e-commerce business, which has even higher EBITDA margins. You've got the superstore business, which is currently loss-making, though again in our earnings we did describe that the losses there are coming down quite rapidly. And then you've got the House of Brands business in there, which is even higher EBITDA margins. So it's a mix of sort of one growth phase, investment phase business, and 2 businesses that are firing really well from an EBITDA perspective. So as that mix changes, you can expect the gross margin and the EBITDA margin profile to change.
All right, and final question before we let you go on House of Brands itself. You've guided for a 30% CAGR over the next few years, a target of 6,000 crore. You've already reached an ARR of 2,700 crores this year with a 70% uptick that we've seen in the first quarter. And we haven't even seen the fashion and the festive season yet for House of Brands. So what kind of growth uptick can we expect in House of Brands for this year and the year thereafter?
So thanks for talking about that. I think, for us, this is one really important strategy that we're watching play out, which is this, this foray into being a brands business in addition to the retailer business that we built over the last couple of years. And I think it's astounding the growth that this business has had. It's grown 7x in the last 5 years. It is now a 2,700 crore run rate business on the back of about 10 brands, of which 3 are really sizable, whether that's Dot & Key at about 1,500 crores, Nykaa Cosmetics at 350 crores, and K-Beauty at 250. So I'm feeling really good about some of those big brands that we've got in the mix. These top brands are growing incredibly well. Dot & Key is growing at 100% year on year. K-Beauty is growing at 60% year on year. So this overall beauty side of this house of brands business, so our beauty brands are growing at 70% year on year. So I do see a lot of that growth momentum continuing. Obviously it's not going to be at that 70% forever, but I think there's it's really just the start. We've just started focusing on this side of the business. So there's definitely a lot of growth potential possible here. And for me personally, what I aspire to in this house of brands business is a very strong EBITDA margin profile. I'm inspired by a lot of the large beauty brand businesses out there, which all trend towards a 20% EBITDA margin profile. So we're trying to build these brands with that kind of discipline in mind.
Where would those margins be right now?
So again, we've not really released that yet. I would say some of the mature brands like Dot & Key are at the mid teens, and some of our newer brands, that we're still investing in are below that. But like I said, the vision over the next 5 years is to get to a 6,000 crore top line for the house of brands business and to strive towards, best in class EBITDA profiles, which tend to be around 20%. So, I'm not sure if we'll get to exactly 20% in 5 years, but that is where and how all the brands are being built with that goal in mind.
Okay, so that's the management of Nykaa talking to Mangalam on the Q1 numbers. They do expect growth rate in the fashion business to increase going forward. That stock doing well today, up around 7% at this point in time. In fact, a lot of earning reactions which have been positive. The other one which stands out is Apollo Hospitals, which is up around 6.5% top gain on the Nifty. Well, we'll take a short break. We'll connect with the management of Nazara Technologies on their Q1 numbers once we're back. Stay tuned.
Welcome back to Halftime Report on CNBC TV18. Let's put the spotlight on Nazara Technologies, a mixed set of numbers that came in Q1 FY26. New acquisitions like a Curve, which was acquired last year, 1 full year over there, that's managed to do good growth. Smashes, that's come in as well in the offline side of the business. Gaming business has done well, but the bit of a subdued performance that came in from Sportskeeda, Pokerbazi, muted set there. So what is the outlook of the company going forward? What are we watching out for in terms of overall the growth from the offline business as well? We have Nitish Mittersen, who's the joint MD and CEO of the company, to talk to us about the numbers. Nitish, good afternoon and thank you so much for giving us your time. Let's start by talking about your overall growth story that's coming for the gaming side of the revenue business. Good growth, whether you look at it sequentially or year-on-year basis. Now, how have the sub-segments done in this side of the business, as well as in terms of contribution that you've seen coming in from the newer acquisitions? That's Curve as well as Smash. How is that performing as well?
Sure. Our gaming business, year-on-year has grown close to 160% in revenues and contributed over 300% year-on-year growth in EBITDA. I think our strategy of building, core gaming, established IP-first businesses is paying off very well for us, and we will continue to do that. We've acquired new businesses in Curve Games, which is our first entry into the PC and console space, and a few sports games, which makes a Love Island game, is now launched Big Brother. We're launching Big Boss very soon. So I think we've got a series of very well-known IP coming out, and we're very excited about this gaming segment, high EBITDA margins as well.
Okay. Nitish, hi. Welcome to the show. Just wanted to understand what's taking place with Kiddopia. It's seen 9 consecutive quarters of a decline in subscribers.
Yes, I think we've been working a lot on it, but it's obviously taken much longer to recover than we originally anticipated. That said, if you look at this quarter's results, overall KPIs seem quite good. Our cost of acquisition has reduced. Most of the KPIs you look at, like churn, etc., have improved. So I think we're getting there. Hopefully, the light at the end of the tunnel is there, and we should start showing some growth in the coming quarters.
What about, esports? That saw 29% decline quarter on quarter. Nodwin as well, continue to report EBITDA losses. What's the turnaround plan for that? And what really was the rationale behind, you desubsidizing Nodwin?
Sure. I'll speak about Nodwin first. As you know, Nodwin has been the market leader in esports, and they actually continue to grow quite a lot on revenues. Year-on-year growth is 49% for this quarter, and I think this whole year revenue growth is going to be quite significant. The Q1 saw slightly exaggerated EBITDA loss of 11 crores, but I think they will catch up in the rest of the year, and we're quite confident that this company this year or latest by next year will be profitable. So I think maintaining market leadership for Nodwin is important, and in that context, they will have to raise more capital and aggressively grow the business. Now, from a Nazara perspective, as you can see, our gaming segment is, our core gaming segment is generating high margins for us, very healthy cash flows. And we have a lot of attractive opportunities to invest in that business, both organically as well as potentially new studio acquisitions. So we kind of took a call that at this stage, for us to invest more capital in Nodwin versus investing into our core gaming business, that was a capital allocation priority that we have done. And this also, the deconsolidation allows Nodwin now to go out and raise funds from external investors, which can potentially aid a lot of their growth. It's important to remember that we own a large stake even post deconsolidation. We'll probably land 46-47% ownership. We are the largest shareholder, and therefore, Nodwin growing aggressively and building a lot of value for us will be very useful for us in the longer period. As far as Sportskeeda is concerned, this quarter has definitely been a disappointment for us. That's a company that's been on a fast growth track in the last 4 years and been highly profitable for us. Unfortunately, due to some external changes at the Google end, the March Google update kind of destabilized the Sportskeeda.com traffic, while their other properties continue to do quite well. So we're taken a couple of, we've reduced costs, we've reduced content costs, we've right-sized the teams, and hopeful that this will recover in the next quarter or two.
So you're expecting recovery in the next quarter or two for Sportskeeda. Just two questions that are from my side. One is in Kiddopia, the margins. This time you said that there is some royalty cost that comes in as well. So now this is what you'll be paying every quarter. Is it yearly? When do we expect this impact to actually, come in every year? As well as in terms of ad tech business as well, what is the outlook there? Because sequentially we are seeing a decline there. So when will you start seeing those synergies come in for DataWorks, Space and Time acquisition that has come in as well?
Sure. So on Kiddopia, we have partnered with global IPs, such as, with Mattel, we have a partnership for Barbie, and we have some stuff happening with Hasbro, etc. So these are revenue shares we pay on a monthly or quarterly basis. Initially, you're seeing a slight, decline in EBITDA margins, but over a period of time, the IPs will actually drive a lot of organic traffic, so our cost of acquisition should come down, and the margin should go back to where they were. In terms of the ad tech business, we are starting to see, good synergies play out between Space and Time and DataWorks, the cost side as well as on the product and revenue side. So again, I'm sure this year we will see, those margins come up and those synergies kind of play out.
Okay. Nitish, just quickly before we let you go, what is the plan in terms of scaling up the offline business? How much is it going to probably be a percentage in terms of total sales going forward, and how important a segment is it going to be?
I think it's a very exciting space for us. We have two assets or two IPs over there. One is Funky Monkeys, which is for younger kids. Funky Monkeys had about 10 centers when we acquired it. They are up to 14 or 15 now. And now the launch rate has increased a lot. We're launching at least a center a month and hoping that over the next 2-3 years, we should be able to take this to 75 to 100 centers. I think there's a huge potential in our country for this kind of format. And, even 500 centers could be, hosted in our country. So I think profitable business, quick break even, and we are pushing very hard on that. Smash for us is a great IP that we've, acquired. It requires a little bit of stabilization and reinvention. So you will start seeing growth over there in FY27. But there's a lot of synergies that we see that we can bring from the online Nazara, what we do, into these offline activities. And we also believe that, consumers increasingly, especially the youth, want to go out for social, interactive entertainment experiences. And the share of wallet will keep increasing over there. So I think it's a great space for us to operate in.
Wonderful. People do want to go, Nitish. It will be very interesting to see how much they can afford it right now. And secondly, how profitable as a proposition it is for you versus esports businesses or, online gaming where the margins are obviously a lot higher. But that conversation for another time. Thank you so much for joining in. With that, we'll slip into a short break. As we do that, let's give you a reminder once again. Unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Access, our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interactions with our journalists along curated studio tours, e-learning sessions and masterclasses along with lifestyle benefits. The market picks up once again, closer to 25,600 on the frontline index. In a regulatory boost for Paytm, the RBI has granted an in-principle authorization to operate as an online payment aggregator to the company. Ritu joins in with more updates because the street is cheering that move. Remember when it was earlier taken out, the stock was down big time. Now it's recovering all those losses. Ritu, good news coming in for Paytm.
Well, after a near 3-year wait, the Reserve Bank of India has finally granted Paytm's 100% owned subsidiary, Paytm Payment Services Limited, in-principle authorization to operate as an online payment aggregator. Now, that is essentially the business which runs Paytm's digital payment gateway for all of its merchants. But importantly, RBI has also lifted the ban on new online merchant onboarding, which had been in place since November of 2022. But to be clear, even when that ban was in place, Paytm had still been servicing the existing online clients, and it had also been signing up new offline merchants. But this, of course, clears a big regulatory cloud over the payment business. Now, the market is quite crowded. There are more than 50 players that have this license, but Paytm's massive base of 1.3 crore merchants does give it a strong shot at regaining momentum. The timing is also quite interesting. It comes just days after its Chinese investor Antfin fully exited Paytm, selling that remaining 5.8% stake. Now, remember, Paytm's initial application in 2022 was returned by RBI, and the company had reapplied for this license only in September last year after getting the government's nod for its downstream investment into PPSL. Keep in mind, though, that the RBI nod right now is not unconditional. The company will have to complete a system and cybersecurity audit within 6 months' time and submit the report to RBI or risk losing the license. Now, brokerages have given the move a thumbs up. Citi says the license win is positive for sentiments because it lifts a major regulatory restriction on the business and it will help Paytm be more competitive than before. And Bernstein adds that this will have limited immediate impact on metrics, but it is a major relief nonetheless and is going to support higher payment margins for the company over time.
Okay, all right, Ritu. Thanks very much for that. Just keep your eye out on Max Healthcare. That hospital company has come out with its numbers and the stock should come up for you. It was reacting positively to the Q1 performance. So on your screen for Max, as you can see, in the green for that particular counter. Vivek now joins in, however, to take us through all the stocks that are moving around in trade this morning. Vivek, over to you.
Well, thank you so much for that. So many results, so much news flow, so a lot of stocks to pick in today's trading session. Well, first on the list, in the list of gainers, you have to start off with Apollo Hospitals. A strong beat across all parameters. That particular stock high by almost 6% in the session today. One of the top gainers even in the F&O pack. The other stock on the radar, one that we haven't discussed much since morning, is Archean Chem. One of the subsidiaries of the company has received the government nod to set up a semicon fab unit. The back of that stock high by 8% was up almost 12% at one point during the session. The other is a list of defense companies. So Bharat Dynamics, despite a loss on the bottom line, as well as operationally strong performance, all of the defense companies in this particular quarter doing quite well. HAL, BML, all of these stocks among the top gainers today. Honasa or Mamaearth, as already known, that particular stock, very good set of numbers. Margin expansion on the cards. Company has given a very strong guidance as well. That stock higher by 7% today. But again, on the list of laggards, quite a few. NSDL, remember, post-listing, very strong listing, post which the company did see significant up move on the back of a slightly muted Q1, seeing significant profit booking come about in the session today. The other stock, EMS Limited, this particular infra player, slightly muted set of numbers. Operating leverage didn't really play out as expected. That stock down almost 4%. Rupa and Company, again, this particular stock from the broad end of the markets, a weak set of numbers, almost 9% lower. And Oil India, remember this particular stock in the F&O space, one of the top laggards today, profitability dipped over 50%. And on the back of that, that stock lower by almost 5% in the session today.
Okay, Vivek, thank you so much for that. So those are the buzzing stocks. And as of now, the Nifty is inching back towards those days' highest point, 24,600 around that mark. But what is the F&O setup looking like this afternoon? We have Mangalam to give us those details.
Yes, the market has indeed moved higher right now. The Nifty is above the 24,600 mark, and that's an important level to watch out for from a market standpoint as well. Let's keep an eye out on the mid-cap index along with the Nifty Bank. What's taking the Nifty higher right now is the underperformance of the Nifty Bank, which was marginally in the red, is now turning into an up move. And let's see whether that continues. If that moves into the outperformance thing, we'll have to watch out for how that goes. The India VIX is declining, and that's a good sign. With the market moving higher, the India VIX going down by about 0.5% is good news. And we have a lot of these sectoral indices supporting the frontline index as well. So we have the metals index doing well, the auto index doing well, along with the Nifty pharmaceutical index. We'll have to watch out for whether the IT index at some point picks pace as well or not. The broader markets, the advanced decline ratio, the lines briefly came closer, but now they're moving far apart once again, with 1,500 stocks in the green for about 1,100 stocks, which are in the red. So for the Nifty, two levels to watch out for. On the way up, we have the 24,531 mark, rather on the way down, that will be the support. The Nifty's actually conquered the 100-day moving average in today's trading session, but yesterday's high of 24,703 is important for further short covering in the market. And there are a lot of shorts in the system. FIs are 92% short in index futures. For the Nifty Bank, the important support area is the 100-day moving average, which is around that 55,000 mark. Now we are seeing a bit of an up move from there itself. The 24,600 mark is the fulcrum, where we are seeing both put and call writers active. So 24,600 put writers, premium of 50 rupees, telling you 24,550 thereabouts would be support coming in. But at the same time, the 24,600 call writers have a premium of 85 rupees, telling you closer to 24,700 or yesterday's high. There would be some supply coming in for the frontline index as well. So we'll watch out for these two levels, but much lower around the 24,425, 475 mark. There is a much stronger support. A lot of stocks on our radar. Nykaa, the stock moved to the high point of trade post the management joined us, saying there could be higher growth prospects for the company in the next couple of quarters. A lot of long positions added on that. Apollo Hospitals, Ekta has been telling us good numbers coming in. The management joined us as well. That stock too at the high point, seeing a lot of long positions being added, along with the second day running well bid up stock was Alchem Labs. So for 2 straight sessions, a lot of long positions on that counter. Finally, we have Suzlon, which is seeing a lot of short positions being added. So watch out for that stock.
Okay, all right, Mangalam, thanks very much for that. So that's on the F&O space. We'll take a short break. On the other side, Manisha Gupta will join in to discuss what she's talking about in the commodity space. She has Atul Chaturvedi of Sri Renuka Sugars joining in.
Welcome back, and joining us on the show is Atul Chaturvedi. He's Executive Chairman at Sri Renuka Sugars. Mr. Chaturvedi, hi, thank you so much for joining in. First of all, on sugar itself, how would you look at the markets? Because everybody seems to be talking about the festivities right now. How has the sugar consumption been? And would you say that sugar availability is clearly not a concern right now?
No, sugar availability is definitely not a concern because we have adequate stocks, and in any case, India has been consuming much less sugar compared to last year. So my take is that marginal increase in the sugar prices is definitely on the cards, and largely on the strength of even lower allocation which the government has given for the month of August. August month, they have only allocated about 22.5 lakh tons. So this is actually helping sugar values go up marginally. But I don't see sugar prices running away, because what we are seeing is that the next year's crop looks to be much better than what it was last year. And in any case, the crushing also would probably start a little earlier. And maybe Diwali is earlier, so you could possibly see crushing taking place from the third or fourth week of October. So that should keep a lid on the prices.
Sure. Mr. Chaturvedi, also, there seems to be a lot of numbers floating around for India's annual sugar consumption, anywhere between perhaps 279 to 285 on the higher side. What is your take within this?
No, I was doing a little bit of a sum as far as the allocations for the current year goes. So allocations till August are lower by about 1.4 million tons compared to last year. So even assuming last year about 700 to 800,000 tons of material would have slipped into Bangladesh, because Indian situation with Bangladesh was much better. So you probably see the drop in allocation, effective drop in allocation by about 700 to 800,000 tons. So my take is that our sugar consumption is not above 28 million tons. And we used to earlier pencil in about 500,000 tons of increase on an annualized basis. Now we would probably be penciling in just about the growth in our population, which is closer to about 1%. And at 1%, it will be roughly about 250,000 tons on an annualized basis. The sugar consumption is definitely on the decline. It's not, and the whole lot of alternates, and you also keep talking about 17 alternates. So that is also bringing down the consumption probably.
Chaturvedi, would you say that it is the household consumption which is declining, but it really is the Horeca or the bulk consuming or the institutional buying for sugar, which clearly seems to be growing, with the fact that you have processed food and bakery items and ready-to-eat food doing quite well?
No. In fact, contrary to what you're saying, what we've seen is on the beverage industry has been struggling for sales. In fact, India hardly had any summer worth the name. We probably didn't see the full impact of summer this year. And the beverage consumption has been down, and beverage is one of the biggest consumer of sugar. You look at cola or you look at Pepsi and things like that. So probably that segment is facing demand headwinds. Other segments like Horeca and all, their increase may be marginal, but I don't, and that will get factored in within that 1% growth. But beverage is one of the major commodities which has suffered this year.
All right. How are you also looking at the prices then? Because while, of course, the industry has been asking for an increase in that minimum selling price, it also is about the cost of production and the retail, where we haven't seen too much of a gain. But as you said, some bit of an incremental gain is what the street can anticipate during this festival season. What do you see that as a percentage of?
I wouldn't say the industry has been demanding the raising of the minimum selling price, because sugar being a very highly regulated industry has been talking in terms of taking the price increase to about 41 rupees or closer to that, and with the FRP also going up in the current season or the forthcoming season. So there's all the more reason why it should be taken up. But having said that, more important, but the reason why we are insisting on this is it should get actually institutionalized. As it is, that 31 rupees price which has been fixed by the government is meaningless because sugar is selling at much higher prices for that. But what is more important than the minimum selling price is the ethanol. And ethanol, we are now hearing a whole lot of funny stories, or whether they are targeted stories, we don't know. But ethanol is where we actually need price increase if India is to continue to keep 20% blending as their target.
At that point, thank you so much for joining in and giving us those details. Mr. Chaturvedi, ethanol is where price hikes are needed. This summer was impacted by low sugar sales because of beverages and, increasing trend of people going off sugar as well. I was looking at a Varun Beverages note, which is obviously the bottler for Pepsi in India. They say that 59% of their consolidated sales volume, so the last 2 quarters, between 50 to 60% of their consolidated sales volumes have been from products which are no or low sugar. So obviously that does not bode well for the sugar industry, even as it does for everyone's health. So we'll watch out for how that pans out. Thank you, Manisha, for taking us through with that conversation. Take a short break. On the other side, we have the management of Gateway Distriparks joining in about their new agreement on a multimodal logistics park. Well, we spoke with the management of Gateway Distriparks just a couple of weeks ago on their numbers, but incrementally the company has gone ahead and signed an exclusive container train operations agreement for a multimodal logistics park in Ankleshwar. And this will, entail the company providing them rail services for that logistics park. So let's get in Samvid Gupta once again. Samvid, good to speak to you, so soon once again. The quick questions that we have for you. If you could give us an incremental volume and revenue potential for this, and what is the kind of EBITDA per TEU that you would expect in a business like this?
Hi, good afternoon. So there are two aspects to this agreement that we've signed. One is the domestic side, and then there's the EXIM and DPD business. So for domestic, we can start immediately, and we're expecting about 1,000 to 1,500 TEUs as the exit number for the year per month. But there's good potential, and we can take this up to 3,000-4,000 TEUs per month over the next couple of years. The EXIM part, they've received the in-principle permission, but fully the operations for the ICD portion will start probably by April next year. And there's good scope here. There's only one other ICD which is full right now, and a lot of it is going by road. So we hope to convert a lot by from road to rail, and it's 100% towards JNPT right now. And this can probably scale up to 5,000 TEUs per month over the next, again, 2 to 3 years of operations coming in, with the potential of going up to 10,000 TEUs per month. The revenue side and EBITDA side, we have to see, because the lead distance is much shorter compared to our normal mix right now, which is primarily 90% for the north. So the EBITDA per TEU we're looking here will be about 3,000 rupees per TEU.
Okay, all right. So that's the EBITDA per TEU that you're looking at around 3,000 odd rupees. Samit, just wanted to understand, what is the investment by the company in this particular project?
So this is a complete asset-light model for us. What we've signed is zero investment from our side, as the trains are on lease, and even the containers that we will use for domestic purpose, those are also available on lease. If there is regular good volume on the domestic side, we will invest in the container side, but that will be very nominal. So for us, it's a EBITDA sharing basis that we've signed this agreement.
Okay, Samvid, thank you so much for joining in this afternoon and giving us a quick check in terms of, what to expect from this new update that has come in from the company as well. So that's the management of Gateway District Parks for you all in terms of the latest update. But on that note, we're going to actually slip into a very short break, and we'll get you more on the markets and stock-specific action on the other side.
Welcome back. Well, for the markets, stocks specifically, there's a lot going on and the markets have also picked up. So we have the Nifty, which is up around 135 odd points at this point in time. It's up around 0.6%. We have the Midcap Index, which is picked up to the high point of the day, along with the Bank Nifty. So there's buying, which has come into financials, which is helping the entire texture of the market. Just want to point out that Apollo Hospitals continues to reign on the Nifty as the top gainer. So up around 6 odd % for that particular counter. Hindalco is doing well. Remember, there was a positive CLSA note which came out. They have an outperform rating on Hindalco, so that stock continues to see some amount of gains. Just watch out for Alchem as well from the broader markets, where there are some brokerage reports or bullish brokerage reports which have come out on Alchem. So that stock doing well as well, up around 4 odd %. Well, with that, it's a wrap on Halftime Report. Thanks very much for watching. Business Lunch up next.
Stocks rise with the Nifty rising to the highest point of the day even as geopolitical and trade uncertainties persist. Metals and healthcare stocks gain even as FMCG and IT are the big drags.
Apollo Hospitals turns in a strong show with all three verticals growing in double digits. The addition of 500 beds in H2 is expected to further push up growth in FY26. The healthcare major is also keenly scouting for acquisitions.
Hindalco Managing Director Satish Pai holds out a firm forecast for aluminum and copper demand that should help it sustain profitability through the current financial year. He also expects cost savings to boost Novelis' performance in the second half. The stock perks up.
RBI grants Paytm Payment Services the nod to operate as an online payment aggregator, pulling back on merchant onboarding restrictions imposed in November 2022. The easing opens up the channel for growth, sparking a rally in the stock.
Nykaa owner FSN e-commerce turns in a good show with strong growth accompanied by margin expansion, although fashion sales remain a drag. Honasa Consumers too beats expectations with healthy volume growth despite early monsoons hurting the sales of sunscreen.
Well, hello and welcome to Business Lunch live from the CNBC-TV18 Motilal Oswal studio. I'm Bamakshi Toria and with me is Hormas Patakia. Good afternoon to you, Hormas. You know, it's been a good day for the markets. Unlike yesterday, it's been, a one-way move. Right now, we're actually above the 24,600 mark. And in fact, it's been phenomenal since the get-go.
Recovering all that was lost in yesterday's trading session and a little more at the highest point of the day. But of course, the key level that needs to be watched out for, of course, is yesterday's high, which is 24,702. So we are firmly above the 100-day moving average. So that is a positive. We are at the highest point of the day. That is also a positive. We are going into a truncated week, tomorrow being the last trading session of the week. Tomorrow is also the weekly expiry for the Nifty. So there are a lot of moving parts to keep track of. Earnings season comes to an end tomorrow. That is a bigger trigger. So we'll be devoid of cues now going forward, and the focus will shift back to what's happening globally. But of course, for now, the bulls are in a comfortable position, still 70 points away from yesterday's high. But there are a lot of stocks that are moving around in the broader markets. So look at NMDC Steel, you look at Yatra Online, Windlass Biotech, JM Financial, all of them seeing double-digit gains, anywhere between 12 to 15%. And unlike the trend that has been, Vamakshi, so far in this earnings season, today's session has had more positive earnings reactions compared to the negative ones, be it NMDC Steel, be it Windlass Biotech, be it Honasa, be it Nykaa. So that is also aiding the sentiments in the broader markets.
Well, absolutely, Hormas. And just talking about earnings reaction, take a look at Apollo Hospitals. That stock is up almost 6% in today's trading session. Apart from that, we'll also highlight Honasa and Nykaa in just a short while. But both of these counters, these are BPC players, beauty and personal care segments is what they cater to. And all of them have been doing quite well. Take a look at, Orient Pro as well. That stock is up, there was news flow. They secured an urban mobility project for the Mumbai Metro, which was at 250 crores. And Orient Pro has spiked up in trade right after that announcement, up almost 7% today. But let's bring the spotlight back on wellness and beauty brands, Nykaa and Honasa Consumer. Both of these counters have surged on strong first quarter numbers. Mangala gets us a wrap of all of this.
Well, for Honasa, after 2.5 quarters of disappointment, it seems like it's turned a corner. Why do I say that? Because the revenue growth for the company this time around has been 7.5%, and the EBITDA has declined by just 0.8%. The street was expecting a much bigger dip in the company's EBITDA this time around. The net profit has shown a mild growth year on year. The revenue growth, which is 7.5%, is actually understated by 200 basis points on account of the early onset of monsoon and a shorter summer. The sunscreen category was impacted. The company has reported an underlying volume growth of 10.5% as well. So they seem to be coming out of the woods, and some of their core categories, which account for nearly 80% of the company's sales, that has seen a growth of double digit, which the management believes can sustain along with 7% margins this year as well. The stock has seen a big cut from its highs, still below its issue price of 324 rupees. So that's causing a further up move in today's trading session. The underperformance of the stock over the last few months as well. Moving on to Nykaa. Remember, the stock was higher, thereafter saw a big cut and now has moved towards its 52-week high. Good performance coming in this time around, not only from their beauty business, but the fashion business also showed a 14% growth, which was led by men's fashion, which accounted for nearly 74% in terms of a growth, a contribution. While their overall GMV contribution is 16%, the street believes that this can grow from here on. So for Nykaa, couple of things are firing. One, the beauty business is doing well with a trigger on quick commerce beauty. Nykaa now doing well for them. The second part, fashion business, which has been struggling for the last few quarters, seems to be coming back with the second half of this year having the promise of the festive season doing well as well. And the company holds on their guidance of, EBITDA break-even in the fashion business in this year as well. The third vertical for Nykaa, which is their own brands, House of Nykaa, has actually grown at 70%, and that's actually driving the overall growth for the company, and that explains why both these stocks are buzzing in today's trading session.
Indeed, Mangalam, thank you for that update. 8.5% higher on Honasa, 6% higher on Nykaa. Honasa, though, still below its IPO price. So keep an eye out on both of these names. But in another positive news, a regulatory boost for Paytm, the Reserve Bank of India has granted an in-principle authorization to operate as an online payments aggregator. Ritu is now joining in with more updates on this. Ritu.
Well, after a near 3-year wait, the Reserve Bank of India has finally granted Paytm's 100% owned subsidiary, Paytm Payment Services Limited, in principle authorization to operate as an online payment aggregator. Now, that is essentially the business which runs Paytm's digital payment gateway for all of its merchants. But importantly, RBI has also lifted the ban on new online merchant onboarding, which had been in place since November of 2022. But to be clear, even when that ban was in place, Paytm had still been servicing the existing online clients, and it had also been signing up new offline merchants. But this, of course, clears a big regulatory cloud over the payment business. Now, the market is quite crowded. There are more than 50 players that have this license, but Paytm's massive base of 1.3 crore merchants does give it a strong shot at regaining momentum. The timing is also quite interesting. It comes just days after its Chinese investor Ant Fin fully exited Paytm, selling that remaining 5.8% stake. Now, remember, Paytm's initial application in 2022 was returned by RBI, and the company had reapplied for this license only in September last year after getting the government's nod for its downstream investment into PPSL. Keep in mind, though, that the RBI nod right now is not unconditional. The company will have to complete a system and cybersecurity audit within 6 months' time and submit the report to RBI or risk losing the license. Now, brokerages have given the move a thumbs up. Citi says the license win is positive for sentiments because it lifts a major regulatory restriction on the business and it will help Paytm be more competitive than before. And Bernstein adds that this will have limited immediate impact on metrics, but it is a major relief nonetheless and is going to support higher payment margins for the company over time.
Well, thank you so much for that, Ritu. Big relief coming in for Paytm, and resultantly the stock is surging higher. But moving on then, Mumbai's Economic Offences Wing has launched a preliminary inquiry into an alleged accounting lapse at IndusInd Bank. My colleague Santya is joining us with more details. Santya?
Mumbai Police Economics Offence Wing has launched a preliminary inquiry in the IndusInd Bank accounting lapse matter. The PE is based on a complaint that cops received from the current management of the bank. The matter pertains to an accounting lapse of over 1,900 crore rupees in the bank's derivatives portfolio. The matter came to light and led to a 25% stock decline, eroding 15,000 crore worth of its stock value. Now remember, it is a PE and not an FIR. A PE is an investigation process that Mumbai Police Economic Offence Wing has launched, and it empowers Mumbai Police to summon and record statements. But at this stage, it is a PE and not an FIR. A PE is a process where the cops investigate a matter to establish the cognizability of a matter, and once the cognizability is established, only then an FIR is registered. In this matter, Mumbai Police has already recorded the statements of the staff members of the former CFO of the bank, and statements of the staff members of bank's accounts department have also been recorded by Mumbai Police. Mumbai Police have told CNBC TV18 that it is going to summon the former CEO Sumant Katpalia and the former Deputy CEO Arun Khurana in the matter. Mumbai Police is also going to summon the former CFO Govind Jain and former Deputy CFO Santosh Kumar in this matter.
Santya, thank you for that update. 1% lower is where IndusInd Bank is currently trading. But moving on to some geopolitical developments, Parikshit is now joining in. He's picking up some details with regards to Prime Minister Modi's potential visit to China amidst this US tariff war. Parikshit, tell us more.
This will be a meeting of huge geopolitical significance. India and Chinese ties had broken down after the border clashes in Galwan in June 2020. But there is an expectation that from September this year, there will be some stability and predictability in ties. PM Modi is set to visit China for the SCO summit in Tianjin from 31st August to the 1st of September. This will be his first visit to China in 7 years. Sources say India's objective would be to instill positivity in the relationship. We've also been told by sources that the India-China relationship and the upcoming meeting between Modi and Xi should not be seen through the prism of an India-US relationship. While India and US relations have taken a rough turn lately, India and China have been working on improving ties for the past few years, and more so after October 2024, much before Donald Trump even won his second term. When Prime Minister Modi met President Xi Jinping on the sidelines of the BRICS summit in Kazan, Russia last year, both leaders had agreed to work towards a peaceful and stable India-China relationship, and they'd also decided to not allow differences on the boundary issue to disturb peace and tranquility at the LAC. Since then, there have been multiple meetings at the level of foreign secretaries, NSAs, Defense Minister and the External Affairs Minister. Sources say the consensus reached between Modi and Xi is now being given the shape ahead of the SCO summit in Tianjin. Now, there are some deliverables and early signs of thaw between the two countries that we are seeing. India has restarted issuing tourist visas for Chinese nationals after 5 years. Final timelines for resumption of direct air flights between India and China is expected soon. India and China had earlier agreed in principle to resume direct flights. Reports say China has eased curbs on urea shipments to India, and the Indian industry hopes China will ease supply of specialty fertilizers as well. China's restriction on rare earth magnets has created a crisis for the Indian industry, and the auto sector especially is hoping that a positive meeting between Modi and Xi will help ease high rare earth magnet exports to India. India has also been clearing Chinese JVs with Indian companies wherever a technology partner is needed for Indian manufacturing. Also, in a first since 2001, an Indian vessel with 496,000 barrels of ultra-low sulfur diesel has been shipped to China. Prime Minister Modi is expected to have a one-on-one meeting with Xi Jinping, and this meeting will definitely set a roadmap for ties in the next few years.
Well, thank you so much for that, Parikshit. Definitely a development that all the investors will be keenly watching out for. But let's also listen in to what Amitabh Kant had to say on India's engagement with China.
I'm a believer that India needs to do joint ventures with China. India needs to do joint ventures for components. India needs to do joint ventures on a range of inputs which go into manufacturing. We need to bring down the input and component manufacturing right on strategically important. And I think we need to work with China, and we need to really rework out the Press Note 3 to enable India to work with China to become a great manufacturing nation. The manufacturing must move from China to India, and for that it's important that we work in our national interest.
Amitabh Kant there, speaking exclusively to CNBC-TV18. Back home, all eyes are now on Prime Minister Narendra Modi's Independence Day speech on Friday. Parikshit is here to tell us what he is picking up from sources ahead of that speech. Parikshit.
Prime Minister Modi's 15th August speech may lay out the next phase of India's self-reliance push and Atmanirbhar Bharat program. Sources say PM may emphasize on the need to double down on self-reliance and India's commitment to economic reforms, including ease of doing business, ease of living and ease of taxation. In the current geopolitical environment, the government has been considering ways to increase self-reliance in domestic manufacturing while taking advantage of GVCs where India is not yet competitive. The government is exploring ways to ensure supply chain of critical components are not dependent on any one country. The PM is likely to acknowledge the role of MSMEs as the backbone of the country and reassure them of government support amidst geopolitical headwinds. Another theme for the Prime Minister may be about the strength and resilience of Indian democracy in current times. PM Modi is likely to reiterate India's commitment to farmers and emphasize that the country will not compromise on their interests in any trade deal. In the backdrop of geopolitical uncertainty, the government is expected to work towards greater export diversification and also diversification of energy imports for national security. This theme may also figure prominently in the Prime Minister's speech.
Well, thank you so much for that, Parikshit. We'll definitely be watching out for that. But moving on then, sources tell CNBC-TV18 that the Reserve Bank of India's Monetary Policy Committee is set to witness a rejig. Current internal member Rajiv Ranjan is to retire ahead of the next MPC meet, which is slated for October. Sources suggest that Indranil Bhattacharya, who was recently named as ED in charge of RBI's Monetary Policy Department, is likely to replace Rajiv Ranjan as new internal MPC member. The RBI Central Board is likely to approve Bhattacharya's nomination as a new member in its next board meeting. Well, time for a short break now. More news flow on the other side, so don't go anywhere. Welcome back. You're watching Business Lunch on CNBC TV18. AI startup Perplexity makes an unsolicited $34.5 billion bid for Google's Chrome browser. CNBC's Dan Murphy is here with more details. Dan?
AI startup Perplexity has made a long-shot offer to buy Google's Chrome browser for $34.5 billion. Venture investors have proposed funding the deal, according to the company. It comes after the Department of Justice suggested Google divest Chrome, its flagship search browser, as part of an antitrust suit the company lost last year. That ruling said Google had illegally monopolized the search market. The unsolicited bid by Perplexity is higher than the AI startup's current valuation, which is estimated to be around $18 billion. Perplexity has seen rapid growth, climbing from a $500 million valuation at the start of 2024 to where it is now, after at least 5 capital raises. CNBC understands there's no current Gulf sovereign wealth investments in Perplexity. It was reported by PitchBook that Qatar's QAA was a backer, but we have not been able to independently confirm that investment yet. In April 2025, Perplexity's CEO said the search engine was serving approximately 30 million users. It has received backing from investors including Nvidia, SoftBank's Vision Fund 2, VC firms New Enterprise Associates and IVP, as well as Amazon founder Jeff Bezos and Meta's Jan LeCun. Perplexity is best known for its AI search engine, a potential Google challenger that gives users simple answers to questions and, unlike many other AI search engines, links out the original source material. Last month, it launched its own AI-powered browser called Comet.
Well, in some news from the upcoming Trump-Putin meeting, White House officials have revealed the location of the meeting on August 15th. The summit-level meeting will take place at Elmendorf Air Force in Alaska. Meanwhile, the Trump administration has tempered expectations of a major progress towards a ceasefire, calling the summit a listening exercise. Ukraine's Zelensky and most European leaders have said a lasting peace cannot be secured without Ukraine at the negotiating table. European leaders are set to hold a virtual meeting with Trump on August 13th to underscore their concerns before the summit. Well, time for a short break now. More news and updates on the other side when we return.
Welcome back. Now, the Parliament has passed the new income tax bill to replace the 6-decade-old Income Tax Act. Timsy is joining in to tell us what has changed in the new act. Timsy, over to you.
The Modified Income Tax Bill 2025, a landmark piece of legislation poised to replace the 6-decade-old Income Tax Act 1961, offers more clarity and makes the rules and laws simpler for taxpayers. To begin with, what changes for the individual taxpayers? Earlier, during search and seizure actions, officers were entitled to inspect or seize physical books of accounts, digital devices, etc. But now, officers can access emails, social media profiles, accounts, or any other books, documents in any electronic format. Also, officers can now access passwords, privacy codes. This rule did not exist in the previous Income Tax Act of 1961, but was introduced later on when digital records became a reality. So these rules were not explicitly said in the Act, and now it has been clarified in the new Act itself. Up next, a big relief for taxpayers in terms of claiming refunds. Earlier, the Act had a clause which blocked refunds on belated or late filed returns. But now, refunds will be allowed on returns which have been filed late, which gives a benefit to the taxpayers. So the new income tax bill is not just a relief for individual taxpayers. Here are some highlights for the corporate taxpayers too. First up, on beneficial ownership. Earlier, there were test conditions at level of ultimate owner of shares, and now the bill has removed the ambiguity and gotten a clarity for beneficial ownership in line with the Income Tax Act of 1961. The IT bill released on 13th Feb had brought in alternate minimum tax for LLPs, where capital gains tax had been mentioned at 18.5%. But in the revised version passed by the Parliament yesterday, this has been clarified and reinstated at 12.5% rate of capital gains tax for LLPs, just at par with existing Income Tax Act of 1961.
Well, thank you so much for that, Timsy. But, before we go, let's take a look at Samvardhana Motherson. The company has just reported its numbers, and we're seeing a very sharp spike coming on the stock. When we compare the numbers to the estimates, though, they're, much worse off. Keep in mind that we were working with a net profit number of around 975 crores, and this time around, the net profit has come in at almost 500 crores, and the EBITDA margin, too, has come in much lower than what the street was anticipating. But despite that, it's a very sharp spike in the stock. It's up almost 2.5% for now. With that, that's all the action we have on this edition of Business Lunch. Don't go anywhere. Midcap Radar comes up next.
Good afternoon. Welcome to Midcap Radar, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. A good day for the bulls. So we are above that 24,600 mark. A lot of segments that are contributing. Most of the sectoral indices in the green as well. Good earnings and some good handover from Asia as well.
That's right. Yesterday around this time, we actually saw the markets take a dip for the worse, but today it seems to have sustained, and especially the mid-cap end of the markets, broader in the markets, we're seeing the advanced decline ratio quite strong. We have a lot lined up on the show, an important story and an important conversation as well with the corporate talk. So let's start off with the top headlines. Stocks rise with the Nifty rising to the day's highest point, even as geopolitical and trade uncertainties persist. Metals and healthcare gain, even as FMCG and PSU banks drag. Mid-caps outperform.
Nykaa owner FSN e-commerce turns in a good show with strong growth accompanied by margin expansion, though fashion sales remain a drag. Honasa Consumer 2 beats expectations with healthy volume growth despite early monsoons hurting sunscreen sales.
Archean Chemicals post third straight day of gains. The Union Cabinet yesterday approved a proposal for the company's subsidiary to open a plant to manufacture semiconductor chips.
NSDL under pressure after weak Q1 numbers. Revenue declines 14%. Banking business revenue falls 26% versus last quarter.
Oil India under pressure after posting a muted quarter. Revenues down 9%, while profit after tax declines almost 50% sequentially.
All right, those are the top headlines that we are tracking for you. As Vik pointed out earlier, it's the mid-caps which are doing really well. A lot of them reacting to earnings as well. We have Samvardhan Motherson's numbers which are flashing for you at the bottom of your screen, and the stock is higher in trade. We'll discuss that in greater detail, but for now, this is our special segment, Mid-Cap Movers. We have Hormus to take us through the mid-caps that are moving around in trade. Hormus.
A positive commentary coming in from Samvardhana Motherson that explains the spike that you're seeing, but there are a lot of other movers within the broader markets. We'll start out with the gainers today, considering it is a good-looking screen. And take a look at a lot of these gainers in the broader markets today trading with double-digit gains. Take a look at JM Financial up 14, EIH up 10, and healthy gains also coming in for HBL Engineering and Minda Corp, both at the highest point of the day as well. Positive earnings reactions. It's a day that is dominated by positive earnings reactions, be it Nykaa, be it Samvardhana Motherson, or be it Honasa Consumer as well. But look at NMDC Steel, the biggest single-day gain on record. Windlass Biotech also seeing a gain of around 13% after its results that were reported yesterday. Among the newsmakers today, there have been announcements that have come in from companies like Shakti Pumps on the back of their order win, Bharat Dynamics for the upgrade that they received, the regulatory relief for Paytm, and Orient Pro also receiving an order for the Mumbai Metro today, 6% higher on that stock as well. Stocks that are doing well on the volumes front, and these names, look at Jain Irrigation now at the highest point of the day, 9% higher on that stock. Techno Electric and Yatra Online, another double-digit gain in today's session, and the stock has finally moved above its IPO price of 143. And lastly, there are stocks that are bucking the trend in today's trading session. Not a lot, but look at Oil India at the lows of the day. PG Electroplast in the FNO band, but a 5% knock here today as well. And Coromandel International at the lowest point of the day, 7% lower on that stock. Back to you guys.
Thank you so much for that, Hormaz. A very good list, a comprehensive list of all of the stocks in the broader end of the markets that are making all the moves. Well, we'll now take a short break. Up next, we'll be joined by the management of Lakshmi Dental to discuss the Q1 results. Welcome back to Midcap Radar, where last promised, Lakshmi Dental is the management on our radar today. The company's revenue ticked up slightly, but margins fell on a year-on-year basis. To discuss the quarter gone by and the way forward, we are now joined by Sameer Merchant, who is the MD and CEO at Lakshmi Dental. Thank you so much, Sameer, for joining us. Well, on a year-on-year basis, top line up almost 10%, but you had actually guided the street to almost a 20 to 25% year-on-year growth. So that leaves you with a very steep ask, especially as far as Q2 and H2 is concerned. Are you maintaining the guidance, or post Q1 are you looking to revise it down further?
No, in fact, we have maintained the guidance as well. So, thank you for CNBC getting us on the call. We have maintained the guidance. In fact, we just finished the earnings call. We are still very confident about maintaining 20 to 25%. And we are seeing this sequentially because post IPO, we have just invested the funds that we got from the IPO. And Q1 is, say, about 10% up. And that is how we have guided that sequentially will be 8 to 10% up quarter on quarter. And we are very confident that we will remain at a guidance of 20 to 25%.
Okay, so let's talk about quarter one itself, Sameer. Is it seasonally a different quarter or weaker quarter versus the others, which is making you more confident of better growth coming in the other quarters? What would the growth drivers be, especially on the largest segment, which was lab business? This was up 8% on 8% this quarter, while the domestic business was flattish. Any headwinds that you're seeing? What is your take on what's happening in this particular space?
So on the domestic side, in fact, when we went for our IPO in also our first earnings call, we said scanner, which is the digital scanner to make the impression. Currently, if you go to a dentist, they're making a physical impression, and we have pushed very strongly on the digital part where close to 70% of our impressions received today are digital. So with that push, if you see our Q1 last year, we sold about 84 scanners. Q1 this year, we are about 207 scanners. So that is clearly our indication of the way we are deploying these scanners that we will keep growing. And these scanners are sold with a minimum value commitment to the dentist. So we are very confident that as we keep improving those scanners and as we keep, getting the fruits back of the deployed money that we have done in the last 4 to 5 months, we are still very confident of doing 20 to 25%.
Okay, so that 20 to 25%, if you can split that growth for us, I know lab business is the bigger one. Will it entirely be driven by that, the 20 to 25% growth?
So not just that, so it'll be driven by lab, aligner, and the other businesses, all of them, whether it's India or across the world, whether it's geographically, we are saying that we will grow approximately similar in range of 20-25% for all the companies.
Okay. So, you gave us some insight, especially into the scanner business. We understand this quarter it grew in excess of 26%. Aligners business around 18% growth, and the lab business around 8.5% growth. Now, the issue with the scanner business is we understand that it goes ahead and deteriorates the mix as far as the top line is concerned. So that has also impacted the gross margins as well as EBITDA margins this time around. So going forward, you have guided the street for an expansion as far as EBITDA margins is concerned. Will you now trim that lower?
No, we will keep maintaining that. So what we are guiding is see the scanner margin and the margins for the company separately. Scanner is an enabler for us, correct? So it's a product that we are buying and selling, which is done at a typical normal margin that you would do in any trading business. So if you see apart from the scanner, our gross margins are stable. And that is how, as we grow more in terms of our revenues, we will have the margin expansion as well. And that is what we are still confident. And we are still saying that 20-25% is what we will do this year.
Okay. Aligners is up 18% this quarter itself. Can you split that growth for us between BizDent and Vedya? And in this particular segment, what are the levers for growth? Will you be putting in more investments? Give us a sense of that.
So both are different businesses. One is B2B and the other is B2B2C. So one is Vidya is where we sell the raw materials for the aligners in India and across the world. And BizDent is where we sell the actual aligners, which is a branded aligners where we sell in India. So both the segments currently are seeing different growth trajectory. One is more India and international. The other is India focused. And like I said, even there, quarter on quarter, we will see the impact of what we have done in terms of our deployment of scanners in India and in terms of our geographical deployment, whether it's the salespeople who are moving to better geographies or the regulatory clearances that we are having. So both will have their growth pattern.
Understood. See, we also want to understand in this particular quarter, there were ESOP expenses, that went ahead and impacted the EBITDA margin. However, on a sequential basis, like you had guided, it has come down. FY26, what will be the total impact you will see? And also a picture, as far as the debt is concerned, what is the debt reduction be?
Debt, we are debt free as of now, as we speak. So there is no debt on the company. And in terms of ESOPs, we are going to be in the range of 6 crores. That's going to be the yearly ESOP.
Yearly ESOP will be around 6 crores. So that will be the overall impact as far as the EBITDA margin is concerned. Well, give us a space. We understand that this particular space largely dominated by unorganized players. So we want to understand what has been the market share that you enjoy currently and what is the shift towards the organized space that you're seeing?
So there are a few parts to it, Vivek. In terms of market share, since you rightly said it's very fragmented, so it's very hard to gauge what's the market share. But what we can confidently tell you as to what we have done in the past couple of years, you speak to any dentist in India, I'm definitely sure they know us. So from a marketing perspective, we have created that reach and that is why they know us. But from a share perspective, since it's so fragmented, it's very hard to gauge what's the share right now.
Okay.
Please.
Okay, all right. So the street likes your commentary, Sameer. The stock has spiked from the day's low. The fact that you're maintaining your guidance in terms of top line growth and in terms of margins as well. The stock has recovered sharply. It was down and now we are seeing it down, just being 0.8% as we speak. Thank you so much for joining us, Sameer, today and giving us those details. So that's the word coming in from Lakshmi Dental. But with that, we'll move on to a CNBC-TV18 exclusive. Our colleague Yash is joining us on the latest he's picking up on LIC divestment.
Well, this is a very important update as far as government's divestment plan for the year is concerned, and a large piece as far as that entire plan is concerned, that is in the form of Life Insurance Corporation of India or LIC. What we've been given to understand from our sources is that government is likely to initiate investor roadshows for its LIC divestment process, and that could happen as soon as in the next 2 weeks itself. Now, the early idea that we have been given to understand in terms of government's plan or intention to divest is about 2.5% to 3% of its stake in Life Insurance Corporation of India. As per current price and market cap, that could fetch government anywhere between 14,000 to about 17,000 crore rupees. Now, of course, the divestment process is expected to start. The roadshows are expected to start in 2 weeks. And what we've been given to understand is that a final decision on the quantum of divestment that the government would look to make in the first tranche, as well as the price, will be done after the roadshows conclude, once the government has a better idea in terms of investor appetite. Just to give you some clarity in terms of where the government stands in terms of its stake in LIC, the government holds about 96.5% stake in LIC. SEBI, the market regulator, has given LIC time till May 16th, 2027 to raise public shareholding to 10%, which means government will have to sell about 6.5% stake till May 2027 to reach that 10% public shareholding mark. As per valuations are concerned, IPO price, the upper end of the price band for LIC, the company's market cap was around 6 lakh crore rupees. The listing price, it reduced to 5.5 lakh crore rupees. And today, the market cap stands at about 5.74 lakh crore rupees.
All right. Thank you so much, Yash, for joining in. So the stock is at the day's low, down 3% as we speak, is on our radar. But remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists, shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back. You're still tuned into Midcap Radar on CNBC TV18. We've been talking about how the broader market index is doing really well. Midcap index is higher in trade as we speak, and it is outperforming the benchmark as well, 0.7% higher there. But one stock which is not doing so well on the back of earnings is Oil India. The stock is lower in trade. It is down around 5.5% as we speak and has been trending lower. That's because it reported weak set of numbers. And remember, ONGC's numbers, they were better than estimates. So Oil India's numbers have been a disappointment. Revenues, they were down 9% to come in at 5,012 crore rupees. The EBITDA was down 19% to come in at 1,605 crore rupees. Margins lower by 390 basis points to come in at 32%, and profits were down 49% as well. Now, that bigger blip in the profits have come in because of impairment that came back in 2 blocks in Bangladesh, and that is something that dragged earnings on the bottom line. Their oil and gas production, while it was up 1.8% on a sequential basis, it was lower 0.5% on a YOY basis. This is at a time when ONGC's gas and oil production has been flat on a quarter-on-quarter and on a YOY basis. Crude realization at $66.2 per barrel, in line with estimates. Some of the brokerages also estimated $68 per barrel, so maybe some disappointment there. But yes, a bigger cut in terms of impairment losses, and also it has, in comparison to ONGC, missed on expectations. So subjectively, we are seeing a bigger cut there.
Absolutely. This particular stock quite a steep cut, especially almost 5% lower. Well, another set of stocks that are doing quite well in the session today are actually the defense pack. Remember, the defense stocks are, in the month gone by, actually quite a bit of a steep correction. But some of the stocks today, after an encouraging set of Q1 results, are doing quite well. First on the list is BDL, that is Bharat Dynamics. Now, even though the company reported a loss on the bottom line, it was slightly lower than what the street was anticipating. And the very strong order book is something that has prompted a few analysts to go ahead and upgrade the stock. In fact, Motilal Oswal today has upgraded the stock. Bharat Dynamics up 6%. The other set of defense stocks that are doing quite well are Bharat Electronics, that particular stock up over 2%. HAL, that stock too is doing quite well. And some of the shipbuilders, names like Mazagon Dock, these stocks too are at the day's highest point. We did allude to Motherson Sumi a while ago on the back of the fact that the company saw quite a bit of a sharp recovery. Now, in the investor presentation, the company has said that the impact of tariffs on its operations will be quite limited. In fact, they've quantified it at close to $10 million only in the quarter gone by. And that particular clarification coming in from Motherson Sumi has ensured that that particular stock is now up almost 4% in the session. The other set of stocks that are continuing to do quite well, we spoke to Lakshmi Dental. That stock too has recovered quite sharply. But with that, it's all the time we have on this edition of Midcap Radar. Your stocks when we return.
Hello and welcome to Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in. As always, a good afternoon coming in for the markets. Today we had opened up on the positive note and now we have just picked up in terms of the momentum there. As of now, the Nifty is trading near the day's highest point. Look at it, 24,650, around that mark is what the Nifty is trading at, up 0.6% in today's trading session. Even the broader end of the markets, that's performing in tandem with the benchmark indices. Let's look at Nifty Bank, because that was a bit under pressure. Now, where's the Nifty Bank moving? That has also seen a recovery from the day's lowest point. That is also up 0.3 to 0.4% in today's trading session. And clearly, that advance decline ratio today is in the favor of advances versus declines. That's what we're seeing coming in. Now, for NSE, the number of stocks on the advance side are around 1,600 stocks are advancing versus 1,082 stocks that are declining. A lot of movers in the last 1 hour that we've seen coming in, whether EIH, Motherson Sumi, Godfrey Phillips, these have gained in the last hour specifically. So that's 1 o'clock, post 1, we've seen these run up in trade. Avanti Feeds, that's reported its numbers as well. We have net profits that's up by 39%. EBITDA seeing a good performance as well. So operationally also seems like a good performance coming in from the company. 2% uptick right now is what we're seeing coming in for the stock. We did see a spike up and then that fall is again coming in for the stock, but still holding on to gains of 2%. So not bad for Avanti Feeds, given that they do have that exposure that comes into the US market as well. So more clarity in terms of tariffs is something that they will also be watching out for, but numbers seem to be good. As of now, revenues, 7% growth there. But this is a show where we solve all your stock-related queries, and we'll be doing just that with our experts for today. We have Astha Jain, research analyst at HEM Securities, as well as Somal Mehta, head of alternate research, capital market strategy at Mirae Asset Sharekhan, to answer all the stock-related queries. Astha as well as Somal, good afternoon. Thank you so much for giving us your time as always. Let's start with the first query for today. We have S. Jaykumar, who's writing to us from Tamil Nadu. He's holding 100 shares of Bharat Rasayan, and this is at a price of 10,656 rupees. He's a long-term investor, wants to know whether he should hold or look to sell at the current levels. He's making a profit on this one. Astha, good afternoon, and what's your view here?
Hi, good afternoon, Vinny. Good afternoon to Somil as well and all the viewers out there. So talking about Bharat Rasayan, what is the key point in this company that they have declared today results, and that too in the morning at around 10:30, I suppose. So now I'm today talking about the results only. So we find results to be very good. Why? Because there was a 35% rise in their net sales. I think it has come at around 377 crores. But what was the major feature of the result was the profit after tax, and that has seen a quite a jump of around 25%. Here they have posted some exceptional items. So if I exclude that exceptional item, then my profit after tax is coming at around 25% rise. So this company being into the pesticides, technical grade pesticides they manufacture, and they have posted a very good set of a number, a decent set of number, I believe. So on that basis, we are positive on this counter, recommending a hold with a price target of 12,600.
Okay. And good set of numbers that's come in. So you're telling them to hold, keep an eye out on those levels over there. Also, 12,600 is what Astha is saying. Somal, on the technical front also, what is it looking like? Should the viewer continue to hold this one or just book out their profits now?
Good afternoon, everyone. Yeah, I'm absolutely positive in the short term, in the medium term, in the long term, all three of them. So I think in the very short term, 200 daily exponential moving average was retested a couple of trading sessions before, and now it has started forming high tops, high bottom. In the medium term outlook, it has been sustaining a very broad range between 9,000 and 12,000. It's a very broad range, but that is the range for a little while now. And I think this range will break on the upside and it will give a very good rally. So in the medium term outlook as well, I think it is 14,000, 15,000 levels is expected in next coming probably 6 to 9 months. So a good setup at this point of time. Stop loss would be around 10,300 and my targets would be around above 14,000 levels.
Okay, 14,000 levels. Interesting. So yes, continue to hold the stock because you can still make more profit. That's the word coming in both on the fundamental as well as the technical front. Let's move on to the next query. We have Ajit Menon, who's writing to us from Kerala. He's holding 100 shares of Tata Motors at a price of 947 rupees per share and 50 shares of Tata Tech. This is at a price of 920 rupees per share. So for Tata Motors, they're making a profit. For Tata Tech, they're making a loss right now. Yes, Tata Motors also, yes, they're making a profit right now. So, Asta, what's your view coming in for this one? Should they continue to hold, sell, average? What's the word for both these Tata stocks? Tata Motors as well as Tata Tech. And given that Tata Tech has not done much in terms of performance, then what would you suggest?
Yes, Tata Tech has not done much because what we have seen that they are continuously facing some macro headwinds. And in fact, if I talk about their management guidance also, so now management has started showing some sort of optimism and they are expecting a strong recovery maybe in the H2 of FY26 on the back of a strong deal pipeline which they are having. So I think on that basis only, because if the management is confident, we should give them some chance. And that's why I am recommending a hold, although I know that this counter has not done very well. And here the cost price is also very high because the cost price of investor is at around 900 rupees. But I think at least we should wait for 3 to 6 months time horizon because H2 FY26 is to be believed by the management to be a better half year for the company. So right now, just wait and watch and hold this counter with the initial price target, which we are expecting for this counter, not more than 700 to 750. Although these are not at the cost price of the viewer, but I think they should wait for at least these levels and again review their query in the same show. Now, talking about Tata Motors is majorly facing problems on the JLR front because of the tariff related uncertainties, because of the demand weakness. So I think, and that's why we continue to believe that this counter will continue to face headwinds regarding the margin also. Now, talking about their India business, in fact, the CV and PV business is not looking very much optimistic for this company as of now. So this is pure a long-term play. So here there is no short-term view. It is just if anyone has a long-term horizon of more than a year, then they should remain invested in this counter for the price target of around 750 at the initial levels.
Okay, 750 at the initial levels for Tata Motors can remain invested there. Tata Tech also, 700 levels max is what you're expecting there, right, Asta? Somil, what's your view for both these stocks, Tata Tech as well as Tata Motors? Should they continue to hold both, add some more? What's the view there?
Tata Motors and Tata Tech, very similar charts because in Tata Motors, if you've seen since September 2024, it has been trading below 200 daily moving average, and maximum majority of the time, it has been trading below 20 and 40 daily moving average. Trend is definitely down. Very recently, couple of months back, it has taken resistance at 200 daily exponential moving average and has started making low tops, low bottoms. So Tata Motors, definitely, I would say that it has corrected a bit. It has corrected from 1200 levels to 500. So very good retracement has already done, but I would still wait and watch. If it closes above 740, 750, that will be the right time to go ahead and buy the stock for a medium to long term, positions. So wait and watch, revisit again about 200 daily exponential moving average. Now the next stock is Tata Tech. Tata Tech, I'm not very positive because it's been trading below 200 daily moving average. It has never been gone above 200 daily moving average. Low top, low bottom formation, long-term trend, medium-term trend, all down. So I'm not expecting too much from this stock, and I'll be expecting new lows to be formed below 600 levels. So yeah, exit would be my strategy on this one.
Okay, exit would be the strategy coming in for Tata Technologies. Tata Motors, you can still hold. Let's move on to the next query then. NSDL, that's the one we have on. Now, this is obviously a new listing that's come in. Now, Sundar is writing to us from New Delhi. He's holding 100 shares of NSDL at 1,402 rupees per share. Wants to know whether he should hold or, right now he's making a loss on this one. But NSDL, Asta, this is the one that has done done well, right? What a performance coming in after listing, right? If someone got it at those listing prices of around 800, today 1,200, it did reach that 1,400 mark as well, right? Viewers bought it at that level. But now it's corrected a bit from that 1,400. What should they do? Continue to hold this?
So the IPO came, I think, in the July end, and it was at an issue price of 800. So we have given a subscribe rating to this IPO with a listing gain and long-term perspective. But we were also very much surprised with the kind of listing premium it has shown, not on the day of the listing, but afterwards it has just shown a strong or a sharp run-up. So now the valuations are looking quite high in this counter, because at the time of the IPO also it was coming at price to earning multiple of around 45 to 46. Although at that time CDSL was running at a price to earning multiple of 60, I suppose. So there was a huge gap between both the counters, because they are working in an oligopolistic market where only two players are there, right? So now my idea here is, because the investor has purchased it at a very high price from 800 to 1400, very, very high price. So wait for some time. Definitely these levels will be shown by the stock in the medium term. But right now maybe some sort of profit booking is going on, because it has shown a strong run up. So idea here is to stay invested in this counter. Definitely it will yield profits, but not in the short term, maybe in the medium term. So time horizon can be set for at least 3 to 6 months.
Okay, that's the word there on the fundamental front. Saumil, would you like to add anything? I know there's not much anything in terms of charts, but CDSL is there. So, NSDL, any thoughts there?
See, overall, if you see the sector looks definitely good. Buy on decline should be the strategy. If you see for NSDL, I don't have much charts, but CDSL, let's say CDSL charts definitely looks good. Long-term trend is up, medium-term trend is up. In the very short term, it has taken support at 200 daily moving average. So overall, buy on decline should be the strategy, and I'm very positive on the entire sector here.
Okay, positive on the sector there, CDSL, NSDL, any of them. Just a duopoly there right now. Let's move on to the next query for today. We have Vinesh Gupta, who's writing to us from Jammu, holding 200 shares of Atul Auto, and this is at a price of 450 rupees, wants to know the long-term view for Atul Auto. Asta, your view?
Yes, so long-term view is okay for this counter, not very optimistic, because what we have seen that they have given their results, and the results were, were a okay set of performance, which we have seen on the bottom line as well as top line front. So here Atul Auto is looking to us a very simple and a decent counter with not much of expectation. But yes, one can remain invested in this counter for the price target of 475 to 500 at the initial levels.
Okay, and Atul Auto on the charts and technicals, what is that looking like, Saumil?
Atul Auto, overall, if you see the long-term trend is up, but in the very short-term or the medium-term outlook, I think it should go till 390 levels. That's a very crucial level to watch out for, because there is multiple support zone around 390. So I think in the medium-term outlook or in the short-term outlook, it will slide a little below the current prices till 390, 380, and that will be a good price to revisit, or probably buy on decline should be the strategy, because the long-term outlook is definitely good.
Okay. That's the view coming in there for Atul Auto. But on that note, we're going to actually slip into a very short break, viewers. But here's a reminder for our viewers. Unlock a world of exclusivity, expertise and influence. Become a member of CNBC TV18 Access, our premium members only experience on CNBC-TV18.com. The membership includes access to CNBC TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits. Welcome back to your stocks on CNBC TV18. We still have with us Asta Jain as of M Securities as well as Somil Mehta of Mirae Asset Sharekhan to answer all your stock-related doubts. Let's move on to the next query then for today. We have Vishal Mohan who's writing to us from Chandigarh. It's an investment query. Now he wants to know if he can buy Havells India at the current price for the long term. Asta, what's your view for, Havells, consumer durable side? Are there any other players that you would look at in this space, or Havells is the best bet right now at this price?
So I would recommend not to invest Havells at this point of a time. Let the stock fall more and then take some sort of entry. Now why? Because we all know results were not that great. Lloyd and ECD, that is Electrical Consumer Durable Division, has not performed well. And the reasons can be, yes, unseasonal rains. And we are seeing that this is the phenomena which we have seen across the industry. But the wires and cable division is doing well. But still, and we have seen a volume growth in that division also. But I think let's give it a chance for at least 2 to 3 months more. Let's see how their Q2 numbers pan out to be, and then make a fresh entry into this counter. So right now, I'm not recommending to enter into this counter at this point of time.
Okay, right now do not enter the counter. The stock was down almost 19% in the last 12 months as well. Somil, what's your view for Havells as well? Would you also say on the charts and technicals, it's better to wait out maybe till Q2, wait for the Q2 numbers and then decide whether you want to enter the stock?
Absolutely, I agree to Asta. At this point of time, it is trading below the averages, forming low tops, low bottom formation. A huge consolidation has broken on the downside. It does not look that great for me at this point of time. 1380 would be the right level to enter the stock probably, or just revisit again because 1350, 1380 is a very good, very strong support zone. So I would suggest to revisit again around 380 levels. Short term negative, medium term negative, but the long term is definitely good to revisit around 380, 350 levels, 1350, sorry.
1350, 1380 levels is what they could look at and revisit at that time in terms of, whether it merits entering Havells right now. Long-term story surely intact, but wait, maybe there could be some bit of a correction. That's the view coming in both in the fundamentals and the technical front. Let's move on to the next query for today. We have Sampath Kumar, who's writing to us from Tamil Nadu. He's holding 60 shares of Go Fashions. This is at a price of 791 rupees per share, making a loss on this one. Now wants to know if he should continue to hold or book out his losses. Asta, what's your view coming in for Go Fashions? What is it that the viewer should do? This is on the textile retail side. Is this the best play, and should they continue to hold, and will they recover their losses?
Not a best player, because there was a reason behind it. The same store sales growth was negative this quarter. It was negative 2% against positive 2%. So I think that is the major reason we have not seen a strong stock performing so well, because of the poor results. But now what is catching point about this is they have opened 27 EBO, and in fact their end of season sale has gained quite a traction. So I think that can be the reason. Maybe the next quarter can be a good one, because management is also on the track of opening 120 to 130 stores by FY26. So I think this is a candidate which can be given a chance to hold for at least 3 quarters rather than booking losses at this point of a time. Idea here is to stay invested in this quarter with a price target of somewhere around 740 to 750.
Okay, and on the technical front also, what are we watching out for, Somil, right now? Does it merit continuing to hold the stock?
No, I don't think so. It's been in the downtrend for a little while, and it's the 200 daily moving average. Every time it goes to 200 daily moving average, it takes resistance and starts forming low top, low bottom. My suggestion would be to exit the stock. There could be a bounce in the very short term. That would be an opportunity to sell or exit the stock around 750, 730 levels, and then I would be expecting this stock to again make new lows.
Okay, that's a view coming in there on Go Fashion right now. Let's move on to the next query. We have Rajesh Rajan, who's writing to us from Bangalore. He's holding 3,000 shares of Biocon. This is at a price of 380 rupees per share. Wants to know a short-term view, 3-month view for Biocon. He also wants to know if he should continue to hold or book partial profits in this one right now. Actually, he's making a loss. There's no profit as much. It's just slightly below his buy price. So what should he be doing? Asta, Biocon, what are we watching out for? While clearances did come in terms of their facilities, the Malaysia side, the Bangalore facility. But this time the earnings were not that great. Earnings were not as exciting as one was expecting it to be.
Yes, earnings were not exciting. Management guidance was exciting because I believe we have given the guidance of around double-digit revenue growth in FY26, and that was on the basis of the sustained momentum in the biosimilars as well as their generics margin are expected to see some sort of increase in H2. So on these basis, management has given the guidance, and I want to believe the management. Then I can recommend only hold for this counter. So right now we believe that this can be a hold category counter, and hence we are recommending hold on this with a price target of 405 at the initial level. So I think definitely this will yield some sort of profit also because the cost price is 380 rupees.
Okay, and Somil, a quick word on Biocon on the charts?
Absolutely positive on the stock, been positive for a little while now. It has broken a small triangle pattern on the upside. In the very short term, we've seen correction, but I think the next level on the upside would be 400, 410 levels. I agree with Asta, positive on the stock. Support would be around 350 and 330 levels.
Okay, keep an eye out on those levels over there. Positive views coming in on the fundamental and the technical front for Biocon. But that was the last query for today. So Somil as well as Asa, thank you so much for joining us on the show as always and helping our viewers solve the stock-related queries. Thank you so much for that. And viewers, thank you so much as always for sending us your queries. Remember, you can always email us your queries at the email ID at the top of your screens. But with that, we're going to wind down this edition of Your Stocks. Thank you so much for tuning in. Up next, you have Closing Bell to take you through the last hour of trade.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The high which the market made was 24,702, and that remains the first level.
If you took away gold from core, then it falls to actually 3%.
24,487, 0.4 lower.
Dollar's been consolidating post the 10% fall we saw over the last 4-5 months.
But more importantly, EBITDA grew to 845 crores.
Be the mid caps, which is up 0.6%, be the bank Nifty, which is up 0.1%.
The Indian industry hopes China will ease the supply of specialty fertilizers as well.
It will help Paytm be more competitive than before.
Most of the sectoral indices in the green as well. Good earnings and some good handover from Asia as well.
Well, that is the day so far, and the markets are at 24,642, which means we're about 150 points in the green at this stage, not quite at the highs yesterday, and that remains the first resistance level, the high of 24,702. So we'll see if the market's got it in it to kind of sort of take those highs out, but that's the first port of call as far as the Nifty is concerned. For the Nifty Bank, it's 0.25%. It's an inside day. I mean, we are basically trading within yesterday's high and low, so there's not very much to take away in terms of price action there. Small cap and mid cap indices are doing much better. You got about 0.6, 0.7% gains coming through there as well. Let me just quickly run you through what's lined up here on the program. Paytm is a stock which we will address. Stocks at a new 52-week high. There is regulatory easing which has come through. Ritu joins us on that. NSDL has slipped as valuation concerns weigh post a mixed set of first quarter numbers. Stock's done very well today. It's down about 5-6%. Apollo Hospitals up 6%. We spoke with the management numbers at a beat, and you'll hear that commentary coming through as well. Hindalco is the other one. Top gainer on the index after copper and aluminum segments outperformed expectations, and Nigel will take us through that. So that's what's coming up here over the next 60 minutes. But let me welcome in Nigel and Rima, who are with me. Guys, good afternoon.
Hi, good afternoon. We expected a positive start, but this has turned out to be a little better than where the start is. So one was a softer CPI print. Asian markets closed very well. Hang Seng 2.5% up. Japanese markets were strong from the word go, so 1.5%. Europe right now is up close to about 0.5% across the board. So global markets have been fairly buoyant, and plus we had fairly good earnings reaction. The top two Nifty gainers are reacting to numbers, whether it's Hindalco, Apollo Hospitals, and so many in the mid-cap space as well.
Well, today's trading session is such where it reminds me of the 1990s, right, the Indian cricket team, when everyone scored, Sidhu, Azhar, everyone did well, but Tendulkar didn't score, at that point of time, because the Nifty Bank is not able to get itself up. And that is the problem. If Tendulkar scores, then that score looks even bigger. The run rate comes about, the pressures on the opposition. Now, as we speak, that Nifty Bank is not performing. So that is a bit of a worry. Otherwise, the team is in good form. You have stocks like Hindalco doing well, Apollo Hospitals, but both of them together, I think they account for 2.5% of the Nifty. That's the only problem pocket. And the Nifty Bank at any kind of bounce is getting sold into. So Tendulkar or Rima.
Not me.
The Nifty Bank needs to find its form. If that is the case, there's a genuine fear for the bears because this market is net short. Any kind of good news can pepper up. So let's see whether or not Nifty Bank can find its form. I think that's the most important trigger from here on.
Now, I think the big one to watch will be the Friday meet, right? Earnings is largely done. You've got a BPCL, and a few of the mid caps, but that triggers out. So I think looking ahead, it's the...
Actually, it was till 2 days back, it was just one event on Friday. Now it's two. It's also the speech in the Red Fort, Prime Minister Modi, right? And I think expectations are... I don't know how much of it is, of course, going to happen, but, this 1991 type of... It sounds very cliched, but actually, if you think about it, it is true. I mean, backs to the wall in a tough spot with the US, the largest market in the world. So I think the calls are not unfair that, you should do. And I mean, even the most staunch supporters of the government say for the last couple of years, things have kind of stalled in terms of reforms, etc. So maybe you need to, kickstart that once again. And we do it when you are in a tough kind of a spot historically. So we'll see. There is, of course, Alaska, but there is also New Delhi. which should be
Red Fort and Alaska, both on our radar right now. But it's good to see that there hasn't been too much optimism or market built up in anticipation of what might come out on 15th of August. But let's prep you up for the last hour of trade. Mitesh is now joining in with his closing strategies. Mitesh.
So I think the index, while Nigel was complaining about Bank Nifty not participating, I think the important part is that the indices have stopped falling. I think on the for the first time in the last many days, when we've seen the markets make lower highs and lower lows as a sequence, this is the first time that we had a bounce back from 24,350, went to about 24,700. The closing was around 24,600 for that candle on the 2-hour chart, and then came down to 24,450. Now we are trading beyond the 24,600 level. So there's something positive which is happening. The indicators have started to slightly turn up in the oversold category, in the oversold zone, which means that we could still be in for a good bounce back. As I maintained, 24,750, 800 is the first level. Once we start getting past that, then I think we might have a stronger bounce back. So in that sense, the tone is slightly turning positive. On the stock side, I have buy on Indian Bank. The stock was trading exceedingly well 2 days back, and then it's completed a pullback in the last 2 days. So buy now with a stop at about 664. Look for a target of around 690 to about 695 on the upside. And the second stop is Laurus Labs. Went to about 920, came down to about 820, and has reversed that, completed the correction. So buy here with a stop at about 847 for targets of 885.
Thank you very much for that. Let's talk about Paytm. That's a big mover in a regulatory boost for Paytm. The RBI has granted an in-principle authorization to operate as an online payment aggregator. Why is this important? Ritu joins in with the updates and the details.
Well, after a near 3-year wait, the Reserve Bank of India has finally granted Paytm's 100% owned subsidiary, Paytm Payment Services Limited, in principle authorization to operate as an online payment aggregator. Now, that is essentially the business which runs Paytm's digital payment gateway for all of its merchants. But importantly, RBI has also lifted the ban on new online merchant onboarding, which had been in place since November of 2022. But to be clear, even when that ban was in place, Paytm had still been servicing the existing online clients, and it had also been signing up new offline merchants. But this, of course, clears a big regulatory cloud over the payment business. Now, the market is quite crowded. There are more than 50 players that have this license, but Paytm's massive base of 1.3 crore merchants does give it a strong shot at regaining momentum. The timing is also quite interesting. It comes just days after its Chinese investor Ant Fin fully exited Paytm, selling that remaining 5.8% stake. Now, remember, Paytm's initial application in 2022 was returned by RBI, and the company had reapplied for this license only in September last year after getting the government's nod for its downstream investment into PPSL. Keep in mind, though, that the RBI nod right now is not unconditional. The company will have to complete a system and cybersecurity audit within 6 months' time and submit the report to RBI or risk losing the license. Now, brokerages have given the move a thumbs up. Citi says the license win is positive for sentiments because it lifts a major regulatory restriction on the business, and it will help Paytm be more competitive than before. And Bernstein adds that this will have limited immediate impact on metrics, but it is a major relief nonetheless and is going to support higher payment margins for the company over time.
Okay, all right. Thanks a lot for that, Ritu. Well, let's welcome Sudeep Bandyopadhyay, Group Chairman at IndiTrade, who joins us on the show. Hi, Sudeep. Good afternoon. Good to see you, Ben. Markets as well are in a far better place, so it always, livens up the mood. What about Paytm? At 2,000 rupees odd when it came out of this IPO, a lot of investors, they were not too happy. And from there, the stock went all the way down, I think, to around 400 rupees. Now at around 1,100 rupees, the pieces seem to be falling in place. Do you think it's had its good run, or do you think the good run is yet to come?
Good afternoon, Nigel. I think Paytm has gone through the roller coaster ride, really. And you're absolutely right. From the IPO days till about 400 levels and then back to 1,000 plus levels. I think today's news definitely is positive, sentiment positive, definitely. And I think eventually this is a very positive development from the company perspective. Regulatory cloud getting lifted is always a welcome development. But I must say that The field is extremely competitive. Last 3 years, they have lost kind of momentum when the regulatory restrictions were in place on onboarding merchants online. So they have lost some ground, no doubt. And, they have to catch up quite a bit. Of course, they have a strong merchant base and they can do a lot of things and things can move very fast. But we have to wait and see how things move. This is just good for sentiment. As far as valuation is concerned, I think I would say it's kind of fully valued. At this stage, without things actually happening on ground, I don't think I will, recommend a buy or put a target which is above the current levels. In fact, it is fully valued at these levels.
Okay, Sudeep, the other one is another, if I can call this a digital business, it is a digital business. NSDL is what I'm talking about. In focus after their numbers, stock's done very well from the listing price, but today it's down. And Vamakshi is here with the results and what the street made of the first numbers post-listing. Vamakshi, take it away.
Well, yes, a mixed set of numbers coming in from NSDL. The revenue saw a decline of almost 14% quarter on quarter, but the decline in the total operating expenses was at a much faster pace of almost 20.5% sequentially. This resulted in the EBITDA margin expanding by 543 basis points to 30.5%. The EBITDA was up 4.4% and the net profit saw a much sharper uptick of almost 7.6% sequentially, driven by largely a 15% jump in the company's other income quarter on quarter. Now let's look at how different segments perform. The core depository business, which accounts for a significant portion of the company's revenue, saw a decline of almost 3.4%. The big hit came in from the banking segment, which declined by almost 26% quarter on quarter. But margins on the flip side improved across the board. The highest improvement came in for the database management business, which saw an improvement of almost 450 basis points. The depository business margins also improved by 380 basis points. But the margins for banking saw a limited improvement of around 46 basis points. Let's take a look at the valuations. Based on the closing price yesterday, NSDL trades at 72 times. This is coming in at a significant premium to CDSL, which trades at 53 times. So not a great set of numbers from NSDL. Valuations are relatively higher. Resultantly, the stock is tanking in trade today.
Okay, look at the valuations there. NSDL, Sudeep, any thoughts here?
I've been always saying that I think, if you look at the matrix, CDSL is much better positioned in terms of margins and in terms of future revenue as well. Because CDSL have got 4 times the number of folios compared to NSDL. And in this business, remember, per transaction is what you make. So obviously the opportunity for CDSL to make money when the market is good is significantly higher. And even when the market is not so good, their pressure on CDSL will be much lower than NSDL. So under the circumstances, I think, the NSDL attracting a much higher valuation multiple compared to CDSL is not a viable proposition. So I would say, at least they should be similar multiples, or if at all, they should be at a lower multiple compared to CDSL. The multiple at which they came in when they did the IPO, I think that was more realistic than what they're quoting now.
I think that time it was about 45, 50 times and at a discount to CDSL, considering that CDSL was growing faster, better margins and gaining market share. But now with the run-up in NSDL, it's become more expensive. Sudeep, stay on. Apollo Hospitals is surging in trade on the back of strong Q1 earnings. Earlier today, we caught up with Sunita Reddy, Managing Director at Apollo Hospitals. This is what she had to say about their expansion plans and the demerger.
Currently, we're opening Pune with 250 beds by the third quarter. We're opening Defence Colony this quarter with 87 beds. Defence Colony is a fully focused women's healthcare, including on-call unit. We have Sonapur in Calcutta with 250 beds, as well as Belapur. So Belapur is an acquisition, Belinis Hospital, which is an acquisition in Bangalore with 150 beds. So these are the 4 hospitals that we will be opening in the third and fourth quarter of the year. In terms of addition, we're looking at 500 beds added this year. It's been approved by the board. I think we've made the application to CCI and NCLT. This should take about 18 months. In about 18 months, we should be ready to announce, and following that, AGM approval, we should be able to list. We continue to look at acquisitions. Let me just put this one figure before you. Of the 16 lakh beds in the private sector, 1 lakh are, are totally private, held by trusts, etc. They are only less than 50,000 corporate beds. So there is a huge structural demand-supply gap.
Okay, that's Apollo Hospitals. Sudeep, generally the numbers from hospital companies has been good. Apollo Hospitals is, 15% revenue growth year-on-year, steady margins. Max Health came out with numbers a while back. Here, the top line growth is 27%. In the hospital space, which is the most attractive stock, according to you?
Well, I like Apollo Hospitals and I've been liking it for quite some time. And I believe it still has a long way to go. I think the way they have been going about their business is, absolutely copybook. And, the demerger also is a very welcome step. It will happen over a period of time. But I think it's a fantastic step. Consolidation is happening big time in the industry. The acquisitions are happening. Apollo has been also in the forefront of acquisitions. And I think, the way they have been increasing the average revenue per patient per bed also is commendable. So even the online business, which was kind of a drag, I think that also has improved significantly. So I am definitely positive on the entire hospital sector and Apollo in particular.
Apollo in particular. Any other single stocks on your radar? We reported, Sudeep, this was, of course, yesterday's story, that the Suzlon CFO is leaving to join what was erstwhile Indiabulls Housing. Of course, Indiabulls Housing had been a troubled name in the past with a lot of issues. I think the book, etc., has been cleaned up. Himanshu Modi has put in his papers. That news came out yesterday. And we'll see if the actual announcement of him joining what is now called Sammaan Capital happens or not. I don't know if you've looked at this company or any thoughts at all. Sudeep.
Well, I've looked at both. In fact, Suzlon I do like. And I think, of course, Mr. Modi leaving will be probably a bit of a challenge, but they will get a new CFO. And the business is on a good pace at this stage. Mr. Chalsani has been an experienced hand and he has been running it pretty efficiently. So I think, I won't change my view on Suzlon based on this exit. As far as Sammaan Capital, professionalizing and more bringing in high quality professionals is a welcome step. You're absolutely right. There were a lot of question marks and challenges which erstwhile Indiabulls Housing did face. And with experienced professionals coming in, I'm sure things will be better. As of now, I think overall we are positive on housing finance sector, and Sammaan Capital has a large housing finance book. So we are positive overall, but specifically Sammaan Capital, we haven't done much work.
Okay. All right. Sudeep, I wanted your view on JM Financial. Yesterday we had the management who joined in on the show. I had this show, on Finding Alpha, and Digant Arya, he was talking about this one being the dark horse and it could relatively outperform from here on. If you look at their presentation as well, they've clearly given a far clearer path on the way ahead. And the street, it looks like, is taking note of it. At around 185 rupees, everything's in the price, or do you think it has more to go?
No, I think it has got more to go, Nigel. In fact, I do like JM as well. I think they're, getting the pieces right, and the growth opportunity is significant. There are some financial businesses which have grown to an extent, and future growth will be only incremental. Whereas in case of this particular company, I think exponential growth from here on is definitely possible. They're getting all the pieces right now, and we are positive on JM Financial. The results were pretty good.
In fact, Digant has put out a view on his handle. Strong traction in capital markets, expansion in wealth management, scale up in private credit, and stake sale in HFC at 3.2 times book. Those are the reasons. The old business, the NPA pain is over, and recovery has started as well. So that's one of the big movers. So they have a couple of more questions. Then Orient Pro, that's up close to around 7.5%. The stock, I recall, had gone one way, and then from the top, it did see a correction. But earlier today, it got around a 250 crore order with regard to the metro. The street likes it. Volumes are very, very large on this name. What's your view?
Nigel, I'm a little skeptical of this entire, what is happening in the market. The moment a company gets an order, there is excitement built around the counter and the prices start shooting up. See, we have to understand that there is a difference between, getting an order and successfully executing it and, making it a profitable proposition. So I normally look at these kind of excitement with a lot of caution and, care. And I will say that, there's no need for this kind of excitement based on this order win. Yes, I think things are slowly but steadily improving, but I won't, subscribe to buying the stock at today's elevated price.
Got it. Well pointed out, Sudeep. Thanks a lot for joining in and giving us your view on that name as well. Not too impressed with Orient Pro at this particular price. By the way, the accident of the last 1 hour is Insecticides India. Pull up the intraday chart on that stock. It's falling on very, very large volumes. I think Insecticides India should come up for you on the screen. I think it's down closer around, it's down 9%. Just take a look at that. What a fall on that name. So big downtick is what we're seeing on that one. On the flip side, I think Fact came out with its set of numbers and the street likes it. So that stock as well has spiked up in the last few minutes. Yes, Rima.
Insecticides numbers, just to recap, revenues up 5.2%. EBITDA margins 12.2 versus 11%. So there is margin improvement. There is modest growth at the top line, 5.2% revenue growth, and profit up 17.5%. But clearly, the street doesn't like even modest growth.
I think volumes, just to be sure, I don't know, volumes are some 20,000 shares so far, right? I mean, in terms of 22,000 shares. Or
someone just press sell on.
I mean, it's kind of low volume kind of name, but it's fallen. You're absolutely right.
No,
$100.
It's large volume, actually. Just take a look. 4 lakh shares, maybe on one exchange, Prashant, you're looking at. It's 4 lakh.
Yeah, sorry, 4 lakh shares. 4 lakh shares on the NSE.
And I think on the other exchange, it must be relatively lower. So falling on rather large volumes on that one. I'll tell you what, we'll slip into a short break. Come back, we'll continue to focus on the markets. We'll also be joined by Dinshaw Irani. Stay with us.
Welcome back. On Insecticides India, all we know is that the last time the company spoke to us, which is post their Q4 numbers, they said that FY25 was a tough year. But in FY26, the company was expecting to see more than a 10% revenue growth in FY26. And versus that, they've done a top line of 5.2%. So versus expectations for the full year, it's been a bit of a subdued start. But we'll wait for more what the company has to say. But let's talk about Hindalco. Numbers came out yesterday. It didn't react so much yesterday. It did come out in the last half an hour.
Yeah.
But today you're seeing the big move.
Well, that's right. The global cues as well are positive. If you look at optimism with regard to Fed rate cuts, as well as there is some optimism that China is going to pepper the economy out there. So both those two are working in favor. So the global backdrop actually is positive. The results were mixed. Yesterday on this show itself, we had told you that Hindalco's numbers actually look good. The India business, while Novelis was weak. So on that front, it's actually a little bit of a mixed set that we saw in terms of their numbers. Let's take you through the India piece, which was good. Aluminium business, EBITDA number, 4,300 crores, better than the 4,000 crores. Copper business, 670 crores, better than the 600 crores that we were working with. So on both those two parameters, the EBITDA number was a beat. Added to that, at the start of the day, we had news that Novelis's debt had gone up mildly. But on a consolidated basis, because the India business is throwing up so much of cash, their net cash as it is, and the net debt number actually has improved on a sequential basis and even on a year-on-year basis. So that's heartening to see because they've been incurring a big capex. Moving to Novelis, that's a bit of a problem pocket. The EBITDA per ton number came out around $432 per ton. The street was working with a number of around $450 per ton. So you'll say that is disappointing. Yes, it is. And in the first quarter, the tariff impact was around $28 million. Now, the management said that since the tariff actually has been fixed at 50% instead of 25%, the impact on a quarterly run rate could be around $60 million. Earlier, they were talking about $40 million. So in quarter two, in all probability, you'll have a negative impact of around $60 million. Now, that as well is negative. But the management is calling out that this is bottoming out of the EBITDA and things will improve from here on. That's because they're going ahead and they're focusing on the cost side and they're looking at saving close to around $100 million by the end of this year. In the coming years, they're talking about a number of around $300 million odd. And earlier, they were talking about $75 million in the near term, which now they've upped to around $100 million. So the street likes it that the management is actually calling out that things will bottom out from here on. The management spoke to me earlier today. They said that the quarter two performance for Novelis will be similar to what we saw in quarter one. But in the second half of the year, they're saying the aspiration is to gradually head towards that $500 on a per ton basis. So that's encouraging to hear. And in terms of brokerages, various brokerages were skittish, but CLSA, they have an outperform rating, target price of around 850 rupees per share. They're expecting the capex to peak out and they're expecting the consolidated leverage will be sub 2 times. So put everything together, global backdrop is good, India business is doing quite well, and they are calling out that the Novelis business will actually bottom out. Street likes it, stock, one of the top gainers on the Nifty.
Okay, let's move on and get to some more stocks which are buzzing. Hormus is now putting the spotlight on the top movers at this hour.
Well, the earnings season is calling it time for the quarter with a bang with these outsized moves today. But look at NMDC Steel here, 20% higher on the stock now. It's the biggest single day gain on record for the stock. And we have already had 10 crore shares being traded compared to the 20-day average of just around 13 lakh shares. Another outsized move seen in GM Financial. It is the 6th day that the stock is gaining today. This is the biggest single day gain that the stock has seen since April of 2020. The 16% move. We've already had close to 6.5 crore shares that have changed hands, and a 20-day average is just 60 lakh. And this year, the stock has already risen 40%, and this is the best calendar year return that it has seen since 2017. Jain Irrigation is the other one that has seen double-digit gains today. It's the biggest single-day gain seen since June of last year. Now, before gaining on Monday's trading session, the stock was down for 10 days in a row. And in today's session, the stock has gained on volumes that have had almost over 2 crore shares traded, 20-day average at just 18 lakh. But despite this 14% up move, the stock is still down 22% on a year-to-date basis. An interesting name here is Windlass Biotech, and this CRAMS player is gained the most since February of this year. It's the third straight day of gains, but we've already had 10 lakh shares being changing hands. The 20-day average is just 50,000. Now, this is one of those IPOs that listed at a discount. It made a low of around 200 rupees, and from there the stock is is up 5x, and from its IPO price, which was 460, the stock is up almost 2.5 times. And lastly, to balance it out, we'll give a name on the downside as well. Rupa and Company is one of them, and the stock has had a pattern. It's down 8.5% today, but over the last 5 weeks, the stock has had a pattern of gaining only once every week, and the rest of the sessions that has declined. In today's session, the stock is down on volumes that have had 5.5 lakh shares compared to around 1.2 lakh being the 20-day average. It's down 20% this year, and this is the 4th straight year that the stock has had negative returns. Back to you guys.
All right, Harmas, thanks very much. Rupa and Company, not talked or heard about that name for a while now, but it's...
What a pattern he's found.
Yeah,
it's gained only once in a week for the last 5 weeks.
For the last 5 weeks.
Amazing.
Amazing.
First bencher in the class, na? Harmas always on top of his game, completing his homework. Good guy. Lovely.
Come on. Anyway,
Thanks, Harmas. Thanks.
Let's bring in Dinshaw Irani, CEO, Helios Mutual Fund is with us. Dinshaw, good afternoon. Great to have you with us here. Thanks for joining us. We'll talk about markets broadly in a bit, Dinshaw, but I reckon you have Paytm in your portfolio, right?
Yeah, Prashant, first of all, thank you for having me on your show, and a very good afternoon to you and your viewers. Yes, we have a Paytm in our portfolio. In fact, all our top 4 holdings have been doing fairly well for us. Paytm is one of the top 4 in the portfolio.
Okay. Which are the other 3?
There's Eternal, there's ICICI Bank, and HDFC Bank.
All 2 digital businesses, and actually the other 2 also would like to call themselves digital businesses. All 4. Yeah, Paytm, you think there will be continued... have you discussed this with the team? Obviously, you own it. You think there is more upside here. But do you think there is more regulatory easing which is possible, or it's done? They can onboard merchants now, which was disallowed. Is there anything else to do?
I think, Prashant, it's just a starting for not only Paytm, but all the fintech guys, in the sense that India's got a long way to go anyways. And obviously, Paytm being the biggest, and we've loved this stock for a while. We didn't obviously participate in the IPO, but we came in at the time when the stock was looking fairly exciting. After that, the regulatory issues happened also, and still we started adding to that stock even during on the way down. And frankly, the stock has been one of the best performing in our portfolio today. And in fact, even today, if I'm not too mistaken, my CIO, who doesn't believe in keeping any cash in his portfolio, in fact, every morning he shakes his fund managers to find if there's any loose change. I'm sure he would have again added to the name as such, because that's how comfortable we are with that stock. And I think it's got a long way to go. It's not even touched the tip of the iceberg today.
What else is coming in terms of recommendation that your CIO is buying? You can't hold cash, money is coming in. So what have you been buying in the last, say, 1 month?
No, we can hold cash, Reema, but we don't like to hold cash because we believe in markets like ours. It's a sin to hold cash as such. And frankly, there's always ideas. Like Eternal was one of the ideas that we liked at the very beginning itself. And obviously, we played along with that idea. I'm sure there are others also, which you'll see when you see the portfolio getting declared. You've already seen in the July in the portfolio, there are a few names which were added. And again, going forward, you'll see a few more names getting added again.
Always. The July additions? Which ones?
So basically, I think a couple of new names which came in. I don't remember the exact names, but if you look up the portfolio, you'll see the names as such. I think Aether Energy was one of them, which we had picked up. I won't know beyond that.
We have PNB Housing as well?
So PNB Housing, yes, that's been there for a while with us.
You have not topped up on that one?
We did add to that one in the recent correction that came by.
So clearly, new age tech companies, so-called, something that you like, Eternal, maybe even Aether Energy. What about Honasa and Nykaa? These are the 2 flavors. So anything in the consumer pack?
So, okay, the fact is that when you're looking at these new age companies, you want a very, galloping top line kind of a growth, which we don't see, at least in the case of Honasa. Nykaa still, I think the maturity levels are still there, but frankly, in both these names, we weren't too excited, though the numbers were pretty good. And that they were good mainly because of the way the margins expanded rather than the other way around. So I think we are looking for more of a, when you're a new age company, you're obviously looking at capturing market shares and stuff like that. That doesn't seem to be playing out in these 2 names. So we are avoiding these 2 names as of now.
Dinshaw, what about tech? I don't think you were, too positive on the traditional tech names. You're nodding your head as that comes, as I'm going to deliver that one itself, you're saying, no, that's not the delivery that I want. But, it's suddenly started holding its own, the negative news flow is being ignored. The growth is going to be very, very tepid. We know that. But in terms of valuations, the yields, still it doesn't excite you at all?
So, okay, Nigel, let's go back a bit and let's see the valuations, what these guys were commanding probably pre-COVID, right? Pre-COVID, the growth rates were like the same as what you see, not even same. They were slightly more than what you see today. In fact, they were high single digits kind of growths. The valuations of the top line, I mean, top end IT companies were 17, 18 times forward earnings. Even today, after these corrections, they're still at 20, mid-20s kind of Ps as such for a growth rate, which is like mid-single digits to low single digits. So still not exciting for us, frankly. I mean, but the point is not that. I mean, if obviously if the valuations were lower, we would have looked at those very benignly. But the fact is that there's a lot of uncertainty today playing out with these guys. One of the rejection factors that we have is midterm triggers, medium-term triggers. Now, medium-term triggers, AI, I think, if anything, is not a big positive for them. And that's what we want to see how that plays out. Once that plays out properly, then probably we'll look at it with a fresh lens. But as of now, we're not at all comfortable. And obviously, given the uncertainties in the US, the way the businesses are, I mean, the way the tariffs are being negotiated and stuff like that, I don't see much of businesses prospering in the US itself anyways. So discretionary spends won't be happening. So that's why we are rather better off staying away from IT as of now.
You have Motilal Oswal Financial Services in your portfolio. Actually, April was, obviously it's all benefit of hindsight, right? But $500 was the low on Motilal Oswal. Stock's at 930 rupees now. So you got to, I mean, the lesson has been any meaningful, non-meaningful dip, you got to grab.
Yeah, obviously, I mean, Prashant, if you convince on your stocks, and that's what helps us. I mean, our philosophy of elimination investing is what helps us in understanding why we actually don't select stocks, we reject stocks. So whatever remains behind, we know what is the reason why the stock is behind you. I mean, why it is there with you. And obviously, till the time you don't hit any of those rejection factors, you keep lapping up that name as and when you see an opportunity coming by. And actually, not only Motilal, that same happened in the case of Eternal, the same happened in the case of Paytm. And in fact, the Ather Energy that I talked about, again, the stock after our buying went down, but we were very convinced on that name. And you've seen after that what has happened in that name as such. So that's what helps you around. The conviction of your picks is what helps you in probably evening averaging it out at the right time, I suppose.
Ather, there's still, it's not, I mean, for me, I mean, as an owner of the stock, there's, I'm assuming, a decent upside, right? I mean, if it works out, it's not run away.
So none of the stocks are slam dunks, right? I mean, the fact is that what was the reason why we bought Ather? We bought Ather because at that point in time when we bought it, the market cap was around $1 billion odd. The market share of that company was around 15-16% in the EV space, two-wheeler EV space. Now, the whole logic here was that is the Indian EV space worth what? $6 odd billion, $5 to $6 billion? No, it was not, right? I mean, the same reason is why we bought an Ola. By the way, that's one of the new names that you'll see in our portfolio. You will see, as in you've already seen in the July portfolio. So obviously, these are the reasons that we pick up these names. There are macro stories. Growth rate is insured. The fact is that these are changing, and that's why we believe that this is the way forward. The new age companies, the new technologies, that's what you want to play with. And frankly, I mean, we've always been clear about our philosophy that, rather our investment strategy, that you have to be inward looking. You have to look at only India growth stories and not China +1 plays and stuff like that, which can be decimated by way the tariff has panned out for us.
But you all did add to your position in Gokuldas Exports. Is that correct, in the month of July?
No, we didn't. We didn't actually. No, we didn't. In fact, you would see that the weight has gone down per se. The fact was that we were also taken aback by that additional 25% which came by. And obviously, we were quite wary of the first 25% that was being applied to it. So that's why we rather decided to stay away from that, and whatever was remaining was lying in our portfolio, and we didn't touch it.
Just one thing, Ola is going to be 15th of August is when they have that annual event at their factory, the border of Tamil Nadu and Karnataka, and they will unveil bikes, I think, this time around. And we will, of course, we report on that, and our reporter will be there to track the developments. Ola, of course, is a recent addition, as you said, to the portfolio at Helios. Thank you very much for joining us. Good speaking with you, and really appreciate it. Thank you.
Thank you.
Okay. All right. Thanks a lot for that, Dinshaw. Well, let's move on then. Nimesh is waiting by. He is going to tell us what he's picking up in D Street Chatter. Nimesh, take it away.
Hi, Nigel. A decent pullback, but the big question is, can it sustain? And all will get answered as to what happens in that big meeting on 15th with the global leaders. So that's going to be a big trigger to watch out for as far as India is concerned. But, given that we've recently underperformed and valuations have become a bit attractive, and technically also there could be a sharp, short covering rally, it looks like we can head for a decent pullback. It could be short term, but could be a very fast and a very sharp, decent pullback. So that's something people are betting on from a market technical perspective. Flow-wise, again, it's a mixed day, but first signs of buying interest back in the technology names. So that's a bit of a contra view as far as positioning from large institutions are concerned, a bit of buying back in the technology stocks today. The other sectors which have done well is defense and metals, and it looks like more or less it's more of a short covering rally on those sectors rather than genuine buying. But broadly, the position-wise, it do suggest that if something positive comes up over the weekend, you might see a very sharp short covering rally in the Indian markets, at least in the very near term. So that's something to brace for.
What about stocks, Nimesh?
Well, so in terms of individual names, the theme of fundraising continues. So the first stock is Blue Jet Pharma. The stocks are very sharp correction after the earnings, but I understand there could be a fundraising via QIP very soon. So that's the first stock to watch out. The second stock is IndusInd Bank. It's been under pressure of late because of various reports as well. But from a flow perspective, I understand one large long-only fund has started selling or trimming into IndusInd Bank in the last few days, and hence a bit of supply there. The third stock is a couple of names where there was block deals today. Zinca Logistics, there is a 1% equity got change hands, and we've seen a recovery there. And even in Jain Irrigation, big volumes on that stock, and the stock has reacted sharply, almost 15% up in Jain Irrigation as well. In Jain Irrigation, the feedback is, there are a couple of the PSU banks which were looking to sell. If that gets cleaned out, you might see a bit of a sharp rally in that stock as well. So need to see whether there is a disclosure in terms of any PSUs banks selling out of Jain Irrigation. And the last name is Manappuram Finance. The stock has been consolidating post the earnings, but first signs of flows back in from larger HNIs. And I understand some large HNIs have bought as well in today's market into Manappuram. But again, for Manappuram, the big trigger to watch would be the approval for the open offer. That's still pending. So that's the next trigger to watch out as far as Manappuram is concerned.
All right. Thank you very much, Nimesh, for that. So those are individual names in focus. Let's take a quick commercial break here. We get you trades, near-term trades with our technical experts coming up.
Welcome back. It's above 24,600, but not quite getting to yesterday's higher levels of 24,700. So holding pat with a gain of 130 points. Mitesh is back with us for a few BTST calls. Mitesh.
See, a lot of action and strong price momentum is seen in the hotel stocks. Look at EIH Indian Hotel. So I picked up Indian Hotel as a BTST call. Keep a stop at about 763 half and look for a target of around 780, 782 for tomorrow. And the other name which I like, that's on the IT side, that's LTIM. It's just trying to reverse. Yesterday was bounced back. Today is a flat day, but the already indicators have started crossing over. So we'll take a BTST here with a stop below 50.99 and a target of 51.60.
Thank you. Got that. Let's now go across to Nigel. He's going to fill us in with the latest trends from the futures and options space.
Well, it's a good steady session for the bulls. The problem is the main, the main part of the index that actually normally swings it is not performing. That's the Nifty bank. It continues to underperform and it's not able to hold on to the higher levels. So as we speak, it's hovering around the 100 DMA. So the Nifty bank is the one that's underperforming. The India VIX, that's the big trigger, right? Till it runs away, that's when the traders will get a little bit skittish. But for the time being, it's very well behaved, sub that 15-odd mark, and that continues to remain lower. The PCR, what started today's trading session at around 0.75, 0.8, that's moved to around 1.1 because the put writers, they have come back. And remember, tomorrow we'll play out the weekly expiry. So these put writers, they're going in there, they're writing various strikes. 24,600 put. 24,500 put. Just take a look at the premium out there. It's down drastically from the morning trading session itself. On the 24,600 put itself, we're seeing it down drastically, and 24,500 put. Now, these writers, they are hoping that this 24,420 odd level holds out because at the start of today, it was more than 75 rupees. So big drawdown out there. So in terms of levels that we're looking at, the broad range, 24,450 on the upside, 24,750. Going by the options data as well, the bears will believe that they can defend this higher level of around this 24,750. In terms of stocks that I'm looking at, BSE, we had the management who joined us yesterday. The street is feeling rather good about it because yesterday as well, the premium volumes were very, very strong. In fact, it was the highest we've seen in multiple weeks, and yesterday was expiry out there. So you have the open interest that is down, the stock is up. Clearly telling you there's a bit of a short covering bounce that's playing out. Nykaa, that's the other one in there. Just take a look at the massive open interest build up. More than 10% build up of open interest. The stock is moving up. There's long build up out there. And finally, PNB Housing Finance will track the stock today as well as tomorrow because there is unwinding yet again. Yesterday, there was massive unwinding. As a percentage of MWPL, the open interest was around 84%, market-wide position limit. As I checked last, it's at around 82%. So there's a slim chance that it moves out of the F&O band. But in the next few trading sessions, if there is unwinding on these lines, then that's the one that could come out of the F&O band. Back to you.
Nigel, thanks very much for that. So that's the F&O perspective, the F&O action live coming through from the F&O desk. Mayuresh Joshi is with us to run us through what he's making of things. Mayuresh, tomorrow is the last day of the week. And then day after, there is the PM speech, and then there is the summit in Alaska with regards to Ukraine. So there are some important triggers from a market perspective. Near term, do you have a view? Is the risk to the upside, to the downside? What's your sense? Is there a big move around?
Afternoon, Prashant. No, I think there are a lot of events, as you just pegged off. And therefore, I think the markets will be viewing these events with a very, very sharp and keen eye. Obviously, I think what we've gone through at this juncture, I think the markets have gestated the worst, both in terms of the tariff imposition that has probably happened on India, as well as the expectations in terms of what might happen going forward as well. Obviously, I think Trump has deferred the entire China thing by 90 odd days. He's obviously visiting Russia in a resolution to probably stop the Ukraine war. And therefore, I think the markets are globally taking on these events very, very positively. From our perspective itself, I think a combination of factors together, including expectations of how earnings will play out and richer valuations, is something that capped market gains. But in my opinion, and how we see it at Markets Made India, I think even if distribution days have gone up, which means that the correction that we've seen in the last few days have really taken Nifty way down as we speak on the downside. But I think there is not much of a downside risk as we see it. there is expectations of earnings improvement over the next few quarters. And there is expectation that as resolutions start happening on the global front, I think things might normalize even as FPI and FDI flows have moderated to a large extent. Domestic flows have remained extremely strong. And therefore, a combination of these factors, corporate earnings expected to improve, and expectations in terms of global macros probably just bottoming out in terms of the worst, in terms of what the markets are expecting, might actually prop markets higher. So I think structural downside is something that we are not foreseeing for the internet.
Okay, all right. Hi, Mayuresh. Good to see you. Mayuresh, any view on HPL Engineering? We're talking about a sluggish market, things not moving too well. This stock is up 25% in this week.
It's in a new one.
Yeah.
Back to highs. Yeah.
Absolutely. It saw a big correction and the stock has run away. Any view? HPL Engineering?
I think we don't track this one, Nigel, but I think an interesting space within the capital goods or infrastructure stories, one which I've always carried in our local and global portfolios, NR Industries, and also its competitor to a certain extent, built developers. I think somewhere what is happening is the expectations in terms of pre-engineering buildings and the market size itself. The expectation here is that from an 18,000 crore market that exists for pre-engineered buildings, that can actually double over the next 3 to 4 years. Again, a large part of the market is unorganized, and therefore I think organized players like a Pennar or an Interact might actually start benefiting quite significantly. And therefore our own sense is that integrated facilities with expansions that are probably happening for both these companies put together, earnings growth along with market share gains, because there are very limited players within the organized players and the listed players itself, that can have a decent chunk of new orders probably flowing their way with better margins and with capacities at their behest as they continue executing well. I think forward-looking numbers might be good. So we're not covering everything, but I think a few of these pre-engineering stocks, PEV stocks, might actually do well.
All right, Mayuresh, I wanted to ask you about Bajaj Housing. I recall when it listed, there was so much excitement. The stock became so expensive. If I'm not mistaken, let's pull up a one-year chart. It went all the way to around 185 or thereabouts. And from there, it's come down to around 110 rupees. Bajaj Housing is the one I'm talking about. Let's get the right stock first up for our viewers on the screen. Not Bajaj Finance. I do want a longer term chart. Bajaj Housing is what we're talking about. Let's get it up for our viewers. It's down close to around 3%. And, post listing, the stock went dancing away to around 185 rupees. Mayuresh, what's the view on this name? It ran ahead of itself, but at around 108, what's your view? I'll tell you why I'm asking you. In the SLBM market, there's unusually very, very high volume out here. It's 35 to around 40 lakh. You never know, maybe there's fresh supply that's likely to come in there. What's your view on it?
Oh, so if it corrects a little more, Nigel, I think it will start looking very, very attractive. Obviously, I think the expectation here is that with the rate cuts that have probably happened, the cost of borrowing for better rated players will obviously be at the forefront. And better rated players like a Bajaj Housing, which has a very strong parent or a parent pedigree, somewhere like LIC Housing, or PNB Housing as well. Yes, there has been a management change out there, but the core dynamics of the business still remain intact and extremely strong in our opinion. And therefore, I think with rate cuts, a lot of fence sitters who are probably looking at mortgages, registrations are still looking extremely strong. You look at the registration data in Mumbai, in Maharashtra, across the length and breadth of the country, still remains very, very stable. And therefore, I think the element of growth expected to come through with asset quality pressures expected to remain benign. I think a combination of these two factors, along with better capital adequacy for the better rated players, will obviously mean better balance sheet growth, better ROEs and better ROAs as well. And therefore, I think if it declines further, yes, I think this stock will make a proper base as we look at it in markets with India. But something like a PNB Housing as well, with the correction that has probably happened, the affordable and the emerging segment where the yields are significantly higher for PNB Housing, and they've got a very good handle in terms of asset quality issues as well, might actually do it.
All right. Mayur, stay with us. There's about 8 minutes to go for market close. A bunch of other names we want to discuss with you. Shilpa Medicare has just reported numbers, and stocks moved up 2% from the time that the numbers came. So it's up total 47 crores in profits compared to 14-15 crores same time last year. And I think margins are 28.5% compared to 25%. These are year-on-year comparison numbers. Revenues are up 10-12%, but there is a big improvement as far as the net number goes. So Shilpa Medicare in focus, 9-10 more on this one in a bit. We'll take a break. See you on the other side. Okay, welcome back. There's about 3 minutes to go, 3 minutes, 20 seconds to go for market closing. Mayuresh is with us. Mayuresh, any thoughts on Force Motors? I mean, big move today, but more importantly, 200% this year so far. YTD, Mayuresh, big re-rating here.
Oh, absolutely. So anybody holding can continue holding because I think the momentum remains extremely strong with them. The expectation largely is that the kind of product mix that they have, it should largely start benefiting them. And it has already started getting displayed on numbers. So somewhere I think the expectation and the hope on the street is that the product mix probably holds out for them. The expectation from a margin performance holds out for them as well. And therefore, I think anybody holding on to this stock should continue holding. Our top pick, Prashant, within the auto universe remains Hyundai India within the four-wheelers and TVS Motors within the two-wheelers.
Mayuresh, you track the agrochem space also closely. I think last time you were talking about Zuari Agro. Insecticides India, have you analyzed the numbers? The stock has fallen off a cliff, 11% down.
Didn't get the time, Rima, but honestly, I think this space looks very, very interesting even now. I think what has really happened and transpired is that the volumes have remained extremely robust with the early onset of monsoons this time round. the farm gate prices, which had remained extremely stable, are expected to remain stable going forward as well. And with input cost remaining very, very soft and benign, I think that leverage component obviously played out for a whole host of players within this space itself. Again, going forward, I think with a better monsoon around, with a better Kharif season, there is expectation of a better Rabi season because of the better moisture content that might still remain. And therefore, I think the hope for agrochemical players to probably have a better show going forward as well, with better control on costs, will mean better numbers on the bottom line as well. So very, very interesting space. I think we continue holding stocks like a Coromandel, Deepak. I discussed stocks like a Paradeep, Bangalore as well.
Okay.
Premier Explosives, last word, quick word. Mayuresh, do you track it?
Decent order book, Prashant. I think 2.5 times of FY24 revenues. Margins have been pretty decent this time around at 15%. They executed well, specifically on their defense segment. Even a large component of their order book is largely defense, more than 80%. And therefore, I think the expectation is that the execution should continue happening at a very, very decent pace. Margins, again, I think if you historically look at margins, as a comparison to last year, were significantly higher. So if they're able to execute well, and the cost of material is under control, I think there can be every scope of margin expansion as well. So I think good set of numbers getting it.
All right. I think we're at the end of the show on closing bell here. But Mayuresh, stay with us. We're going to talk to you on markets forward in just a bit as we wrap up things. So a pretty good day all told. Much better though, I think, for the mid and small cap indices with 0.65, 0.7% kind of gains. 0.6 on the Nifty as well. The Nifty Bank was up just about 0.25%, so a little behind as compared to the other three indices coming through. So lots of moves actually today. No dearth of big moves. Apollo Hospitals by far the big one, 7%. But there was also Hindalco, Dr. Reddy's, Cipla, Hero in the 2% range. Bharat Electronics, etc. No noticeable large Nifty loser coming through today. And of course, I mean, Rima, lots of broader market, mid and small cap moves as well.
JM Financial 13% up. Force Motors now touching the 20,000 rupee mark. Yatra Online continues to gain 9% up for the day. For the week, 56% higher. Honasa, Nykaa, these were some of the big gainers in the mid-cap universe. Add to that an NMDC Steel, Premier Explosive. Paytm had a good session on the back of a regulatory relief. On the way down, softness seen in Insecticides India, NSDL, Wari Energies, and Aarti Pharma too sold off in pretty large volume.
Well, that's right. To name a few more big movers, Jain Irrigation was up 12%, EIH was up close to 12.5%. You had Lloyd's Enterprises as well ahead of its numbers. That stock was up close to around 5.5%. So big move out there. Vishal Mega Mart moving on very, very large volumes. Another one in the last few minutes that came out of the set of numbers was Shilpa Medicare. The stock went up close to around 5% in reaction to its numbers. The street liked what they saw, and that got locked immediately. So 5% higher on that one. While MIRC Electronics, that stock, in fact, it was locked up. It's been rallying for the last few sessions. Nimesh had alerted us about that board meeting that was today. But from the high of the day, MIRC, that's the one we're talking about, that did end actually closer lower. So it's come off drastically from the highs of the day. But a good session nonetheless. For the bulls, we go home with gains of around 130 points. The Nifty Bank, a relative underperformer. On that note, though, we'll wrap up on this edition of Closing Bell. You don't go anywhere. Markets Forward comes up next.
Market regains yesterday's losses to end at the day's high. The Nifty reclaims 24,600. Pharma, metals, auto lead the up move. The Nifty Bank relatively underperforms.
Apollo Hospitals turns in a strong show with all three verticals growing in double digits. The addition of 500 beds in the second half is expected to further push up growth in FY26. Hindalco MD Satish Pai holds out a firm forecast for the aluminum and copper demand that should help sustain profitability through FY26.
Nykaa also turns in a good show with strong growth accompanied by margin expansion. Honasa Consumer beats expectations with a healthy volume growth. Paytm gets a regulatory boost after the central bank's nod to Paytm Payment Services to operate as an online payment aggregator.
Good evening. You're watching us here on Markets Forward, your go-to show where we aim to get you all the key data points you need to gear up for the next trading day. I'm Mangalam Malu, with me Reema Tendulkar. Reema, it was a more secular day of trade in today's session, right? 130 points on the Nifty. Yesterday, yes, there was an uptick, but thereafter there was a downtick, and towards the last hour, we gave up nearly all the gains that we made and ended about 100 points lower. Today wasn't the case. Today we were higher. There was a mild dip that was bought into, and we ended virtually at the high point of trade with the Nifty conquering that 24,600 mark. And this despite the absence of Nifty Bank as being the frontline batter for the Nifty. If you look at it, the Nifty Bank ended just about 0.25% higher, but we had good gains coming in from the auto index, the metals index. Along with that, we had the pharmaceutical index that did well as well. And then the broader markets, 0.2% that came in terms of gains for the mid-cap index, and more stocks advancing versus the stocks which were declining. So the distance between both the red and the green lines was maintained uniformly through the session.
And global markets were also upbeat, so they lent their support to the Indian markets. But let's also tell you what we have for you on our show today. We start with the top movers and shakers with Vivek. Nykaa, Honasa Consumer gain on the back of a strong Q1 performance. LIC falls on the government's divestment plan. And we'll talk about the big events to watch out for in tomorrow's trading session. But as promised, let's talk about the big movers today on the way up and on the way down. Hormis joins it.
Well, when you're looking at the list of stocks that did very well in the session today, first up, you have to start off with Apollo Hospitals. Very, very strong set of numbers in the quarter gone by. Apollo Hospitals, one of the top gainers as far as the overall market was concerned. Strong beat and beat street estimates along all of the parameters. Apollo Hospitals is the one that we're discussing. The other set of stocks that did very well is the entire pharma pack. All of the pharma stocks today bounced back quite significantly. Look at names like Alkem Lags, very strong set of numbers over there. Zydus Life, post a conference call where the management retained the guidance, did very well. And along with that, aided by strong export data, the rest of the pharma pack too moved higher in the session. The other set of stocks on the back of very encouraging Q1 as well as strong order booking was the defense pack. The entire pack moved higher. Bharat Dynamics, you did see an upgrade coming from Motilal today. Hindustan Aeronautics, that stock too did very well. And along with that, the rest of the defense pack too did quite well in the session today. Arcane Chemical, a stock we don't discuss too often, but that particular stock ended the day higher by almost 6%. One of the subsidiaries got the cabinet nod for setting up a semiconductor unit, and back of that, that stock did very well in the session. And BSE, throughout the trading session, this particular stock on very high volumes did very well, one of the top gainers in the F&O pack. This was on the back of the fact that the premium, as far as August are concerned, especially on expiry sessions, has been much stronger compared to the previous quarters. On the other hand, the list of stocks that didn't do quite well. NSDL, post-listing, that stock saw a one-way upward rally, but a slightly soft Q1 led to quite a bout of profit booking on this particular name. EMS Limited, this particular infra company, slightly muted Q1, saw a bit of a sell-off today. You also saw names like Rupa and Company, one from the broader end of the markets, very weak quarter gone by, down by almost 9%. Oil India, profitability halved, slightly muted commentary coming in, and that stock down by almost 4%. And lastly, Insecticides India, this particular stock came out with the numbers towards the end of the trading session, ended the session lower by over 12% today.
All right, Vivek, thank you so much for that. Those were the movers on both the way up and the way down. But a couple of stocks, specifically from the new business, beauty, wellness, and makeup sort of along with fashion space, we have Nykaa and Honasa Consumer rallied fairly well, between 5 and 7%. They delivered well in the first quarter, telling you that maybe things are improving. Let's start with Nykaa, for instance. The overall performance of the company was good, led by the beauty business. But this time around, after a few quarters of weakness, there was a pickup coming by in their fashion vertical as well. The revenues grew 14%, but the gross merchandise value of that grew over 20%, and that was a positive. Add to that, the management did guide for improvement in the operational performance of the fashion vertical in particular, could break even by the end of this year, even as the losses narrowed by about 300 basis points out there. Importantly, we did see other verticals of the company do well as well. Most prominently the men's fashion business, which grew 74%, and the own brands of Nykaa, which is the house of Nykaa, grew about 70% at 578 crores. The annual run rate for this business at 2,700 crores versus what it was at the start of this year, 2,100 crores. So big jump happening out there, which is obviously a higher margin business as well. So after some quarters of volatility in the past, we've seen now some secular growth return to Nykaa or FSN e-commerce. On the other hand, we had Honasa as well. Remember, the last 2.5 quarters weren't particularly good for them. The stock had corrected almost 50% from its post-listing high. Even after that, the street was hoping for some sort of turn in the corner, and that's exactly what has happened. The underlying volume growth at 10.5%, much better than the industry and better than what the street was anticipating. And this despite the sunscreen category being impacted by early onset of monsoon. So about 200 basis points of sales were shaved off because of the early monsoon or shorter summer. The overall revenue grew by 7.5%. Margins held around that 7.7% mark as well. And the profit after tax saw a marginal improvement year on year. They did see improvement of nearly 264 basis points in the EBITDA margins quarter on quarter. And despite them having maintained their ad spends around that 34.5% mark as well. Management commentary here as well guides for good growth in their focus category, which is about 80% of their sales, and increase in offline distribution along with margins being maintained at that 7% mark. The street believed in Honasa this time around after 2.5 quarters of disappointment. But mind you, the stock's still a fair distance away from its IPO price of 324 rupees and its post-listing high of over 530 rupees. But let's go back to Nykaa. We spoke with the management of Nykaa today, and this is what Advaita Nair had to say to us. All right, the first quarter was good. You think that the next couple of quarters are likely to be fairly strong as well, continue the momentum. If you could give us a sense on, what kind of GMV growth can we expect in both the beauty and the fashion business over the next couple of quarters? The second half typically better for the fashion business as we move towards festive season.
Yeah, I think, beauty has been very consistent at this sort of mid-20s for the last, 6 quarters or so, and we'll hope to kind of stay steady with that. We're slightly outpacing the market growth there, and every quarter sort of chipping away at a little bit more market share. I think fashion is where we should see an acceleration. We are feeling really confident with where the business stands today. I think Q1 at about 25% is sort of the start. I'm hoping, and we're sort of looking forward to collectively for a higher growth rate going into Q2, Q3. That is season for us, and we also have some really strong launches and partnerships that should come through to drive much of that.
Okay, Mayuresh, Honasa and Nykaa, would you like these stocks? Nykaa has this increasing contribution of its own brand. Honasa, the question is, has it turned around? Is the performance of Q1 sustainable? But weigh in with your thoughts.
Afternoon, Reema. Afternoon, Shrikant. No, two things. One, I think the results have been very encouraging this time round. And both the management seem to be very optimistic in terms of demand coming back very, very strongly with more launches expected to come through. And with demand, the natural operating leverage with both prices expected to be relatively better, playing on margins and the bottom line growth will be very, very evident. So I think that becomes a base case scenario. But the proof of the pudding will lie in next quarter's numbers itself, Reema. I think if they're able to replicate what they have done in the previous quarter and demand actually comes back very, very strongly and sustains for both of them, specifically for focus brands of Honasa, House of Nykaa, as far as Nykaa is concerned, They were obviously also expanding their own distribution network to counter e-commerce players as well, to a certain extent in terms of delivery times. I think that is a strong positive move. But all will depend in terms of the consistency that they'll probably achieve in terms of numbers in the coming quarter, and the commentary thereof whether demand actually and genuinely sustains going forward as well. So in my opinion, I think a large part of that move has largely been done and dusted with. Nykaa a tad bit better placed in my opinion compared to others.
All right, Nykaa is a much better placed versus Honasa as per you. Shrikant, from a market standpoint, the Nifty, yesterday saw an up move. Thereafter, that was sold into. Today was a little more stable than what we saw earlier. Do you think we're out of the woods here, or still maybe testing the upper end of the range, and maybe thereafter there could be some selling? What levels are you watching out for on the Nifty and the Nifty Bank?
Afternoon, Mangalam. Afternoon, everyone. The market has been trading below the 20-day simple moving average for last almost 24, 25 days. And the best part is that today it closed about 10 days exponential moving average, which is something can help the market to move higher. Yes, what you're saying is right. It is chasing a lot. It is like in the range. It is not crossing the upper level. But today's closing is little bit encouraging. And today we saw buying interest in almost all the sectors and all the indices. Bank Nifty also closed little bit on the higher side. So while looking at the entire pattern of last 4 days, I'm of the view that the market is on the verge of breaking out on the upward side. And we can see the levels of maybe 24,800 or 24,900 in the near term. In case if there is any correction, then I don't think that the market is going to sustain below the levels of 24,400 so easily. So in case if there is any correction, look for taking some contra bets of going long with a stop loss at 24,400.
And there are two triggers to look ahead in the next few days. One of them is the 15th of August speech by Prime Minister Modi. Does that hold any relief? And the other one is the big meeting in Alaska on Friday between Putin and Trump. But according to Shrikant, markets headed higher, 24,800, 24,900. Paytm was a big mover after RBI granted it an in-principle authorization to operate as an online aggregator. Ritu joins in with the details.
Well, after a near 3-year wait, the Reserve Bank of India has finally granted Paytm's 100% owned subsidiary, Paytm Payment Services Limited, in principle authorization to operate as an online payment aggregator. Now, that is essentially the business which runs Paytm's digital payment gateway for all of its merchants. But importantly, RBI has also lifted the ban on new online merchant onboarding, which had been in place since November of 2022. But to be clear, even when that ban was in place, Paytm had still been servicing the existing online clients, and it had also been signing up new offline merchants. But this, of course, clears a big regulatory cloud over the payment business. Now, the market is quite crowded. There are more than 50 players that have this license, but Paytm's massive base of 1.3 crore merchants does give it a strong shot at regaining momentum. The timing is also quite interesting. It comes just days after its Chinese investor Ant Fin fully exited Paytm, selling that remaining 5.8% stake. Now, remember, Paytm's initial application in 2022 was returned by RBI, and the company had reapplied for this license only in September last year after getting the government's nod for its downstream investment into PPSL. Keep in mind, though, that the RBI nod right now is not unconditional. The company will have to complete a system and cybersecurity audit within 6 months' time and submit the report to RBI or risk losing the license. Now, brokerages have given the move a thumbs up. Citi says the license win is positive for sentiments because it lifts a major regulatory restriction on the business and it will help Paytm be more competitive than before. And Bernstein adds that this will have limited immediate impact on metrics, but it is a major relief nonetheless and is going to support higher payment margins for the company over time.
Right, Ritu, thanks a lot for that. Mayuresh, it's Nykaa over Honasa. What about Paytm?
No, I think that overhang has got removed, and absolutely right so as well. And therefore, I think all the regulatory hurdles that Paytm had gone through the last few quarters, I think there are resolutions that are happening piecemeal by piecemeal basis. And therefore, that will act positively in terms of forward-looking numbers as well. However, my only concern with merchant onboarding is the delinquency ratios. And therefore, I think if delinquency ratios remain relatively higher, that can still pose as an issue in terms of the overall balance sheet dynamics. Albeit, I think what is probably transpire in terms of onboarding of merchants as we speak, and a lot of regulatory hurdles being cleared one by one. I think that has acted positively for Paytm. So I think anybody holding Paytm should continue.
You know, exactly a year back, 14th of August last year, the company had hit its 52-week low at 505, and since then, it's moved up 130%. But let's talk about LIC. The stock declined by nearly 3% after we learned from sources the government is likely to initiate roadshows over the next 2 weeks for divestment of its stake. The government could sell 2.5% to 3%. Yash joins in with the details of what he's picked up. Yash?
Well, the government could initiate the divestment process for the stake which it holds in LIC, and this could happen as early as in the next 2 weeks itself. What we've been given to understand from our sources is that the government is looking to undertake investor roadshows for divesting its stake in LIC, and that, as I said, could happen as early as in the next 2 weeks. As far as the quantum of divestment is concerned, the early indication from our sources is that the government could look to dilute about 2.5% to 3% of the stake which it holds in LIC through this first tranche of OFS as far as LIC is concerned. And if the reference point is to be taken as today's price, then the government could look to raise about 14,000 to 17,000 crore through the first tranche of divestment in LIC. As far as timeline is concerned, the government is looking to launch the OFS issue for LIC right after Diwali or in the first half of November. And bankers like Motilal Oswal as well as IDBI Capital have been appointed to run this OFS process. We've written to, of course, the DIPAM, the Department of Investment and Public Asset Management, as well as LIC on this particular story. A response from both parties is still awaited.
All right, Yash, thanks a lot for that. The fear of supply in LIC takes the stock lower, though the street was aware of that. Srikanth, LIC from a chart check standpoint, how does it look?
Yeah, it is like it is in the range. It is not crossing the level of 950. It is not breaking the level of 850. So I think it is going to spend some more time within the same range. But in case if it breaks the level of 850, then the stock may again fall back to the levels of 775, 780, where it has spent maximum time. So I am of the view that it is better to stay away from taking any specific position for the time being. But in case if there is any correction close to 850, then there one should look for adding some positions.
Srikanth, open-ended question. What's the best looking chart to your mind?
See, at this level, State Bank looks really a strong candidate to buy for, along with Reliance Industries. And that's why I am of the view that the market is heading for the levels of 24,800 or 900. These two stocks are very close to their important support levels. And after crossing the important levels on the higher side, we can expect rally of nearly 2 to 3% from current levels. So State Bank, which is currently around 820, 825, there I'm seeing the levels of 850, and for Reliance, 1450, 1440 looks achievable.
All right, take that point. Thank you, Mayuresh and Srikanth, for joining in and giving us your views on individual stocks and the market on the whole. What we'll do is take a short break. We've given you snippets of some of the stocks that were moving around today, told you what Advaita Nair spoke to us also. But on the other side of this break, we'll get you some more corporate voices that joined us on the channel today and some events you need to watch out for today. Well, it was a good day of trade today and a day for a lot of stocks that moved around on the back of numbers as well. So we spoke with a lot of managements. Let's tell you about some of the corporate conversations that we had today. First, we had the management of Suzlon, who stated that the company is still in the process of appointing a new chief financial officer. They added that the promoters are expected to maintain their involvement in the business. The recent promoter block deal was primarily for some cash generation along with their long-term commitment to the company, which remained unchanged. The management further added that Suzlon is targeting a 60% annual growth across all their key parameters, and their order book too has consistently grown over the past 10 quarters. They confirmed that it is compliant with the latest ALMM norms.
Up next, Senco Gold gained about 1% after a strong Q1. The management said achieving a 20% revenue growth in FY26 should not be a problem. They said the margin expansion in Q1 was led, 1, by increase in diamond jewelry sales, and 2, a lower hedge ratio. That said, despite a 10% margin in Q1, for the full year, they maintain EBITDA margin guidance between 6.8 to 7.2%. They also said that the wedding season post-Diwali will boost growth in the coming quarters.
And finally, we had BML as well. That gained nearly 4% after the firm's top management said that it would majorly focus on improving its working capital for FY26. They also expect 20% revenue growth in this financial year due to strong performance in the upcoming quarters. They expect the second quarter to be better than the current one, and they expect strong order inflows, but do believe that execution may be a bit of a challenge in FY26.
And before we wrap, we'll bring you some of the key market events to watch out for tomorrow. Ria is standing by.
Well, yes, let's take a look at the key events to watch out for tomorrow. A lot of key data points to watch out for in tomorrow's session. First, we will have the initial jobless claims and the PPI data coming out from the US. For the UK, we have the GDP data, the industrial production data, as well as the trade balance data. And in Europe as well, GDP and industrial production data will be the key things to watch out for. In India, we have the WPI inflation print coming out tomorrow. We also have a whole host of earnings to be reported tomorrow in India. We've got the likes of IOC, Vodafone Idea, Patanjali Foods, Glenmark Pharma, Ashok Leyland, as well as Inox Wind reporting their Q1 numbers tomorrow. Also watch out for Saturn Credit Care. They are going to hold a board meeting tomorrow to consider a fundraise. Also watch out for RIL and Mahanagar Gas. The record date for the dividends for both of these companies is tomorrow. Keep an eye on the listing of JSW Cement as well. And the last key event that we're watching out for, the US Department of Commerce is going to review exemptions related to a 90-day tariff exemption period for select electronics from India, which is set to expire on the 14th of August.
All right, Ria, thank you so much for that. So with that, we'll wrap up on this edition of Markets Forward. Stay tuned to CNBC TV18. We'll be back with more news and updates on the other side.
Hello and welcome to Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. Indian equities rally on the back of firm global cues and domestic inflation falling to an 8-year low. The Sensex and the Nifty gain 0.5% each. The rupee strengthens 0.25% as the dollar index hits a 2-week low on renewed hopes of a rate cut by the Fed. European leaders set to engage in frantic phone diplomacy with President Trump ahead of his summit with Russia's Putin. Ukraine's Zelensky, along with leaders from Britain, France and Germany, set to make a case about not ceding territory to Russia to end the war. India continues back-channel negotiations with U.S. lawmakers with 2 weeks to go for the 50% tariffs to kick in. India's U.S. ambassador meets Democratic Senator Richard Blumenthal after meeting Republican Senator Lindsey Graham. Both had sponsored a legislation proposing higher tariffs on India for buying Russian oil. A further thaw in the India-China relationship amidst Trump's trade war. India ships diesel to China after 4 years. China clears urea exports to India. Both nations set to resume direct flights after 5 years. All of this comes ahead of Prime Minister Modi's scheduled visit to China later this month, the first in the last 7 years. The US applauds Pakistan on combating terrorism and promises to deepen bilateral cooperation. The joint statement comes nearly 4 months after the deadly terror attack in Pahalgam, which killed 26 people. Big boost for Paytm. The RBI allows the company to operate as an online payment aggregator. The move effectively lifts the 2022 ban on onboarding new customers. Paytm shares perk up in trade. The Mumbai police launches a preliminary probe into IndusInd Bank's alleged accounting lapse based on the management's complaint. Police record statements from staff members, including the former CFO and deputy CEO. AI startup Perplexity offers to buy Google's Chrome web browser, makes an unsolicited bid of more than $34 billion, according to the Wall Street Journal. Google may have to sell Chrome as part of an antitrust proceeding. President Trump mocks Goldman Sachs CEO David Solomon, claims he made a bad prediction on the repercussions of the tariffs. Trump tells Solomon to get a new economist to focus on being a DJ. Chief Justice B.R. Gavai says he will look into a plea against the Supreme Court's order on rounding up of stray dogs in the Delhi National Capital Region. The apex court had directed all stray dogs to be moved to shelters within 8 weeks, sparking concerns and protests. Well, let's go straight to the day's market action. The Sensex and the Nifty regaining yesterday's losses, ending the session near the day's high. The Nifty reclaimed 24,600, largely led by pharma, metal and auto stocks. The Nifty Bank up by about 137 points, 356 points higher there on the Nifty Midcap. The Sensex closing about 300 points higher. That's the story for the stock markets. But the big global story, European leaders will speak to President Donald Trump at a virtual meeting ahead of his summit with Russia's Putin. Ukraine's President Zelensky will travel to Berlin to join German Chancellor Merz and other European leaders. The EU leaders are expected to reiterate that no decisions should be taken without Ukraine, including, of course, changing its borders by force. Remember, the US president has said that both Kyiv and Moscow will have to cede land to end the war. President Trump has said that his meeting with Russia's Putin is, and I quote, a feel-out meeting to see what the Russian leader has in mind, end of quote. The White House has also called the meeting a listening exercise.
Is that a deal will emerge from this meeting, or is he simply going to listen?
I think this is a listening exercise for the president. Look, only one party that's involved in this war is going to be present. And so this is for the president to go and to get, again, a more firm and better understanding of how we can hopefully bring this war to an end.
Well, a listening exercise, says the White House ahead of the Putin-Trump meeting. Now, the U.S. Department of Commerce has initiated anti-dumping duty investigations into the import of solar cells from India. The probe will also cover imports from Indonesia and Laos. This after the U.S. solar manufacturers claimed that importers benefit unfairly from government subsidies. Vivek is standing by with more details on how this is likely to impact Indian companies. Vivek, which are the companies that will be hit?
Well, that's right. A development to take note of. Number one, it's actually a consortium of U.S. solar manufacturing companies, cells, modules, panels that earlier had petitioned for both an anti-dumping duty as well as a countervailing duty to be imposed on Indian exports along with 2 other countries. So now the U.S. Department of Commerce has initiated this particular probe into both solar cells, modules as well as panels. So there are 3 countries that are part of this particular probe: India, Indonesia, as well as Laos. Now, what is the claim? The claim is that these companies from these countries actually benefit from unfair government subsidies, and the sale price at which they sell in the US market is lower than the fair market prices which the US companies produce and sell at. So now when you're looking at the impact, currently the impact will be determined by the final outcome of this particular probe, but any adverse ruling may lead to one-time large penalties that these companies will have to face. So which are the companies that will remain in focus? Well, the company that will be impacted the most is Waaree. Over 40% of the order book is from exports, mainly into the US markets. 2 other companies do export, very minimal. Premier Energies have continuously told us that the order book mainly is in the domestic market, and also Adani Energy does go ahead and export, Adani Enterprises, does export some solar products into the US market. So these companies will be impacted. When it comes to Waaree, remember the company will also face the double whammy of the 50% tariff that the USA has imposed on India. That could be offset by a 1.6 gigawatt facility that the company is planning to set up in the US market. Overall, a slightly negative development, but key details are still awaited.
Vivek, many thanks for joining us. With just 2 weeks to go for the 50% tariffs to kick in, India continues to hold back-channel negotiations with US lawmakers. India's US ambassador met Democratic Senator Richard Blumenthal after meeting Republican Senator Lindsey Graham last week. Parikshit is standing by with the details. Parikshit, why are these meetings crucial? Take us through where things now stand.
Now, Lindsey Graham, the Republican senator, and Democrat Senator Richard Blumenthal were 2 leading US politicians who were championing and pushing a bill that would impose not just additional sanctions on Russia for the war in Ukraine, but would also impose penalties on countries like China, Brazil, and India for purchase of Russian oil and fueling what they call Russia's war against Ukraine. India has been trying to sensitize these politicians, and the person leading the charge is India's ambassador to the US, Vinay Quatra. Last week, he met Lindsey Graham, and this week, he has met Richard Blumenthal, who is a Democrat, and made him understand what India's view on India-US energy ties are and perspective on our energy security needs as well. India has been trying to convey to the US administration and US politicians that India-US energy trade has significantly gone up this year. It's up almost 70% on a year-on-year basis between January to June. It's now to the tune of $7 billion, would go up to possibly more than $14 billion in this fiscal. We're also going to see greater LNG imports and long-term contracts. So this needs to be kept in mind while seeking action against countries who are doing business with Russia. So let's see what happens. But this outreach is important because India is trying to strike some sort of agreement, some sort of solution with the United States ahead of 27th of August, when these 50% tariffs would kick in.
All right, Parikshit, many thanks for joining us. And staying with the US, it has applauded Pakistan's efforts to combat terrorism and its promise to deepen bilateral cooperation. In a joint statement, both nations have reaffirmed their intention to work closely to promote effective and enduring approaches to counter terrorism. Now, this statement comes nearly 4 months after the deadly attack in Pahalgam, which killed 26 Indian civilians, and also after that second visit of Pakistan's chief of army to the US. Amidst President Trump's trade war, there is a thaw in the bilateral relationship between India and China, and this comes ahead of Prime Minister Modi's scheduled visit to China later this month. That is the first visit of the Prime Minister to China in the last 7 years. Parikshit, let me come back to you for more on that. Now, there have been several measures taken by both sides to try and amplify the efforts to re-engage economically. What are we talking about now on both sides?
Well, this will be a meeting of huge geopolitical significance. Indian and Chinese ties had broken down after the border clashes in Galwan in June 2020. But there is an expectation that from September this year, there will be some stability and predictability in ties. PM Narendra Modi is set to visit China for the SCO summit in Tianjin from 31st August to the 1st of September. This will be Prime Minister's first visit to China in 7 years. Sources say India's objective would be to instill positivity in the relationship. We've also been told by sources that the India-China relationship and the upcoming meeting between Modi and Xi should not be seen through the prism of an India-US relationship. While India and US relations have taken a rough turn recently, India and China have been working on improving ties for the past few years, and more so after October 2024, when Prime Minister Modi met President Xi Jinping on the sidelines of the BRICS summit in Kazan, Russia. Both leaders agreed to work towards a peaceful and stable India-China relationship and also decided not to allow differences on the boundary issue to disturb peace and tranquility at the line of actual control. Since then, there have been multiple meetings between foreign secretaries, NSAs, defense minister and the external affairs minister level. Now, sources say the consensus reached between Modi and Xi is now being given shape to ahead of the SCO summit in Tianjin. There are some early signs of improvement in ties. India has restarted issuing tourist visas for Chinese nationals after 5 years. Final timelines for resumption of direct air flights between India and China is expected soon. India and China had earlier agreed in principle to resume direct flights. Reports say China has eased curbs on urea shipments to India, and the Indian industry hopes China will ease supply of specialty fertilizers. China's restriction on rare earth magnets have created a crisis for the industry, and the automotive industry especially is hoping for a positive meeting between Modi and Xi that will help ease high rare earth magnet exports to India. India has also been clearing Chinese JVs with India wherever a technology partner is needed for Indian manufacturing. Also, in a first since 2021, an Indian vessel with 496,000 barrels of ultra-low sulfur diesel has been shipped to China. So these are all positive indications that both sides are trying to instill some stability in the relationship.
Parikshit, many thanks for joining us, and that SCO summit will take place at the end of the month. Former Niti Aayog CEO and G20 Sherpa Amitabh Kant says it is in India's national interest to mend the bilateral relationship with China. He was speaking to me at a summit organized by the Federation of Hospitality and Tourism yesterday. Take a look.
I'm a believer that India needs to do joint ventures with China. India needs to do joint ventures for components. India needs to do joint ventures on a range of inputs which go into manufacturing. We need to bring down the input and component manufacturing right on strategically important. And I think we need to work with China, and we need to really rework out the Press Note 3 to enable India to work with China to become a great manufacturing nation. The manufacturing must move from China to India, and for that it's important that we work in our national interest.
The former Niti Aayog CEO Amitabh Kant. Shares of Paytm rallying in trade today after a boost from the Reserve Bank. The RBI has granted an in-principle approval to operate as an online payment aggregator. This move effectively ends the ban imposed on Paytm in 2022 from onboarding new customers. Ritu is here with the details. A big breakthrough there for Paytm. Ritu, take us through the impact.
Well, after a near 3-year wait, the Reserve Bank of India has finally granted Paytm's 100% owned subsidiary, Paytm Payment Services Limited, in principle authorization to operate as an online payment aggregator. Now, that is essentially the business which runs Paytm's digital payment gateway for all of its merchants. But importantly, RBI has also lifted the ban on new online merchant onboarding, which had been in place since November of 2022. But to be clear, even when that ban was in place, Paytm had still been servicing the existing online clients, and it had also been signing up new offline merchants. But this, of course, clears a big regulatory cloud over the payment business. Now, the market is quite crowded. There are more than 50 players that have this license, but Paytm's massive base of 1.3 crore merchants does give it a strong shot at regaining momentum. The timing is also quite interesting. It comes just days after its Chinese investor Antfin fully exited Paytm, selling that remaining 5.8% stake. Now, remember, Paytm's initial application in 2022 was returned by RBI, and the company had reapplied for this license only in September last year after getting the government's nod for its downstream investment into PPSL. Keep in mind, though, that the RBI nod right now is not unconditional. The company will have to complete a system and cybersecurity audit within 6 months' time and submit the report to RBI or risk losing the license. Now, brokerages have given the move a thumbs up. Citi says the license win is positive for sentiments because it lifts a major regulatory restriction on the business, and it will help Paytm be more competitive than before. And Bernstein adds that this will have limited immediate impact on metrics, but it is a major relief nonetheless and is going to support higher payment margins for the company over time.
Ritu, many thanks. And staying with the banking sector, the RBI's Monetary Policy Committee is preparing for a key internal reshuffle ahead of the October policy meeting. Executive Director Rajiv Ranjan is set to retire before the meeting, and we learn from sources that RBI ED Indranil Bhattacharya is expected to replace Ranjan as the new internal MPC member. Further, RBI is also likely to approve Bhattacharya's nomination as the new MPC member in the upcoming board meeting, so stay tuned to that. Shares of IndusInd Bank under pressure after Mumbai's Economic Offences Wing launched a preliminary inquiry into the alleged accounting lapse. The complaint was filed by the IndusInd Bank management. Speaking to CNBC-TV18, officials from Mumbai's Economic Offences Wing said that they recorded statements from staff members linked to the offices of the bank's former CFO and former deputy CEO. Officials also said that the bank's senior officials, including CEO Sumant Katpalia, will be summoned in due course to record statements. Market regulator SEBI has banned former DHFL promoters Kapil Vadhavan and Dheeraj Vadhavan along with 4 others from the markets for up to 5 years. SEBI has also imposed a fine of 120 crore rupees on the 6 individuals for committing financial irregularities, diverting funds and fabricating their books. This order follows an interim order issued in 2020 imposing restrictions on the Vadhavans. Jewellery retailer Bluestone's IPO was subscribed over 2.6 times on the final day of bids. This was largely driven by the portion reserved for the qualified institutional buyers, which was booked over 4.28 times. As of 4 p.m., this was followed by the portion reserved for retail investors, subscribed over 1.26 times. On to a CNBC-TV18 exclusive. The government is likely to initiate the disinvestment process for selling a minority stake in LIC in the next 2 weeks. Sources tell us the government could look to divest between 2.5% or 3% of its total equity through an offer for sale process. The government may raise 14,000 to 17,000 crore rupees in the first tranche. We will head into a break, but up next, AI startup Perplexity offers to buy Google's Chrome web browser, makes an unsolicited bid of more than $34 billion. That and more when we return. Parliament has passed the new income tax bill, which will come into force from the 1st of April 2026. The new bill will replace the 6-decade-old Income Tax Act. Timsy is here to explain the key changes in the new legislation that you need to know. Timsy.
The Modified Income Tax Bill 2025, a landmark piece of legislation poised to replace the 6-decade-old Income Tax Act 1961, offers more clarity and makes the rules and laws simpler for taxpayers. To begin with, what changes for the individual taxpayers? Earlier, during search and seizure actions, officers were entitled to inspect or seize physical books of accounts, digital devices, etc. But now, officers can access emails, social media profiles, accounts, or any other books, documents in any electronic format. Also, officers can now access passwords, privacy codes. This rule did not exist in the previous Income Tax Act of 1961, but was introduced later on when digital records became a reality. So these rules were not explicitly said in the Act, and now it has been clarified in the new Act itself. Up next, a big relief for taxpayers in terms of claiming refunds. Earlier, the Act had a clause which blocked refunds on belated or late filed returns. But now, refunds will be allowed on returns which have been filed late, which gives a benefit to the taxpayers. So the new income tax bill is not just a relief for individual taxpayers. Here are some highlights for the corporate taxpayers too. First up, on beneficial ownership. Earlier, there were test conditions at level of ultimate owner of shares, and now the bill has removed the ambiguity and gotten a clarity for beneficial ownership in line with the Income Tax Act of 1961. The IT bill released on 13th Feb had brought in alternate minimum tax for LLPs, where capital gains tax had been mentioned at 18.5%. But in the revised version passed by the Parliament yesterday, this has been clarified and reinstated at 12.5% rate of capital gains tax for LLPs, just at par with existing Income Tax Act of 1961.
Timsy, many thanks for joining us. So that's the new Income Tax Act being cleared by Parliament. The changes will come into effect next year. Chief Justice B.R. Gavai said that he will look into the plea against the Supreme Court's order that issued rounding up of stray dogs in Delhi NCR. Remember, the Supreme Court had directed the Delhi government to round up stray dogs in shelters. And this was the order that was passed on the 11th of August. The order sparked mixed reactions, with animal rights activists asking for the order to be reversed and a large majority supporting the Supreme Court's directions. Israeli forces have killed at least 73 Palestinians, including 19 aid seekers in Gaza in the last 24 hours. This after the European Union and 26 countries condemned the unimaginable levels of suffering in Gaza. Nations have called for urgent action to halt and reverse the famine in the enclave. AI startup Perplexity has made an unsolicited offer to acquire Google's Chrome browser for $34.5 billion, as per Wall Street Journal. This figure is higher than Perplexity's current valuation of $18 billion. The company has several investors, including large venture capital funds, that have agreed to back the transaction in full. Dan Murphy here with more.
AI startup Perplexity has made a long-shot offer to buy Google's Chrome browser for $34.5 billion. Venture investors have proposed funding the deal, according to the company. It comes after the Department of Justice suggested Google divest Chrome, its flagship search browser, as part of an antitrust suit the company lost last year. That ruling said Google had illegally monopolized the search market. The unsolicited bid by Perplexity is higher than the AI startup's current valuation, which is estimated to be around $18 billion. Perplexity has seen rapid growth, climbing from a $500 million valuation at the start of 2024 to where it is now, after at least 5 capital raises. CNBC understands there's no current Gulf sovereign wealth investments in Perplexity. It was reported by PitchBook that Qatar's QAA was a backer, but we have not been able to independently confirm that investment yet. In April 2025, Perplexity's CEO said the search engine was serving approximately 30 million users. It has received backing from investors including Nvidia, SoftBank's Vision Fund 2, VC firms New Enterprise Associates and IVP, as well as Amazon founder Jeff Bezos and Meta's Jan LeCun. Perplexity is best known for its AI search engine, a potential Google challenger that gives users simple answers to questions and, unlike many other AI search engines, links out the original source material. Last month, it launched its own AI-powered browser called Comet.
Dan, many thanks for joining us. Now, President Trump mocked Goldman Sachs CEO David Solomon, saying that he made a bad prediction about the impact of his tariff policies on the markets. In a post on social media, Trump said that Solomon and Goldman Sachs refused to give credit where credit is due, adding that Solomon made a wrong prediction and he should get a new economist to just focus on being a DJ. His comments came after a note by Goldman Sachs said American consumers will bear the brunt of Trump's tariffs. Well, with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a moment with more. The bilateral relationship between India and the US is perhaps at its lowest ebb in nearly 3 decades. It was this way back in May of 1998 when the United States imposed sanctions on India after the nuclear test in Pokhran. It took nearly a decade since 1998 for India to sign a civil nuclear deal and bring the relationship back on track. Now, President Trump, in just 6 months at the White House, has wreaked havoc on the progress. Not only in the US, threatening to impose punishing tariffs on India for buying oil from Russia, it's also moving much closer to Pakistan. Pakistan's Army Chief General Asif Munir has visited the US twice and even threatened a nuclear attack on India from US soil. The US has gone on to applaud Pakistan for, in its words, combating terror. This in a joint statement issued by both sides. As India's ties with the US sour, New Delhi and Beijing are moving towards mending the relationship after the Galwan clashes in 2020. So the big question is, what's next? Can India and the US settle their differences? And even if they did, will there be a trust deficit going forward? And how will that shape the future of this partnership? And more importantly, how should India deal with China and Russia? This is the Editor's Playbook. I'm Shireen Bhan, and joining me on the program today, Parikshit Luthra, Prashant Nair, Nimesh Shah, and Sriram Iyer. Gentlemen, thanks very much for joining us here as we count down to the 27th of August, which is the deadline for the additional 25% tariffs to kick in, taking the rate on India to 50%, the only country after Brazil to get a 50% tariff hit. There are, of course, back-channel negotiations that are currently underway. In fact, that's what I want to address to start with. What can we hope between now and the 27th of August? The first signs which have been made public by the US ambassador to India, Vinay Quatra, and he's had several meetings on the contentious issue of India buying Russian oil. So, Parikshit, let's address that issue first. This is the first public outreach, so to speak. Our ambassador in the US, Vinay Quatra, has met Lindsey Graham, the senator, and now has added to that meeting with another senator. Both these senators have been driving that bill, that bipartisan bill, which has asked for tariffing countries like India and Russia.
Yes, perhaps two of the most important senators in the US Congress right now. One, of course, is Lindsey Graham, and that meeting took place between Vinay Quatra and Lindsey Graham in Washington, D.C. last week. And then now you have a meeting between Richard Blumenthal, who is a Democrat, and Vinay Quatra again. Now, both these leaders were among 85 politicians in the US who were pushing a bill for additional sanctions on Russia, which would be a sledgehammer. They were calling it a sledgehammer for Trump in terms of bringing Putin to a halt. Secondly, they were also recommending additional sanctions on countries like India, China and Brazil, which are big buyers of Russian oil. So India is trying to convince them, make them understand that we have an India-US energy partnership as well. The point that the Indian government has made at multiple forums and also in these meetings, we've given data also through documents that the India-US energy trade has gone up 70% year on year between January to June this year. It's going to go up even more. I was told by sources that it's already $7 billion. It will be $14 billion worth of crude from the US by the end of this fiscal. That's a big amount. It'll only go further. So we're trying to explain them that acknowledge the India-US energy partnership, try to understand that we will reduce our oil purchases.
And we have reduced our oil purchases from Russia. So that point being highlighted, and the point also being highlighted that we have been buying more, especially in the last few months from the US, and that number is expected to go up significantly. So these two meetings are crucial because, you know, President Trump has said that this additional 25% tariff is about Russian crude. I mean, he's made that very clear in his conversations that he is penalizing India for buying Russian crude. So let's see whether this arrives at some sort of a middle ground or whether there can be a rapprochement, a breakthrough of any kind at this point. But the other point to factor in, Parikshit, at this point is that trade negotiations between both sides. The US team was supposed to come to India, and it's a coincidence they're supposed to be in India on the 25th of August, just ahead of that 27th August deadline for the tariffs to kick in. Is that visit on track at this point in time? What do we know about that?
You know, there are two very important things, Shireen, in this. It's getting so complicated, but the fact is, first, we have to make sure that these additional penalties are waived off. That's related to the oil issue. Even if we achieve that, you've got the 25% non-reciprocal tariff that many are saying. That still remains. We've been told by sources that those conversations, the 6th round of talks, remain on track. The USTR team, led by Brendan Lynch, is expected to come to India on 25th of August, and those talks are still slated to take place for now. And it is being said that despite what Donald Trump is saying, in fact, the deal is lying on his table apparently, he's not signing it. Everyone in the US administration is keen to have this deal done with the Indian government, and all other aspects of the relationship are flowing right now. So we really have to get the trade angle sorted out.
Yeah, and you know, even in Parliament, the response by both the Finance Ministry as well as the Commerce Ministry in response to these questions raised in Parliament continue to maintain that both sides continue to negotiate on a bilateral trade agreement. So there is nothing to indicate that, you know, that there is a departure or there is a stop as far as the negotiations for the BTA at this point are concerned. So at least we have to assume that these negotiations will continue and that maybe the date will change. We don't know at this point in time. But as of now, the negotiations will continue is what we're given to understand as well.
Absolutely. They continue for the 25th of August, and they're also ongoing right now, because if Ambassador Quatra, Ambassador to the US, is talking to US senators, there is clearly something on behind the scenes. One important point, this week is being termed as important by the Indian side, because if there is some sort of consensus between Putin and Trump, we could expect a reprieve for India, but it's very dynamic. No one really knows what is happening. Everyone is waiting and watching.
Yes, we are waiting and watching that big meeting that will take place between President Trump and President Putin. But, you know, the White House tempering expectations, Prashant, on that, saying that President Trump is there to listen. And this is going to be a listening meeting, whatever that means. And there's also now the possibility of a call with Zelensky ahead of that meeting between President Trump and President Putin. So as Parikshit was pointing out, it really is all up in the air at this point in time. And separately, before you take up all of these issues, I want to highlight the fact that you've got another crucial meeting coming up, end of the month. Prime Minister Modi is going to be headed to China. For the first time, you're going to see the Prime Minister visit China after the Galwan clashes. So that's also something to take note of, and we'll address the China issue in just a second. But Prashant, over to you.
No, I just wanted to, you know, so Parikshit beautifully laid out the oil bit and everything which is happening. And, you know, he wrapped up by saying something interesting, and it struck me. He said, well, the deal apparently is on the president's desk, right? He has to sign it. And everyone in the US administration is in favor of this deal. So it's basically one person, I mean, happens to be the president who's got to sign on it. And the only thing is, so and this is a question which I've asked, and I think Parikshit has asked, and you've asked, you know, former diplomats, ambassadors. So oil is one reason, but is there a bigger reason away from oil, which perhaps is the reason why, you know, this additional 25% has come through? And, you know, it was people who were whispering this earlier, but I think now people are talking about it openly. Saying that, well, actually, oil is one thing, but maybe the president himself, you know, and I think we've spoken about this on an earlier episode we've done. He feels a little slighted, insulted, whatever you want to call. Yeah. Because, I mean, he was looking, I guess, I don't know what he was looking for, but I mean, the general perception is that he was looking very clearly for acknowledgement, Prashant. He was looking very clearly for acknowledgement. He was looking for the Nobel. And the fact that India is not just... Forget about acknowledgement. The fact that India has repeatedly denied any U.S. involvement in the ceasefire. I mean, so forget acknowledgement. It's been you know, a denial of any kind of role played by the U.S. You know, so that is one of the factors. Yeah. My question is, and maybe Parikshit can answer this. When you talk to your sources, Parikshit, do they tell you? I mean, you know, but is the realization there? Maybe this is a fact. Of course, it's there, right?
Yeah. You know, there is definitely tension with that issue because President Trump wanted to be thanked. You know, what has Pakistan done? They've nominated him for the Nobel Prize. So many of the ambassadors coming to our studios have said that possibly India could have just acknowledged Trump's role in stopping Pakistan and standing with India against terrorism. That would have been enough. India did not do that for reasons which are important and sensitive to us. But one additional reason that is coming out, between China and India. Every day, experts are telling us that these are double standards. You're not saying anything to China for buying Russian oil. You're going hard on India. That's because India does not have the kind of leverage that China does with rare earth magnets, APIs, fertilizers, electronic components, semiconductors. They can hold up those supply chains. And that's the heat that Donald Trump is facing right now. Yeah. But when it comes to India, we do not have those leverage points. And Donald Trump feels you can threaten Russia with India, but you can't bring up China in that context.
No, and just to take that point, that's a good point that you make on China. And we will address a large part of what's happening with China and, of course, the India-China thaw in the relationship as well. The other aspect, Prashant, that I want to highlight here is also the fact that, look, it's hard for India. If Trump wants zero tariffs, India is also negotiating with the EU. The EU will turn around and say, if you're going to do zero tariffs for them, why should it be any different for us? So I think, we also have to be mindful of what the asks have been from the US. I think too much is being made about dairy and agri and so on and so forth. But if Trump actually was pushing for zero tariffs on a whole host of products, then India would have to offer very much the same deal to other trade partners that it's negotiating similar deals with. And I think that's, again, constraining the Indian hand, the Indian side. And perhaps that's one of the factors that President Trump, and, we heard Scott Bessent again saying that, the Indian side has been recalcitrant, has been reluctant in trade talks and so on and so forth. And I would imagine that that's what they're alluding to. But there are sensitivities, as we point out, on our side as well. But Prashant, you wanted to make a point about what happens to the markets now with these dynamics.
No, absolutely. And I will come to that in just, but just 2 points, Reen. One, there was very gentleman who came on the program, one of the programs, he said, well, if tomorrow India is to issue, now, of course, it's very hard to do. But if, if we're to issue a statement acknowledging, not giving him credit, but acknowledging President Trump's role.
I think that's past now, Prashant.
It's past,
I think
absolutely.
That's past. I think
I'm just telling you this,
that ship has sailed. That ship has sailed.
Even in markets now, I think there is I don't, Nimesh can see, but there's this realization that maybe, you got to play the card that you're dealt, right? And maybe you could have sort of, that realization is there. That kind of,
but I want to add to that.
Could have been handled a little better. Go on.
You have a point that, see, presidents in the Cold War era, whether it was Nixon, etc., whoever fought with India or were angry with India, they were looking for power. Like the most important variable in the equation was power in a Cold War. Post-Cold War era, when you enter the liberalization era, then, Clintons and others, they would start talking about principles. Yeah. Are you a democracy? Do you follow human rights on the same standards as US does or whatever, right? So whatever perceived the principle that was, they would bat for that. Those are your friends. But Trump is a showman. He is only working on perceptions. For him, all of this principles are obviously not of a question because, like Shireen said, if China is buying oil from Russia, why are we are the only ones paying the extra tariff? So he wants perception. We need to give him a story. Now, is that story going to be the one that he wants? Which is that and this is something that this is not the first time he's brought it up, by the way. Trump wanted credit for, a role in the India-Pakistan, Kashmir, dispute. Even in the first term, we didn't give it to him then. I don't see why we will give it to him this time.
Absolutely point taken. The point about China, Shireen, and I think Parikshit will take us through the steps towards normalization of relations, and this is, of course, an important one as well. Many here, by the way, in India have been industry, etc., have been asking for it. I am kind of sort of flipping the question. Of course, it is great. Flights are going to start after 5 years. You had to fly via Hong Kong or Singapore, I think, right? So far for the last 5 years, and flights are going to start, and the press note 3 being sort of watered down. More engagement, companies being allowed to operate, etc. Fantastic. And of course, that basically may also mean that, the supply of those precious rare earth magnets into India from China also become easier. So I think that part has been talked about, has been well understood. I want to flip that on its head, and it's just food for thought. We don't know if it's going to, if this is how it's going to play out. But the question, just 4 points. First of all, will Chinese companies be allowed to operate with much more freedom in India? That, of course, is the basic question. And it is important because for most think about the 100p stocks in India, the high valuation, high growth sectors in India, EMS, FMEG, capital goods companies. For these, starting 2020, 2021, it was about China plus one. But actually, China plus one has not played out for these companies in any significant way. What helped these companies, especially these category of companies, was import substitution, helped by schemes like PLI. And actually, what helped them was restriction of Chinese players, both brands and OEMs. So the question is, will easing of restrictions on sourcing from China actually hurt Indian players? Remember, Shireen, when the US is a market, China is a supplier, China is a factory. I mean, we can't sell to China. China can sell, I mean, it actually does sell a lot more to India than we sell to. We've got record deficits there, right? So, I mean, and that, it's, as I said, it's just food for thought. We don't know if it's going to happen. But I just want to put out these categories, right? Dixon, Amber, PG Electroplast, the EMS plays, power equipment, generation. If you remember back in the day, 10, 15 years ago, it used to be Chinese boilers, etc., which used to be big in generation. Quality, of course, at that point was a story. BHEL, L&T, Thermax, power equipment on the transmission and distribution side. These are straightforward categories where we pick up from industry, etc., that China's got large capacity. CG Power, TRIL, Hitachi. And of course, there are emerging segments, right? Motors, EV chargers, solar inverters, smart meters, etc. So, as the title says, friendlier skies, but maybe, price competition, because that's what China does. I mean,
no, absolutely. And I just want to, before we address this issue, Nivesh, just let's listen into an interesting conversation that I had with Amitabh Kant. Now, this is the man who designed and executed the PLI schemes when the PLI schemes were introduced. Here's Amitabh Kant essentially saying that you need to engage more with China, do joint ventures with Chinese companies, get them to manufacture in India in partnership with Indian companies, and review Press Note 3. Let's listen into Amitabh Kant and then take that conversation forward.
I'm a believer that India needs to do joint ventures with China. India needs to do joint ventures for components. India needs to do joint ventures on a range of inputs which go into manufacturing. We need to bring down the input and component manufacturing right on strategically important. And I think we need to work with China, and we need to really rework out the Press Note 3 to enable India to work with China to become a great manufacturing nation. The manufacturing must move from China to India, and for that it's important that we work in our national interest.
Well, so that is important there, and you're hearing it from the man who brought in, as I pointed out, the PLI schemes. And I think there is growing acknowledgement within government that if you want to address sectors like EMS, if you want to do more of the Apple type of manufacturing in India and so on and so forth, you will need to bring the component suppliers, largely Chinese,
Shireen,
into India. You're going to have to learn to work with them. I don't see that there's going to be any omnibus change that you're going to allow them everywhere and all kinds of things. But I think that I think there is going to be in areas where we feel that today we can have a competitive edge and a competitive advantage. Does it make sense for us to be able to partner and work together with the Chinese? I think perhaps that is a question that is up for debate, discussion and action.
Shireen, just want to add, opinion versus the reality. If you look at the reality, in the last 1 month, we've saw 2 large Chinese exits from Indian company, right? And financial sold out of Zomato, as well as in Paytm. And the day, just 2 days back, they sold out, and Paytm got an RBI approval for aggregator license. So reality is something different, and maybe the opinions are something different.
But on that opinion, the last line was super interesting. Huh? Like a few years ago, the national interest would have been to keep Chinese people away. Today, in this last line of the soundbite, he says that national interest is in letting them in and working with them.
No, but by the way, and that's what I began by saying, if you just look at the track record, right? COVID and China plus one, both these themes hit us together. Actually, China plus one is a theme hit after COVID, right? And because of COVID. And the point is, all these companies did not benefit because of China plus one. They did not, it basically benefited because there were restrictions on Chinese imports.
So, but the point is that, so these guys, who were they selling to then? That is an important question, right?
Bulk of what I mentioned are all mostly B2C companies. I mean, they're making products for the end consumer. I mean, consumer durables, I mean, ACs, washing machines, etc. Right? I mean, the entire PLI, EMS PLI,
their costs were on
phones, mobile phones, for example, right? So there are ways to do it.
Nimish, you want to come in on what we need to be mindful of, and more importantly, what's the market looking at?
Well, Shireen, market is looking at this, somewhere this has to settle down with the US. And that's why India has been the biggest underperformer in the last, say, 2-3 months in the Asian peers or even in the global context. So clearly, this is one thing which everybody is hoping for and waiting for. And remember, we are extremely short in terms of FI positioning as well from a market perspective. But, I just want to add some data on why, while we all talk about, we should tilt towards China or we should tilt towards Russia, why is US very important? And the data is very, very clearly saying that US is indispensable. The India exports to the US is almost 18 times more than what it is to Russia. Okay, and even if you look at Russia's exports, there is nothing which is more than $1 billion. All these components are not more than $1 billion. So scaling up is going to be a big risk and a big challenge as well as far as India is concerned. So there are a lot of data which suggests that we have to have a close tie-up with US if the market has to do well. And I guess if there is some settlement this weekend with Russia, maybe at least there will be a relief rally for sure from a market perspective. So clearly we have to align with US in some form or the other as far as markets are concerned.
And I want to add one line to that, Shireen, basically tying it up back to what Parikshit and most of the people in the US administration, including his latest nominee for the Bureau of Labor Statistics, E.J. Antony, these are all people who have constantly said that India and other countries need to be weaned away from Chinese influence. Trump is the only outlier in this opinion, right? I mean, he's the only one who doesn't seem to act on it, even if he says whatever he says. So I think the consensus in Washington, minus Trump, will be in favor of India in having a reasonable deal. This Friday might be the end of the 25% penalty.
Yeah,
and
if there is a settlement with Russia.
If there is a settlement. I mean, Trump has cornered himself into a position here right now. And the good news, we don't know.
I think they kind of started to walk back on that, saying that this is a listening meeting and so on and so forth. Because look, if what has been put on the table between the US and Russia is that large parts of Ukraine are going to be handed over to Russia, then I don't really see. Forget Zelensky. The other Europeans, agreeing to that or allowing that to go through. That's going to be the big question as well.
Europeans have agreed to far worse already in the tariff debate. So they don't seem to believe.
On the tariffs, they're giving a lot of what President Trump has been asking for.
Saying because their position is hardened, right? I mean, they were passive players in this entire thing. No longer. I mean, Germany is coming up and saying that we're going to spend this much on defense. So they're no longer passive players in this entire.
They had to settle it. The entire tariff negotiation with the US has gone against them. Because the problem with Europe
I'm saying on Friday, Europe is also a factor now. So it's not just Russia and US. I mean, Europe also wants to have a say.
They want to put the Ukraine war is a settlement of land swap. How much are you willing to give Russia? How much are you willing to leave it with Ukraine? And I think here Trump is running out of time. He needs to, because I'm going back to my first point on perception. He needs to solve. If you look at this 200-day report card, which is put out by the White House, this two or three key elements are missing. Inflation he has not conquered in a reasonable way, even though he might.
A problem because he's fired the head of the labor.
Correct. So the next guy is coming. That's the guy we quoted right now.
You can have all the statistics you want.
So it's inflation, jobs is not under his control. He has not stopped any war. And tariff negotiations with any major.
That's what you think. That's what you think. He thinks he stopped every single war.
Exactly.
Which is why, with the exception of Ukraine, I mean, and he's pushing for Putin to get to the table.
Yeah, that's the easiest thing he can solve because there is near unanimity in the US as to how this war ends. In the case of Israel-Gaza, there are multiple POVs. But
when we have our backs against the wall, we seem to perform the best and deliver. Will the Prime Minister deliver something from the ramparts of the Red Fort on the 15th of August? We will have to wait to see. But I can see you guys have got the Oval Office into studios, so you're getting a taste of what it's like to be Donald Trump.
I think we have Sriram here, who knows.
I'm saying makes India great again. Why not?
Absolutely, I completely agree. I think we all agree. 100%. That's the only way.
Yes. make India great again is the hope, and that is certainly going to be top of mind as far as our policymakers are concerned. But gentlemen, thank you very much for joining us on the Editor's Playbook. We will of course continue to track all of these moving parts, the many meetings, the many developments, and of course the backroom chatter, as they say, on what's going on between India and the US. Parikshit, Sriram, Nimesh, Prashant, thanks very much. We'll see you again in a short while from now, but thanks very much for watching the Editor's Playbook.
Hello and welcome to News Center. I'm Parikshit Luthra. The top story we are tracking this evening. Finance Minister Nirmala Sitharaman has introduced a bill in the Lok Sabha for amendments to the Insolvency and Bankruptcy Code. The amendments are aimed at reducing delays under the IBC and will introduce creditor-initiated insolvency resolution process. The government has also proposed an out-of-court initiation mechanism for genuine business failures. The changes are aimed at facilitating faster and more cost-effective insolvency resolution. The government also aims to ease burden on judicial systems, encourage ease of doing business and improve access to credit. Group insolvency framework will also look at efficiently resolving insolvencies that involve complex corporate structures. The new law proposes cross-border insolvency framework to protect interests of domestic and foreign stakeholders. The bill has been referred to a select committee of Parliament. To take this discussion forward, I'm now joined by former Finance Secretary S.C. Garg and Kumar Saurabh Singh, partner at Ketan and Company. Gentlemen, thank you very much for joining us. Mr. Garg, one of the major problems with the IBC, the original intent was clear and was good, but what we were seeing is that the average time taken for admission was almost 434 days. And we're not talking about resolution, we're talking about admission. Do you think this bill will do a great service by fixing a time period for an application to be admitted or not?
See, fixing timetable is the easiest thing to do, but adhering to that is the real test. The IBC has the time sort of table for every process, including the total resolution and all. So how would this one, once it becomes the act, so far it's going to the select committee of the Parliament, they will take time, and what finally becomes the law, we don't know. But assuming that this becomes the law as it has been introduced in the Lok Sabha, there are good proposals sort of to start counting from the day, specifying timelines for the initial admissions and all. Hopefully that is a step forward. But don't sort of discount the ingenuity of Indian legal system, the lawyers and the people involved to sort of test this out as the time comes.
Right. That's an important point, sir. Saurabh, if I can come to you, what do you think will be the proof for global investors and even domestic investors to trust India's insolvency process even better? All right, we will be joined by Kumar Saurabh Singh in some time. Mr. Garg, if I can put that question to you, going forward, if we want investors to trust India's insolvency and resolution process, what do we need to do in terms of implementation?
Well, the bill has many provisions to sort of address the interest or the concerns of the investors, whether foreign investors or domestic investors, including trying to put together a regime for the cross-border resolution, insolvency resolution. This has been in the works for many years. I remember when I was in the system in 2017-18, we were talking about introducing cross-border insolvency resolution. That has come now, and that has come, by the way, only as a kind of enabling provision. The bill talks about that the government will frame the rules as it when you go through it. So becoming the law and then framing the law is quite far in the future. Likewise, the group insolvency resolution is also a very complicated kind of thing. Remember the ILFS issue or the GenSol, and where multiple companies, subsidiaries exist, and if one has defaulted, the other one has not defaulted. How do you resolve in such kind of group bankruptcy and insolvency cases? Again, there, the bill proposes enabling provision. The government will bring the rules in times to come. So we'll have to watch out what comes into those rules. A good move possibly is, yeah.
All right, you're saying a good move, a good intent, a good message that we're sending to domestic and foreign investors. Let me also go across to Kumar Saurabh Singh. Saurabh, if I were to ask you, do you think this bill will address concerns in the banking sector among investors about what has happened with the Bhushan Steel resolution process? Now, the Supreme Court had quashed JSW Steel's plan for resolution in the case of Bhushan Power and Steel. The banks were asked to return 19,300 crores. There was 34,000 crore of bank exposure, which is at risk. This is at a review stage right now. But do you think this bill and the government's message here will address those concerns?
I think the message is very clear. I think some of the problems of last 3-4 years, if you see the last amendment of law came in 2021, and some of the problems which had crept in the system through various interpretations of courts have sought to be addressed through this amendment. Now, in terms of very specific context of Bhushan Steel, yes, I think the intent seems to be to address, but the messaging is more at the NCLT level, because NCLT is required if in case of non-compliance of the provisions of the plan with the law, to send the plan back to COC and give it a chance to come back. Now, while NCLTs are going to work in that framework, I mean, for the apex court of the country, they have a lot wider powers and they have exercised discretion in many situations. So, I mean, that, as Mr. Garg was also mentioning, the interpretation of law is something that will be left to the courts. But I think the intent from government side is quite clear. Some of the issues that the process has faced in the last few years, there is an attempt to address it. Does it completely allay all apprehensions? That only time will tell, and it will depend a lot on how the law is implemented through courts. So it will have to be seen over a period of time, but I think the direction of changes seems to be quite welcome and in the right direction.
All right, let me go back to Mr. Garg. Mr. Garg, when it comes to out-of-court settlement, in the case of genuine business failures, there is a provision for this to encourage out-of-court settlements. This will be an important factor in reducing litigation pendency of cases under the IBC process. Do you think if this bill is passed in this form and implemented, a lot of people in the corporate sector will try and resort to this process?
See, this is a very interesting proposal. So what essentially is that the lenders are being put in charge of the insolvency process instead of the court as part of the corporate resolution process. Now, putting the lenders in charge is efficient, definitely. The lenders can take more and faster decision, and they can do a commercial kind of deal in case there are genuine business failures. But the very same proposal can also be misused completely. What we saw in several cases resolved here, where the haircut was 90% or 95%, you don't know whether that was actual business failure or there was sort of some game going on between the lenders and the corporate debtor. So will in future this provision be sort of used to compel bankers to grant the accommodation to whoever need to be favored, or used for the actual genuine business failure kind of cases, is yet to be seen. So it's a double-edged sword in my judgment.
Right. So you're saying it's a double-edged sword. Let me go back to Kumar Saurabh Singh right now. Kumar Saurabh, when it comes to group insolvency provisions and provisions around cross-border settlements, How important are these amendments that are being suggested by the government?
So again, I mean, if you see the proposal, it is creating enabling framework for government to create rules around cross-border insolvency and group insolvency. The law is not really being set through the proposed bill. So in that sense, it will take some effort before we have, say, particularly cross-border insolvency framework in place, because that will also entail discussions between countries, between governments to create a reciprocal regime, because typically cross-border regime is, created as an enabling framework on a reciprocal basis. Group insolvency, again, we have had experiences like ILFS, which has taken a fair amount of time to resolve. So in that sense, both the aspects need to be addressed very clearly. I mean, the first round of distress that we have seen, say, from 2015 onwards, a lot of that has got resolved. But now is the time really to look at second generation of insolvency reforms. And I think as part of that, these two are very critical areas, not just ILFS, but if one were to look at Videocon, GenSol, various other cases where you may have businesses spread across multiple companies, and in distress, you take a corporate debtor specific approach. That can be, say, counterproductive, value degenerating. So in that sense, very, very important to have a framework which is functional and not left to courts to decide.
One very quick... Right, that's an important point. My final question to you would be, how important is it to increase the staffing, increase the infrastructure under the IBC framework if we want these new amendments to succeed, Saurabh?
No, I mean, infrastructure is very, very important. And I would also say that, if you look at, say, infrastructure, while there has been a lot of delays, but a lot of it is also because of the gaps which get created in our law. And sometimes at the level of committee of creditors, the tendency to get adjudication from courts. As long as that tendency remains, you will not see merely amendments leading to minimization of disputes or delays in the process. So it also requires some sort of a attitudinal change, and I think support from regulatory side, that if there is decision making which is done by committee of creditors, accept that and move on, particularly if you see examples like BPSL, reopening the whole case, that in a way shakes the confidence of the entire system. So those aberrations, if they are not there, and you create further improved infrastructure, and with these changes, I think things can get better. But I mean, to the larger question, of course, a lot of it will remain to be seen how we implement and whether all the problems get addressed through this changes or not.
All right, Kumar Saurabh Singh and Mr. Garg, thank you very much for joining us on the program. We're taking a short break, but don't go anywhere. The news continues on the other side. Welcome back. Amidst President Trump's trade war, there is a thaw in the bilateral relationship between India and China. This comes ahead of Prime Minister Modi's scheduled visit to China later this month. The first in the last 7 years. This will be a meeting of huge geopolitical significance. Indian and Chinese ties had broken down after the border clashes in Galwan in June 2020. But there is an expectation that from September this year, there will be some stability and predictability in ties. PM Modi is set to visit China for the SCO summit in Tianjin from 31st August to 1st of September. This will be Prime Minister's first visit to China in 7 years. Sources say India's objective would be to instill positivity in the relationship. We have also been told by sources that the India-China relationship at the upcoming meeting between Modi and Xi should not be seen through the prism of an India-US relationship. While India and US relations have taken a rough turn recently, India and China have been working on improving ties for the past few years, and more so after October 2024. When PM Modi met President Xi Jinping on the sidelines of the BRICS summit in Kazan, Russia. Both leaders had agreed to work towards a peaceful and stable India-China relationship, and they had also decided to not allow differences on the boundary issue to disturb peace and tranquility at the LAC. Since then, there have been multiple meetings at the level of foreign secretaries, NSAs, defense ministers, and the external affairs minister. Sources say the consensus reached between Modi and Xi is now being given shape to ahead of the SCO summit in Tianjin. There are signs of a thaw as well. India has restarted issuing tourist visas for Chinese nationals after 5 years. Final timelines for resumption of direct air flights between India and China is expected soon. India and China had earlier agreed in principle to resume direct flight. Reports say China has eased curbs on urea shipments to India, and the Indian industry hopes China will ease supply of specialty fertilizers. China's restrictions on rare earth magnets have created a crisis for the Indian industry, and the automotive sector is hoping that a positive meeting between Modi and Xi will help ease high rare earth magnet exports to India. India has also been clearing Chinese JVs with Indian companies wherever a technology partner is needed for Indian manufacturing. Also in a first, since 2021, an Indian vessel with 496,000 barrels of ultra-low sulfur diesel has been shipped to China. PM Modi is expected to have a one-on-one meeting on the sidelines of the SCO summit. The meeting will definitely set a roadmap for ties for the next few years. Speaking to CNBC Awaz, Indigo CEO Peter Elbers said that the airline is ready to begin flights to China if a bilateral pact is reached between both countries.
Government is planning to open up to China also. So if they ask you to start, are you prepared for that?
You know, whenever the sort of bilateral arrangements between China and India were to enable flights, Indigo clearly is happy to start operating. Indigo was operating there prior to COVID. Indigo is known for its entrepreneurial spirit and exploring it. So if the governments were to come to an arrangement that the air travel would resume, clearly Indigo would be ready to do so.
Swedish home furnishing brand IKEA has opened its first city store in Delhi. This marks the retail giant's big expansion push in India. Shivani Bazar's caught up with the outgoing CEO Suzanne Palvera and IKEA's India's new CEO Patrick Antony to talk about the company's plans in India. Take a look.
Well, IKEA has a brand new store, a city store they're calling it, in Delhi. We are standing here in the new IKEA in Pacific Mall, Tagore Garden. And to speak more about this and IKEA's future plans, we have the people themselves, Patrick and Suzanne. Thank you so much for joining us here on CNBC-TV18. Let me begin by asking you, Suzanne, how do you feel about this? And what is IKEA's strategy basically about these city stores? We saw last year that IKEA made its entry into North India. How has that been going, and what role does this play?
I am immensely proud to open the door with the first store in the Delhi region. And it's a city store, but it's the first in a long row of more stores to come. And as you said, we opened the online business half a year ago, and we have now a good sense of what the Delhiites live. So we can further meet them here, and they can come and physically experience our products and solutions. So we are very happy to be here today.
Two big stores coming up in Delhi NCR. The North India market looks up for IKEA. What is the expectation? Is there an expectation, a ballpark figure for sort of what is the kind of plan when it comes to revenue growth, profits? Is there something that you have in mind?
we can say that Delhi is most likely the biggest home furniture market in India, and hence the expectations are very, very high over time. We have started in one way, which is the online. We're complementing it with various formats, and we will see a quite rapid growth, I believe. So we have much more capacity to do, so we can meet many more of the delights. We don't have a ballpark number to give you, but it's expected to be by far one of the biggest 1 to 2 markets in India for us.
India is looking to include the global tender inquiry feature in the government's e-marketplace. The move is aimed at providing easier market access for government procurement through existing and potential free trade agreements. Abhimanyu Sharma spoke to Mihir Kumar, Director and CEO of GEM Portal, on this feature and began by asking him about the platform's expansion plans.
Our expansion plan depends on the demand which comes from the buyers and the sellers. So we are working on, firstly, as I was mentioning, the rate contract is one functionality which we have created, which will help the buyer community. The other thing is the global tender inquiry, on which we are working, which will be launching in this financial year. So it's a constant journey, it's a constant interaction based on the requirements which are coming from various stakeholders. We try to align our functionality as per the needs. So that is the way to go forward. Secondly, we are trying to say to the states especially, who have not been able to do big business through the portal, that there is a lot of merit on coming to the GEM portal. So that is our other endeavor on which we are working.
So you were also debunking myths about the fact that states are also witnessing contracts from outside the state. So GEM portal is not stopping or forbidding, but rather is facilitating the taking of contracts by contractors from outside the state. Now, as we move ahead, we also have insurance, which is growing on the portal. What kind of expansion plans are you looking at in these domains, and also on the procurement aspect which you spoke about? Now, India is signing FTAs. You have a public procurement aspect in the UK FTA. We are also looking at FTAs with other countries. What kind of what kind of things are you looking at as far as harmonizing India's standards with these countries is concerned?
You see, so far as the product development and the services development, like for example, insurance as a service or the other services, it's completely based on the demand which is coming from various buyers and the sellers who are able to offer that kind of service or the catalog. So that is a ongoing process. So that's how we have created more than 343 odd services and product vertical more than 11,000 products. Now coming to the other aspect which you are talking about is the bilateral trade agreement and the market access, which is public procurement space. So obviously that will be through the mode of global tender inquiry, which is otherwise also it's a mode of tendering and mode of procurement which is already in vogue. So we were not having that functionality. We will be creating that functionality. We are working on that.
With that, it's a wrap on this edition of News Center. More news and updates continue right here.
Very good afternoon, ladies and gentlemen. I'm Ritika Jhanti-Chaktiani, and what an honor it is to extend a very, very warm welcome to all of you to HSBC Presents CNBC-TV18 SME Champion Awards 2025. This is an afternoon of celebrating resilience, impact, and innovation right from the heart of the enterprise ecosystem in the country, ladies and gentlemen. So let's get it kick-started with a big round of applause. Today, as we meet here, it is time for all of us to celebrate and acknowledge small and medium enterprises who are transforming sectors. Now, if season 1 was about spotlighting the scale of SMEs and also about celebrating resilience, this edition, that is the season 2, is all about celebrating readiness. Without further ado, let's get it kick-started by inviting onto the dais to deliver the opening address with a warm round of applause, of course, the managing editor of CNBC-TV18, Shireen Bhan.
Albert Camus once said, "In the depth of winter, I finally learned that within me lay an invincible summer." And that spirit of resilience, born of challenge, defines today's gathering. Ladies and gentlemen, welcome to the second edition of the HSBC CNBC-TV18 SME Champion Awards 2025. Now, this platform began with a powerful premise that India's economic future lies not just in the boardrooms of global giants, but in the determination shown every day by millions of small and mid-sized businesses like yours and all of you sitting here in this room. In season 1, we observed this reality. We saw enterprises driven by the clarity of their purpose and the strength of their design. And this year, we've deepened that inquiry. We not only mobilized the participation from across India, but we went to Ahmedabad, Pune, and Bengaluru, where our roundtables centered on global readiness, sustainability-driven operations, and tech-led value creation. Behind every milestone lies resilience, the ability to persist when capital dries up, when logistics break down, when the horizon narrows but the vision stays sharp. As Churchill said, success is not final, failure is not fatal. It is the courage to continue that counts, and the courage is visible in every business that we will honor this evening. Ladies and gentlemen, welcome to the HSBC Presents CNBC-TV18 SME Champion Awards 2025. We now have the privilege of welcoming a leader who's engaged with enterprises across portfolios from aviation to commerce to regional development. His focus remains on delivering results that outlive the announcement and fostering growth that includes those at the margin. Our guest of honor this evening, Shri Jyotiraditya Scindia, the Honorable Minister for Communications and Development of the Northeastern region, and the Telecom Minister. May we request you to join us up on stage. It's now time to commence the SME Champion Awards 2025, a celebration of ambition, endurance, and excellence. Before we begin, a heartfelt note of appreciation to all our nominees, and may I now request our Honorable Minister to present the CNBC-TV18 SME Awards 2025.
Our first special recognition, ladies and gentlemen, is for the SME Entrepreneur of the Year, Mr. Arvind Lakshmi Kumar, founder and CEO, Donbo Imaging. Moving on, our next special recognition today is the SME Woman Entrepreneur of the Year. And the SME Woman Entrepreneur of the Year is Ms. Ruchika Bhuvalka of Urban Month. I request the Honourable Minister to please stay with us on stage, as I would now like to invite Mr. Dinesh Khara, former Chairman, State Bank of India, to please join us for the next set of honours. Now we begin this next set with the Award for Excellence in Tech Export Promotion Small Enterprise. The winner, ladies and gentlemen, is Illogix Software. Moving on to the second category, which is Excellence in Tech Export Promotion Medium Enterprises. And the winner, ladies and gentlemen, Tonbo Imaging India. And now, ladies and gentlemen, it's time to honor the small enterprises for excellence in goods export promotion. And the winner is Axio Biosolutions. And now we present the award for excellence in goods export promotion medium enterprises. Please join me in welcoming and celebrating team Advance Wells Private Limited. Thank you so much, Mr. Khara, for taking this forward. I request you to kindly take your seat. I would now like to invite Mr. Subhash Chandra Garg, former Finance and Economic Affairs Secretary of India and member of our esteemed jury, to join us on stage to present the next set of awards. Our next set of honors recognize SMEs who've demonstrated extraordinary commitment to the communities they operate in as a core value. The next award is for Excellence in Community Engagement, Small Enterprise. Let us all put our hands together for We Voice Labs Private Limited. We now present the award for Excellence in Community Engagement Medium Enterprise. Let us all put our hands together for CS Tech AI. Many congratulations to the entire team. And with that, we would like to thank Mr. Garg. Thank you so much, sir, for joining us and presenting this set of awards. And now it's time for us to turn our attention towards sustainability, a core pillar of long-term enterprise value. And to take this forward, I would like to invite Mr. B. Tyagarajan, Managing Director of Blue Star, to please join us on stage. We now present the award for Excellence in Sustainability Practices Medium Enterprise. Ladies and gentlemen, let's hear it up for Advait Energy Transitions Limited. Many congratulations to you, ladies and gentlemen. Moving on, up next is a special mention now in this category of Excellence in Sustainability Practices Medium Enterprises. Ladies and gentlemen, the winner is Chalo Mobility. Many congratulations to Chalo Mobility, to the entire team. Let's have a round of applause for them, please. And with that, ladies and gentlemen, now we're wrapping the first set of awards for this evening. And I think that was a compelling glimpse into the kind of businesses that are building with depth and intent.
at this wonderful event that really symbolizes the chrysalis of India. My old friend and someone who always makes sure that we are on our toes, Shireen Bhan, Ajay Sharma ji, members of the jury, and most importantly, all the awardees of today's event, and the hundreds of people behind the success of today's award ceremony. It's indeed an honor and a pleasure for me to be at this event. Today is a day where we are not only felicitating, we are not only awarding, but we are celebrating the story of not only the success of the awardees today, but celebrating the success of the real builders of the modern, powerful, and passionate Bharat that we all represent on the world stage. India's destiny is written. And today, with conviction, every Bharatiya Nagrik stands with his or her head held high, because we are on that path of actualization, of realization. Prime Minister Narendra Modi's leadership, where we are moving from our Amrit Kal to our Shatabdi Kal. A country that has moved up the ranks from the 11th largest economy to today, the 4th largest economy. By 2028, the 3rd largest economy. And whilst we look at those headlines, the movers behind those headlines, ladies and gentlemen, are all of you who have been awarded today. You are the movers of that modern India. And I am reminded of a phraseology that was used by one of my professors at Stanford Business School. And he said, always remember two things. The only constant in the world is change. Line one. And he quickly followed that up with line two. Only the paranoid survive. So whichever space we are in today, if your eyes are set on success, and दिल में वो ज्वालामुखी की जो एक तड़प होती है वो है, तो जिस रास्ते पर हम संकल्पित हैं, if that yearning for change is always within us, success will be at your doorstep. A company with the name of Urban Monk, and she's bridged the rural-urban divide so beautifully with that name. Let the market be urban, but have a soul of a monk, and transition from processed foods and atta and rice to Sri Anna. So across that gamut, medical equipment that will cryogenically freeze wounds of our armed forces. There was an era where we marched with the world, and there is an era now where through energy and entrepreneurism like we have seen today, we will lead the world in the area of technology. The diversity that we have seen on this stage today, the ability of turning ideas into action, whether we are in public life or we are in media or you're in industry, our mission has to be focused on a higher goal. Our vision has to be focused on a higher goal. And societal service has to be, societal benefaction, societal service has to be at the core of that goal. And if you're able to achieve that, the profits and bottom line will surely follow. The SME sector has been the core of India's essence. Millions employed by the sector. 46% of our exports determined by the sector. And may I add that all of those that we see in the large cap universe were 2 decades ago also in the SME universe. And therefore, today's SMEs, I have confidence in my heart, not in my head, will become tomorrow's large cap companies in India and in the world. Today, across the world, there's a fascination with unicorns. And there's quote unquote this notion, think big. But it is our SMEs that work assiduously with this conviction of start small, think smart, and scale fast. 6 words as opposed to 2. But the path to progress and the path to service is enshrined in your hearts. I've seen many examples in my own area of ideas that have blossomed into action. From blossoming into action, emerged as SME companies. A group of SHG women in rural Shivpuri that started out as a group of 100 women, collecting milk, processing it, and now looking at getting into branding their own product and selling it in the market. And from 100, 6 years ago, today that group has grown to over 10,000 women. And so is the case in my Northeast. When I was Civil Aviation Minister, I cogitated and all of us sat together, and the ministry came up with a new scheme called Krishi Udan. And in the belly of aircrafts, which would go normally empty, at a very subsidized cost, we decided to transport perishables. And I was amazed to see that in a period of 6 months, my king chilies from Nagaland, through my SMEs, were reaching Dubai. My queen pineapples from Tripura were reaching the tables of people in Germany. And today, ladies and gentlemen, the government of India is not walking behind you. The Prime Minister and the government of India is walking side by side with you. And 3 enablers that have assisted this process. The first, of course, is an unseen new highway. In the 1900s, when the world went through an industrial revolution, the Vanderbilts and the JP Morgans and the US of A built out the railroads and the road system. Today, that new highway is the digital highway. It is the unseen highway. But it is that highway that connects every single person. Forget about markets and countries, but every single person across the globe, 8 billion of us. And what does that do? The phone is no longer a receptacle for only exchange of emotions and voices. It today is an intermediary that connects every single person to the global market. And that allows people sitting in rural areas to be able to manufacture, brand, and process their products and sell it in the global marketplace. Which is the reason why you've seen a runaway success with our DPI, our UPI system, with close to about 2.16 trillion transactions per year, equaling $3 trillion. 46% of today global digital transactions take place in Bharat Mata soil. That ability, along with the opening up of our economy, 100% of FDI being opened across every sector. The Prime Minister has just signed the UK-India CETA, Comprehensive Economic Trade Agreement, which allows us unbridled access into that market. And therefore, I say, with regard to technology, with regard to an investment regime that is liberalized, with regard to huge movements in technology, today government is walking side by side with you. Why? Because in your success lies our country's success. And therefore, each of you today that have come up on the stage, each one of you not only carry the flag of your company, but each one of you carry Bharat's Tiranga in your hand as well. So I say to you that your story is not celebration of your success alone. It is the spark that will ignite many other such successes to come India's way in the future. You are the trailblazers. And on this day, it should be our resolve that our notion of becoming a Vishwaguru, our notion of Vasudeva Kutumbakam, in our eyes is the growth of the world, is the safety of the world, the security of the world. Our ability to grow from local to global is an act that we must deliver on, not tomorrow, not the year after, but now. I wish you all the very best. Thank you very much for having me. Jai Hind, Jai Bharat.
A big thank you, Shri Jyotiraditya Scindia, for sharing those words, which I think were just a perfect blend of insights and vision and intent, and for making time out of your very busy schedule and being here for the SME Champion Awards. Ladies and gentlemen, a big, big round of applause there. Now I'd like to invite Mr. Hitendra Dave as we bring this evening to a formal close. We would love to hear a few words from you. There's been quite an impact that this edition has created, and we look forward to many more with HSBC support. Over to you, sir. Love to hear closing remarks from you.
Thank you. Thank you. Thank you, ladies and gentlemen, for joining us today. Congratulations once again to all the winners. I can tell you that the jury we have, Mr. Khara, Mr. Garg, other members of the jury, Mr. Panda, I think these are not people easy to impress. I know that from my own personal experience, actually. So you've done much better than I could in my life, get a nod from them. A bank like HSBC, for entrepreneurs out there who wish to deal with the rest of the world, I think you will very rarely find a better partner, because we know what the buyers outside look for. We know the quality that works with them. We know the payment terms that they work on. We know the reliability factor that they look for. So when we started partnering on the SME Awards, one of the motivation for us was, can we play our own small role? Everyone talks about Viksit Bharat, right? But somebody will have to do something. Viksit Bharat will not happen by itself. Our hope is that through awareness campaigns of this or high visibility programs like this, we can help SMEs realize that the world out there has opportunity which is unlimited.
Thank you, Mr. Dave, for those closing thoughts and also for your continued partnership towards shaping this platform.
Hello and welcome to Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. Indian equities rally on the back of firm global cues and domestic inflation falling to an 8-year low. The Sensex and the Nifty gain 0.5% each. The rupee strengthens 0.25% as the dollar index hits a 2-week low on renewed hopes of a rate cut by the Fed. European leaders set to engage in frantic phone diplomacy with President Trump ahead of his summit with Russia's Putin. Ukraine's Zelensky, along with leaders from Britain, France and Germany, set to make a case about not ceding territory to Russia to end the war. India continues back-channel negotiations with U.S. lawmakers with 2 weeks to go for the 50% tariffs to kick in. India's U.S. ambassador meets Democratic Senator Richard Blumenthal after meeting Republican Senator Lindsey Graham. Both had sponsored a legislation proposing higher tariffs on India for buying Russian oil. A further thaw in the India-China relationship amidst Trump's trade war. India ships diesel to China after 4 years. China clears urea exports to India. Both nations set to resume direct flights after 5 years. All of this comes ahead of Prime Minister Modi's scheduled visit to China later this month, the first in the last 7 years. The US applauds Pakistan on combating terrorism and promises to deepen bilateral cooperation. The joint statement comes nearly 4 months after the deadly terror attack in Pahalgam, which killed 26 people. Big boost for Paytm. The RBI allows the company to operate as an online payment aggregator. The move effectively lifts the 2022 ban on onboarding new customers. Paytm shares perk up in trade. The Mumbai police launches a preliminary probe into IndusInd Bank's alleged accounting lapse based on the management's complaint. Police record statements from staff members, including the former CFO and deputy CEO. AI startup Perplexity offers to buy Google's Chrome web browser, makes an unsolicited bid of more than $34 billion, according to the Wall Street Journal. Google may have to sell Chrome as part of an antitrust proceeding. President Trump mocks Goldman Sachs CEO David Solomon, claims he made a bad prediction on the repercussions of the tariffs. Trump tells Solomon to get a new economist to focus on being a DJ. Chief Justice B.R. Gavai says he will look into a plea against the Supreme Court's order on rounding up of stray dogs in the Delhi National Capital Region. The Apex Court had directed all stray dogs to be moved to shelters within 8 weeks, sparking concerns and protests. Well, let's go straight to the day's market action. The Sensex and the Nifty regaining yesterday's losses, ending the session near the day's high. The Nifty reclaimed 24,600, largely led by pharma, metal and auto stocks. The Nifty Bank up by about 137 points, 356 points higher there on the Nifty Midcap. The Sensex closing about 300 points higher. That's the story for the stock markets. But the big global story, European leaders will speak to President Donald Trump at a virtual meeting ahead of his summit with Russia's Putin. Ukraine's President Zelensky will travel to Berlin to join German Chancellor Merz and other European leaders. The EU leaders are expected to reiterate that no decisions should be taken without Ukraine, including, of course, changing its borders by force. Remember, the US president has said that both Kyiv and Moscow will have to cede land to end the war. President Trump has said that his meeting with Russia's Putin is, and I quote, a feel-out meeting to see what the Russian leader has in mind, end of quote. The White House has also called the meeting a listening exercise.
That a deal will emerge from this meeting, or is he simply going to listen?
I think this is a listening exercise for the president. Look, only one party that's involved in this war is going to be present. And so this is for the president to go and to get, again, a more firm and better understanding of how we can hopefully bring this war to an end.
Well, a listening exercise, says the White House ahead of the Putin-Trump meeting. Now, the U.S. Department of Commerce has initiated anti-dumping duty investigations into the import of solar cells from India. The probe will also cover imports from Indonesia and Laos. This after the U.S. solar manufacturers claimed that importers benefit unfairly from government subsidies. Vivek is standing by with more details on how this is likely to impact Indian companies. Vivek, which are the companies that will be hit?
Well, that's right. A development to take note of. Number one, it's actually a consortium of U.S. solar manufacturing companies, cells, modules, panels, that earlier had petitioned for both an anti-dumping duty as well as a countervailing duty to be imposed on Indian exports along with 2 other countries. So now the U.S. Department of Commerce has initiated this particular probe into both solar cells, modules as well as panels. So there are 3 countries that are part of this particular probe: India, Indonesia, as well as Laos. Now, what is the claim? The claim is that these companies from these countries actually benefit from unfair government subsidies, and the sale price at which they sell in the US market is lower than the fair market prices which the US companies produce and sell at. So now, when you're looking at the impact, currently, the impact will be determined by the final outcome of this particular probe. But any adverse ruling may lead to one-time large penalties that these companies will have to face. So, which are the companies that will remain in focus? Well, the company that will be impacted the most is Waaree. Over 40% of the order book is from exports, mainly into the US markets. 2 other companies do export, very minimal. Premier Energies have continuously told it that the order book mainly is in the domestic market, and also Adani Energy does go ahead and export, Adani Enterprises, does export some solar products into the US market. So these companies will be impacted. When it comes to Waaree, remember, the company will also face the double whammy of the 50% tariff that the USA has imposed on India. That could be offset by a 1.6 gigawatt facility that the company is planning to set up in the US market. Overall, a slightly negative development, but key details are still awaited.
Vivek, many thanks for joining us. With just 2 weeks to go for the 50% tariffs to kick in, India continues to hold back-channel negotiations with US lawmakers. India's US ambassador met Democratic Senator Richard Blumenthal after meeting Republican Senator Lindsey Graham last week. Parikshit is standing by with the details. Parikshit, why are these meetings crucial? Take us through where things now stand.
Now, Lindsey Graham, the Republican senator, and Democrat Senator Richard Blumenthal were 2 leading US politicians who were championing and pushing a bill that would impose not just additional sanctions on Russia for the war in Ukraine, but would also impose penalties on countries like China, Brazil, and India for purchase of Russian oil and fueling what they call Russia's war against Ukraine. India has been trying to sensitize these politicians, and the person leading the charge is India's ambassador to the US, Vinay Quatra. Last week, he met Lindsey Graham, and this week, he has met Richard Blumenthal, who is a Democrat, and made him understand what India's view on India-US energy ties are and perspective on our energy security needs as well. India has been trying to convey to the US administration and US politicians that India-US energy trade has significantly gone up this year. It's up almost 70% on a year-on-year basis between January to June. It's now to the tune of $7 billion, would go up to possibly more than $14 billion in this fiscal. We're also going to see greater LNG imports and long-term contracts. So this needs to be kept in mind while seeking action against countries who are doing business with Russia. So let's see what happens. But this outreach is important because India is trying to strike some sort of agreement, some sort of solution with the United States ahead of 27th of August, when these 50% tariffs would kick in.
All right, Parikshit, many thanks for joining us. And staying with the US, it has applauded Pakistan's efforts to combat terrorism and it's promised to deepen bilateral cooperation. In a joint statement, both nations have reaffirmed their intention to work closely to promote effective and enduring approaches to counter terrorism. Now, this statement comes nearly 4 months after the deadly attack in Pahalgam, which killed 26 Indian civilians, and also after that second visit of Pakistan's chief of army to the US. Amidst President Trump's trade war, there is a thaw in the bilateral relationship between India and China, and this comes ahead of Prime Minister Modi's scheduled visit to China later this month. That is the first visit of the Prime Minister to China in the last 7 years. Parikshit, let me come back to you for more on that. Now, there have been several measures taken by both sides to try and amplify the efforts to re-engage economically. What are we talking about now on both sides?
Well, this will be a meeting of huge geopolitical significance. Indian and Chinese ties had broken down after the border clashes in Galwan in June 2020. But there is an expectation that from September this year, there will be some stability and predictability in ties. PM Narendra Modi is set to visit China for the SCO summit in Tianjin from 31st August to the 1st of September. This will be Prime Minister's first visit to China in 7 years. Sources say India's objective would be to instill positivity in the relationship. We've also been told by sources that the India-China relationship and the upcoming meeting between Modi and Xi should not be seen through the prism of an India-US relationship. While India and US relations have taken a rough turn recently, India and China have been working on improving ties for the past few years, and more so after October 2024, when Prime Minister Modi met President Xi Jinping on the sidelines of the BRICS summit in Kazan, Russia. Both leaders agreed to work towards a peaceful and stable India-China relationship and also decided not to allow differences on the boundary issue to disturb peace and tranquility at the line of actual control. Since then, there have been multiple meetings between foreign secretaries, NSAs, defense minister and the external affairs minister level. Now, sources say the consensus reached between Modi and Xi is now being given shape to ahead of the SCO summit in Tianjin. There are some early signs of improvement in ties. India has restarted issuing tourist visas for Chinese nationals after 5 years. Final timelines for resumption of direct air flights between India and China is expected soon. India and China had earlier agreed in principle to resume direct flights. Reports say China has eased curbs on urea shipments to India, and the Indian industry hopes China will ease supply of specialty fertilizers. China's restriction on rare earth magnets have created a crisis for the industry, and the automotive industry especially is hoping for a positive meeting between Modi and Xi that will help ease high rare earth magnet exports to India. India has also been clearing Chinese JVs with India wherever a technology partner is needed for Indian manufacturing. Also, in a first since 2021, an Indian vessel with 496,000 barrels of ultra-low sulfur diesel has been shipped to China. So these are all positive indications that both sides are trying to instill some stability in the relationship.
Parikshit, many thanks for joining us, and that SCO summit will take place at the end of the month. Former Niti Aayog CEO and G20 Sherpa Amitabh Kant says it is in India's national interest to mend the bilateral relationship with China. He was speaking to me at a summit organised by the Federation of Hospitality and Tourism yesterday. Take a look.
I'm a believer that India needs to do joint ventures with China. India needs to do joint ventures for components. India needs to do joint ventures on a range of inputs which go into manufacturing. We need to bring down the input and component manufacturing right on strategically important. And I think we need to work with China, and we need to really rework out the Press Note 3 to enable India to work with China to become a great manufacturing nation. The manufacturing must move from China to India, and for that it's important that we work in our national interest.
The former Niti Aayog CEO Amitabh Kant. Shares of Paytm rallying in trade today after a boost from the Reserve Bank. The RBI has granted an in-principle approval to operate as an online payment aggregator. This move effectively ends the ban imposed on Paytm in 2022 from onboarding new customers. Ritu is here with the details. A big breakthrough there for Paytm. Ritu, take us through the impact.
Well, after a near 3-year wait, the Reserve Bank of India has finally granted Paytm's 100% owned subsidiary, Paytm Payment Services Limited, in principle authorization to operate as an online payment aggregator. Now, that is essentially the business which runs Paytm's digital payment gateway for all of its merchants. But importantly, RBI has also lifted the ban on new online merchant onboarding, which had been in place since November of 2022. But to be clear, even when that ban was in place, Paytm had still been servicing the existing online clients, and it had also been signing up new offline merchants. But this, of course, clears a big regulatory cloud over the payment business. Now, the market is quite crowded. There are more than 50 players that have this license, but Paytm's massive base of 1.3 crore merchants does give it a strong shot at regaining momentum. The timing is also quite interesting. It comes just days after its Chinese investor Antfin fully exited Paytm, selling that remaining 5.8% stake. Now, remember, Paytm's initial application in 2022 was returned by RBI, and the company had reapplied for this license only in September last year after getting the government's nod for its downstream investment into PPSL. Keep in mind, though, that the RBI nod right now is not unconditional. The company will have to complete a system and cybersecurity audit within 6 months' time and submit the report to RBI or risk losing the license. Now, brokerages have given the move a thumbs up. Citi says the license win is positive for sentiments because it lifts a major regulatory restriction on the business, and it will help Paytm be more competitive than before. And Bernstein adds that this will have limited immediate impact on metrics, but it is a major relief nonetheless and is going to support higher payment margins for the company over time.
Ritu, many thanks. And staying with the banking sector, the RBI's Monetary Policy Committee is preparing for a key internal reshuffle ahead of the October policy meeting. Executive Director Rajiv Ranjan is set to retire before the meeting, and we learned from sources that RBI ED Indranil Bhattacharya is expected to replace Ranjan as the new internal MPC member. Further, RBI is also likely to approve Bhattacharya's nomination as the new MPC member in the upcoming board meeting, so stay tuned to that. Shares of IndusInd Bank under pressure after Mumbai's Economic Offences Wing launched a preliminary inquiry into the alleged accounting lapse. The complaint was filed by the IndusInd Bank management. Speaking to CNBC-TV18, officials from Mumbai's Economic Offences Wing said that they recorded statements from staff members linked to the offices of the bank's former CFO and former deputy CEO. Officials also said that the bank's senior officials, including CEO Sumant Katpalia, will be summoned in due course to record statements. Market regulator SEBI has banned former DHFL promoters Kapil Vadhavan and Dheeraj Vadhavan along with 4 others from the markets for up to 5 years. SEBI has also imposed a fine of 120 crore rupees on the 6 individuals for committing financial irregularities, diverting funds and fabricating their books. This order follows an interim order issued in 2020 imposing restrictions on the Vadhavans. Jewelry retailer Bluestone's IPO was subscribed over 2.6 times on the final day of bids. This was largely driven by the portion reserved for the qualified institutional buyers, which was booked over 4.28 times. As of 4 p.m., this was followed by the portion reserved for retail investors, subscribed over 1.26 times. On to a CNBC-TV18 exclusive. The government is likely to initiate the disinvestment process for selling a minority stake in LIC in the next 2 weeks. Sources tell us the government could look to divest between 2.5% or 3% of its total equity through an offer for sale process. The government may raise 14,000 to 17,000 crore rupees in the first tranche. We will head into a break, but up next, AI startup Perplexity offers to buy Google's Chrome web browser, makes an unsolicited bid of more than $34 billion. That and more when we return. Parliament has passed the new income tax bill, which will come into force from the 1st of April 2026. The new bill will replace the 6-decade-old Income Tax Act. Timsy is here to explain the key changes in the new legislation that you need to know. Timsy.
The Modified Income Tax Bill 2025, a landmark piece of legislation poised to replace the 6-decade-old Income Tax Act 1961, offers more clarity and makes the rules and laws simpler for taxpayers. To begin with, what changes for the individual taxpayers? Earlier, during search and seizure actions, officers were entitled to inspect or seize physical books of accounts, digital devices, etc. But now, officers can access emails, social media profiles, accounts, or any other books, documents in any electronic format. Also, officers can now access passwords, privacy codes. This rule did not exist in the previous Income Tax Act of 1961, but was introduced later on when digital records became a reality. So these rules were not explicitly said in the Act, and now it has been clarified in the new Act itself. Up next, a big relief for taxpayers in terms of claiming refunds. Earlier, the Act had a clause which blocked refunds on belated or late filed returns. But now, refunds will be allowed on returns which have been filed late, which gives a benefit to the taxpayers. So the new income tax bill is not just a relief for individual taxpayers. Here are some highlights for the corporate taxpayers too. First up, on beneficial ownership. Earlier, there were test conditions at level of ultimate owner of shares, and now the bill has removed the ambiguity and gotten a clarity for beneficial ownership in line with the Income Tax Act of 1961. The IT bill released on 13th Feb had brought in alternate minimum tax for LLPs, where capital gains tax had been mentioned at 18.5%. But in the revised version passed by the Parliament yesterday, this has been clarified and reinstated at 12.5% rate of capital gains tax for LLPs, just at par with existing Income Tax Act of 1961.
Timsy, many thanks for joining us. So that's the new Income Tax Act being cleared by Parliament. The changes will come into effect next year. Chief Justice B.R. Gavai said that he will look into the plea against the Supreme Court's order that issued rounding up of stray dogs in Delhi NCR. Remember, the Supreme Court had directed the Delhi government to round up stray dogs in shelters. And this was the order that was passed on the 11th of August. The order sparked mixed reactions, with animal rights activists asking for the order to be reversed and a large majority supporting the Supreme Court's directions. Israeli forces have killed at least 73 Palestinians, including 19 aid seekers in Gaza in the last 24 hours. This after the European Union and 26 countries condemned the unimaginable levels of suffering in Gaza. Nations have called for urgent action to halt and reverse the famine in the enclave. AI startup Perplexity has made an unsolicited offer to acquire Google's Chrome browser for $34.5 billion, as per Wall Street Journal. This figure is higher than Perplexity's current valuation of $18 billion. The company has several investors, including large venture capital funds, that have agreed to back the transaction in full. Dan Murphy here with more.
AI startup Perplexity has made a long-shot offer to buy Google's Chrome browser for $34.5 billion. Venture investors have proposed funding the deal, according to the company. It comes after the Department of Justice suggested Google divest Chrome, its flagship search browser, as part of an antitrust suit the company lost last year. That ruling said Google had illegally monopolized the search market. The unsolicited bid by Perplexity is higher than the AI startup's current valuation, which is estimated to be around $18 billion. Perplexity has seen rapid growth, climbing from a $500 million valuation at the start of 2024 to where it is now, after at least 5 capital raises. CNBC understands there's no current Gulf sovereign wealth investments in Perplexity. It was reported by PitchBook that Qatar's QAA was a backer, but we have not been able to independently confirm that investment yet. In April 2025, Perplexity's CEO said the search engine was serving approximately 30 million users. It has received backing from investors including Nvidia, SoftBank's Vision Fund 2, VC firms New Enterprise Associates and IVP, as well as Amazon founder Jeff Bezos and Meta's Jan LeCun. Perplexity is best known for its AI search engine, a potential Google challenger that gives users simple answers to questions and, unlike many other AI search engines, links out the original source material. Last month, it launched its own AI-powered browser called Comet.
Dan, many thanks for joining us. Now, President Trump mocked Goldman Sachs CEO David Solomon, saying that he made a bad prediction about the impact of his tariff policies on the markets. In a post on social media, Trump said that Solomon and Goldman Sachs refused to give credit where credit is due, adding that Solomon made a wrong prediction and he should get a new economist to just focus on being a DJ. His comments came after a note by Goldman Sachs said American consumers will bear the brunt of Trump's tariffs. Well, with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a moment with more.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Ritu Singh. These are the top headlines from the startup space. Cashback and saving platform Cash Karo delivers in FY25. Revenues come in at 350 crore rupees, powered by 6,000 crore rupees in sales driven by its 1,500 partner brands. The firm witnessed over 36 million transactions. In a bid to scale its forex business, Neo acquires Kanji Forex, a reputed player in the foreign exchange space. Acquisition will allow Neo to deliver a full-stack forex offering across FX cash, FX cards, and outward remittances. B2B visa platform Stamp My Visa acquires Teleport, a new age travel tech startup with a significant presence in South India. Teleport is backed by top Indian startup founders like Kunal Shah and Vidit Atre and will help Stamp My Visa to simplify and scale visa services across India. Oli Space gets $3 million from Rockstar Capital and global investors. The funds will help the firm advance its laser quantum communications and directed energy weapon systems. AI startup Perplexity offers to buy Google's Chrome web browser, makes an unsolicited bid of more than $34 billion, according to the Wall Street Journal. Google may have to sell Chrome as a part of antitrust proceedings. Well, those are the headlines we've been tracking for you this evening. Let's start with the top story. AI startup Perplexity made an unsolicited offer to acquire Google's Chrome's browser for $34.5 billion, as per Wall Street Journal. Now, this figure is higher than Perplexity's current valuation of $18 billion. The company has several investors, including large venture capital funds, that have agreed to back the transaction in full. CNBC's Dan Murphy is here with more.
AI startup Perplexity has made a long-shot offer to buy Google's Chrome browser for $34.5 billion. Venture investors have proposed funding the deal, according to the company. It comes after the Department of Justice suggested Google divest Chrome, its flagship search browser, as part of an antitrust suit the company lost last year. That ruling said Google had illegally monopolized the search market. The unsolicited bid by Perplexity is higher than the AI startup's current valuation, which is estimated to be around $18 billion. Perplexity has seen rapid growth, climbing from a $500 million valuation at the start of 2024 to where it is now, after at least 5 capital raises. CNBC understands there's no current Gulf sovereign wealth investments in Perplexity. It was reported by PitchBook that Qatar's QAA was a backer, but we have not been able to independently confirm that investment yet. In April 2025, Perplexity's CEO said the search engine was serving approximately 30 million users. It has received backing from investors including Nvidia, SoftBank's Vision Fund 2, VC firms New Enterprise Associates and IVP, as well as Amazon founder Jeff Bezos and Meta's Jan LeCun. Perplexity is best known for its AI search engine, a potential Google challenger that gives users simple answers to questions and, unlike many other AI search engines, links out the original source material. Last month, it launched its own AI-powered browser called Comet.
Well, India's home services space is getting a 10-minute makeover, and no, it's not food or groceries this time. Pronto, which is the real-time household help app, has just raised $11 million in a Series A funding round, and over the next 12 to 18 months, it will expand beyond Gurgaon into Mumbai, Bengaluru, and other metros to set up micro-hubs across key residential clusters to guarantee sub-10-minute fulfillment at scale. And joining us today is founder and CEO Anjali Saldana to unpack the business model of the company. Anjali, thank you very much for your time here on CNBC-TV18. You know, for decades, finding domestic help in India has very much been about having your informal networks and also luck. Now, Pronto is promising to, provide trained help in 10 minutes. What does it take, both operationally and financially, to compress a system that was once so uncertain into something dependable?
Yes. So I think the key thing is the main way people have approached formalizing and building a business around the sector has been to be an Uber-style matching platform. And we realized very quickly that that isn't sufficient here, right? That's not, you require much more operational control over your labor supply chain end to end. And so that means, in-house doing the recruiting, onboarding, training, performance management, all of that is done in-house and requires a huge amount of effort from the team and really rigor in making sure that every step of that process we maintain a super high standards.
Well, you've just raised this $11 million to build what you call is going to be a new layer of urban infrastructure. Break that down for us. How do you plan to deploy this capital, and where will investors expect returns? Expansion, tech, or team?
Yeah, so this is largely going to be used for geo expansion into cities, including Bombay and Bangalore. We currently operate only in Gurgaon, and so this will be primarily used for opening up across the country. And with that requires expansion of the team, right? We have field operators in every hub that we set up. We have a central control tower team. All of that has to expand as we expand geographically.
This plan to make household help really a high-frequency service for users, just like groceries or cabs. Is Pronto sticky enough, you think, to be a daily line item for urban families in India?
Yes, a huge number of our customers are using us every single day. And so we already see a very high repeat frequency among our customer base, and really people treating this as, a utility. I mean, in the end, this is a necessity on a day-to-day for most urban households, and it's not a once a week or once a month use case. It's an everyday use case. And so we're very, we've already seen that demand pattern emerge.
Well, guaranteeing the sub 10-minute fulfillment while also offering workers some predictable shifts, it's quite the promise, but it also sounds very expensive. Is there a market or a need you see for 10-minute fulfillment for house help? And how quickly do you plan to scale the service?
I mean, it is absolutely, there's absolutely demand for 10 minutes. As we've seen, the higher frequency with which you're able to hit the 10-minute SOA actually has a flywheel effect where more people are booking that, because if you're actually able to hit it, then customers build trust in your ability to be there in 10 minutes and rely on that rather than having to schedule ahead the booking. And so we've seen a huge amount of demand for that 10 minutes or less, and it's been ever increasing. And in terms of expansion, we have built sort of the modularized version of Pronto in which we can deploy it into new geographies. And so we've been able to, in the last few weeks, expand very quickly into new areas of Gurgaon. Like we've, in the last 1 month, almost doubled our service area without too much strain on operations. And so, we figured out how to essentially how to deploy the playbook into more and more micro markets.
Anjali, you're talking about micro hubs, last mile operations, shift logistics. All of this sounds a lot like hyper-local delivery businesses. How similar is the cost structure, and what is different in terms of margins and workforce management as well?
Yeah, I mean, the cost structure is very different. So let's talk about CapEx first. So if you're opening a dark store, investment is required because there's infrastructure within the store, there's and there's working capital required for inventory. And so that is not a factor in our business, right? Our hubs are simply just like rooms that are air conditioned, and there isn't a huge amount of shelving or any infrastructure needed there. And so the CapEx required to open a hub is significantly lower, and that means that less investment or less capital is required for expansion than say for your quick commerce businesses.
You're a very new business, of course, but what is the roadmap for profitability in that case?
Certainly not profitable today. Obviously, as we expand, there's a large amount of investment that's required, and especially as we're expanding to new geographies. In the run up to that, you have to build up your supply pool in order to deploy that into new areas, and that obviously takes money in order to do that, as well as building the brand and marketing for the first time and getting Pronto's name out there. That all requires marketing spend, as well as the HQ team, right? And if you think about your HQ, that's where you get operating leverage from as you scale. Right? Your percent of revenue that you take for your engineering team is obviously going to be very high, over 100% now. Or actually isn't over 100%, but in general, your HQ team is where you'll see a lot of operating leverage going forward, and that impacts your EBITDA margin today. So very EBITDA negative today, but over time, we think, I don't see us, getting to profitability in the next 2 years, but within 5 years, ideally, we'll be EBITDA positive.
Well, finally, let me ask you, what really keeps a competitor from copying this tomorrow? Because this is a space where we're hearing of players like Urban Company come up with something similar. And of course, there is this huge informal market that already exists. So how will Pronto protect itself?
Yeah, I mean, there's a couple things here. One is that, we have laser focus on this business, and we built our business model from first principles And with that, I describe Pronto's operations as a 1,000-piece machine, and we understand, of those 1,000 pieces, what are the 50 most important, and of the 50, what's the 5, and of the 5, what's the single most important piece, and that is allowing us to, execute better. And I think in general, what keeps this business moated is there is a high capital barrier to entering this, right? And so there's going to be a limited set of companies that are going to be able to acquire the capital in order to enter the market. But in addition, long term, what determines the winner is going to just be operational rigor and execution and just focus on this.
Well, Anjali, that's quite the interesting service you're building, and it's been a pleasure speaking with you. Thank you so much for your time here today on Startup Street.
Well, moving on to our Investor Eye segment, early growth investment fund Atomic Capital has announced the final close of its maiden fund at 400 crore rupees, targeting early growth stage consumer startups in India. Now, the Mumbai-based fund will invest in sectors including food and beverages, personal care, apparel and consumer technology, with check sizes ranging from 10 to 30 crore rupees. The fund claims it takes an active operational role with its portfolio companies and aims to back 10 to 12 startups over an 8-year horizon. To talk about the fund strategy and the future of Indian consumer brands, joining me now is Apurv Gautam, founder and managing partner of Atomic Capital. Apurv, welcome to Startup Street. Now, you position Atomic Capital as an operating VC. First, what does that mean in practice? And then tell us, how does your hands-on approach differ from traditional venture capital?
First of all, thank you for having me, and it's a pleasure to be here. I think our core belief at Atomic Capital is that throwing money at the problem doesn't solve the problem. And it's not just capital which is required for a business to be successful. So what we like to do is we like to come in at a stage, which we call it post-product market fit. And we apply a very unique hands-on approach, where we obviously provide capital, which is necessary but not sufficient. But beyond that, we help founders in X to 10X journey. And in that journey, we actually contextualize our playbook for each company, because we believe that every company is unique. Having said that, there are common principles. For example, building the right team, making the right strategic choices, having the right decisions. I think that is where we help founders in that journey.
All right. Apurv, with check sizes of 10 to 30 crore rupees and a portion of the fund preserved for follow-on rounds, you're building a focused portfolio of 10 to 12 startups. Now, within consumer tech, what innovations are you most excited to back right now?
No, I think that's a very important question for us, because given our playbook requires us to spend significant time with our portfolio, we are not going to do a spray and pray approach where we make large number of investments. That's why we like to take large concentrated positions in fewer companies. Having said that, I think the few innovations which we are really looking forward is we are chasing India's consumption in 2030. And if you look at India's consumer in 2030, what will drive that consumption? And I think a couple of themes emerge. One is Middle India. We're extremely bullish the way Middle India is going to drive the future of India's consumption. And second, the digital infrastructure. I think the way India's digital infrastructure is evolving, led by UPI, I think very bullish on how can we leverage that in our investments going forward.
In fact, you've already invested 50 crore rupees in 4 startups like, Conscious Chemist and Doodh Wale Farms. What attracted you to these companies? And if you could also take us through the cornerstone of your investment philosophy, how do you evaluate a startup?
Absolutely. We call investing is a professional marriage. And then the way in marriage, what matters most is 2 people. Similarly, I think in our journey, the founders play a very, very important role. Given that we spend significant time with our founders, and our playbook is very, very extensive, and we sort of spend significant time with them. So I think founders and our alignment with the playbook plays a very important role. Second, I would say we focus a lot on capital efficiency. And our view is that capital efficiency is DNA of the company. And a lot of founders feel that profitability should be solved only at scale, while our view at Atomic Capital is that you need to solve that from day one. So we also like to back companies which are solving the problem in a very capital efficient manner. And last but not the least is revenue momentum, because we are in the business of making good businesses great. So that's, I think, the last thing we look for.
All right. And in fact, you're currently evaluating over 20 companies and have issued a term sheet for your 5th investment. How many investments do you plan to make by year end, Apurv?
Absolutely. I think in our view, it takes significant time and effort from our side to deploy our playbook, because we are not just writing a check and moving on. Because we are spending significant time and energy with each and every portfolio company. For example, we connect with every company once a week. Because of that, we are not going to make large number of investments. We do thankfully, we are getting a lot of founder love, and we are getting inbound from multiple companies and founders. We want to be very razor focused, and we will do approximately one investment per quarter. So this year, I think we'll do mostly 2 to 3 more investments.
All right, 2 to 3 more investments this year. Let's get a sectoral view. The consumer sector is rapidly evolving with shifts in preferences and technology, emerging trends in Indian consumer tech. If you could tell us, what are you most bullish about? You spoke about UPI and Middle India, but what are the emerging trends that you're most bullish about?
Absolutely. I think if I look at India's consumer in 2030 and if India's GDP per capita will double hopefully by then, if I take that view, I think there are a few mega trends which are emerging. One, as people become more affluent, they want to look good. So there are certain categories which will fall into that bucket, whether it's fashion, whether it's skincare, whether it's cosmetics, hair care. So I think that's one big piece of our investment. Second, I would say as India's become more affluent, they want to focus a lot more on wellness, whether it's physical wellness, mental wellness, spiritual wellness. So I think there are a lot of investment. I think we would like to make an investment in that category. Third, I would say that consumer enabler, because the way consumer space will be evolving, a lot of consumer brands will be coming up. The companies which are solving a pain point of a consumer company, whether it's a logistics company, a payment company, or manufacturing company. So consumer enabler will be the third piece we are very excited about.
All right. Many startups, Apur, face challenges scaling beyond initial product market fit. And you spoke about how Atomic Capital supports founders operationally beyond just funding. So what would be your one piece of advice for early growth stage founders?
It's absolutely right. And we have seen that as well. And I think for me, the core reason is that people feel that throwing money at the problem will solve the problem. And capital alone will be able to help them solve all the problems. But in our view, that is not the case. And if I were to offer one piece of advice, which I've seen a lot of founders realize but don't do that well, is building the right team. What I've seen is that what it takes companies to go from 0 to 1 is not necessarily true for 1 to 100. And founders are very reactive and they like to hustle. But org building and hiring is not something you can do in a reactive manner. So our ability to work with founders in a very proactive manner and help them build organization, I think makes a big difference. And that is something I would advise everyone.
Okay. My one final question, what is your roadmap for the next 2 to 3 years in terms of fund deployment and building long-term value? And will you be announcing your second fund anytime soon?
I think making promises is easy. Delivering them is hard. So I think the promises are made to our investors. So that part is done. Right now, it's time for us to just put our head down and execute. Right now, the entire team's focus is on to deliver Fund 1. And we are not just thinking about anything else. And hopefully next time when I'm on your show, I can talk about Fund 2.
Absolutely. We'll surely keep a track of that. Apurva, many thanks for joining us on Startup Street today and wish you the very best with your Fund 1.
Thank you for having me.
On that note, it's time for us to head into a short break. But coming up, CEF Group bags 38 million euros in a mix of equity and debt. How does the startup plan to spend the funds? We put the founder on the hot seat to find out more. Stay tuned. Welcome back to Startup Street. Clean tech player CEF Group has secured 38 million euros in equity and debt from the German Export Finance Bank to set up 2 state-of-the-art compressed biogas plants. Now, the first step in an ambitious plan to build 22 such facilities across the country under the government SATAT scheme. These plants will convert municipal and agricultural waste into clean fuel process, thousands of tons of organic matter daily, and produce valuable byproducts like organic manure and refuse-derived fuel, with projects in Jammu, Ahmedabad and Western UP already in advanced stages. CEF says that this investment will fast-track India's transition to a circular economy while creating new revenue streams for rural communities. Joining me now to discuss this further is Maninder Singh Nayyar, founder and CEO of CEF Group. Many thanks for joining us on Startup Street. First up, if you could elaborate on the 38 million euro equity and debt funding package from the German Export Finance Bank and how it will be deployed for the first 2 CBG plants.
Yeah, very good evening. So this initial debt funding that we have got from Germany, plus the equity funding that we have from few conglomerates in India, is going to be deputed to 2 projects primarily, one for the city of Jammu and one for Ahmedabad. In Jammu, we are going to treat 350 tons of municipal solid waste every day. And in Ahmedabad, we're going to treat 500 tons of municipal solid waste every day. In totality, we're going to make around 27 tons of compressed biogas and almost 80 to 90 tons of organic manure and almost 150 tons of RDF on everyday basis to convert the waste into wealth and biofuels to make it into a circular economy.
All right. So tell us, beyond the initial projects that are ongoing in Jammu and Ahmedabad, what is the timeline and the geographical plan for setting up the 22 compressed biogas plants across India?
So it generally takes around 1.5 to 2 years to set up a plant of this magnitude.
Yes.
And in Jammu and Ahmedabad both, we are going to commission the plants next year, since the work was already going on in this plant since last 1 year. And following these plants, as now we are nearing completion and commissioning, we have already started launching with other municipal corporations where we are signing more such deals and going to set up more such plants across the country.
So tell us, Maninder, what kinds of agricultural, agro-industrial and municipal waste streams will the CEF Group tap into for these plants, and how will they ensure consistent supply?
So we are primarily focusing on the municipal solid waste, where we generally take a 25-year supply contract from the city's municipal corporations. Apart from that, we target the sugar mills, which are large-size sugar mills, and that have the commodity called pressed mud, which is generally a waste for them. We take that for a period of 20 years, and we convert that into biofuel as well. So these are the 2 primary sources of raw material that we first engage with on a long-term basis, and then we start building the plant and complete it thereon.
So also, Maninder, throw some light on how do these projects directly support the government's SATAT scheme, and what policy incentives or partnerships are enabling this growth? If you could throw some light on that.
Yeah, sure. So SATAT scheme is basically a scheme that gives leverage to any such manufacturing unit to produce bio-CNG or CBG as it is called, and sell it to the oil and gas majors like Indian Oil, GAIL, Hindustan Petroleum and all. So we get a fixed price, what government has given a minimum assured guarantee. So that makes the project very bankable and doable. And not only that, once we set up these projects, there are multiple benefits that comes along. Number one is that we don't need the imported CNG that we import from other countries. So it's a import substitution. Second, we are getting energy reliant. Third, we are generating jobs, and that too in large extent, because these 2 plants itself are generating over 300 jobs.
Yes.
And we make bio manure, organic manure as a byproduct, which then replaces the chemical fertilizers. And that is also a big saving, not only in cost, but also in health and soil health to our nation. So all these things come together, along with, of course, the environmental impact and environment protection that we get along with the various other benefits I just told you.
Okay. So, Maninder, with the new plants processing up to 850 tons of MSW per day, what is the projected CBG output and how will it be integrated into India's fuel supply chain?
So the CBG output in Jammu is going to be 9.8 tons per day. And in Ahmedabad is going to be 17 tons per day. With this total of approximately 27 tons per day, this gas is going to be directly injected into the GAIL pipeline. The agreements are already signed. The locations are already identified. The pipeline work has to be done jointly between GAIL and us. And that is how the gas will reach the markets. And further, it will be used as a vehicle fuel that we use in every day in the cars to run the cars on CNG rather than running them on diesel or petrol.
So besides CBG, Maninder, what byproducts like organic manure and RDF will be produced and what markets or sectors are they intended for?
So the biomanure or the organic manure which is produced in these plants is for commercial farming. And we already have another wing in our company where we specialize in manufacturing and enrichment of such bioproducts. So we have already established a name in this sector. And apart from that, there's all the inorganic material is called RDF when it comes out. This is generally used as a substitute for coal in the cement plants. So we will be supplying this RDF to the cement plants as a substitute of coal. So it saves coming from coal and it will come from this source.
All right. On that note, I'll have to wrap up our conversation. Maninder, many thanks for joining us on Startup Street today and wish you the very best with all your growth plans that you mentioned today. Thank you.
Thank you so much.
Well, with that, it's a wrap on this edition of Startup Street. For more news and updates coming up on the other side, stay tuned to CNBC TV 18.
Well, some of your most favorite ice cream brands, whether it's Cornetto, Magnum or Quality Walls, are set to get a new home under a new company, Quality Walls India. This, as Hindustan Unilever, India's largest FMCG company, is demerging its ice cream business into a standalone listed entity, hopefully by the end of next financial year. Now, what does this demerger entail? What is the rationale behind that? And what is this cool business going to entail? We are joined by Ritesh Tiwari, the CFO of HUL, to talk to Mangalam and me, not just about the ice cream business, but also about HUL, the strategic reset that's happening here, and the new management that's coming in. Well, Mr. Tiwari, thank you so much for speaking to CNBC TV 18. Let's start off by talking about the reason we're here, which is to talk about the ice cream demerger. Quickly run us through the very basic details of the demerger. What is the, what is Quality Walls India going to entail as a corporate entity, as a company? And what's been the basic rationale behind the demerger?
So ice cream overall has a very distinct business model. It runs in cold change in terms of manufacturing, distribution. It is prone to seasonality more compared to any other business that we have. It also has higher capital intensity compared to other business that we have. This is what makes ice cream very different to the rest of the business. At HUL, it has low synergies because of this very reason with all other categories that we end up doing business with. So that was one reason why we said that we need to have a solution which is very different. So hence, if ice cream is run with a focused management, with different agile strategies which are suited to its own distinctive business model, it can unlock more growth going forward. The decision was that once Unilever globally decided that they will separate the ice cream business and they will end up listing it, we had to, as HUL, take a decision, what do we do with it? The board came to conclusion after a lot of discussion that it is in best interest to separate the business in India as well, and then form a separate company, demerge it, and then list it. Right. This will ensure that all shareholders will be able to participate in the growth story of ice cream in India.
Right. So if you could give us a sense, as delicious as the business idea and the potential and the product sound, it's a very tough business as well, because supply chains, the capital that it requires for you to have a cold chain across the country, etc. If you could give us basic numbers on the ice cream business, it's about 2 to 3% of your revenue right now. What kind of EBITDA margins does it make? What kind of capital is invested in the ice cream business?
Yeah. So ice cream is roughly for us an 1,800 crore business, and it makes, if I look at last few years of margin, it makes low single-digit margin. This is a business now which is in investment phase. We are a national player. We supply ice cream across the length and breadth of the country. And when you do that, the overall cost of running the business is high, which is why a business like this gets a lot of benefit when it starts to scale up. Our business for the last 1 decade has grown in double digit. And going forward, given the headroom which is there to grow of penetration consumption, we expect this growth trajectory to get even stronger going forward. And which is why today, when the business operates at a low single-digit margin on an average, we will get into an investment phase further. So margins will further go a little bit down. But from there onwards, as the operating leverage kicks in, we'll then start seeing acceleration of margin in times to come.
So if you could give us a sense of the capital that has been invested in this business already, because it's housed in Hindustan Unilever right now, I'm sure there are a lot of operational synergies that come by as well, which may not come once it's demerged. So what are the kind of investments that you entail out there? How low can the ROCEs go before they go up, and what are they right now?
Yeah. So the key criteria there is the amount of capex investment. So for a typical FMCG company, let me say Hindustan Unilever example, we spend approximately a little less than 2% of our turnover into capital, in capex. Ice cream business operates anywhere from 5 to 7%. Of course, there are years we'll earn a little more, a little less, but it operates at 5 to 7% capital investment. The point there is you have to further add capacity because of the growth which is happening in the business, and plus the distribution network which you have to set up.
You spoke about low single-digit margins is what you see right now, and then after the investment phase, I think your listed peers does about 5 to 7%, if I'm not wrong. Is that where you would look to get at eventually, or do you think post-investment phase there is scope to expand margins further beyond that?
So if I take margin and make two different components of that, material margin, which is your sales minus all the raw material variable cost, and there's a fixed cost which gets amortized as part of the cost to the entire business. When it comes to material margin, we make industry-leading margins. When it comes to total margin, when you add variable cost plus fixed cost, our margins are lower compared to the benchmark that you quoted. And the reason for that is because we are a national player, and hence our infrastructure is spread. As you start getting more amount of scale further in the business, you start getting operating leverage. So the second component today, where we are, let me say, under index compared to market, we'll start getting that component also getting counted in terms of improvement in margin. And once that starts to kick in with further amount of growth and scale, we should be able to reach high single-digit margins.
Right. That's very interesting, because the variable cost that there is, you said, is industry-leading already. The fixed cost currently is also shared by the large Unilever platform. So just trying to figure out if it is individual, then maybe the denominator would be a lot smaller, and as a result of which it will be amortized a lot more.
Ice cream has a separate distinctive business model. So the entire fixed cost for ice cream is ice cream specific.
Got it.
So when I was quoting the example of a fixed cost, this is all ice cream assets. Because ice cream has separate factories, it has separate distribution system, the ice cream cabinet which are in the marketplace that we end up owning either directly or indirectly. I was referring to all this infrastructure which is all ice cream specific. In fact, the synergy with the rest of the business is very limited, especially when it comes to go-to-market. Our sales force, it has a separate sales force on its own. So there is no dis-synergy, let me say, on such operating costs of supply chain that will happen after the demerger.
And what happens to HUL's overall margins, because our ice cream is fairly margin dilutive, and what happens to HUL's own ROCE? How much improvement do you see there?
Yeah, so ice cream overall is 3% of turnover. It's 1% of our profit. So there'll be small improvement in our ROCE and margin after the demerger. But it is small and immaterial, I would say.
Right. And ice cream as a business, though you spoke about the large scope of growth that there is, it is still seasonal in nature.
Right.
And I think you have spoken in the past, and you've been one of the players that's spoken about how you're looking at de-seasonalizing the business. So how do we look at that? Because if an investor is looking to invest in a company, they would want to be able to reap profits or returns through the year. It cannot be in one season. So how are you looking at de-seasonalizing this? And even globally, in fact, for Unilever, ice cream, a lot of investors have been talking about how ice cream as a business there, the consumption is actually coming down. Is India an outlier in that sense? Is the scope actually a lot more here?
Yeah. So two, three different angles to this. To start with, our key strategy has always been for the last few years, how can we start de-seasonalizing the business? Yes. Now, ice cream can be seen as a dessert, and hence it plays a role in the entire post-meal sweet category. It also has a role as a snacking category. And once you start looking at it a little differently like that, you start seeing that there are many occasions more where ice cream can be center of the plate. So at Diwali season today, for example, we have our own variant which has gulab jamun into it, and we end up marketing that at length during Diwali season. For East, when Pujo happens, we have Nolan Gur ice cream. So we have now launched flavors which are relevant during festival season to start to ensure we keep de-seasonalizing. I was quoting an example to you earlier. A US market is much more colder than what India is. Yeah. The per capita consumption there is 13 liter, and we have 600 ml. So the headroom that we have for growing is substantial. And which is why for the last 1 decade, the industry has grown at double digit. Our own business as Hindustan Unilever for quality walls has grown in double digit. And once you're able to focus differently and more going forward, we could end up seeing stronger double digit growth from the business.
Could you give us a sense of how your sales have panned out across the year over the last many years since you've started to de-seasonalize it? Earlier it was obviously Q1, Q4, and now if you could give us that split. Earlier what it was and post your de-seasonalizing it, or your efforts, how much has it moved?
Yeah, so it's always a gradual move. It will never have a substantial impact. But we keep seeing 100 to 200 BPS move that keeps happening from season to non-season ice cream with every year of effort that we end up making.
So what's the current split right now?
So roughly, I would say little less than half the business ends up happening during the peak of the season. And then the balance business is spread across the balance quarters in the year.
How do you see competition? Because, while you're number 2, we have another very large national player, but we're seeing a lot of the smaller new age D2C brands also that are coming in. A lot of money being pumped in by VC investors also into those companies. A lot of focus on health, low calorie, low sugar ice creams, and they're really taking off, especially thanks to quick commerce. So how are you looking at the competitive scenario? And does that then now, with Quality Walls India also having its own business, its own focus, does that also open up avenues for M&A?
So I quoted one of the statistics earlier. So we have our own direct or indirect 2.5 lakh freezer cabinet. Yes. As an industry of ice cream, we have a little more than 1 million cabinet out of the 12 million outlets which are in the country. So more players start to participate and help support and increase the distribution infrastructure. Every player in the market will end up benefiting from that. Given the per capita consumption is so low this point in time, there's enough headroom for multiple players to coexist. Ice cream is a business which also has much higher amount of innovation compared to typical FMCG business. What we have done, we focus squarely on innovation for the last several years. And as and when required and relevant, we keep getting also brands from the stable of Unilever into India. Going forward, same thing will happen with the Magnum Ice Cream Company, which will ultimately be the owners or majority shareholders of the business in India. We will end up having access to the biggest global ice cream company, the brands from them, the tech from them, R&D from them. So innovation will continue to be exciting. That's what will determine the growth trajectory and competitiveness of the business.
Do you have to pay a royalty to the Magnum Ice Cream? And
so today as HUL, we have a royalty contract, which is for all the categories that we deal with in Unilever. And once ice cream gets separated, our current contract runs till January 28. So we're going to pass on the royalty contract, which is all 3 components. It is component for the brand trademark. The brands that we have in India today, Quality Walls, Magnum, Cornetto, these brand trademarks are owned by Unilever. So the access and license to these trademarks will be passed on to Quality Walls India Limited under the same arrangement, existing arrangement that we have. Today, the R&D is a shared R&D across Unilever globally, and which is why as part of the royalty contract, we also have a royalty contract on technical services that will also get benefited. The Quality Walls India Limited will continue to have access of that as well. And third, importantly, going forward, the innovation and trends, So those benefits will be there for the ice cream business as well. After the demerger is completed in India, and once the global company gets also listed, and they might end up getting into a new relationship of royalty with them later point in time. But as of now, we are equipping the Quality Walls India Limited with access to brand rights, technical know-how, with innovation and R&D capability and leadership from the biggest global ice cream company.
And by when do you expect this entire exercise to complete and shareholders of HUL to get Quality Walls shares in their demat account?
Yeah. So our entire demerge is a court-driven process. We have now got the first motion from NCLT. On 12th of August, we have a shareholder vote to review, and we are proposing for approval for the demerger. Once we get shareholder approval, there are other regulatory steps we have to do. We expect by end of this financial year, the business to get demerged and listed.
Right.
And start trading as well.
How big is the industry likely to be over the next, say, 5 or 6 years? It's been compounding at around 11-12% over the last few years. And where do you see HUL's own ice cream vertical be, say, over the next 5 years? You said high double-digit growth. We just want to understand, what are you foreseeing as a vision for this company? Those who might get those shares want to decide whether they want to hold on to it or not.
Yeah. So one of the information which we'll put in public domain at appropriate time, once all the approvals come of shareholders, etc., is an information memorandum in which we'll talk about at length the new management structure, including independent board, which will be part of the Quality Walls India Limited, the business strategy going forward. But suffice to say, very fact the overall per capita consumption is so small this point in time at 600 ml. There's massive headroom to grow. And we've seen this in different parts of the world. As overall the cold chain infrastructure starts developing in the country, ice cream gets benefit from that cold chain infrastructure getting developed. So I won't put a number to it, but we do believe strong double-digit growth is what should be expected from the business going forward. And that should then improve the operating leverage and hence the margin. And for us, it's also very important to ensure this entire demerger is very inclusive demerger. So for example, HUL has overall more than 12 lakh shareholders. We have 1.2 lakh shareholders who own 1 share of Hindustan Unilever. So the way we are doing ice cream demerger, the share entitlement ratio is 1:1. Yeah. Which means for every 1 share in Hindustan Unilever, the shareholder will get 1 share in Quality Walls India Limited. This will ensure a fair, equitable and inclusive demerger where every shareholder will be able to participate in the growth story of ice cream business.
You believe it can double over the next 3 years or 4 years with better margins?
I hope it does.
Okay. Let's move on.
Let's move on then. Of course, coming to what everyone's been talking about when it comes to HUL, which is the change in management right now. I believe Priya Nair has taken over. It's been a couple of days.
It's been first week for her in the office.
Yeah. Yes, of course. So, a few, initial thoughts once Priya's come over. What's it been like? And also,
how's the vibe changed?
Yeah.
Let's put it that way.
Let's start off with that.
Yeah. So Priya is a homegrown talent. It's been 30 years. In fact, we celebrated her 30 years at HUL and Unilever this week. As Priya comes in, of course, she will have her own set of thinking and thoughts looking into the business. Priya, in last role, globally, she was president for the global beauty and well-being business. And that and we've spoken about it continuously, beauty well-being is an extremely important, strategically important category for us in India and segment for us. The expectation of growth from us for beauty well-being is much higher. And all that experience that Priya has in leading the global business will be extremely important for us as she starts to settle into the business. Now,
sorry, any immediate strategic resets also that you're working on putting in place, and again, taking on the beauty and well-being, is it fair to then say that, that is one category that's going to be the highest focus area for HUL also to sort of capture in India?
Yeah. So in the last couple of years, as part of our strategy, we've been very clear. Driving competitive growth is our first focus. And as part of the strategy, we spoke about Aspire, our strategy to unlock a billion aspiration. We are very clear in India that the portfolio will have to keep transforming. And the effort we've been doing for the last few years continuously on that front. We segment our business into core, future core and market maker.
Yeah.
And future core and market maker is the space where market is growing disproportionately faster, number one. And number two, this is also the space market is more premiumization is happening there. When you look at this portfolio today, at a point in time, a few years ago, we used to have more than 50% business, which was sitting in core. And now we have more than 50% business which sits in future core and market maker. In fact, in the last couple of years, we made 500 BPS shift between core and future core and market maker. This is heart of our current strategy. That is not going to change as we keep working on. We had spoken about that overall our portfolio as HUL is more premium compared to industry. There's one space we are under indexed to industry, which is beauty and well-being. We have a very clear stated business objective to improve by 900 BPS contribution of premium in our beauty and well-being portfolio. So the expansion of portfolio, acquisition that we've done recently, bolt-on, minimalist, these are all basically in service of that one strategic reason that we want to dial up the portfolio. So the business strategy rests on these basically important strongholds. That is not going to change. Now, of course, in FMCG, consumers can change, market can change, overall competition landscape can change, channel landscape is evolving. So strategy, like anything else, will have to keep evolving. As Priya settles in, looking into this consideration, of course, she'll end up making her own set of choices. And we keep saying that HUL is a blockbuster book. Every new leader comes and writes an extra chapter, a new chapter in that blockbuster book. That's exactly what Priya will do.
All right, let's hope that happens. This is also coming at a time when the consumer sentiment itself is at an inflection point. We are seeing acceleration in rural demand, and urban is also gradually picking up. So amidst all of this, with the new, wind beneath the sails of HUL, or beneath the wings of HUL right now coming in with new leadership, do you believe that the time is opportune for the company to grow a lot faster over the next 3 years than it has over the last 3 years?
Yeah. See, there are a few important parameters which determines overall consumption climate and FMCG growth. Number one is disposable income that consumers have, and number two is consumer sentiment. These both items are looking better overall as a country today compared to what it looked a year or 2 years before. So we have seen that the MAT trends, MAT trends are stable for FMCG. In the latest quarter, last quarter, we saw overall consumption demand, we saw an uptick. Rural now is growing ahead of urban. Both have improved. Urban is also improved, rural is also improved, but rural is now growing ahead of urban. Together, we see that overall macro conditions have improved, and we expect that this to sustain. Now, coming to Hindustan Unilever, there's two reasons why we had a better outcome and better results and improved results this time. A, because macro conditions have started to improve, and B, the work that we have done in creating a natural tailwind with our portfolio change. The 500 BPS change that we have done from core to future core and market maker, that ends up getting our portfolio into more high growth spaces. And this change in portfolio and portfolio upgradation and transformation is what is further supporting growth.
So how far are we from double-digit growth?
And even when we're talking about volume also, how far are we from like a higher single digit or closer to a double digit volume?
Yeah. So for double digit growth to happen, two things need to be true. Number one, of course, we have to see further acceleration in the market in terms of volume growth. And pricing will also have to come in. If I look at last 5 year, 10 year,
but mix is coming in anyway, right? You are seeing premiumization of your portfolio. So there is an element of volume, and then there is the element of premiumization. Don't you think together those would be enough for...
It was a couple of quarters of price-led growth. Now slowly volumes are coming back. So
let me unpack this. So typically we do expect 4 to 5%. If I look at last 1 decade, 7 to 8% FMCG growth, market growth, 3 to 4% was volume growth, 4 to 5% was pricing growth. Pricing growth as of now is more like 1%.
Got it.
You saw our latest quarter. So we do expect in times to come, as commodities stabilize, inflation levels become normative, we should keep getting price growth back, which has been the long-term trend. Now, keeping the price component aside, if I just focus on the volume component, if last 1 decade has been 3 to 4% growth of market, of industry, we do expect that to be better in this decade.
One of the quibbles that everyone on the street has is not that consumption isn't growing. It is that consumption is growing, but a large part of the incremental growth is coming in from, say, some of the premium D2C players, or it is coming in from some of the, at the lower end, coming in from own brands by large retail chains, and it is coming from other places. So yes, consumption is growing, consumers' wallets are, increasing, but that wallet share is not coming to the traditional PCG companies, so to say. What do you have to say to that?
See, if you look at post-pandemic last 4 years, HUL has added 16,000 crore turnover to HUL. It's substantial when you compare to the scale of the industry. That's the level amount of turnover we've added to Hindustan Unilever. Consumers are preferring brands which are must-reach in beauty well-being with very differentiated proposition. We now have overall 3,000 crore D2C business in beauty well-being. And this 3,000 crore business in the latest quarter grew at more than 25%. And the point I keep mentioning about that, it's not only important to grow a business which is digital first, but also to have a sustainable business model. This 3,000 crore business that we have, which grows at more than 25%, which is digital focus, organized trade heavy, it also makes double-digit margins as well. So we have tapped in fully, squarely into the D2C space and created a 3,000 crore portfolio. If I take a step back as Hindustan Unilever, we have 8,000 crore portfolio now, which is in market maker. This portfolio grows in strong double digits. And this is where market is also growing. So we are over-indexing ourselves, and which is why the point I mentioned earlier, the strategy of ensuring that portfolio keeps evolving and moving from core to future core to market maker, that will keep generating the right tailwind that we have in the business.
Well, what about the other categories? So you spoke about D2C, especially in beauty and well-being. But what about personal care? What about food and refreshments? Even those are sectors where you're seeing a lot of new D2C players. Eating habits are changing considerably. People are moving to a lot more, even when it comes to food. That's one of the other wallet share change that Mangalam is talking about, is that, it's not that people are not consuming, but they're consuming different, they're consuming better. How are you capitalizing on that?
So we're seeing in two spaces that the market growth is being above average to FMCG. Number one is beauty, and number two, exactly to your point, is foods. When it comes to food, the way we have done the job in beauty, we have equal job to be done more on the portfolio in foods. Our overall beverage business this quarter grew in double digits. So high single-digit growth in tea, double-digit growth in coffee. That business is very strong and performing. Horlicks, we have a job to do. Boost part of lifestyle nutrition is growing, but Horlicks, we have a job to do where we're gaining market share. But we have to start ensuring that consumption in existing Horlicks household starts to increase. We are relaunching Horlicks. The product itself will undergo a change to help further consumption of the category. Now, coming to packaged food, to your point, India is going through the transformation. Unorganized to organized, unpackaged to package. And this is where we will also now keep working on our own portfolio in packaged food as well. We will use Kisan as a brand for Indian cuisine, Knorr as a brand for international cuisine, and we have an amazing condiment brand, which is Hellmann's. And we decided there are 6 different demand spaces in foods that will end up playing. Be it tea, coffee, lifestyle nutrition, our own business, what we call as UFS, the business of selling to restaurant ingredients and for the top dishes, and then condiments, and then mini meals, and overall the job that we have to do in that space. So these 6 demand spaces is what we'll end up getting into. And you will see portfolio transformation from Hindustan Unilever in the space of condiments, in the space of mini meals and accompaniments. Now, the job that we have to do out here is to ensure that we don't get into spaces which are more staples in nature. So we have made a strategic choice that we will not get into staples as this change happens from unorganized to organized and then package to package.
You have to look at a headline, HUL is gunning for growth. Let's put it that way.
When it comes to choices between growth and margin, competitive, volume growth, unblinking.
All right.
Okay,
so let's wrap it up
right.
with a final question, because the company is going into new leadership change, etc. Over the last 2 years, what do you think have been the biggest achievements, and what have been, places where things can improve over the next 2 years?
If I look at last 2 years, I think in the period of deflation, especially last 5 quarters, we've delivered mid-single-digit volume. So our focus on competitive volume growth did not change, and we've seen that getting delivered. Very important, our portfolio has changed. 500 BPS, a substantial improvement in contribution of future core and market maker. This portfolio change is giving us a tailwind to grow further. So it has been a growth which is competitive. It has been a growth which is making the business more future-looking because of the portfolio transformation. And it has seen also a resilient business model where we held to our strong margins, but as needed, we have also taken decision to go and invest more by taking some margin down.
But what do you think you could have probably done better?
Place I would say we could have done better is a place in beauty well-being where our premium portfolio could have been larger. And we called it out as part of our strategy that we want to improve there, and we want to make a 900 BPS improvement in our beauty and well-being contribution of premium. So that's one place I would say I can call out which could have been better. And hence we have now laid out a very clear strategy how we will improve contribution of premium in our beauty well-being business.
And with Priya coming in, I think that's now going to be a very tough
the direction
job.
is. All right. Thank you so much. Good luck.
Lovely conversation. Always great insights. Thank you so much.
Thank you very much.
Well, some of your most favorite ice cream brands, whether it's Cornetto, Magnum or Quality Walls, are set to get